Hello everyone, good morning to all of you. Welcome once again to this live analysis. स्टार्ट करते हैं आज का ये सेशन. मार्केट ओपन हो चुका है, इंडियन मार्केट ऑलरेडी ओपन है, कमोडिटी मार्केट भी ओपन हो चुका है. गुड मॉर्निंग, गुड आफ्टरनून, गुड इवनिंग इन वट एवर टाइम जोन यू आर राइट नाउ. लेट्स स्टार्ट सेशन. नेचुरल गैस को देखें, हल्का सा गैप डाउन ओपन हुआ है, नीचे बाइंग का प्लान करना सपोर्ट एरिया पे. क्रूड ऑयल भी कल का वो सपोर्ट ब्रेक कर चुका है, देखते हैं कुछ नए लेवल क्रिएट होते हैं तो देन वी विल सी. बैंक निफ्टी को देखोगे, गैप डाउन ओपन हुआ है ऑलरेडी. एक मिनट बचा हुआ है, गैप डाउन ही ओपन हो रहा है. यस, गैप डाउन ही ओपन हो रहा है. फ्यूचर देखोगे अराउंड 47,999 पे ओपन हुआ है, कल 48,200 पे क्लोज हुआ था, तो लगभग 300 पॉइंट की नेगेटिव क्लोजिंग थी. बाइंग आ रही है, लेट्स सी होल्ड कर पाता है या फिर नहीं बैंक निफ्टी फ्यूचर लोअर एंड को, क्योंकि सपोर्ट तो ब्रेक हो गए हैं. अब ऊपर ये रेजिस्टेंस बन जाएंगे सारे 48,200 के एरियाज. लेट्स सी क्या करता है मार्केट. लोगों ने लाइक नहीं किया, लाइक भी करते रहो. डोंट फॉरगेट टू लाइक द स्ट्रीम एंड सब्सक्राइब द चैनल. इफ यू हैव एनी क्वेश्चन यू कैन आस्क इन द कमेंट बॉक्स. ठीक है, क्रूड ऑयल के लेवल अभी बनाएंगे थोड़ी देर में. अभी क्रूड ऑयल में लेवल नहीं बनाए हैं, कोई फ्रेश लेवल बनते हैं तो देखते हैं. नेचुरल गैस में कल का ही लेवल है, नीचे आएगा तो एक बाइंग का प्लान रखेंगे. ठीक है, कल अच्छी सेलिंग आ गई थी मार्केट में. लेट्स सी, कल यूएस मार्केट भी अच्छा खासा गिर गया था नैस्डैक को देखोगे, US 100 जिसे हम कहते हैं, काफ़ी अच्छी सेल ऑफ आई थी. बिटकॉइन भी मुझे लग रहा है थोड़ा सा रीटेस्ट करने के लिए आने वाला है, काफ़ी थोड़ा नीचे. फिर अच्छा सपोर्ट है वहाँ पर एक पुल बैक के लिए, बाइंग के लिए. वीकली टाइम फ्रेम पे देखोगे मेजर सपोर्ट आने वाला है इन बिटकॉइन.
News when you want it with Bloomberg News Now. I'm Doug Krisner. So the equity market sold off today with tech shares leading the biggest decline since 2022. There was no shortage of anxiety over slower growth as the result of tariffs and government firings. We had the S&P 500 sinking 2.7% and the Nasdaq 100 plunging 3.8%. Gina Martin-Adams is chief equity strategist for Bloomberg Intelligence.
Significant decline in the Mag 7. Of course, a lot of that is selected stocks, Tesla and NVIDIA weighing heavily there. But nonetheless, that in and of itself is creating a big drag on the index. But it's more than that. Clearly, the Doge firings and the concern about the ultimate consumer outlook as a result of that have been weighing on consumer stocks. At the same time, you do have the tariff chatter.
That is Bloomberg's Gina Martin-Adams there. Now, many attribute today's decline to warnings from the Trump administration about the potential for a rough patch in the American economy. Over the weekend, President Trump refused to rule out the possibility of recession. Here is Bloomberg's Michael McKee.
The economic fundamentals have slowed, but they haven't given any sign that they're falling off a cliff. And while the equity markets are jumping out on the window ledges on Wall Street, the bond market is not. Yields have come down some, but if you look at both high yield and investment grade spreads, they're still very, very tight. So it's hard to say that a recession is baking itself into the cake.
That is Bloomberg's Michael McKee. Now, economists across Wall Street have been raising their odds for a U.S. economic downturn. On Monday, HSBC downgraded the U.S. to neutral, while upgrading Europe, minus the U.K., to overweight from underweight. Tomorrow, President Trump is scheduled to meet with top business executives as they grapple with uncertainty around tariffs, as well as the sell-off in the equity market. After the bell, we heard from Oracle, and the company reported a surge in bookings. This follows Oracle's announcement earlier of a joint venture with both OpenAI and SoftBank. These companies will spend at least $100 billion to build out U.S. data centers for OpenAI. Here is Bloomberg's Sarah Fryer in San Francisco.
They're doubling their data center capacity for the rest of the year. They have huge contracts looking into the future, many billions of dollars that are going to come in. So investors aren't looking at Q3 as much as they're looking at the road ahead and how critical a player Oracle is going to be in the AI build-out.
That is Bloomberg's Sarah Fryer. Now, on the negative side, Oracle's revenue forecast for the current quarter was disappointing, and those shares were down by more than 3% in late U.S. trading. We also heard after the bell from Delta Airlines. The carrier cut its profit expectations roughly in half for the first quarter. More from Bloomberg's Charlie Pellet.
Delta cites economic uncertainty that is hurting demand for domestic air travel. The carrier says earnings will be 30 to 50 cents a share in the period. That is down from an earlier forecast of as much as $1. Delta also reduced its guidance for revenue growth and operating margin in the first 3 months. The airline pointed to, quote, a recent reduction in consumer and corporate confidence caused by increased macro uncertainty, driving softness in domestic demand. In New York, Charlie Pellet, Bloomberg Radio.
A stopgap funding bill, or clean CR, looks likely to pass Congress on Tuesday, and this would in turn avert a government shutdown later in the week. More from Bloomberg's Amy Morris in Washington.
The Republican spending bill is designed to keep government agencies open through September 30th. Representative Don Beyer, a Democrat from Virginia, talked about the options and the worries that the president will unilaterally delay or cancel appropriations, called impoundment.
Unless there are meaningful guardrails to keep Trump from impounding it, we should vote no in the Democrats in the Senate and hopefully some Republicans in the Senate.
Virginia Democratic Representative Don Beyer on Bloomberg's Balance of Power. House Republicans could pass this on their own if they get enough votes from their own caucus, but even after it passes the House, it still has to get through the Senate. In Washington, Amy Morris, Bloomberg Radio.
And that is news when you want it with Bloomberg News Now. I'm Doug Krisner, and this is Bloomberg.
Today, he's vowed to take on Trump's trade war. Mark Carney is Canada's next prime minister. Trump touts progress with Ukraine as Zelensky heads to Saudi Arabia to try and get peace talks back on track. And is Elon Musk toxic for Tesla? It's Monday, March 10th. This is Reuters World News, bringing you everything you need to know from the front lines in 10 minutes every weekday. I'm Tara Oakes in Liverpool.
In first place, the next Prime Minister of Canada, Mark Carney.
Mark Carney being confirmed as Justin Trudeau's successor and becoming leader of Canada's ruling Liberal Party. The former central banker takes over at a tumultuous time, with Canada in the middle of a trade war with the United States. Carney took aim at US President Donald Trump during his victory speech.
And Canada never, ever will be part of America in any way, shape, or form.
Reporter Anna Mailer-Paperny has more.
I think we're watching a party that was on the ropes after almost a decade in power struggle to reimagine itself as it seeks to hang on to power. And it's trying to portray itself as Canada's best shot at prevailing in the face of daunting headwinds. And I think what we're going to see over the next several weeks and couple of months is Canada deciding what kind of country it wants to be and who it wants at the helm.
And Carney is the first person who will hold the office without having been a politician. What challenges will he face as he takes the reins?
Probably the first will be a general election. Sources are saying that he will likely call one himself, probably within the next couple of weeks. Twinned with that, at the same time, he's going to have to figure out what to do with Donald Trump. I don't think I can overstate how upset Canadians are by Trump's threats, both of tariffs, but more disturbingly, regarding annexing Canada forcibly. And Canada has to decide, is it going to roll out retaliatory tariffs? And if so, what does that look like? And when does it happen? And this is going to require a lot more finessing. That could be a challenge for somebody who simply does not have elected political experience. He's never been elected, so he's still learning as he goes.
It's a nervy start to the week for investors with concerns about the health of the US economy weighing on markets. Here's Carmel Crimmins with more.
President Trump appears to be at the center of investor worries. He sidestepped a question in a Fox News interview on Sunday about whether his trade tariffs could trigger a US recession. As one analyst put it, that's as good as a yes as far as markets are concerned. The R word has been making the rounds among traders and analysts. A Reuters poll found 91% of economists view the odds of a downturn to have increased under Trump's shifting trade policies.
US immigration agents have arrested a Palestinian grad student at Columbia University. Mahmoud Khalil has played a prominent role at the college's pro-Palestinian protests, and his arrest comes as Trump vows a crackdown on anti-Israel activists. Khalil has a green card and an American wife who's 8 months pregnant. That's according to local news reports. Secretary of State Marco Rubio said on social media, "We will be revoking the visas and/or green cards of Hamas supporters in America so they can be deported." And Homeland Security say they arrested him because he led activities aligned with Hamas. Neither department has said Khalil is accused of giving material support to Hamas or of any other crime. Khalil says the protests are an anti-war movement that includes Jewish students and groups, and they reject anti-Semitism allegations. Ukraine's President Volodymyr Zelensky is travelling to Saudi Arabia today. Zelensky will meet with Crown Prince Mohammed bin Salman ahead of high-level talks between US and Ukrainian representatives on Tuesday. That's set to be the first meeting between delegates from Ukraine and the US since a meeting between Zelensky and President Donald Trump devolved into an argument last month. Speaking to reporters on Sunday, President Trump says he expects good results.
Maybe not in the distant future. You can have some pretty good results coming out of Saudi Arabia this week.
Hanging over the talks in Jeddah is the fate of a minerals deal between the US and Ukraine.
Well, I think they will sign the minerals deal, but I want them to want peace.
Pesha Magid covers Saudi Arabia from Riyadh. So Pesha, what do we expect from this meeting between Zelensky and Mohammed bin Salman?
Well, there's a lot still up in the air, and it seems as though there's going to be 2 rounds of meetings. So one between Zelensky and Mohammed bin Salman, another one between Ukrainian officials and US officials in Jeddah. And it's likely that there will probably be discussions of what happened 2 weeks ago after the kerfuffle between Trump and Zelensky, discussions further on the mineral deal, discussions on negotiating a potential peace between Russia and Ukraine, but exactly what might come out of these meetings is still up in the air.
So how have Saudi Arabia and MBS in particular become this diplomatic nexus? Like, how does this benefit the Saudis?
That's a big question. There are several things that Saudi could get from it. Their closeness to the Trump administration is something that I think is very important to them because I think they're hoping to influence the Trump administration's policy in the Middle East as well, outside of the Russia-Ukraine talks. For Saudi Arabia, right now the most important thing for them is trying to maintain regional stability so they can accomplish their very ambitious economic transformation project that they poured billions and billions of dollars into. And in order to do that, they do not want to have any attacks from Iran. They don't want there to be further instability from Gaza. I think that facilitating these talks puts them in a good position with the Trump administration. But whether they'll get anything directly out of this is still to be known.
Hundreds protesting in Damascus, condemning the ongoing violence in Syria. New leader Ahmed Sharaa has vowed to hunt down the perpetrators of the violence, which has pitted loyalists to ex-President Bashar al-Assad against the new Islamist rulers. A war monitor says at least 1,000 people have already been killed in what was Assad's coastal heartland. Tesla's stock has defied gravity for years. But over the last 3 months, the EV company's stock has dropped by nearly half. And yet, Tesla's valuation continues to be far higher than the world's biggest auto and technology firms. Reporter Chris Kirkham has been looking at what's causing investors to wonder if the party's over.
There's a couple concerns from investors. One is Musk's time with the Department of Government Efficiency and government cost cutting, is that distracting him from running Tesla? That's one concern. And then I think the other concern is Musk's increasing involvement in politics tarnishing Tesla's image and Tesla's reputation among buyers? Because you've got this interesting dynamic where, I think historically most Tesla owners have been more liberal, kind of more environmentally minded consumers, and Musk's politics are currently pretty opposite to that.
When Donald Trump was campaigning, he was running on a lot of things that seemed to be in conflict with Tesla's core EV business. So what was driving the run-up in the stock after the election?
What a lot of investors and analysts who were bullish on the stock, there's sort of a feeling that maybe Elon Musk's support of Donald Trump in the election, maybe this could help Tesla's ambitions for self-driving technology and robo-taxis. And that's really where they believe the future value of Tesla is, that they're going to solve driverless technology, and that this could sort of unlock really a whole new era of transportation technology, and that this could be a huge multi-trillion-dollar business potentially, like according to some analyst estimates. But now the fundamentals of Tesla's current business are kind of coming into focus, and there's some signs that Tesla's business is really struggling right now. There have been some pretty steep declines in sales in markets including Germany and France. And this all kind of comes at the time that Musk is supporting far-right politics in Europe. And we're starting to see a protest movement rise up against Tesla at Tesla stores. And so I think investors are now starting to say, well, maybe Tesla's electric vehicle business matters more than we thought. And maybe there are some troubles on the horizon.
Our recommended read today looks at what could be the end of cheap palm oil. Production growth has slowed, and top producer, Indonesia, is pushing more towards biodiesel. Used in cooking, cosmetics, and cleaning products, palm oil makes up more than half of global vegetable oil shipments. You can find a link to the story in today's pod description. And for more on any of the stories from today, check out Reuters.com or the Reuters app. Don't forget to follow us on your favourite podcast player, and we'll be back tomorrow with our daily headline show.
We came into this year with such high valuations, such stretched expectations that there still is very little room to absorb any kind of bad news.
It's clear that we do have a lot of headwinds mounting.
I can go across the board. Every single consensus trade has been upended.
Risk assets are very vulnerable.
This risk of something deeper than a 10% drawdown, that is rising.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Monday following the biggest weekly loss of the year so far. Equities struggling to bounce as President Trump forecasts a transition period.
I hate to predict things like that. There is a period of transition because what we're doing is very big. We're bringing wealth back to America. That's a big thing. And there are always periods of it takes a little time.
Echoing sentiment from his Treasury Secretary Scott Bessent calling for a, quote, detox following a boom in government spending. Sobering thoughts for the bond market this morning, sending bond yields lower across the curve, 2-year, 10-year, 30-year, across the board.
And really starting to price in some sort of downturn, if not outright recession. A number of different Wall Street firms talking about the increasing chance of recession. There is some kind of tell in what Donald Trump said over the weekend to Fox News' Maria Bartiromo, which is he seems to be leaning into the idea of markets selling off, almost saying, you know what, you have to be prepared for more of this, which raises the question, and Kellyanne Shaw raised this, What is he preparing markets for to come on April 2nd?
We're going to have a detox. We're going to have a transition. And only last week we also heard from the president, I'm not even looking at stocks.
He says he's not looking at stocks. He's taking a very long-term view when it comes to the entire composition of what they're trying to get done. At the Economic Club as well last week, Scott Besson talked about we're trying to de-leverage the government sector and re-leverage the private sector. What the market is waiting for and hungry for, Jonathan, and Kevin Hassett said this to you on Friday, it's time to get that train rolling when it comes to tax cuts, or at least extension of TCJA and deregulation.
So a few data points to watch this week. Let's start with PPI and CPI. CPI coming on Wednesday. The same day, Lisa, that we get inflation data, we've also got another deadline for trade tariffs, and this time it's 25% on steel and aluminum.
And it raises the question at a time where over the weekend he started talking about the potential for tariffs to go even higher on Mexico and Canada. We still are getting the 25% tariffs across the board on non-USMCA compliant goods. And that, I think, is important. The steel and aluminum still there. It raises the question, what type of reset is he going for? Is he talking about manufacturing coming back to the U.S., or is he talking about just simply shocking some of the world leaders into acquiescence for negotiating?
And how much pain are they willing to tolerate? I think that's the number one question right now for market participants. Stuart Kaiser over at Citi. Markets remain in a spin cycle. Morgan Stanley's Mike Wilson warning of another 5% downside, maybe more, on the S&P 500, saying no pain, no gain. The scenario where the fiscal drag, Doge and immigration enforcement hit the market first, then deregulation and less crowding out of the private market benefit the market, together with the deficit spending maybe a little bit later.
Well, politically, this is the way you'd have to do it, in the sense that they want to get all the quote-unquote bad things done that will hurt the markets early on, ahead of the 2026 midterm elections. Well, I will say, though, is that a number of companies, if you just look at the list of what they're saying ahead of CPI this week and what they're saying about tariffs, they're talking about the fact that they're going to have to pass some of this on. And even Alcoa in January was saying, depending on where metal tariffs come into place, we're going to have to look at potentially how we are going to trade differently when it comes to global realignment.
Equities right now pulling back by about 1 full percentage point on the S&P 500. Coming up this hour, Steve Chevron of Federated, following the worst week for stocks in September. Kim Wallace of 22V Research, as Trump says the U.S. economy faces a transition. And Kamakshar Trivedi of Goldman Sachs, with the dollar near the lows of the year. We begin this hour with stocks falling as concerns grow over the health of the U.S. economy. Steve Chevron of Federated is still bullish, writing, while we acknowledge that the risk of a short-term economic soft patch has risen, we remain constructive on the economy and markets in 2025. Steve joins us now for more. Steve, good morning.
Good morning.
They're telling us what they want. A detox period, a transition. How do you buy this market with that in mind?
Yeah, look, I think Trump is always a negotiator, and he's negotiating with three parties right now. He's negotiating with the Fed that he wants to have cut, and an economic slowdown helps. And he's negotiating with conservatives in Congress where he's looking for a bigger tax cut, and a slowdown helps. And he's negotiating with the bond market. If we were talking 3 or 4 months ago about tax cuts and rate cuts, we'd have 10-year yields north of 5.5%. And so I think that's the detox period that we're talking about. And what's the opposite here of what we saw back in 2017? In 2017, he was coming into a softer economy. He hit it with tax cuts first and then used that strength to try to do tariffs and some other things. Here, he had an economy that was very hot. Any whiff of stimulus was going to be an inflation and a rate problem. And he's doing it the opposite way. As Anne-Marie said, you're taking all of the pain first. So as an investor, if you wanted to get defensive ahead of this, you had to do it 2 months ago. And none of us did. And so now you're in a situation where if you think that you've got the better things to come, and look, tariff uncertainty may peak on April 1st, and you're likely to get into a negotiating on a tax cut soon. I think you've got to invest through this and see the better second half of the year in front of you.
To your point, though, the investor also has a sequencing problem now. And yes, you're too late. But do you want to buy the recovery before you've had the downturn? Because the hard data is still okay.
Yeah, and I think that's the big question. When we talk about recession, you mentioned the word recession. I think we're going to have one. But I don't think it's a United States recession. I think it's a Washington, D.C. recession. I think that's primarily what's being orchestrated. And the question is, can Washington have a recession and the rest of the country doesn't? I think if those savings get passed along, either in terms of a Doge dividend or in terms of a bigger tax cut or lower interest rates, then you can have a Washington recession and the rest of the economy does well. I think the key now is how long does the uncertainty play? When we talk to companies, they're cautious, but they're not pulling guidance at this point.
Hold on a second. I would believe what you were saying, the idea of a Washington pullback. Yes.
Okay.
It would make sense because essentially they want to strip away some of the public spending and put it back to the private sector. Where do tariffs go in from this, given the fact that you hear companies really retrenching some of their plans, and that's one of the reasons we've seen such a, absolute bloodbath in the bank stocks?
So that's the longer term piece, I think. And there's a lot of risk around what they're trying to do there. But I think what we're trying to get to is growing our way out of a debt problem. And the only way you can grow your way out of a debt problem is grow GDP faster than you grow your debt. So if they can get the deficit down to 3, the question is how do you get nominal GDP growth at 5? And part of this administration's belief is one of the ways you do that is you bring economic activity back in the United States and you try to boost productivity. You shrink a less productive government sector, you feed a more productive private sector, and you try to convince companies through tariffs to come back. If that works, that's wonderful. Obviously, there's a lot of risk in trying that. And what I think is the key overarching theme here, which has Wall Street a little bit nervous, is we've had a reactionary fiscal and monetary policy for 25 years right now. This is predetermined, premeditated structural change with longer-term time horizons. The market hasn't really contended with that since Volcker.
Okay. The other thing I'm struggling with, and it seems like you are bullish and you are getting in there and buying and saying that there are going to be many more opportunities going forward just because of this is a sequencing issue. Since this is a slow-moving freight train, barge, whatever you want to call it, how do you do this in 6 months and then get all the good in 6 months? How do you expedite the time frame? So
you don't from an actual policy and economic perspective. The question is does the market root out what you're doing and then get bullish around it? Right. These are changes that are going to take a while to play out, right? Even if you're right on tariffs, and even if that does bring companies back, that takes years, right? The question is does the market look out and say, okay, well, there's fiscal sanity, or there's a push for growth, or we've gotten that chunk of the uncertainty behind us. We know the rules of the game, whether or not we like them or not, and now we're focusing on tax cuts and deregulation in the second half of the year. So I think the market can see that. I don't think that plays all the way through the economy. And by the way, as constructive as we are, I agree with some of the folks that you quoted earlier. I think we will still see pressure for a couple of months here, and equity markets are likely to go lower before they go higher.
What kind of sell-off could we see, especially if you think peak uncertainty around tariffs is actually going to be in early April?
I mean, one of the issues, I was looking at this morning, is we haven't had a 10% correction in 5 years. It's the second longest stretch ever going back to the mid-90s. And so, we look at what we're going through and it's like we're catatonic. I mean, you generally have a 10% correction per year on average. So, look, could it be 10% down? Could it be a little bit more? You tell me how long the uncertainty plays. You tell me how quickly we shift this narrative to tax cuts and deregulation and all that other stuff. You understand
why people are so nervous, though, Steve? Yeah. Because I think this goes beyond just a normal 10% correction in some people's minds, and I'll stress why. Yeah. We've built up this massive dollar long now for the best part of a decade, and that goes beyond just the currency market. That goes into tech stocks and a whole lot more. And the wind down we've seen so far, particularly in equities, goes beyond the banks you mentioned. It goes to places like Netflix. What has Netflix got to do with the kind of things that we're talking about? And that's the worry that people have right now, that maybe this is bigger. Maybe this is the start of a big unwind, of a big long that's built up over the last decade. And the sentiment shift we're seeing goes beyond some of these growth concerns. It goes to a sentiment shift to Europe, to China, away from the US. That maybe it's bigger than what we're talking about.
I'd be careful about that. I think you've been in a scenario right now where you're in peak uncertainty. And what that's done is created a desire for safe haven assets, long duration fixed income, defensive U.S. equities. And in that environment, you've seen non-U.S. do well as the dollar has softened some. That's great because the world's looking at a period of time right now where you have kind of debt spending internationally and some austerity or restructuring in the U.S. I don't know that that's the world that we're in come 4th of July. I think come 4th of July, you may see tax cuts that are larger. You may see a president that's pushing Congress to include pay-fors that maybe don't materialize. And then I think you're back into a scenario where it could be stronger dollar, stronger U.S. growth, and you get an unwind of that trade. So I'm not trusting of that. And then in terms of worry, I mean, I get that, but that's what our industry exists to do, is not to worry and be able to figure this out logically. That's why we charge a fee. And so I get it, but, we've got to...
So earn your fee. If we could do that right now. Let's do that right now. We've had a 9% move on banks just last week. close to those levels, almost wiped out the post-election gains for the KBW Bank Index. We've had moves of Nvidia down like 10% last week and down 25% off the highs of this year. What do you want to buy? What do you want to step into?
Yeah, so what we've done so far is we've stood pat. So we came into the year about 5% overweight equities. You've heard me, it's like kind of waiting for Godot, but we've talked about overweight cyclicals, overweight some of those small caps. I want to buy the things that are in pain right now. I'd like to see the market a little lower. In fact, I'd like to see a little bit more dislocation in the equity market to jump in. But as I look at that back half of the year, I think we've gotten 2 previews of what it can look like. We saw it last July. We saw it last November. It's the cyclical trade. It's those banks that are getting beaten up. It's some of the small cap names. It's the names that benefit from that Trump agenda. It's short duration fixed income. But I think, back in July, it started and then Harris entered the race. And then it started again in November, and then Powell gave that masterclass press conference in December. I think it tried...
Masterclass.
Well, I'm being facetious, if you can't tell. And now I think we're waiting for that as you get rid of this pain stuff and you get into the kind of candy, which I think comes later in the year. So I think it's those things that benefit in the back half.
Steve, it's good to see you.
Good to see you.
As always, level-headed once more. Steve Chevron there of Federated Hermes. Equity futures right now down about 1% on the S&P as we kick off a brand new trading week. Let's get you updated on news elsewhere with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. President Donald Trump says the U.S. economy faces a period of transition, declining to rule out a U.S. slowdown. Trump has argued that he's aiming to reshape the American economy with the belief that it would drive future prosperity. In Canada, Mark Carney has won the race to become the next prime minister. The former Bank of Canada and Bank of England governor will take over from Justin Trudeau. In his acceptance speech, Carney said that retaliatory tariffs would stay on until, quote, the Americans show us respect. Canada has met Trump's tariffs with patriotic fury and widespread boycotts of American goods. Taiwan Semiconductor's revenue increased 39% in the first 2 months of the year, driven by resilient demand for its AI chips. The world's largest chip maker is often seen as a barometer for the sector, and its growth is a sign of healthy spend on AI computing. Their future, though, is uncertain due to Trump's tariffs. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the program, a period of transition.
I hate to predict things like that. There is a period of transition because what we're doing is very big. We're bringing wealth back to America. That's a big thing. And there are always periods of, it takes a little time. It takes a little time.
Up next on the program, Kim Wallace of 22V Research joins us next, live from New York City this morning. Good morning.
Regenerative tourism is about your environment, to go back with a fresh mindset.
For us, luxury is a unique experience. It's a unique product. This inspires us to incorporate local ingredients and Saudi dishes.
I want to blow their minds with every single bite they're taking.
Every member of the team is making sure that we have this unique, raw, immersive experience for our guests to enjoy.
Three-week losing streak on the S&P 500. A week 4 could be lower as well. Early days were down by about 1 full percentage point on the S&P 500. In the bond market, yields down 5 or 6 basis points. The 10-year 424.55. Under surveillance this morning, a period of transition.
I hate to predict things like that. There is a period of transition because what we're doing is very big. We're bringing wealth back to America. That's a big thing. And there are always periods of, it takes a little time. It takes a little time.
So here's the latest this morning. President Trump avoiding predicting a recession this year as his focus on tariffs and federal job cuts rattles financial markets worldwide. Bloomberg's Tyler Kendall joins us now for more from the nation's capital. Tyler, this is a different approach this time around compared to Trump 1.0.
Right, John. And it appears that the White House's message is that there will be a short-term adjustment period in order to have long-term growth. For example, later on in that interview, President Trump went to compare U.S. and China, in his words, saying that China has a 100-year perspective while the U.S. likes to think in quarters. That then led him to double down on the fact that he says he is not watching the stock market, though did say that he has his eye on interest rates. But it really does track with the messaging we've heard from senior administration officials in recent weeks, which is to focus on the broader fiscal agenda here when there are inflationary concerns, consumer sentiment concerns, or workforce concerns. And it's important that when we are talking about that long-term agenda, the White House is really banking on some things actually happening. And perhaps most pertinent to our conversation today, that's twofold. It's one, using tariffs as a revenue raiser, which goes hand in hand with trying to get President Trump's tax agenda over the finish line, something, John, that we know is not going to be easy. And those conversations are already starting as we saw the House Republicans float their short-term spending plan to keep the government open till September. That's signaling to us that they know that it's going to take months to get that tax cut agenda off the ground, considering there's disagreements over the tax priorities themselves, the mandatory spending cuts, and then actually how to get that bill over the finish line when the House and the Senate appear not to agree over that one big, beautiful approach that we know President Trump would like to see.
Tyler, when it comes to tariffs on steel and aluminum, is the White House prepared to enact them this week?
Well, according to Commerce Secretary Howard Lutnick in an interview over the weekend, he said that Wednesday should be the day that we are looking out for. He did, though, make some news saying that those reciprocal tariffs on Canadian dairy and lumber that President Trump had floated could come as soon as last Friday will be on hold until April 2nd. But as of now, we are expecting this to be a big tariff week. Looking ahead to those reciprocal tariff plans that this administration says will be part of this larger macroeconomic fiscal agenda that they're trying to get through.
Hey, Tyler, appreciate the update. More from Tyler a little bit later this morning. Tyler Kendall out of Washington, D.C. Joining us now to extend the conversation, Kim Wallace of 20TV Research. Kim, welcome back to the programme, sir. I think we have to take a giant step back. Think about what we've been told over the last week. There's going to be a transition period. There's going to be a detox. They're going to try and rebalance the U.S. economy. Kim, when you talk to clients, what do you tell them the ultimate objective is? Rebalance towards what exactly?
We haven't been told that part yet, John, so I don't have advice for clients on where the end game is. I do focus on the uncertainty that's been mentioned a lot over the last week, certainly the last weekend and this morning, in fact. That uncertainty hinges on two of the three macroeconomic policy tools, both fiscal and trade. It is difficult to imagine with this level of uncertainty, and I would argue that we are months away, if not quarters away, from peak uncertainty. Markets get to vote on a daily basis, hourly basis. Voters aren't that fortunate. They don't get asked that often. And so you're not sure how the uncertainty is going to play out. It's very difficult to map, in my view, whether this is going to be wildly optimistic or something else because you just don't have enough details and you haven't heard from the stakeholders involved.
Well, based off how Trump dealt with the 25% on Canada and Mexico, what we did learn is that he is willing to negotiate. Do you think everything when it comes to trade from this point on, barring China, is a negotiating tactic?
Anne-Marie, I finished the week thinking that strongly, and I'm still leaning in that direction because of recent history. However, if the administration is putting together the concept and eventually a policy plan for financial repression that deleverages Washington, releverages the private sector, you have a lot of steps to go through before you get to that end point. And so I'm not sure what the administration's game plan is at this point.
Tyler just ended her report there talking about how Howard Lutnick, the Commerce Secretary, said that steel and aluminum tariffs will go in place this week, but they weren't ready to put the tariffs on dairy and lumber. So when you think about steel and aluminum, do you think that the president is just going to pull them back the same way he's pulling back dairy and lumber as well?
Well, I hate to keep going back to last week, but it might have been instructive. As we got information on fiscal policy, Secretary Lutnick was also at the forefront of negotiating in public on tariffs, moving dates back by a month or more. And so I'm not sure we've hit rock bottom on the public negotiating part from the administration. And I'm certain that we haven't landed squarely on what the policy objectives are.
We just had Steve Chiverone on from Federated Hermes, and he was saying sort of akin to eating your vegetables in the first half of the year and then getting candy in the second half when it comes to a policy prescription. Do we have a sense of what that candy is?
I don't, and I'm not sure anyone does. And on the vegetables, the first question you ask, I grew up with a family of 4 kids. How many vegetables are in the pot? Are there enough to go around? That's the redistributive function of Washington. That's the political feedback function of democracy. We're at the early stages of gauging what this clearly secular turn in policy objective means for Americans, businesses, and markets.
Kim, is there anyone who speaks to you who actually says there is a lot of logic to this, that the fiscal trajectory for the United States is completely unsustainable, that had the economy remained strong with ongoing inflationary pressure, the U.S. would get hit with an interest rate bill that would be off the charts and that would stymie any potential longer-term growth and would engineer, frankly, a very deep recession? In other words, people who say it actually might be good if the U.S. economy shifts downward for a bit.
I've not heard that. You know, I've read sections, or this theory appears in section of Stephen Moran's essay at the end of last year, that you slow consumption in the U.S., and that slowing consumption causes contraction. But if you are gaining revenues from tariffs, then that might make up the difference in the lost revenue. What I hear more often than not from risk takers is optimal tariff theory hasn't impressed anyone yet. And when you see the speed with which China, Canada, Mexico, other trading partners either avowed retaliation or set up retaliation, and we'll have some of that from China today, if you're counting on optimal tariff theory to make up for fiscal cuts, and that revenue is going to flow because no one's going to retaliate, if everyone retaliates, your equation's in question, at least.
Kim, appreciate the update. It's good to catch up with you, sir. Kim Wallace there of 22V Research on the latest efforts from the Trump administration. This just dropped from HSBC. Prior to the US elections, we assumed that a Trump victory would reinforce US exceptionalism. Today, we're upgrading Europe to overweight from underweight and downgrading the US to neutral. What we underestimated was how the US's wavering support for NATO and Ukraine would trigger a watershed moment for the Eurozone. So for HSBC, it's not just about what's happening stateside, it's about what's developing over in Europe that's taking money away from that story.
We have seen the sentiment shift in massive form, and it goes to the question that you asked Steve Chiverone. How much do we see a structural shift with a lot of the money shifting away from the United States to the rest of the world, not necessarily because of just what's going on in the U.S., but also because of what's going on elsewhere?
There's tons going on here and lots to catch up on as well. Lots to look forward to too. We'll be catching up with Veronica Clark of Citi in just a moment to talk about the labour market data from last week and the labour markets data still to come this week. JOLTS data is just around the corner later this week, and we get a read on inflation, CPI and PPI. CPI on Wednesday, PPI later in the week, and another trade deadline, this time 25% tariffs on steel and aluminum. From New York City this Monday morning, you're watching Bloomberg TV.
Behind the bright lights and adrenaline of pro sport is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Jay Williams.
I want to be an owner one day.
Billie Jean King.
Learn the business.
Paul Rabel.
Don't chase trends.
Get ahead of them. And so many more.
The worst week of the year on the equity market last week. On the S&P 500 this morning, further losses. We take more weight off the benchmarks here stateside. We're down 1% on the S&P. On the Nasdaq 100, we're down by 1.2. Stuart Kaiser of Citi. Markets remain in a spin cycle. Morgan Stanley's Mike Wilson, no pain, no gain. As we mentioned on the program about 5 minutes ago, HSBC downgrading US stocks to neutral.
And talking about where they actually like to put their money, which is Europe. And this goes to the question not just of what the United States is doing, but the response from others. And it's the reason why that is the wild card, just in this whole equation, how much that fiscal stimulus elsewhere, as well as potential counter tariffs, could shake up some of the grand plan.
Let's turn to fixed income, 2-year, 10-year, 30-year. That fear of softer growth starting to pull down yields. 2-year, 10-year, 30-year. We're down by 6 basis points on 10s, 424.36. Last week we took a little bit of a break. The first week in some 2 months where we actually had climbing yields. They are declining once again, and we've got some key data points through the week, CPI and PPI. No Federal Reserve speak, a Federal Reserve meeting about a week away, and the final word came from Chairman Powell. Chairman Powell is not in a rush to cut interest rates.
He said that he expects the 2% inflation will continue to be bumpy, but he's not in a hurry. He is looking for more clarity. It sort of takes away the chance that they're going to cut aggressively. That said, nobody believes him. Everyone expects him to change as the data changes, so people kind of discounted that.
Well, put it together. You've got a Fed chair that's saying, I'm not in a rush to cut interest rates. You've got a Treasury Secretary saying that we're going to have a detox period. It's hard to be bullish for a lot of people when they hear those kind of things.
Well, bullish on anything, right? Because on one hand, except bonds maybe, and that's actually
Sure.
what Morgan Stanley is coming out and saying, that this increases their bullishness on bonds in favor of equities simply because they want that 10-year yield to go down even if the Fed's not cutting rates. And I think that's what they're setting up, that eventually the Fed will have to cut rates, but there's going to be pain in the economy. The big fear for me is some of this pain gets away with it, gets away from the orchestrator. I mean, the idea of job cuts can build on itself. And that seems to be a little bit of the fly in the ointment.
This is hard to manage. I totally agree with you. If it is by design, it's hard to manage. I want to talk about Europe. Hard to be bullish the German debt market last week. We had a move of more than 40 basis points on a German 10-year maturity. And in the FX market, what do you look to foreign exchange for? This is what I look for. When you loosen up fiscal policy, you look to see if it's validated by a stronger or weaker currency. We've got a stronger currency on the euro side of things, validating that loosening of fiscal policy potentially out of Europe and specifically Germany. The euro just had its best week since 2009. And euro dollar right now is pushing 109.
And a lot of people are saying it can only climb from here. 110 is some of the goals, but some people talking about even 130 on the euro. It goes to this question of can they actually come through with the plans that they have promised in Germany? And we're going to find out. They've got a 2-week window to get some of these plans passed and get the coalition they need. If they succeed, I expect these gains to continue.
Euro stronger by a third of 1%. On our radar this morning, Commerce Secretary Howard Lutnick signaling he doesn't expect a reprieve on 25% steel and aluminum tariffs. The measures are set to take effect on Wednesday and include imports from Canada and Mexico.
Doesn't sound like there's going to be exceptions or a pause when it comes to aluminum and steel. Those tariffs will be going into place this week. But of course, we just heard from Kim, our guest, and what did he say? What he took away at the end of last week is that Trump is in negotiating mode. One thing is clear when you talk to administration officials. April 1st, April 2nd is going to be huge. That's the day they're going to come out with these reciprocal tariffs. The question I have is which tariffs actually hit on April 2nd and which have weeks, months leeway because they're going into filing report and potentially another negotiating period for the president and foreign countries.
I'm trying to understand how different companies actually operate in this environment. And there was a study from Automotive News showing that roughly 1/3 of U.S. auto parts suppliers said they would move production out of the United States if the 25% tariffs on Canada and Mexico were to remain on for 6 months or longer. This is completely counterintuitive, but at a certain point, it would make it too expensive to produce in the United States. It just raises questions about whether this will have the goals and achieve the goals that they're setting out to do.
These are the economic outcomes. They're complicated. And I think that's really captured by what's happened in the FX market. There's so many different variables to manage. Most people assume, though, if you were more aggressive on tariffs, you'd get a stronger dollar. We've ended up with a weaker dollar. That complicates things.
It complicates things because of what's going on elsewhere, but also because of potential growth fears. You cannot just say this is the sucking sound into Europe. This is also people starting to question U.S. exceptionalism.
It's shaking up the politics elsewhere as well. Check out this story. Mark Carney winning the race to replace Justin Trudeau as Canada's next Prime Minister, clinching nearly 86% of the vote. The transfer of power expected to take place within days, with the possibility of a national election soon after. So who's in a world of pain right now? Pierre Poilievre. Poilievre, the leader of the Conservative Party, is sitting pretty comfortable 2 months ago with a 20-point lead over the Liberal Party. And then all of a sudden this trade war starts and completely turns this race on its head.
They now actually, when you look at the polling, Canadians prefer Mark Carney goes toe-to-toe with Donald Trump when it comes to trade. You almost see Trump have a win and then push it too far. And then there's this rebuke that comes in Canada, and they're saying, actually, all Canadians need to stick together, and we're going to go probably stay with the Liberal Party. Pretty incredible. Mark Carney yesterday coming out. Hot rhetoric, Jonathan. So Americans should make no mistake. In trade, as in hockey, Canada will win.
You could have had this conservative alliance, which would have enabled the Trump administration to achieve some of their goals, particularly on energy and perhaps even on fentanyl, someone that wanted to work with them very closely on a number of key issues. And now all of a sudden you're faced with Trump trying to work with Carney, potentially.
And an incredibly angry population of Canadians that want to really stick it to the Americans. It just shows how things can change while you enact some of the policies that you set out to do.
We've still got to have an election. We'll see what happens in Canada later on this year. But ultimately, this is not where we expected to be only 2 months ago, north of this country. Let's turn to what's happening over in the Senate. House Republicans are unveiling a spending bill to help the government open through September 30th. President Donald Trump calling on lawmakers to pass the bill ahead of a shutdown deadline on Friday. This is the House, of course. Then we need to move to the Senate. What's going on with this effort?
So it looks like it's likely going to pass. Donald Trump is definitely going to be calling everyone if there's fear. He said last night at the end of this week it could happen, a funding lapse, but it probably won't. I agree with him. It could happen because you never know with Congress if it becomes silly season, but it probably won't. As soon as Tuesday, tomorrow, we can have a vote in the House, then it moves to the Senate. They have till Friday. Likely this is going to go through. You know why? It's politically unstable and not good for anyone to be blamed for a shutdown, Democrats or Republicans.
And I assume once we get past this, we move to tax cuts. Just how long and what is the timeline for that now?
We move to debt ceiling and then tax cuts. Tax cuts is going to be an end of the year, end of 2025, because there is a deadline for that. TCJA, some provisions of it expire. They have no choice if they want to extend that policy. Or, as Scott Besson has talked about it, you will see a tax hike, which they definitely don't want to do.
Are those tax cuts the candy? I mean, that's sort of what I want to ask. If eating your vegetables, and by the way, I like vegetables, so I don't know why that's always considered a negative thing, is the first half of the year is, some of the Doge cuts and some of the tariff wars. Is that what we're looking forward to, an extension of the trade, of the tax cuts?
Lots of people don't like their vegetables, Bramo.
Do you like vegetables?
Sure.
My kids like their vegetables.
OK. So we come up with something new for you?
Yeah.
All right, like what?
Well, eat like Twinkies the first half of the year. I'm not a big Twinkie person.
Can I move on? We should probably move on. Recession fears rising on the heels of increased tariffs and federal job cuts. Veronica Clark of Citi writes, the payrolls report was not far off expectations, but details of the report suggest a softening trend in labour demand. Veronica joins us now for more. Veronica, good morning. It's good to see you.
Good morning. Thanks for having me.
Let's talk about those details. Where do you see the weakness? What concerns you at the moment?
Yeah, on the surface, this looked like a jobs report that looks like the last 6 or 7 months. We had the unemployment rate staying in that range it's been in, 150,000 jobs. That's fine. But it was really the increase in the unemployment rate, so it's still in the range. But that occurred alongside a decline in participation, so people maybe leaving the labor force. Unemployment rate would have been even higher, something like 4.4% if that hadn't happened. And then even in the details of payrolls, hours worked that are coming down, it doesn't feel like there's a lot of demand for workers right now.
Which raises this question of how resilient this labor market is in the face potentially of a policy shock that a lot of people are talking about. What's your sense? I know you guys have been saying that the economy was weakening. How offsides are people in their expectations of the robustness of the U.S. labor market? Yeah,
we have been seeing this weakening for a while. Primarily, this has looked like a very low churn labor market. That's low hiring, low quits, low layoffs. But that low hiring dynamic, I do think it's restrictive rates that got us here. And that means the labor market's not very well positioned to absorb a shock, even if it's coming from government. Obviously, we're tracking the numbers of those layoffs, and the direct impact of those might be minimal enough. A couple tenths on the unemployment rate could get bigger. But I would really worry about the spillover to private sector contractors and just hiring that is so low and might be going even lower in face of uncertainty. Why would you be hiring people right now? And that could be the bigger impact on the labor market.
It seems like there is a grand plan, and there's sort of the sense that you take your pain up front and then some of the positive, and you rejigger the U.S. economy. And it's moving on a 1 or 2 year cycle. President Trump saying he judges himself in quarters. Can you talk about the time frame of a labor market that is much slower moving?
Yeah. I mean, we've come a long way in terms of the labor market loosening already, of course. We had the increase in the unemployment rate last year, had looked like maybe there was some stability. But I think, we're at that point where in past cycles, you see this much sharper increase in the unemployment rate. That's the layoff stage of this weakening labor market. So it's been slow moving for now. It's been maybe taking a bit longer to get to that last stage than usual. But this could be what pushes us there for sure.
What kind of impact is DOGE having on the labor market?
Yeah, I mean, we do track, the outright numbers of layoffs that we've seen so far. We'll start to see that, I think, in the March employment report. It wasn't as, showing up in this February data quite yet. But we're, something around 40 to 60K right now. The bigger numbers would come over the summer. We have these plans for mass layoffs that are supposed to happen over the summer. Maybe we're looking at something like 300,000, maybe more.
Do you think the private sector could absorb these jobs?
I don't think so. I think this is a private sector also that has been weakening for a while. Hiring rates very low. Of course, the private sector is going to feel some of this also. Government contractors, just general uncertainty. Those are going to be people who are not spending in the economy as much. There will be ripple effects.
Isn't that the ultimate goal of the administration, though? The ultimate goal is to rebalance the economy, and your response to that is, I don't think so. You don't think this is possible?
In a nice orderly rebalancing, I think no, because I think we had a weaker view of the economy, going into this year already, and I think we've seen that in the data. This is a really precarious labor market that maybe can't handle some of these changes.
Is it a rebalancing the Fed needs to support?
I think the Fed will be there to support the labor market. Obviously, we do have concerns of inflation, and tariffs are related to that. But if this is a true weakening economy, maybe you can't pass on those price increases as much. You can't demand a higher wage, and so you're not actually as worried about the persistent inflation from this.
What does the Fed have to see then in order to actually start cutting rates? Does that sort of avoid a recession, or does that mean that we have to see the whites of a recession's eyes before they start engaging?
I think they will probably be getting more concerned on the labor market, on the growth side of things. And so if you do see some inflation data alone that look a bit more favorable, maybe Wednesday's numbers add to that confidence that inflation is slowing, then they can be cutting as soon as May. That's our base case.
Wednesday for CPI, the following week, Fed Chair Jay Powell, a news conference and Fed decision on March 19th. Two things to look for. Veronica, it's good to see you. As always, thank you. Veronica Clark there of Citi. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. President Donald Trump says that he's negotiating with 4 different possible buyers for TikTok's U.S. business, and that a deal for the app could come soon. Trump didn't specify who the contenders were. TikTok does face an April deadline to strike a deal for its U.S. operations or be banned from the U.S. under bipartisan law passed last year. Elon Musk is calling on the U.S. to quit NATO. Musk responded to a post on X that called for the U.S. to exit the bloc, saying, "We really should, and it doesn't make sense for America to pay for the defense of Europe." NBC earlier reported that Trump has discussed calibrating U.S. engagement with NATO, favoring countries that pay a higher percentage of their GDP on defense. Elsewhere for Musk, Tesla shares are falling more than 3% in the pre-market. The EV maker's shipments in China have been declining for 5 straight months. They fell 49% in February compared to a year ago. Tesla has been losing market share to companies like China's BYD. That's your Bloomberg brief. John.
Hey, Danny, thank you. More from Danny later on this morning. Up next is the U.S. losing its edge.
Currency, rates, relative U.S. equity performance to the rest of the world, all the consensus trades at the beginning of the year have been upended. This notion of the U.S. edge, and I worry that this edge is being eroded right now.
Up next on the program, we'll catch up with Kamaksha Trivedi of Goldman Sachs from New York City. This is Bloomberg. leaving behind the biggest weekly loss since September. And adding to it, we're down by more than 1 full percentage point on the S&P 500. In the bond market, a rally here developing. Yields are lower by 5 basis points. The 10-year 424.55. The euro stronger, dollar weaker. Euro dollar approaching 109, 108.63. Under surveillance this morning, the US losing its edge.
Currency, rates, relative U.S. equity performance to the rest of the world, all the consensus trades at the beginning of the year have been upended. The U.S. is still, whether you want to call it the cleanest dirty shirt or whatever, but it's simply not as clean for outsiders as it was a few weeks ago. This notion of the U.S. edge. And I worry that this edge is being eroded right now.
So here's the latest this morning. Investors looking for opportunities outside of the United States on growing economic fears. Kamaksha Trivedi of Goldman Sachs writes, our economists expect the US tariff rate to rise 3 times more this year than it did during Trade War 1.0. To a large degree, the dollar outlook depends on the balance between US policy changes and the foreign policy response. Kamaksha joins us now for more. Kamaksha, welcome to the programme, sir. I want to pick up on this dollar trade story first of all and just figure this out. Last time around, tariffs up, dollar stronger. And we came into 2025 thinking about the same kind of playbook. We've turned it on its head. Tariffs up, dollar weaker. What's changed?
Good morning, John. Thanks for having me. So it's not just the difference between last time around. Think about the response to the imminent threat of tariffs on Canada and Mexico just at the end of January. At that time, we also saw dollar down, near-term rates up. What's changed? What's changed is that at that point and through much of the trade war 1.0, the markets were very focused on the inflationary impacts of tariffs. What has happened in the short span of a month is that as U.S. growth views have repriced lower, the focus has shifted dramatically to the downside growth risks for the U.S. economy. And that's mediating the tariff response. And so now, when there is threat of more tariffs, when that uncertainty rises again, the market is more nervous about what that is doing to U.S. growth and the downside there than it is to the worries about inflation. And I think that's what's causing the tariff response to be much more muted on the dollar.
Can we sit on that, the idea that slower growth in the U.S. is causing investors, traders to move away from the dollar? That's different than in the past, because it's not just the U.S. that's going to face a growth shock from some of these tariffs. It's other economies as well. Why is it that the U.S. is looking like maybe it'll suffer more or it'll have a more significant deterioration than it did just a month ago?
So I think some of it, is just the way the data has panned out. I mean, relative to a lot of expectations, including ours at the start of the year, the increase in tariff uncertainty and the broader environment of policy uncertainty appears to be weighing more on the U.S. economy than the trade uncertainty appears to be weighing on whether it's Chinese data or European data. If anything, those look to have bottomed a little bit. So just in the way the data evolution has played out, I think markets are seeing that concern reflected more on the U.S. side than in the rest of the world. But of course, I think what your question also refers to is there has been some stuff going on in the rest of the world as well. You've had a big shift, German fiscal policy turning on its head, China at the 2 sessions also talking about, a bigger fiscal deficit. That takes you to a big step towards achieving better global balance. And that's what I think is also weighing on the dollar.
I get the story, especially given the fact that you have the biggest potential fiscal spending package going back decades in Europe. But there is a question of whether the narrative has gone too far, especially we're talking before April 2nd when the real bazooka or the real tariff plan will ostensibly get released. Is there a risk, in your view, that people have gone too far with this narrative, that the U.S. dollar is basically peaked and that the euro is the new place to be?
I worry a little bit about that risk as well. We've made a very big shift in markets over a very short period of time. You were showing the euro dollar that's gone up from, close to parity towards nearly, 110 in the, matter of a couple of weeks. So, there are risks and, this big shift in fiscal spending, the shift in policy that we're talking about in Europe, there will be potholes, there will be hiccups. Nothing ever happens easily in the euro area or in Germany, especially when it comes to spending money. So I do worry that, tactically you could see some reversals. But I also think it's important to zoom out a bit and focus on the big picture. If you were thinking of a macro constellation that would lead to an erosion of the overvaluation of the dollar, it would look something like this. It would look like a modest slowing in the U.S., U.S. growth repricing coming down, more fiscal spending in Europe and China, and a more balanced profile of asset market returns like you've been getting in the relative equity performance as well. So in terms of the bigger picture, I don't think we have gone too far. Of course, you could have some tactical back and forth.
When it comes to the President Donald Trump, at one point during the election campaign, he wanted a weaker dollar because of trade, manufacturing in the United States, and wanting to sell products outside. Do you think this is part of what they're trying to do when it comes to global realignment?
I think there are parts of it, certainly sort of the pressure on the rest of the world to boost domestic demand, to boost defense spending. That is all, part of, I think, that global realignment that the new administration has certainly talked about. I don't think, however, that there was a desire to engineer a weaker dollar by, having more weakness in the U.S. economy. That was certainly not part of the agenda and is not part of the agenda going forward. So I do think there are aspects of it that one can pin there. And again, I think that is the big picture to focus on. Does the rest of the world really step up to the plate to generate this more balanced global growth and global asset market picture? Or is this just a question of U.S. growth being a bit softer? Because if that's all that you get, it's going to be a much more risk-off picture.
I was looking at Kit Jukes' note this morning. He talks about the CFTC data that basically wiped out the entire euro short. And we have this huge repricing, and he's talking about, but we don't have the GDP forecast yet to back it up. So how do you think about the rest of the year if you have the FX market basically whipsawing just on headlines?
I do think there's going to be a lot of whipsawing on headlines for the rest of the year, so I think we all have to be prepared for that as FX investors. But you make a good point. I think that the move in the euro, the move in currencies generally, I think the move also in the relative equity performance and rates, I think has run ahead of the kind of, GDP forecast changes just for 2025. But as always, I think the market is looking ahead. It's not just looking to what this means for 2025 growth, but what this could potentially mean for 26, for 27. That broader increase in demand, in the demand impulse coming out of the euro area, that's been very absent for the past few years. If that plays out, that's a pretty big shift. I would not underplay it.
Let's just finish on Europe, and I want to talk about Italy. The good news for Italy and the Italian debt market is spreads were pretty steady last week. The bad news is that because spreads were steady, it meant yields also rose in Italy by 42 basis points. Now, I wonder when that starts to become a problem, or whether you just see that as a factor of better nominal growth, a rebalancing in Europe, and a better story for the Italians. Is it good news or bad news?
The key, as always, is growth. I think in an environment where the cyclical growth views in Europe are being upgraded, if Europe, in Italy, Europe and Italy can both have that higher nominal growth profile, I think sovereign spreads will be okay. I think Italy will be fine. I think that if you get just the fiscal spending and yields going up, but you don't see that follow through in growth, you don't see the follow through in nominal quantities, I think that's when the sovereign side of things starts to get a little bit tricky. That's not what we expect, just given the nature of the news flow that we are getting so far.
And we're certainly not there yet. It's good to get your thoughts, as always, sir. Thoughtful stuff from Kamakshar Trivedi there of Goldman Sachs on Europe. Not a problem for Italy yet. Will it become a problem further down the road?
I love this. Let's talk about Italy. How beautiful is it? Can we go there?
Italy's still beautiful.
Yes, okay.
I'm not sure how beautiful the bond market will be in several months' time.
It raises this question of, is there a self-limiting factor to the spending plans that are getting priced in as fact before they even happen at a time where the economy there still needs a lot of growth? So it does raise this sequencing issue for Europe at a time where the market's getting a bit ahead of some of these plans.
Defence spending is one thing. Infrastructure spending is quite another. And we need to see what's actually going to take place in Europe. Of course, the market's anticipating that and getting ahead of it. Euro dollar very close to 109. In the second hour of Bloomberg Surveillance, we'll catch up with Aaron Cannon of Clear Harbour Asset Management, Henrietta Trays of Veda Partners, former NEC Deputy Director Kellyanne Shaw, and Michael Zezas of Morgan Stanley. From New York, this is Bloomberg.
Those animal spirits that we were talking about just 2 months ago, I think that's been replaced by recession fears.
There's a very big difference between falling into a recession and collapsing growth versus decelerating growth.
The appetite among households, businesses, and the market for the inflation side of the picture is very different now.
The slowdown is taking place, and we will see more of it. It'll snowball as things go forward.
This notion of the U.S. edge, I worry that this edge is being eroded right now.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning, the second hour of Bloomberg Surveillance starts right now. A defensive setup in financial markets across assets to start this morning and a brand new trading week. Equity futures on the S&P near session lows and down by more than 1 full percentage point. On the Nasdaq, we're lower by 1.2. You'll see a similar picture in the bond market. Yields down on the session on a 2-year, 10-year and 30-year. On a 10-year this morning, we're down 6 basis points to 424.17.
The big question here with this type of setup with bond markets seeming to worry more about some sort of economic downturn is the Trump put dead, or is it just in hibernation? Is there a point at which Donald Trump does come in and start to support some of the equity valuations? Or are we talking about the wrong game? Are we talking about a game that prioritizes something that is no longer on the horizon, and we're really looking at bond yields coming down and a reordering of global trade in a way that we haven't done for decades?
A bit of de-risking has started. Who's going to step in? Not the Federal Reserve, Chairman Powell. We're not in a hurry. Who's going to step in? Not the President of the United States. They are very well aligned right now, both the President and the Treasury Secretary, on rebalancing this economy.
They keep talking about this period of transition. Trump over the weekend said on Fox News, you can't really watch the stock market. That's not the barometer of what they're watching in terms of where they want to go. And then he went on to say, if you look at China, they have a much longer term outlook on what they're trying to do. We work by quarters. They're not focused on the stock market. Between Secretary Bessent and Donald Trump, they cannot make it any clearer.
They're not focused on the next 3 months. They're not looking at the stock market. This is a shift from where we were back in 2016, 17, 18, as we worked through the first term of the Trump administration. So we've got to rely on the economic data. CPI on Wednesday, PPI on Thursday. Can the inflation data open the door for the Federal Reserve to step in and reduce interest rates?
Well, some people might see that as potentially the case. The problem with all of this data right now is if you're taking a look at February, are you really getting a clear picture on the trajectory ahead? And do you understand the ramifications of current policies on the underlying
Biden
economy?
data.
It's Biden data, unless it's good, and then it's Trump data.
It's definitely Trump data.
There just is this ultimate question: how do you calibrate an economy on backward-looking data that's moving very quickly at a time where a growing number of analysts on Wall Street are just throwing out their assumptions and saying, we just don't know?
I go back to what Mohamed El-Erian had said to us at one point when we were in that inflation cycle. Listen to what corporate executives are saying. Here's the list. Best Buy, the giant wild card, obviously is how the consumers are going to react to price increases. Why are you having price increases? Potentially because of tariffs. Kroger, possibly shifting to geographies that will be less affected by the tariffs to keep prices low. Very interesting in terms of what these executives saying. Lori Calvasino was talking about the fact that tariffs continuously come up.
I think they've been very clear about what they want to do here. The question I would have is how much pain are they willing to accept in the meantime? And we've talked about what they're trying to achieve. Lots of government at the border. Immigration's going to come down. Tariffs are going to go up. Lots less government inside the border. Spending's going to drop. We're going to allow the private market to step in. That's the rebalancing that they're talking about here. And for a lot of the bulls out there, they're sitting here saying, look, the strategic anchor for us is that the policy mix is still positive, and in 12 months we'll be in a better place. The question you've got in the near term is, OK, how much pain are you willing to accept? And if you're an investor at the moment, are you willing to buy the recovery to the downturn that hasn't happened yet? Could it get a whole lot worse than this at a time when the hard data is actually still OK?
That's what you asked Steve Chivarone. And he said, yeah, you kind of have to stay invested. It could go down before it goes up. But still, the good is coming on the back end of this year. The question I kept asking myself over the weekend, and this is something that the Fed and Mary Daly over at the Fed has talked about a lot. Job losses get entrenched, and the loss in buying power and earning power stays for a longer period of time. And there are scarring effects that come with rounds of layoffs that do start to escalate on themselves. I'm not talking about DOGE, but on a broader economic level. Does it get away from some of the overall grand plan?
It reminds me of Chairman Powell back in the summer of 22 when he talked about pain, which at the time I thought was easy for Chairman Powell to say because he's unelected. The midterms are going to be just around the corner. next year, the end of next year, and they're going to come up so quickly. How much pain are you willing to accept with the midterms coming up?
It's one of the fundamental problems where people have these plans that can only be executed over years, but they have to operate in quarters, just like President Trump was saying.
And that's why China, of course, has a 100-year plan, because they don't do elections. It's another story. Not a story we want to hear stateside, by the way.
Yeah, I was about to say.
On the S&P, just to clarify.
Really?
Just to clarify. We're down by 1.2% on the S&P. Coming up this hour, Aaron Canada, Clear Harbor, with markets whipsawed on tariff and growth concerns. Henrietta Trays of Vader Partners with President Trump's steel and aluminum tariffs on deck. And we'll speak to the former NEC Deputy Director, Kellyanne Shaw, on why ambiguity is a feature and not a bug. We begin this hour with stocks low, with the S&P 500 extending losses following the worst week since September. Aaron Cannon of Clear Harbor writing the following: investors are attempting to determine whether tariff policy will prove more bark than bite. More bite creates higher costs, and more bark generates more noise. Aaron joins us now for more. Aaron, let's talk about the price of noise. What is the price of that noise?
Well, certainly we're seeing, markets shudder here in the United States, but rally abroad. We're seeing huge liquidity tectonic shifts happening, Jonathan, and that's a function of many factors. But one is the U.S. backing away from an 80-plus year historical sort of security agreement with Europe and our other allies, from Singapore to Japan and beyond. And I think Europe particularly has awoken to this reality just over the last couple of weeks. You've reported on this quite well, and you just have Germany out last week. I mean, this is a country that has embraced austerity. They have a very high savings rate, and yet they're going to spend 20% of their GDP over the next 10 years to defend their country, and the EU is going to spend up to €1 trillion or more to do the same. Whereas here in the United States, we have the tariff debate, we have DOGE, and we have that fiscal stimulus that began during COVID really waning now, not to mention that the president has cut off the remaining funding from a good portion of the CHIPS Act and the IRA, the Inflation Reduction Act. And that's only, going to reduce liquidity in the United States. And then, of course, you have valuations in the United States, which are expensive relative to the rest of the world. So lots to contend with right now.
Aaron, how much are you buying this idea that there is so much more to come with some of the gains in European markets at a time where we're pricing in that they will do all of these things, like you just said, even though there still are a lot of potential roadblocks?
Yeah, Lisa, I think the next 2 weeks in Germany are important because you have the parliamentary seats changing in late March. So if they can move before then, I think there's a much higher likelihood that some of this spending will, in fact, occur, that Parliament will pass funding in Germany and that the EU will rally. This is an existential threat to Europe. And so the notion that they're either going to spend or not spend, I think this is now being taken very seriously in Europe. Donald Trump was asked whether or not he would defend a NATO country last week in the Oval Office, and he balked at it. And he said, well, if they've paid their bill, what does that mean? Does that mean that if they move their defense spending in a country like Estonia from 2% to 4%, but they only make it up to 3.9% upon being, attacked by, let's say, Russia, that the United States wouldn't come to their defense? There are huge unknowns here. And I think that's the problem, too, with tariffs, Lisa, that there are unknowns here. It's not that the market can't react to a tariff if we understand what the details of the tariff are. It's that there's so much uncertainty on both timing, carve-outs, which countries are next. Is it China, and then is it maybe the next largest economy in the world, Germany, and then Japan? What's the order? What's the cadence? There are a lot of unknowns, and I think that's really rattling markets.
And one of those unknowns is whether the proposed spending in Germany can even happen. There's a headline that just crossed the Bloomberg that the Greens won't support the draft debt package in Parliament. Do you just assume these are teething problems, or do you think actually there is a chance that maybe these plans don't become reality?
Sure. There's certainly a chance. I just think that this is the first moment in my lifetime where this type of spending is occurring for a reason that's existential to, the sovereignty of these nations. And so there's a greater likelihood than not that finally we will see it. But for sure, I mean, we've seen this story before, Jonathan, in Europe, post 08, 09, spending during COVID. It always comes out a little lighter than we anticipate, and we have to keep that in mind.
Aaron, last week we were talking about how a lot of Wall Street firms don't want to be the first to change their views on the year. But suddenly we're getting a lot of revisions to the view ahead in terms of downgrading U.S. growth, upgrading expectations for European assets. Can you give us a sense of what you've actually been doing in the past week or two? How much you've been shifting allocations on the heels of some of the fundamentally transformative news that we've been hearing?
Yeah, well, I was on in early February, and we mentioned the importance of really thinking long and hard about capital flows into Europe. And so on the margin, we've ensured that, to the extent that clients who need to have non-U.S. exposure or should have non-U.S. exposure, that, we're looking at our targets and making sure that we're at the right levels there. We're also thinking about non-correlated investments here in the alternative space, whether that's statistical arbitrage or just, traditional merger arbitrage. There are many sort of non-correlated alternatives, not just private equity, not just sort of like private credit, which is highly correlated to the overall market that we're looking at. And then just thinking about the fixed income market, where do you want to have duration when the U.S. economy is slowing down? And where do you want to have your credit exposure? So we're keeping our credit exposures more in the short end of the curve, and we're pushing our sort of treasury mortgage-backed security duration a little further out the curve. This was what we've been doing several weeks ago, and that's worked out reasonably well. As growth expectations in the United States have come down, you're able to capture a little more upside as those treasuries rally in the long end of the curve.
Aaron, appreciate your time, sir, as always. Thanks for breaking it down for us. Aaron Cannon there of Clear Harbor Asset Management. Just to return to that headline, two things to look at in financial markets, just to take the temperature of this story. One is the bond market after a 40 basis point plus move higher in 10-year yields in Germany just last week. And the other is the FX market after euro charged high through last week, the biggest week of euro strength going back to 2009. So first of all, to the German debt market, where yields are a little bit lower, down 4 basis points on a session, and the euro coming off session highs, but still stronger on the day as this headline crosses out of Germany, that the Greens won't support the draft debt package in Parliament.
If they don't get some more support behind this proposal, it's not going to pass. It needs a 2/3 majority for a constitutional amendment to eliminate the zero debt break. Just to give you a sense of what the time frame is, discussions and negotiations in Parliament will take place on March 13th. The planned vote is on March 18th. So how much is this a negotiating tactic, and how much is this basically the Green Party saying that this isn't going to happen?
So based on the market reaction, and I'll let the market do the speaking because I won't offer my opinion, I'd say the former and not the latter.
Exactly, that's my
But ultimately, Lisa, we'll see.
Which is the reason why I think it is fair to say Europe has often struggled to get something of this magnitude passed. The fact that the market is running away with the story, and we were talking about this with Kamakshia Trivedi, how much does that really put the euro dollar at risk of some sort of violence, as this is going to be a choppy procedure?
But one thing is for sure, the Greens hold the cards. This entire idea, this entire package will either fall or will pass, whether the Greens sign up or not, which is why they have a tremendous amount of leverage. And to Lisa's point, they might be using that leverage right now.
You'd have to imagine there is an ask, and maybe a big ask. Right now, the euro just off session highs, euro dollar 108.47. Let's get you an update on news elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Starting in D.C., House Republicans unveiled a spending bill to keep federal agencies open through September 30th, setting up a potential confrontation with Democrats. President Trump called on GOP lawmakers to pass the bill, warning them to allow no dissent in their ranks. Congress must act by midnight Friday to avoid a partial government shutdown. Israel has halted its already limited supply of electricity to the Gaza Strip, a move the government said was in response to what it called the Hamas hostage crisis. The 6-week Gaza truce expired a week ago. The sides are divided on conditions for an open-ended suspension of hostilities. Morgan Stanley's Michael Wilson says that stocks are at risk of slumping another 5% on concerns about tariffs and lower fiscal spending. The strategist says that he expects the S&P 500 to fit a low of about 5,500 in the first half of the year before recovering to 6,500 by year-end 2025. His target implies a rally of 13% from current levels. And that's your brief, John.
Danny, thank you. More from Danny a little bit later this hour. Up next on the programme is a recession on the table.
I hate to predict things like that. There is a period of transition because what we're doing is very big. We're bringing wealth back to America. That's a big thing. And there are always periods of, it takes a little time. It takes a little time
Up next on the programme, Henrietta Trace of Vader Partners, live from New York City this morning. Good morning. Stocks are softer here. We're down 1% on the S&P 500. In the bond market, yields are lower by 5 or 6 basis points. The 10-year 424.55. And the surveillance this morning is a recession on the table.
I hate to predict things like that. There is a period of transition because what we're doing is very big. We're bringing wealth back to America. That's a big thing. And there are always periods of, it takes a little time. It takes a little time.
So here's the latest this morning. President Donald Trump refusing to rule out a recession with more tariffs set to take effect on Wednesday. Bloomberg's Tyler Kendall joins us now from D.C. for more. Tyler, a debate that we're having around the table throughout this morning is that they seem to be very, very keen, determined, in fact, to rebalance the economy. The question we've got, and maybe you can help us answer it, how much pain are they willing to take?
Well, John, it does appear that there seems to be a higher threshold for pain here from this White House than previously believed. And you even had President Trump talk about this idea that he acknowledges that there's a disturbance, but there doesn't seem to be any indications that they're going to change their policy rollout. In that same interview, President Trump was asked whether or not businesses can expect more reliability when it comes to his tariff plans. And his answer was that he's at liberty to hike tariffs even higher. And he's not quite sure if there's really any predictability around that. Also notable over the weekend, Commerce Secretary Howard Lutnick saying that Americans should brace for higher prices when it comes to foreign goods and contending that U.S. goods will ultimately go down over the long term, but that there might be that transition period as well. So sort of this evolving rhetoric when it comes to the White House, and we look ahead to what has been shifting tariff plans. Up next, of course, John, this Wednesday, we are expecting those steel and aluminum tariffs to go into place. At the moment, we've been told not to expect any exceptions or carve-outs, although, of course, that could change. But, John, we should also be paying close attention to that these tariffs apply to downstream metal products, and that's where economists say consumers could get hit particularly hard.
So, Tyler, the next question is, are we going to get carve-outs or exemptions when it comes to some companies, especially downstream companies?
Right. At the moment, we are not expecting any, but it's important, Anne-Marie, that we should expect the conversation from the White House to start to shift in their rhetoric, right? We've often heard them talk about their border policies when implementing these Mexico and Canada tariffs. That conversation is soon going to shift to talking about national security concerns. So whether or not countries potentially that can prove to President Trump that they don't pose national security concerns, for example, that might end up being here. We know we're watching closely Australia, for example, one of the countries that has already started bidding for President Trump's favor, particularly when it does come to metal imports. These imports are going to hit Canada and Mexico particularly hard. We're going to have to see as it all shakes out as we get closer to Wednesday.
Tyler, appreciate it. Tyler Kendall down in Washington, D.C. Joining us now to extend the conversation, Henrietta Trace of Vader Partners. Henrietta, welcome to the programme. A really revealing conversation with the President of the United States and Maria Bartiromo over the weekend. I took away a lot about how he was thinking about trade right now, and maybe a lot of people didn't get the answers they want, but they got answers. What did you learn?
You know, what I'm trying to ruminate around here is that the president is saying that there may be a recession this year, and he's not going to predict, but maybe that's the direction it's going. JP Morgan's saying it's a 40% odds proposition. What's really striking to me is that we are about to enact $5 trillion worth of tax policy. And effectively what the president's saying is that that's not stimulative. It's not enough to offset the impact of the tariffs. It's not enough to offset what DOJ is doing in terms of firing federal employees or trying to trim the fat here and there. I think that's the most striking part about this. Even with a $5 trillion spend, $3 trillion of which is deficit financed, there's still a higher potential of recession because of the president's foreign policy and trade agenda.
But Henrietta, also is that because they're not fresh cuts. We're just extending what we have right now in terms of policy.
Exactly. I mean, we frequently refer to these as tax cuts, but they're exactly an extension of existing policy. And all of the stimulative provisions have already been permanently imposed as a part of the tax deal in 2017. The corporate tax rate, for example. You know, we talk about this a lot, but there's a 14 percentage point reduction in the corporate rate that was stimulative, that did generate economic feedback. And the reason inflation partially wasn't massively reported in the wake of the trade war under Trump 1.0 is because we just cut corporate rates by 14 percentage points. This time around, we don't have that potential. Indeed, some of the members on the House Republican Conference are talking about raising the corporate tax rate to 23%, which might generate $150 billion worth of revenue per point, just to offset some of that $3 trillion deficit cost. So, yeah, exactly. This is just an extension of the status quo. Hence, recession risks are rising.
Henrietta, when it comes to what Trump is not paying attention to, he continuously says, and he said again over the weekend, he's not really paying attention to the equity markets. But at what point does he start paying attention to the polling? Last week, a CBS poll was talking about how most Americans want him to focus on inflation and the economy, bringing prices down, something that he ran on.
I'm so glad you mentioned that. I do not buy the narrative that Trump follows the stock market. I think he follows it when it's positive. When it's negative, he blames it on foreign investors and said he's going to limit foreign engagement in the U.S. stock market. That's not consistent. Those are two completely dueling ideologies. What I think is important is exactly what you point out, the polling data. And I'm constantly stress testing whether or not Republican voters continue to support President Trump. The answer is unanimously yes. They think that tariffs are a good idea. They believe that the president has maybe some priorities that aren't theirs right now, such as, egg prices being $11 a carton, but he's focused on the agenda that he has, and they're willing to give him that leeway. Where that leeway does not exist is in the House Republican Conference or the Senate Republican Conference. And so you're seeing members sort of come out of the woodwork. Oklahoma is a perfect example. Try to get carve-outs from DOGE, try to get carve-outs from cuts, keeping the weather service open. Those are member-specific problems that do not have the benefit of the extreme popularity that Trump does. So you're going to start to see fissure between Republicans and Trump eventually.
Henrietta, I heard something different from the president over the weekend. What I was thinking about is maybe we need a lower benchmark rates in order for him to actually carry out some of his plans, including the extension of those tax cuts, which they may not be all that stimulative. This may all be by design to try to lead to lower rates, because otherwise the fiscal picture does not make sense. Does that have any validity to you?
It does, because it does generate some economic feedback. And there is a part of a corporate rate reduction that gets offset by dynamic scoring at the Joint Committee on Taxation. But it doesn't cover the full cost. So, for example, if the 1 percentage point reduction from 21% to 20% in the corporate tax rate costs $150 billion, you might get an economic feedback number in the $30 to $40 billion range. It doesn't cover the cost. It does generate some economic growth. Another good option, and something that investors are really focused on, are things like bonus depreciation extension, 100% expensing. That encourages you to go out and buy, a big piece of machinery, put it in your factory, get it to work, create new jobs, that kind of a thing. So I think you could see those pieces. The R&D proposal, the EBITDA to EBIT shift needs to be changed, and bonus depreciation is something we could see for a short period of time. I don't think a corporate rate reduction is in the cards.
Henrietta, appreciate your input as always. We're all looking for that clarity and struggling. Henrietta Trace there of Vader Partners, struggling to get clarity on trade. Really interesting exchange over the weekend between the President of the United States and Maria Bartiromo over trade. Pressed on whether we'd get that clarity anytime soon, because that's what most officials, most people running businesses right now want. It's what they desire. They're not really too fussed if it's 5%, 10% or 15%. What's paramount at the moment is just knowing. Is it going to be 10%? Is it going to be 15, 20, 25? Tell us, then we can plan. And the president turned around and said, might go up a little bit more.
Yeah, although he then said, they always say that. That's almost like a soundbite. They always say that. We want clarity. He said, you have clarity. And then he just went on to say, essentially, you have our plan. What more do you need? And everyone's saying, well, it's a little thing about, details.
Also very telling right now, we heard from Kevin Hassett, and what he told reporters over the weekend is he doesn't like the word exemption. He said, when I go into the Oval Office and I say, what about an exemption? He goes, then I'll probably get kicked out. So maybe don't expect too many of those.
Jim Zauter of Apollo had a great phrase in the last week, macro paralysis. I think that kind of sums up where businesses right now are at, still confident but not doing anything. And that's the problem. Coming up next, former NEC Deputy Director Kellyanne Shaw with President Trump's steel and aluminum tariffs on deck. 2 hours away from the opening bell. Let's start with equities stateside. Negative again. We're down 1% on the S&P 500. On the Nasdaq, we're down by 1.1. I just want to sit on Europe just for a beat and take a look at the German 10-year and euro dollar. We talked about this about 20 minutes ago. This is what we've heard from the Greens, that they plan to reject a draft debt package in Parliament. Initially, that took the euro off the highs and sent bond yields in Germany lower. The key part of this story, though, is that they seem to be annoyed that they were left out of talks about the debt plan and have signalled that they do want to come to an agreement and are prepared to negotiate what they call a real reform to constitutional debt restrictions. So Germany, as far as the market is concerned, is still pointing in the right direction. It's just not going to be as easy as some people thought it might be.
Which really kind of goes to the point that they are willing to negotiate, which is actually a positive to this getting done, not necessarily an obstacle to Germany actually making plans to spend money. This is the key question. Can they go through with something that potentially is an existential threat that they need to do, or is it going to be stymied in all of this procedural and disagreement that we've seen in the region? This actually speaks more to negotiation than it does to obstacle.
I won't offer my opinion. I didn't 20 minutes ago. I'll just let the market speak for us, right? And the market's speaking pretty loud and clear. This market still believes this is going to happen, because if it didn't, you wouldn't see the euro positive on the day, and I don't think you see German 10-year yields lower by 3 or 4 basis points after rocketing higher by more than 40 last week.
If they really were looking to block this, they would criticize the spending. They would criticize the goal of it. They wouldn't criticize their particular involvement of it. They just want their say too. I'm just saying. I mean, look, everything can change, but that seems to be that seems to be the tone in markets.
We'll see if that changes. Yields down just a little bit. The euro stronger on the session. With 2 hours until that cash open, let's get you up to speed on equities with some morning movers. Here's Manus Cranny. Hey, Manus.
Jonathan, a very good morning to you. The laggard of the Mag 7 last week was Tesla, down 10%, down for 7 straight weeks. We start on the back foot again this morning. This is just a manifestation of the concerns around politics and production, and also within the Mag 7 as well. Dan Ives, the evangelist of this stock, buy it. Price target $550. Double your money. Roll it over. Airbnb, give you a little bit of light. This is Novo Nordisk. Excuse me, slightly out of sequence here. This is all about your weight loss trials and the CagriSema. This is the next generation of weight loss drugs, clinical trials for people with diabetes. They lost 15.7% weight loss over the period of time. The expectation, again, was higher. It was a 20% weight loss. And by the time you get to 68 weeks of using the drug, well, 2/3 were on the highest dose. Now we'll have a little bit of Airbnb. In the midst of all this recession talk, in the midst of all this growth slowdown, in this wealth effect that we're talking about, Airbnb, you've got one out there, Jefferies, upgrading the stock to a buy. Durable growth, 38% upside. Price target, $185. Who's calling recession? Jonathan.
Not me. Manus Cranny. Manus, thank you. More from Manus a little bit later on this morning. On our radar this morning, President Donald Trump reiterating there will be growing pains as his policies go into effect.
I hate to predict things like that. There is a period of transition because what we're doing is very big. We're bringing wealth back to America. That's a big thing. And there are always periods of, it takes a little time. It takes a little time.
Will there be a recession? I won't forecast that. There will be a period of transition. It takes time.
It takes time. And what you're hearing from the president, what you've also heard from the Treasury Secretary, Scott Bessent, is that, one, they are preparing the American people for this. And two, they think it's necessary for long-term gains to have this short-term pain. The issue I have with all of this is not even what happens in the financial markets, but at some point, do you start seeing a lot of this turn up to polling, especially to your point, Lisa, if you see people being laid off and the scars that leaves?
Right now, you're not. And actually, Nate Silver of 538 came out with a poll, and it showed Donald Trump's approval rating at about 48%. It's holding in there pretty much in line, maybe a tick or two lower. But I've been watching those polls, too, to see if they've been shifting, and they haven't been. And that, I think, is telling. He still has some leeway to go. And that really is the reason why it's hard to see why he would take a step back from this approach.
And at the index level, we haven't had a massive gap lower just yet. We might in the future, but at the moment, where are we at? 6-7%, something like that on the S&P?
Right. It feels more dramatic than it is. That said, Wall Street already is downgrading their forecasts pretty significantly. And you're seeing that across the street. You're seeing that Goldman Sachs now a 20% chance. On Friday, they said of a recession. You saw a 40% chance put out there by J.P. Morgan. There is a sense that things are shifting, and they're shifting very quickly.
Saw the same thing from Mike Gapon last week of Morgan Stanley, dropping his growth forecast, increasing his inflation forecast. Let's get you the latest elsewhere. Elon Musk urging the U.S. to exit NATO, saying it quote, doesn't make sense for America to pay for the defense of Europe. His comments coming as NATO's future hangs in the balance.
So this is a lot of consternation between NATO allies because of that man right there, Elon Musk, the proximity of power he has to President Donald Trump. And last week in the Oval Office, when Trump was asked about NATO, he said, do you think they're going to come and protect us? They're supposed to. I'm not sure. What I take from all of this is the fact that there's two things that we do know. We do know that the United States is pressuring NATO allies to spend more, 5% of GDP, which, by the way, the United States doesn't, but maybe they're going to get to. The other thing, last week at the Economic Club, I was struck by what Scott Bessent said. He said that increased burden sharing on security is critical amongst friendly nations. He sounded like Jonathan when he said this. No longer should American tax dollars, American military equipment, and in some cases American lives be the sole barriers of holding up friendly trade and mutual security. Basically, we are no longer going to fund these social programs that Europe has the blessing of having because of the U.S. defense.
If people were worried about the Green Party stymieing any negotiation in Germany, this just basically pushes them that much further. You know, if the U.S. drops out of NATO, Green Party wants this, okay, give it to them. You know, let's keep going.
You ever seen that meme? You're about to find out why America doesn't have socialized healthcare.
Yes.
It's those pictures of, like, fighter jets coming through and aircraft carriers.
Uh-huh. Yeah,
that's what that's about. I think that speaks to this story perfectly.
Very much
Europe
so.
has nice trains. Europe has nice socialized health care. And we have a, $800 billion defense budget.
Do you know how popular Doge is, just to mention Elon Musk? I was at a concert on Friday, comedy show, Barclays Centre. Doge and Elon Musk gets a shout-out. 20,000 people, raw. So much support for some of the policies coming from Doge in the general public.
The concept of reducing waste, of becoming more efficient, is hugely popular, and it's something that a lot of people should embrace. Question really remains how it's being done and whether it's going to be effective, and frankly, whether people who are affected by it are going to feel the same about it. And I think that that's really the key question as this unfolds.
Sebastian Maniscalco said, I want Doge to come to my house.
Yes, well, yeah. And,
yes.
And deal with what?
We'll talk about that another time. President Trump saying he's negotiating with 4 possible buyers for TikTok's U.S. business. Trump didn't specify the contenders and didn't say if he's leaning in a particular direction. This story, front and center.
Front and center because guess what? The clock is ticking, literally tick-tock. Deadline of April 5th. Although there is a caveat. Trump could extend it. He could give all these parties a little bit more time when it comes to negotiating, but more people keep throwing their name in the ring when it comes to who wants to take over TikTok. Then you have to remember, of course, Beijing has to sign off on it. That's a big problem.
True. It's a big hurdle. Let's turn back to the tariff agenda. 25% tariffs on steel and aluminum imports still on deck for Wednesday. The former NEC Deputy Director, Kellyanne Shaw, writing, the ambiguity of Trump's tariff plans are a feature and not a bug, as he sets to negotiate both USMCA and relationships with a number of key trading partners. Kellyanne Shaw joins us now for more. Kellyanne, welcome to the programme. Those negotiations set to kick off a whole lot more in the next month, at the start of April, when we get the reciprocal tariffs. What are you expecting to see in the next month or so?
Yeah, good morning. I think what's been really interesting is, despite the fact that last week's tariff action on Canada and Mexico was the single largest tariff action of any president in modern history, the administration keeps saying, hold your breath and wait till April 2nd. So I'm expecting the announcement of large tariffs on a number of U.S. trading partners, particularly those with large trade deficits, which will give them an opportunity to potentially negotiate their way out of whatever the administration has planned in terms of rebalancing those trading relationships.
Kellyanne, when it comes to April 2nd, is this just the announcement and then we're going to have a public comment period? How long until we see the tariffs actually take place?
Yeah, the truth is we don't know yet. We're not clear on how the administration intends to structure this, whether they intend to actually move forward with tariffs under something like IEEPA or Section 338 on April 2nd, as well as some of these sectoral tariffs that they've been talking about, or whether they'll announce their plan and then kick those off into investigations, which would take several more months before those tariffs went into effect. They could pick either path.
If it's a path that they're going to have some more time, does that mean that Trump is in negotiating mode and he's happy to maybe pull back the tariff threat if he gets something from one of the trading partners?
Well, I think the president has been clear that he is open to negotiations on these reciprocal tariffs. His idea is that we'll charge you what you charge us, and if other countries come to the table and lower their own tariff barriers, then those tariff rates would go down on the U.S. side as well. And I think that is the beauty of this concept of reciprocity. It really is the epitome of fairness from the perspective of the president. So I certainly think there's scope for negotiation.
What about Wednesday when it comes to aluminum and steel? Do you expect those tariffs to go through, as Howard Lutnick said over the weekend?
Yeah, I do. I think that this is a redo of what the administration did back in 2018. And the view that you're hearing coming out from the White House is that there were so many exceptions, so many exclusions that it became a loophole you could drive a truck through. And so they're starting with the maximalist tariff approach when it comes to steel and aluminum. I do think that there is scope for countries like Australia or maybe Canada and Mexico to get some sort of country exception, country exclusion. But for now, I think he's moving forward with the full measure.
A number of studies, Kellyanne, have been pointing to the fact that actually production might move more quickly out of the United States if the 25% tariffs do continue, particularly on Canada and Mexico. I'm talking about auto parts makers in particular. How much do you think that the president accounts for this type of behavior at a time where a lot of companies are trying to insulate themselves from headline risk?
Yeah, I think that the president's reaction to pare back some of the Canada and Mexico tariffs and say that for companies that are complying with USMCA rules of origin, that you would be exempted from the measure shows that the president is paying attention to this and that it's not just about production in America, but in North America. But this is an administration that is really focused on production. And so not only are they using tariffs to achieve that, but they have forecasted that when it comes to tax cuts, deregulation, and a number of other policies, they're going to do what they can to incentivize producing in the U.S. and producing in North America.
Kellyanne, what do you make of this theory that this is all by design, that a little bit of pain is kind of the goal here to get interest rates lower, to offset some of the tax cuts and just the increasing deficit and increasing interest expense that the U.S. is paying? Do you believe that that could actually be by design?
I'm not sure if that's the objective of the administration. I think when they talk about the fact that there's going to be pain and when the president talks about this transition period, what they're talking about is the fact that they have their eye on the ball 10 steps ahead. And that at the end of the administration, they want to be in a place where U.S. trading relationships are in a more balanced position, where there are lower tax rates and there is a greater incentive to produce in the United States and what they refer to as this golden age of manufacturing, golden age of production, but that is not going to be easy to get to. It's not a straight line. You're going to have to break some plates in the meantime. And so if some of these other economic consequences are happening, that is part of the entire measure, but I'm not sure that all of these are necessarily intended consequences.
Kellyanne, there's one place we know where the tariffs are going to stick, and of course that's China, 20%. And as of today, China's reciprocal tariffs on the United States, those retaliatory measures have gone into place for a number of agricultural products. Given you were there for phase one, do you think potentially there's a bigger deal to be had at the end of this when it comes to China? Because I remember in 2018, there was billions of dollars of losses from the agricultural sector in the United States, and then Trump had to actually have a bailout for these farmers.
Yeah, agriculture really is at the tip of the spear when it comes to trade and tariff policy because they're the first to get retaliated against. They are one of the most politically sensitive products in the United States, and every member of Congress has some form of agriculture in their district, which is why it's so attractive for our trading partners to hit them first. We'll have to see where this goes. I mean, the president has tweeted and posted on True Social about taking care of the farmers, having them sell domestically. I think he is keenly aware that they are getting hit first. But when it comes to China and some sort of trade deal, the jury's out. We'll have to see what happens and whether China wants to come to the table with the United States and vice versa. April 2nd, the president has a report on China's compliance with the phase one deal, a review of the $18 billion in tariffs that the Biden administration added, and then China's IP practices. So I fully expect this relationship to get a bit more tumultuous before it gets better. And then maybe this spring or summer, there might be some scope for negotiating some of it back down.
Well said. Kellyanne. Good to see you, as always. Kellyanne Shaw there, the former NEC Deputy Director. We get the tariffs potentially on steel and aluminum this week. Then next month, it's reciprocal tariffs time, which we're told by the administration will be the big one. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. President Trump is set to meet with CEOs of major tech companies at the White House today. That includes HP, Intel, IBM, and Qualcomm. The meeting will focus on trade policy and U.S. manufacturing, with mounting questions on expected policy changes. That including tariffs and stricter export rules that could impact the tech industry's global supply chains and operations. A U.S. negotiator says a new Gaza ceasefire deal is possible within weeks. Adam Boehler told CNN this weekend the possible agreement could even see Israel recover all hostages held by Hamas. A 6-week truce expired earlier this month, with both sides divided on conditions for more suspension of hostilities. And a check on Novo Nordisk shares, those down 6.4%. That's the most since December, after the drug maker's next generation shot, CagriSema, showed a 15.7% weight loss in a clinical trial of people with diabetes. Patients were allowed to choose their dose of the medicine, and after 68 weeks, less than 2/3 were on the highest dose. Shares have fallen 37% in the past 12 months on investor concerns that Novo won't be able to compete with competitors long term. And that's your brief. John.
Hey, Danny, thank you. More from Danny in about 30 minutes' time. Up next on the programme, separating signal from noise.
While there have been recent developments in some of these areas, especially trade policy, uncertainty around the changes and their likely effects remains high. As we parse the incoming information, we are focused on separating the signal from the noise as the outlook evolves.
The chairman of the Federal Reserve in no rush to cut interest rates. Up next on the programme, Michael Zezas of Morgan Stanley from New York. This is Bloomberg.
News when you want it with Bloomberg News Now. I'm Doug Krisner. So the equity market sold off today with tech shares leading the biggest decline since 2022. There was no shortage of anxiety over slower growth as the result of tariffs and government firings. We had the S&P 500 sinking 2.7% and the NASDAQ 100 plunging 3.8%. Gina Martin-Adams is chief equity strategist for Bloomberg Intelligence.
Significant decline in the Mag 7. Of course, a lot of that is selected stocks, Tesla and NVIDIA weighing heavily there. But nonetheless, that in and of itself is creating a big drag on the index. But it's more than that. Clearly, the Doge firings and the concern about the ultimate consumer outlook as a result of that have been weighing on consumer stocks. At the same time, you do have the tariff chatter.
That is Bloomberg's Gina Martin-Adams there. Now, many attribute today's decline to warnings from the Trump administration about the potential for a rough patch in the American economy. Over the weekend, President Trump refused to rule out the possibility of recession. Here is Bloomberg's Michael McKee.
The economic fundamentals have slowed, but they haven't given any sign that they're falling off a cliff. And while the equity markets are jumping out on the window ledges on Wall Street, the bond market is not. Yields have come down some, but if you look at both high yield and investment grade spreads, they're still very, very tight. So it's hard to say that a recession is baking itself into the cake.
That is Bloomberg's Michael McKee. Now, economists across Wall Street have been raising their odds for a U.S. economic downturn. On Monday, HSBC downgraded the U.S. to neutral, while upgrading Europe, minus the U.K., to overweight from underweight. Tomorrow, President Trump is scheduled to meet with top business executives as they grapple with uncertainty around tariffs, as well as the sell-off in the equity market. After the bell, we heard from Oracle, and the company reported a surge in bookings companies. This follows Oracle's announcement earlier of a joint venture with both OpenAI and SoftBank. These companies will spend at least $100 billion to build out U.S. data centers for OpenAI. Here is Bloomberg's Sarah Fryer in San Francisco.
They're doubling their data center capacity for the rest of the year. They have huge contracts looking into the future, many billions of dollars that are going to come in. So investors aren't looking at Q3 as much as they're looking at the road ahead and how critical a player Oracle is going to be in the AI build-out.
That is Bloomberg's Sarah Fryer. Now, on the negative side, Oracle's revenue forecast for the current quarter was disappointing, and those shares were down by more than 3% in late U.S. trading. We also heard after the bell from Delta Airlines. The carrier cut its profit expectations roughly in half for the first quarter. More from Bloomberg's Charlie Pellet.
Delta cites economic uncertainty that is hurting demand for domestic air travel. The carrier says earnings will be 30 to 50 cents a share in the period. That is down from an earlier forecast of as much as $1. Delta also reduced its guidance for revenue growth and operating margin in the first 3 months. The airline pointed to, quote, a recent reduction in consumer and corporate confidence caused by increased macro uncertainty, driving softness in domestic demand. In New York, Charlie Pellet, Bloomberg Radio.
A stopgap funding bill, or clean CR, looks likely to pass Congress on Tuesday, and this would in turn avert a government shutdown later in the week. More from Bloomberg's Amy Morris in Washington.
The Republican spending bill is designed to keep government agencies open through September 30th. Representative Don Beyer, a Democrat from Virginia, talked about the options and the worries that the president will unilaterally delay or cancel appropriations, called impoundment.
Unless there are meaningful guardrails to keep Trump from impounding it, we should vote no in the Democrats in the Senate and hopefully some Republicans in the Senate.
Virginia Democratic Representative Don Beyer on Bloomberg's Balance of Power. House Republicans could pass this on their own if they get enough votes from their own caucus, but even after it passes the House, it still has to get through the Senate. In Washington, Amy Morris, Bloomberg Radio.
And that is news when you want it with Bloomberg News Now. I'm Doug Krisner, and this is Bloomberg.
I think it's too early to know for sure. I think that the technology developments around DeepSeek are an important reminder of China's profound technological capacity. I think there are signs that the Chinese government is having, frankly, the kind of experience that often happens in societies where fear does the work of reason. Their fear of economic stagnation is driving a rapprochement with their technology businesses, which have enormous potential economic energy. And there are some signs that the commitment to economic reform is increasing in China. I also have to say that I think the degree of division that has been created in the last 2 weeks between the United States and Europe, the degree of abandonment of the developing world that the United States has manifested with its attack on developing countries, with efforts to essentially eliminate our international aid agencies, that is also an immense strategic gift to China. And I cannot imagine a greater strategic gift over the medium and long term to China than the prospect that has been raised by the Secretary of Defense with White House support of 8% annual defense cuts for the United States on an annual basis going forward.
Elizabeth Economy, senior fellow at the Hoover Institution, gave us an overview of the two sessions, what they could mean for the direction of the Chinese economy, and how the United States might respond.
And it's not just about the economy. They're going to look at foreign policy. They're going to look at the judiciary and the anti-corruption campaign. They'll look at the military. And then third, it's an opportunity to present new proposals and ideas for legislation. And they'll present a couple thousand different proposals over the course of the year and then debate them during this period. So it's a kind of interesting moment. But fundamentally, this is about assessing how successful has the Chinese government been and what do they need to do moving forward.
Put us in the seats of some of the delegates. What are the challenges do you think that they are looking at right now?
And there's no doubt that the Chinese economy, I think, from COVID until now, has faced a pretty significant set of challenges. At the same time, January was not so bad. You had the breakthrough of China's AI company DeepSeek. You had some good news in the property sector, some good news in lending. So I think there's enough that Xi Jinping and the sort of Chinese leadership can speak to that's reasonably positive, and they'll try to make the case that right now they're going through some challenges, but they see the path forward and ultimately they will succeed. So the delegates know the reality of the economy on the ground, but they're going to be also, caught in the middle of some pretty positive propaganda that the leadership is going to try to feed to them.
As they come together with a plan for the future, what levers could they pull? I mean, and let me be specific. How much fiscal headspace do they have? Because I've read a lot of things about the level of debt that actually may be underestimated on part of the Chinese government.
Right. So, they put forward a number of steps, fiscal stimulus back in September. And again, it seemed to have some positive implications for the economy.
How would you describe the overall economic goals of China, of the Chinese government right now?
I mean, China has a number of goals. I think, one goal certainly is to Trump-proof the economy. Xi Jinping, announced his theory of dual circulation, which is basically the idea that China can innovate, manufacture, and consume largely within itself. He says, the Chinese economy is incomparable in terms of its size and its ingenuity. It wants to continue to export, to continue to have foreign manufacturers depend on China for parts of their supply chains. But, for the most part, he wants to insulate China from the pressures of the global economy. I think that's one big goal. Again, I think number two, they want to, make China the leading innovation power in the world. They want to increase GDP per capita. That's really slowed down in the past couple of years. They want consumer spending to be rebooted. So I think they have a lot of different kinds of goals for their economy. Fundamentally, Xi Jinping, I think, is saying, this is a difficult period for us, but it's part of our industrial upgrading. These are sort of normal bumps in the road. Once we get through these, challenges, we're going to see the Chinese economy take off. So I think there are a lot of different elements to this in terms of what Xi Jinping wants to see moving forward.
Let me ask about two specific sectors. One is, I could call it green energy. It can be EVs, solar panels, things like that. The other is tech. Does Xi Jinping need to win on those, or is flourishing enough? I mean, does he need to beat the United States?
Now, I think at this point, this is a zero-sum game in Xi Jinping's mind. And I think if you listen, and if you've listened to his rhetoric over the past, more than decades since he came to power about the East is rising and the West is declining, we're going to have the triumph of socialism over capitalism and all the targets that he's put in place, he wants China to be the number one innovation power in the world. And that does mean supplanting the United States. So I do think that this is, to some extent, China beating the United States. Just to look at one of the things that they're going to be looking at in the two sessions is how successful China has been with its Made in China 2025 program. And this was a plan that was put in place under Xi Jinping in 2015 to ensure that Chinese companies would become the dominant manufacturers in China across 10 critical cutting-edge technologies, like clean tech, like new materials, like semiconductors, like medical devices. They become domestic champions and then become global champions. So
upskilling is becoming more important. So the world has to be prepared for it. So there has
The Chinese markets they've done well. I think the last time you were here, you're already bullish on the market. We've been seeing signs of consolidation in the last, call it, 2 sessions. No pun intended. What's the next catalyst?
I think it's interesting. If you compare the rally now, this year to last year, it's been very different. This year has been driven by tech. It's been driven, obviously, by AI, but it's also been driven by, and I think probably one of the most important factors for growth, a sort of warming up of the private sector with the meeting of President Xi and Jack Ma and the other private entrepreneurs. I think that's important because that creates jobs, ultimately. And if that is a sign that investment's going to continue and there's going to be more money in the private sector, well, then I think there'll be more job creation. And you just look at the inflation data today, services is down. People still don't have confidence in Beijing and Shanghai. Salaries are going down, and they're not confident on spending, even though housing is seeing signs of recovery, certainly on sales, not on prices. So, when you go back to what the rally happened in September, sort of October, it was really driven by financials, by insurance companies, by the consumer. And, clearly we have a much better Chinese market driven by AI factors and also earnings upgrades and under-positioning and also people switching from the US into China for that tech side. But we're not really seeing a clear movement in the domestic economy. When we see that, I think that will widen out and we'll certainly have more participation in what I would call the old economy, and really which is driven by policy. So that's the next stage. I mean, I think now, they'll probably stall, people looking at China going, actually, China's changed, but it's 30% up. Do we buy now? Probably not. But we have to be careful as regional investors because probably the larger stocks are going to be more attractive to the global investors. And I know we can look at the charts of some of the leading movers this year. They're up 50, 60%. But if you look at the long-term charts, they're way, way below the levels that they could be, going back to February 21. So I would have thought a bit of consolidation, more of a broadening out. You're already beginning to see it in Hong Kong financials, and then I expect you'll start to see it in the wider economy. But it might take a month or 2.
I just want to push that hypothesis a little bit further. Sure. We're still seeing weakness in the Chinese consumer. We saw stimulus measures at MPC essentially meet consensus. Are we seeing a rally in tech driven independently of the fact of Beijing? Is this rally continuing despite what Beijing does and says? And does that matter?
I think the interesting thing is this is the first time that the market in the last few years has gone up without a policy hope. And so that's actually much more positive. And I do think, going back to 21, before the sort of regulation came in, people were writing like 90% of tax credits, 90% of job creation was done from the private sector. The private sector got a clear message that they were out of favour, and we had a massive derating in markets. So I think partly this is a re-rating. If you take, Rebecca, the market or the PE of the market as a third the economy, it's not getting better, but it could. And they're putting in policy things to try and get it better, but it's going to take time. A third, geopolitics. Well, that's a lot better than we expected. I mean, it could go worse, but it looks like it's getting better, or at least not getting any worse. And a third, attitude to the private sector. When we buy these companies, are we getting our money back? And that release, I think that's looking a lot better. And I think China, these companies have proved that they are as competitive as US companies in certain areas. So I think that's what's led it.
We mentioned earlier that, and I think our producer's about to bring the chart up, that MSCI China is set to outperform the S&P this quarter by the most in 18 years. So it certainly cost people money to be underweight China. But that's not rocket science observation. My question is, has that message resonated enough, to your point, with the crowd that China's uninvestable? Are they starting to pay attention to that? So in other words, are people investing using geopolitical biases? Not so much along geopolitical themes, that's a different thing. And I'm wondering where your head is on that.
Yeah, look, I think it's still a question mark in the US, and certainly, our client base is still quite nervous, but nothing like a market going up to get people in. But actually, interestingly, this rally was started not by regional investors. Most people thought that the there was value in China and were overweight like us, it was really driven by US tech investors. So there is a certain type of investor that is prepared to go on a bottom-up basis and buy. I still think there'll probably be a bias. I mean, look at the ETF flows into EM ex-China rather than into EM. I think that slightly will reverse, but I think people will still be nervous going into April. I still think people would like, in the US, want to see, is it sustainable? I think you were talking earlier on the show, the market's gone up 30%. We've been here before. What's the next leg? I do think it is sustainable, even though if it might consolidate in the short term. And I think then people will look at it and go, actually, we're very underweight China. And I think it will, firstly, the next stage will be the EM and Asian funds, because there's a lot of international money who's completely ignored China. I don't think the US global accounts, China's too small in the index, etc. They can afford to miss it out. And it's been a very narrow rally, just like the S&P's been. But I do think wider, if you're worried about the US market, even these consolidating or going lower, particularly the stocks, you've got to be quite worried about some of the sort of correlated areas of Taiwan and Korea. India, I know a lot of the strategists are saying buy India, it's corrected. But we're seeing earnings revisions continuing to go down. And so maybe that's a second half of the year story. It means China's looking quite good relative within Asia as well. And it's sucking a lot of money out, sucking money out of Japan, sucking money out of, India a bit. We've seen massive flows out of India. But the main driver's been the southbound investor. The locals themselves are saying this is changing. And that's a really good sign.
The upskilling is becoming more important. So the world has to be prepared for it. So there has to be a complete shift in how people
Good morning from our global headquarters in New York. I'm Manish Krenny alongside Danny Berger. Welcome to Bloomberg Brief. Let's set that agenda.
No pain, no gain. President Trump declines to rule out a recession and says the U.S. faces a period of transition. Those comments weighing on Treasuries, equity futures down into the red after stocks posted their worst week since September. And Canada has a new prime minister. Mark Carney demands respect from the U.S. and vows to take on the tariff fight. Good morning, Manis.
Danny, good morning. It was a brutal week for stocks last week, and we start on the back foot this morning, down 3% on the S&P 500, the biggest weekly fall in 6 months. We're starting the fourth week of decline in these equity markets. The Nasdaq already in correction. Well, it blipped into correction on Friday. If we continue at this pace, we will be firmly there. Laurie Calvasina at RBC says a garden variety pullback has finally begun. The risk is now these markets draw down 14 to 20%. Roll it over to the bond market. Extreme movements have been the real narrative here. We've gone from exuberance to despair. And, of course, this tariff risk is now from an inflation risk to recession risk. We've got $119 billion worth of 3s, 10s and 30s, along with the CPI and the PPI later this week, coming in the bond market. 424, Danny.
A busy week to come. Don't forget University of Michigan sentiment survey also coming too. We've got some individual stocks we're keeping an eye on, along with the whole risk-off thing we're seeing in markets. Bitcoin is also falling. That's affecting crypto stocks like Coinbase, down 6.5%. It is now the 5th consecutive session of losses for Bitcoin. Some of the negative sentiment came last week when President Trump's executive action on a crypto reserve led to some disappointment,
to say the least. DoorDash Rising, as the food delivery company, is being added to the S&P 500 index along with Williams-Sonoma, TKO Group and Expand Energy, all in.
Finally, wrapping things up with some luxury. Ferragamo getting a nice little bounce back intraday, up 2.7% in the Italian trade. But that is mostly because it had its worst ever plunge on Friday, falling nearly 16% after issuing a weaker than expected outlook.
And in just a few moments, we'll catch up with Andrew Sheets of Morgan Stanley, and later in the hour, Terry Wiseman of Macquarie Group joins us. Danny, there's no doubt about it. We are on the back foot this morning. I like what Ed Yardeni said late on Friday. We're wondering whether Trump tariff 2 turmoil might trigger a rare kind of flash crash that then almost triggers the recession or is accompanied by a recession?
Well, you have this concern that 10% of the world's wealth spend 50% on corporate spending. So is the wealth effect a bigger issue? And I think that's kind of what Yardeni is getting at. You're seeing that kind of recessionary language start to creep in. JP Morgan has upped their recession odds to 40%. Morgan Stanley has downgraded what they say is GDP of this and next year. The growth concerns are starting to become real.
Yeah, and the vibes are shifting as well. You just look at the commodity market, you look at the oil market, and that really begins to scream something much more aggressive. You've got JP Morgan talking about $50 oil. That is well into the downturn kind of numbers. But the Trump administration, it's starting to hint that the president's economic plans may cause some short-term pain. POTUS has not ruled out a slowdown in the U.S., saying, quote, this: there is a period of transition because what we're doing is very big. His Treasury Secretary, Scott Bessent, has sung a similar tune over the weekend, saying that there's going to be a detox period. And here's what Andrew Sheets of Morgan Stanley says. The market impact. We think there are signs of weakness in the hard data. It will feed into recession fears and challenge the resilience of credit. The beta should increase on further drawdowns. Please say Andrew joins Danny and I this morning. He's the global head of corporate credit research over at Morgan Stanley. Look, these recession fears are rising. The count is rising. We're at 30% by some of the analysts. What is the risk of this potential flash crash triggering recession? And therefore, do you prepare for some kind of significant repricing in credit? Andrew.
Yeah, thanks. Good morning. So look, I think we need to take a step back and think about kind of the dynamics of what's happening. And so, our initial assumption, kind of if we think back to the end of last year, was that the Trump administration would make these larger policy changes to tariffs and immigration, but they'd be somewhat slower to occur. And so the economic impact would occur somewhat later. And so for an asset class like credit, where you still had very strong demand, you had attractive yields, it could be somewhat more resilient. And I think really over the last month, we've seen an administration that's pushing harder and faster on tariff and immigration policy. And that's causing real fundamental change in terms of how we at Morgan Stanley are seeing the U.S. economy. We are effectively bringing forward some of the slower growth and stickier inflation that we saw kind of happening later in the year and into 2026. We're bringing that forward into 2025. And that's happening in the context of a credit market that's been very resilient, that's in some ways ignored the weakness you mentioned in the commodity markets, the weakness we've seen in cyclical stocks or small cap stocks. And so I think that's the vulnerability. It's not just that our fundamental expectations at Morgan Stanley are getting worse. If we think about our base case, it's that specifically for credit, it's really kind of been surprisingly, impressively resilient. That rubber band is stretched a lot, and we're worried it can't stretch anymore.
What does it actually take to make the rubber band snap, though, Andrew? Because you probably could argue that seeing risk assets except credit do as poorly as they have 3 weeks of selling. I think if you said to someone you'd get over $70 billion worth of IG issuance last week and it would be easily absorbed, I think people would be surprised by that in isolation. So what does it take to actually bring the rubber band back in, to have it snap?
Yeah, I think that's the right question to ask. So one factor is growth. I mean, credit is a growth sensitive asset. So, moderation is great for credit. Growth expectations kind of coming down maybe to the lower end of 2%, high ones, that's still okay. But, our tracking estimate at Morgan Stanley has got down to kind of 1.4 for this quarter. I think if that drops another couple of tenths, then you're starting to flirt with kind of a 1% number, which I think the market would read as too low. I also think the decline in yields can be a bit of a dangerous dynamic. Initially, that decline in yields is great. It means that the total return on the bond fund that investors are holding is getting better. That can attract inflows. But I think as you break down below, say, 4% in the U.S. 10-year yield, and our expectation is that U.S. yields will continue to fall over the course of this year, we think that could sap some demand as those yield buyers step back. So, I think it's the growth data that's going to matter most, that people are going to be most focused on. But I think the decline in yields, that could turn from, an ally into an enemy as it progresses.
It's going to be interesting to see what yield flashes red at the White House on the Treasury market for Scott Bessent. If the U.S. elasticity is becoming more fragile in credit, then how much more elasticity is there in European credit, given the fiscal shift and narrative in Europe, Andrew?
Yeah, so I think this is one of the genuinely interesting dynamics. I think some of the developments over the last week in Europe were good. We saw a larger than expected German fiscal plan. Our economists think that's good. Our economists have taken, up the risks to European growth or up the outlook to European growth at the same time that we're downgrading the outlook to the U.S. The ECB cut rates at a time where we think the Fed is going to be very hesitant to cut rates in the U.S. We only have one cut in 2025. I think the market in the U.S. is close to 3 cuts as their base case. So, Europe, we have the growth forecast going in a better direction. We have the ECB, which we think is going to be able to deliver more than the market expects in contrast with less. Europe has rarely been able to completely decouple from the U.S., but it does seem to be in a better place. And so we think it should have somewhat more resilience, and that resilience we think going forward can continue.
Yeah, who knew that building the wall would be the wall of worry that we were going to get for the U.S.? But, Andrew, I just wonder how bad the economic data actually is, because a lot of it seemed to hinge on sentiment survey. And then we get the ISM. The services actually wasn't bad. The official reading wasn't too bad. How much about this moment is vibes versus an actual fundamental shift?
Yeah, so I think it's an important debate, right? Because a dynamic that investors always need to face, and certainly credit investors need to face, is that by the time that the hard data is really weakening, it's often historically too late. Markets move ahead of the hard economic data. And so I think that's why the market's so focused on these more leading economic indicators. Confidence has, not always, but on a number of instances, confidence is more of a leading indicator because people first get worried and then later they actually pull back their spending, and then later that kind of actually shows up in the data. So, we do think confidence measures need to be respected. And a survey like ISM PMI, the manufacturing survey, a survey that I like quite a bit, I think the underlying details of that, of weaker new orders but higher prices paid, that's just kind of the worst of both worlds when it comes to potential for weakness down the line and then difficulty for the Fed to react to that. So I think the market is right to be focused on some of these more leading indicators that have been weaker. I also, again, going back to what you mentioned at the top of this program, the weakness in commodities, the weakness in oil, signaling somewhat greater weakness in the cyclical economy. I think that should also be taken seriously. And that's both a segment within credit, but that also we see has some leading indicator aspects as well.
Yeah, oil prices reaching a 3-year low last week, which I think people would be forgiven if they missed, given everything else that was going on. Andrew, so wonderful to have you on. Thank you so much for joining us this morning. That is Andrew Sheets of Morgan Stanley. Oil prices, again, have been falling. Stocks at the lows of this morning, down more than 1% in the future session. Let's get some other top stories that are trending on the terminal this morning. China's consumer inflation has turned negative for the first time since 2021. Strategists are now worried that prices could be near contraction for the rest of the year. Economists estimate that it could rebound to near zero in March, and deflationary pressures are likely to persist unless government addresses excess capacity.
TSMC's revenue increased 39% in the first 2 months, driven by resilient demand for AI chips. That compares with a 34% growth during the full year for 2024. Its growth is seen as a sign of healthy spending on AI computing. However, TSMC faces uncertainty through 2025, including potential U.S. tariffs on chip imports, which could impact the business.
TikTok faces a deadline of April 5th to strike a deal for its U.S. operations or be banned from the country. President Trump spoke to reporters on whether a deal for the social video app is in the future.
There could be. We're dealing with 4 different groups, and a lot of people want it, and it's up to me. So there could be.
Coming up on the show, more on President Trump's pivot in economic messaging. That's next on Bloomberg.
I hate to predict things like that. There is a period of transition because what we're doing is very big. We're bringing wealth back to America. That's a big thing. And there are always periods of, it takes a little time. It takes a little time.
That was President Trump on Fox News responding to a question as to whether he thought that there would be a recession coming. Notably, he did not say that there wouldn't be, but said there would be a transition. His plea for patience was also a similar tone struck by his Treasury Secretary, Scott Bessent. On Friday, he spoke with CNBC, saying the market and the economy have just become hooked and we've become addicted to government spending. There's going to be a detox period. Joining us now is Bloomberg's Kevin Whitelaw. Kevin, this seems to be a very specific message coming from the White House, though we should mention that the Commerce Secretary did speak to Meet the Press, saying that there would not be a recession. But what is this new tone coming from Treasury Secretary Bessent and President Trump suggest about a put of sorts coming from the White House?
Well, I do think some of this is about managing expectations and trying to figure out how to spin what look like some, slightly worrying numbers about sort of where the U.S. economy is headed. But, I think more broadly, I think Trump has talked a lot about tariffs. He's talked about applying them for several different reasons. And I think a lot of the world was hoping that this would mostly be a negotiating tactic where he'd threaten things, people would make some kind of deal, and then the threat of tariffs would go away. I think some of this is suggesting that the tariffs indeed are really seen as potentially more of a structural change for the way Trump wants the economy to work, and that is going to be more of a long-term effect with an adjustment period. And obviously, in the short term and perhaps the medium term, that's going to mean inflation. It's going to mean a hit to GDP, and it's not obviously really clear whether his strategy would succeed in the long run. But he's got to find a way to start getting people to accept that there may well be some short-term economic pain, which was not something that he campaigned on at all.
Indeed, and as Treasury Secretary said, it's more about the call option that you want to focus on, perhaps not the put option. Kevin, we've also got the House with a stopgap bill coming through. Doesn't contain any permanent spending cuts. It's upping the defense spending. This is razor-thin numbers that we're dealing with here to get this through, and the president calling for unity to push it through the House.
Yeah, it's going to be a very tough thing to get through in the House. Democrats really have no reason to help Republicans out on this one, and there are Republicans who have just been long opposed to the idea of any kind of continuing resolution, anything that sort of maintains current spending. There are some minor cuts. There are some tweaks. There are some things Democrats don't like. The harder path is going to be in the Senate, where obviously they're going to need Democratic votes to get it through in a more significant way. And at the same time, it's not really clear that Democrats want to have a shutdown fight over this right now. So that's going to be the political choice they have to make about whether or not the cuts in this particular bill are really worth going to political war over.
Okay, Kevin, thank you very much. Kevin Whitelaw, the very latest from Washington. This sell-off is accelerating. Danny and I are tracking this for you. Bond market yields are falling, but on the stock side, the market really is absorbing these comments from the weekend. A detox period, as Treasury Secretary said, and this period of transition, Danny, it really is about a dissipation of the belief in a Trump put at the moment in these markets.
Exactly. Trump's not coming to the rescue, but we're going to catch up with Thierry Wiseman, I'm pleased to say, later in the hour, who talks about this idea that the brinkmanship that Trump is playing with tariffs also maybe extends to this economy and recession. NASDAQ futures taking the worst of the beating, down 1.1%. Okay, coming up, Carney in, Trudeau out. We're going to discuss the challenges that lay ahead for Canada's incoming leader. All of that's to come on your brief.
Behind the bright lights and adrenaline of pro sport is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all stars like Jay Williams.
I want to be an owner one day.
Billie Jean King.
Learn the business.
Paul Rabel.
Don't chase trends. Get ahead of them.
And so many more.
Get you set up with your front pages from around the world. First up, the FT. It kicks it off with Ukraine. They will try to persuade the U.S. to resume intelligence and military aid this week. And President Trump said that he has largely lifted the intelligence sharing freeze, and he hopes to push both Ukraine and Russia to negotiating table to broker a peace deal. U.S. pressure on Kyiv has forced Zelensky's administration to shift its position after a meeting at the White House.
Next up, we have this on the Bloomberg that Chinese tariffs on many American farm products have officially come into effect. They run from 10% to 15%, a long list of items that includes grains, proteins, cotton, fresh produce. Traders have been asked to limit overseas purchases of grain, while shipments of soybeans have been delayed.
Yeah, Mark Carney's up for the fight on that. We'll talk more about that in a moment. The Wall Street Journal leads with Mark Carney winning the race to become the new Canadian Prime Minister. He will succeed Justin Trudeau just as President Trump's administration threatens its economic future. Now, Carney won the contest to lead the Liberal Party of Canada with nearly 86% of that vote. Joining us now with a little bit more is a Bloomberg Daybreak editor, Mark Perrier. Mark, good to see you this morning. Look, Carney is now officially the party leader. It's fighting talk out of him last night. But what lies ahead? He's had a strong vote. Does he go straight to calling the election?
Well, that's the big question. The party's behind him. Obviously, he's got to get Canadians behind him. Once sworn in this week, he can basically call an election. Does he do it? Does he wait a little longer? That's the big question. My thoughts is that he'll probably go on the early side just to capture that momentum.
You look at the language that Mark Carney is already using, saying that retaliatory tariffs stay on until the U.S. shows respect. Mark, there has been this trend of foreign leaders standing up to Trump, helping their politics. Claudia Sheinbaum having a whopping 80+% approval rating from her country. Is there a scenario here where Mark Carney acting tougher helps him win the general election?
I think it does. Canadians are pretty angry right now with the situation, having to modify how they do business, what products they purchase. They are firmly behind whoever will lead in the general election. The message is we're not going to take these tariffs. We're going to impose our own tariffs. So I think the resolve is very much there to fight as a united country. And it'll be interesting to see how both nations repair their ties. These are two fantastic neighbors. They'll need to work on improving these ties as well.
Well, Carney talks about dark days, and this is a fight that they didn't call. We're seeing various sort of headline actions taken over these tariffs, from electricity threats into the USA to Starlink contracts. How are the tariffs actually impacting Canadians?
The mood is, again, as I said, angry. People are, in supermarkets are basically trying to avoid buying U.S. products. Very difficult to do, obviously, as both economies are so tied together. It's having a major impact on supply chains. Some people are canceling their trips to the U.S. There's very much a rise in patriotism. But again, I think most Canadians understand we need a fix to this in order to repair the damage that has been done to relations between both countries.
Yep, goes further than just booing at a hockey game, although that's definitely an element of it. Mark, thank you so much. There's our Bloomberg Daybreak editor, Mark Perrier. And just a quick disclaimer for our viewers that Mark Carney is also the chair of Bloomberg. All right, as we head to break, a quick look at these markets this morning. You're at the lows of the S&P 500 future session with a 10-year yield that is also moving lower by 4.5 basis points. Coming up, from policy uncertainty to government efficiency drives, we're going to discuss slowdown risks with Terry Wiseman. That's coming up next on Your Brief. From our global headquarters in New York, welcome to Bloomberg Brief. Danny Berger alongside Manus Cranny. Let's set your agenda.
No pain, no gain. President Trump declines to rule out a recession and says the U.S. faces a period of transition. Those comments weigh on Treasury yields and equity markets after stocks posted their worst week since September. And Canada has a new Prime Minister. Mark Carney demands respect from the U.S. and vows to take on the tariff fight. Danny, good morning.
Good morning. The Sunday scary seeping in to Monday. We are off some of the lows but still lower this morning by nearly 1% for your S&P 500 futures. Morgan Stanley's Mike Wilson says that U.S. stocks are at risk of slumping another 5%, that some of these worries are going to start to hit corporate earnings from both tariffs and lower fiscal spend. Meanwhile, the bond market gets a bid. Remarkable to see where yield levels are, considering that Germany just had the biggest sell-off since reunification in 1990. Your U.S. 10-year yield at 4.25. Your 2-year yield, that goes lower by another 5 basis points at 3.9, Manus.
Yep, Danny, there certainly is some kind of a snap in the band. I think Andrew Sheets sort of referred to it, the elasticity of these markets, the credit markets specifically, with some kind of sort of a very tight moment. And the risk is that you just push it all a little bit too far and you accidentally break something. And that's essentially what Ed Yardeni is talking about this morning. The risk of a flash crash.
Well, when you have these transition periods in markets, they're really marked by periods of volatility. And I think one of the questions we have to ask, are we still in that transition period where we're volatile and we're trying to find a new trend? Or is this the new trend? Is lower risk assets and weaker dollar, is this a trend that's going to be sustainable?
Well, cross assets, you talked about it multiple times, which is the negative feedback loop of the wealth effect. And that has a much more profound impact on the U.S. consumer than perhaps we've experienced thus far. Nobody's calling it a doom loop, but it is about trigger points. And sometimes things accidentally get broken in markets, the unintended consequences of both actions and rhetoric.
Is the White House willing to get us to that trigger point? Certainly the tone has changed from the White House, with President Trump echoing Treasury Secretary Scott Bessent over the weekend on what's ahead for the nation. He was asked, is a recession coming? Listen to his response.
I hate to predict things like that. There is a period of transition because what we're doing is very big. We're bringing wealth back to America. That's a big thing. And there are always periods of, it takes a little time. It takes a little time.
Macquarie's Terry Wiseman writing this, that there is a risk that too much policy uncertainty ensues to cause a recession. But that risk, too, is exploitable through brinksmanship. By feigning that he'd allow a recession, Trump improves his advantage even more. We still think that ultimately it is mainly concessions rather than permanent tariffs that will ensue. Terry joins us now. I'm pleased to say he is the global FX and rate strategist at Macquarie Group. Terry, so great to see you this morning. And this is the question and the hope so many people have abandoned, that Trump coming in to save things because markets turn so much isn't going to happen because of the tone shift. Are you kind of pushing back on this idea that the put is completely evaporated?
Not really. There's always going to be a level where things get so bad that even the U.S., despite the fact that it might have the more dominant position with regard to its negotiating counterparties, would relent here. Ultimately, I think that if you had a recession that was that bad, Trump would see the Republican majority at risk in the midterm elections, let alone what's going to happen to Republicans in 4 years from now. So there is always a level. The question is, where is that level? And the reason we bring up brinkmanship is because obviously this is a Cold War concept. It's been around for 60 years. John Foster Dulles in 1956, James Reston at the New York Times, Thomas Schelling, his famous book Strategy and Conflict, talked about this in the context of the Cold War, that one negotiator may want to feign or pretend that he's willing to take things over the brink to get a negotiating advantage. And I think this is, in some respects, explains why President Trump is willing to talk about a recession, because he knows that once he talks about a recession, his negotiating counterparts will think that it's okay by him, or at least a mild recession is okay, and they'd be more willing to relent on these issues.
It almost seems like a pincer moment between Bessent, the Treasury Secretary, talking about a detox, a fiscal detox, and President Trump talking about this discomfort which is to come. If they were worrying at 480, where is the trigger point in the bond market? Because that is what Scott Bessent and the President have told us they are focused on. We're at 425 now. So where do they blink in bonds?
Well, they certainly don't blink while bond yields are coming down.
It helps them, I know, from an economic point of view.
Absolutely. I think
But at a certain point, it shows recession, doesn't it?
It does, but I don't think that they're going to measure the extent of the recession by the extent of bond yields and how much they go back down by. They're going to measure the recession more by what you alluded to earlier, the wealth effect that might come out of a very weak stock market. No, absolutely not. To them, I think lower bond yields are a benefit. Think about it. It would be a mitigating factor for any recession that might otherwise ensue anyway. You get lower bond yields, you get lower mortgage rates, you certainly get consumers feeling they can borrow potentially at a lower rate. But more importantly, it ultimately gets the Federal Reserve potentially to cut in view of the inversion of the curve that might ensue. They certainly don't want to see an inversion. And then you get another benefit potentially, or at least another offset to the prospect of a recession. So, no, I think they're okay with lower bond yields.
To the point of the Fed, and this has been talked about, this idea that the uncertainty, I mean, the Fed themselves has been talking about it, Bostic has been talking about it, that his view could change rapidly, that the uncertainty in policy means that they kind of have to be on hold, that threat of inflation means that they can't move. But as they're on hold because of the policy uncertainty is also causing economic pain. So at what point, what is the bar for the Fed to start to cut, even if we don't have certainty in policy coming out of the White House?
This is still a Federal Reserve that respects a dual mandate. So I think and they also, it happens to be a Federal Reserve that is increasingly watching the data. I mean, they've said that for the last few years. So it really all comes down to the unemployment rate. I don't think it comes down to growth. There's at least some people on the FOMC are still Phillips curve oriented. They're going to watch the output gap. They're going to interpret the output gap through the unemployment rate. And if the unemployment rate were to rise significantly as a result of this policy uncertainty, which certainly is a factor in business decisions and delays of undertakings, whether it's employment or investment, if that happens, I think the Fed would move. But we're nowhere near there now. I think they see 4.1% unemployment rates as sufficiently low and really uninteresting at this point to motivate them to cut.
Going back to the narrative that we had from Andrew Sheets at Morgan Stanley, where he talked about a taut market and elasticity, there's an inelasticity or some kind of break point. Do you feel that we're at a very taut point in these markets?
I do, but I still think that plays to the advantage of the negotiators on the U.S. side here. The fact that the market has come down and conceivably can come down more because of the wealth effect or whatever other reasons we would cite, I think they're seeing it as a bit of an advantage. Again, that's only one reason why they're allowing this to happen now. There is an international discussion taking place with regard to tariffs and regard to the orientation of the U.S.'s role. Of course, there is also the need to reduce the deficit. I think that is an imperative on the part of this administration. Scott Bessent had said very early on that he wants to get the deficit to 3%. And keep in mind, a recession that would be caused by a debt crisis in the U.S. would be much worse than the kind of recession we would get through a fiscal contraction, including everything that's happening at Doge or anything that's happening with regard to trade uncertainty. So if it's a question of choosing between the very bad recession and the mild recession, I would take the mild recession any day of the week.
It just feels like this bizarre world where we're talking about some form of austerity in the U.S. while Europe is running higher deficits or plans to, doing more spending. And it's a very short-term memory. It wasn't that long ago that fear of higher deficits in Europe sent the currency falling. It's the opposite now, and you point this out, too, that we have a currency that's strengthening. How sustainable is that?
It is sustainable as long as Europe follows through. And I want to highlight that if all Europe did was spend more and get their deficits higher, I think Europe would be in trouble ultimately because these concerns about debt to GDP ratios and high deficits and sovereign risk would recur. What Europe needs to do is not just spend more. Europe needs to reorient and restructure its economy so that trend growth goes up, so that when you see these high deficits, it's not as fearsome, not as worrisome as it would be in the context of low growth. What Europe doesn't need right now is high deficits and low growth. High deficits with high growth that would mitigate the ultimate trajectory of the debt to GDP ratio would be okay, tolerable to the market. And I think in those conditions, the euro could continue to do well.
And this is something that came up last week, the distance between promises, rhetoric, and actually delivery on the fiscal front. This is what Mark McCormick questioned in terms of the actual delivery. When you see that flow into the euro and that spread move between US bonds and the Bund, does that continue? Because there have been really, really quite punchy moves in the bond spread over the past sort of 5-6 days.
It can continue. I think there are a lot of people who doubt the premise that the Europeans will actually follow through on the amount of defense spending and infrastructure spending and spending on digitization and all of the other spending programs that they discussed. The reason they doubt this is, in fact, because they see the bond yield rise and they say, effectively the opposite of the U.S., right? We're seeing bond yields fall. They see bond yields rise. They say that will be the constraint on the amount of spending, because ultimately it will cause other deleterious effects, including pressure on the household to stop spending. But I actually think that the Europeans might very well be successful this time in following through. And I think ultimately that also depends on what President Trump says, right? As long as he keeps the pressure on with regard to leaving NATO, the pressure will be on for them to continue to spend. So this is not just dependent on what the Europeans want, it's also dependent on what President Trump wants and what he says.
Yep, there's plenty of mileage left on this road. Terry, thank you very much. Terry Wiseman there of Macquarie Group. Setting the agenda this Monday morning. There are other stories trending on your Bloomberg terminal. Let's get you up to speed. China's consumer inflation has turned negative for the first time since 2021. Global banks are now worried that prices could hover near a contraction territory for the rest of this year. Economists estimate it could rebound to near zero in March, and deflationary pressures are likely to persist until the government addresses excess capacity.
Deliveroo will be closing its Hong Kong business after weak sales in the city weighed on their international division. The London-based delivery company has been facing stiff competition and price wars in China from Foodpanda and Kita. The delivery app will remain active in Hong Kong until April 7th.
TikTok faces a deadline of April the 5th to strike a deal for its U.S. operations or be banned from the country. President Trump spoke to reporters on whether a deal for the social video app is in the future.
There could be. We're dealing with 4 different groups, and a lot of people want it, and it's up to me. So there could be.
Coming up, the president deflects concerns of a slowdown after his early economic plans start to weigh on markets. Futures down this morning. We're going to have more from Washington, D.C. on deck on your Bloomberg Brief. This is Bloomberg Brief, and you're looking live at the Principal Room. Coming up later today, an interview with the Chipotle CEO, Scott Boatwright. That's at 3:30 p.m. Eastern, 7:30 p.m. in London on Bloomberg.
I hate to predict things like that. There is
Skilling is
a
becoming
period
more
of
important. So the world has to be prepared for it. So there has
completely up in the air. So what I'm really going to be looking at when we get the results later tonight, maybe tomorrow morning, is this one party called Nalirak. And if you're out there looking, just look for this one party. It's a pro-independence, nationalistic, some would call it populist party. And if they get a really strong showing, and maybe if the leader becomes prime minister, we could see things really shake up in Greenland. And when it comes to Trump, it's obvious, an independent Greenland, if they break away from Denmark, that would be easier for him to gain influence of, to invest in. But having said that, Greenland does not really want to be American.
Yeah. OK, really excellent setup. Bloomberg's Copenhagen chief, Ciala Sjolin, on these elections in Greenland. We will be watching closely. Thank you, Sarah. Coming up, we're going to discuss crypto's wild ride since President Trump returned to office with Deutsche Bank's researchers, senior strategist in the space, Marion Labor. That comes up next. This is Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 12 p.m. Eastern, right here on Bloomberg. Context changes everything.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling.
Join us on Bloomberg Open Interest. Weekdays at 9 a.m. Eastern, only on Bloomberg.
Bringing you up to the minute economic news whenever and wherever it happens. I'm Jennifer Zabasanja in Luanda, Angola, and this is Bloomberg.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. The magnificent meltdown. US and European futures stabilise after a tech-led rout sees the Nasdaq tumble to its worst day since 2022. The US pushes Ukraine for concessions at talks in Saudi Arabia as Kyiv launches what appears to be its biggest ever drone attack on Moscow. Plus, Germany's Greens demand tougher rules on defence spending in talks aimed at unleashing hundreds of billions of euros. The party's co-leader tells us she's hopeful of a deal by this week. Breaking lines crossing right now from the German automaker. Staying on the story of Germany, Volkswagen, the redhead, VW, seeing 2025 operating return on sales of between 5.5% to 6.5% at the high end. So at the high end of that range, that is above the estimates of 6.2%. Volkswagen's full-year operating profit coming in above the estimates, so that is a beat in terms of full-year operating profit, just over 19 billion euros. The estimates had been for 17.9 billion euros, so about €1 billion of beat coming through for full-year operating profit. In terms of net cash flow for 2025, they see that number at around 2 to 5 billion euros. Full-year revenues, by the way, coming in also above the estimates. A beat there in terms of full-year revenues. 324 billion euros. The estimates had been for 321 billion euros. Full year dividend per share coming in at €6.30. And Volkswagen sees 2025 revenue up to 5% in terms of the increase. So they're looking at potentially an increase of revenue of around 5%. Of course, the stock has essentially been largely flat. About 1.5% is the gain that we've seen for VW in the last 12 months. Focus, of course, on the cost-cutting plans, new models, anything they have to say about the tariff impact, of course, the Chinese market as well. Let's bring in Bloomberg's Oliver Crook, who, of course, has followed this story in granular detail over the last few years. Joining us out of Wolfsburg right now, where Volkswagen is, of course, headquartered. Ollie, your take from these numbers?
Yeah, so Tom, we're here in Wolfsburg. We're just here behind us is where we're going to have the annual press conference. We're going to hear from all of the sort of different executive suite here at Volkswagen, from the different brand heads, from the CEO, Oliver Blume, and the CFO, Arno Antlitz, who we'll be speaking to in a little bit of a while. But listen, overall, what we got from the full year is basically revenue that was flat, operating result, though, that it beat estimates, as you mentioned, down 15%, and the operating margin coming in at 5.9%. We should contrast that. That's the full year for last year, what we got in 2023. So we got 5.9% last year, 2024. The year before that, it was 7%. And now we're guiding potentially lower, but, you know, a range of 5.5% to 6.5%. Again, when we look at the volumes, the number of cars that were sold last year, they were down very slightly, 9 million cars. That's down about 3.5%. But again, this is a sort of transition period for Volkswagen. This has not been a secret. Remember, last year there was this very tough labor negotiations and all the sort of cost adjustments that had to go. And this is also a very capital-intensive period for the industry in general, but for Volkswagen in general. But I think that going into this meeting, there is a sort of strategy from the C-suite here that's saying that basically they've laid out their strategy. Now it's about execution. And many of the problems that Volkswagen is now facing are many fewer of them are Volkswagen specific. They're really industry specific, right? We're talking about U.S. tariffs. We've got an outlook here. I don't know how anybody in the car industry can give an outlook in March of 2025, just given the uncertainty we're seeing from the United States. But that's going to be one of the major issues. And just to recap what we saw in terms of volumes last year in the the different regions, because this is important. Western Europe was basically flat in terms of the number of cars sold in the fourth quarter last year. North America was a bright spot, up 4%. And again, China, Tom, the recovery in China is just not happening from the high end, from the low end. Chinese volumes in the fourth quarter down 8%. And frankly, I don't know that we're going to see anything sort of in terms of meaningful recovery, and especially also in the luxury recession that we've been seeing in China. That is very much enduring for the higher end vehicles that Volkswagen sells.
Yeah, we know Porsche's been impacted by that, hasn't it? In terms of Ollie, what are you going to be asking the CEO then? What's going to be the first question you're going to be putting to him on the back of these numbers? Is it going to be China? Is it going to be Europe, the US? Is it going to be the tariff question? What is kind of top of mind, you think, for the executive team right now?
Yeah, that's funny you should ask that, Tom. I mean, listen, I think for me, the main question is, in a time of radical uncertainty on so many fronts, whether it's sort of the growth forecast, whether it's a question of tariffs, and your job is to allocate capital and try to be competitive going into next year, but going into the next decade, they're laying out their strategy for the next decade. What is a certain bet that you can do? Where are the places that you can place money that you know are going to provide structural basis for growth for this company, just given the volume of uncertainty? I mean, there's one of the things we were joking about it sort of last night. One of the decisions that they made, so they build some of their battery factories over in Canada in order to access the U.S. market for EVs, right? That is now coming into question. There is the fact that they went to go build the Golf, the famous sort of Volkswagen brand in Mexico in order to get into the United States. So we joked about it. I mean, it's now the Gulf of America, right? And this is the sort of new reality for the sort of auto industry that's trying to figure out where they're trying to build all of these cars. And the reality of the situation is no one is going to make these huge decisions in terms of where you're going to base factories, the sort of rollout of these sort of vehicles that have 7-year sort of timelines with this sort of uncertainty where day to day you're getting a different message from the Trump administration. So really here they're going to be in wait and see what is going to happen with these tariffs.
OK, Bloomberg's Oliver Crook in Wolfsburg. Thank you very much indeed. We'll have that CEO interview, of course. Ollie will be speaking to the Volkswagen Group CFO, Arno Antlitz, I should say, and you will be able to catch that interview at 8:30 a.m. London time. So tune in for Ollie's interview with the CFO of Volkswagen later this morning. Let's get back to these markets right now, because we have seen a remarkable 24 hours in terms of the fading of the Trump trade. Yes, the futures picture is looking slightly more positive, but you saw a sell-off of around 1.3% on European stocks by the end of the close, but the pronounced downside coming through for the Nasdaq 100, closing almost 4% lower. The S&P almost 3% lower yesterday. Of course, the pressure on Mag 7, that grouping dropping 5%. Tesla tumbling 15%. President Trump says he's going to be buying one of the vehicles today as a sign of support for Elon Musk. European futures pointing to gains of 0.6%. FTSE 100 futures pointing up by 23 points. S&P futures looking to add 0.2%, but nowhere near making up the losses of yesterday, as Citi has said that US exceptionalism is on pause, at least for now. Nasdaq 100 futures after the rout of yesterday pointing to very modest upside of 0.1%. Let's flip the board and have a look at cross-asset. The Trump put has crumbled in the face of this pressure, and so far no rhetoric from the US president to assuage some of these concerns. The US 10-year then has been bid 4.19 right now, yields down 2 basis points. Lots of money moving into treasuries as a haven bid. Euro dollar at 1.08. The single currency up 0.3%. Some of that down to what we've been hearing from Green Party leaders in Germany, suggesting that a deal could be done on defence spending possibly as soon as this week. Brent at 6-month lows, below $70 a barrel, but up 0.2% so far in the session. Crypto has also come under pressure, though Bitcoin is up in the session today. Cryptocurrencies among the much-touted Trump trades that have fallen since his return to office. That is despite his announcement of plans for digital asset reserves and pledges to make America the world's crypto capital. Let's check in then on Bitcoin and the pricing. We look at gains today, but this since, of course, January, and the downside is there. The crypto check right now, that's intraday, of course. You're seeing a little bit of money moving back into crypto, but you're looking, of course, at Bitcoin down about 25% since January. So let's talk about some of the factors at play here and bring in Deutsche Bank's research senior strategist Marion Labor for the details and the analysis. Marion, thank you for joining us. Has the thesis that Bitcoin, that crypto could be a safe haven in a time of geopolitical angst, when did that thesis die?
Yeah, first of all, good morning. Thank you very much for having me. Yeah, so at some point, indeed, we used to think that Bitcoin was a good hedge against inflation, good asset. But as you mentioned, it fell about like 25% since the peak. It's now back to this November level around $80,000. I would say much of the recent Bitcoin price action was driven by speculation, wishful thinking, and not fundamentals. President Trump has been promising a lot during his campaign. We've also seen the March 2nd reserve announcement, which caused a temporary jump based again on speculation of government buying crypto and Bitcoin, and this wishful thinking didn't last, and the price retreated sharply. Having said that, because you mentioned the announcement, I would say that a Bitcoin rebound depends on regulatory clarity, institutional investment, and improved market sentiment. And what we've always seen is the fact that Bitcoin prices is also significantly impacted by macroeconomics factor. I'm thinking about Fed interest rates, economic growth, and also geopolitics factors. And usually, it's also more volatile than stock, and it's correlated to the Nasdaq and the S&P. So it's probably going to be very risky to remain highly volatile, especially given this context of uncertainty and tariffs, which are both going to persist.
Okay, so we look for clarity on the regulatory front. We look maybe for some clarity on the macro front as well, and maybe the tariff story is part of that. Do you think, Marion, kind of broadly the pendulum has swung too far in the other direction right now? Has the sell-off gone too far and too fast?
If we look at the big picture, Bitcoin prices doubled last year, which was clearly a significant increase. So now it's reverting, given that this big surge was again driven by what I call the Tinkerbell effect and this wishful thinking. Now, if I look at President Trump and what he's trying to do, we had the summit last Friday. He's also trying to bring some clarity, and there was clearly a demand during the summit for a clear and straightforward regulation. So he is aiming to set a comprehensive digital asset regulatory bill, he mentioned before the August month this year. And I believe that a regulatory landscape will impact also the future of cryptocurrencies, because if we have a clearer regulatory framework, it's going to drive probably more investment, higher liquidity, a lower volatility. So overall regulation is a positive for the industry.
Yeah, Marion, and we've seen change at the top of the SEC and maybe a more benign leadership when it comes to the Securities and Exchange Commission. What we know, the crypto industry was rankled at the former leadership under, of course, President Biden. That has changed, Marion. What specifically on the regulatory front would you be looking for in the weeks and months ahead that could be a catalyst?
Yeah, so there are a couple of regulatory issues. And again, it was mentioned during the summit last Friday, which include defining asset categories, simplifying compliance, facilitating safe integration with traditional financial institutions. So all of this has been mentioned. And also maybe one big news that we had last week, Trump issued an executive order establishing both a strategic Bitcoin reserves, which is going to hold over 207,000 Bitcoin, which have been sized by the government, intended as a long-term store of value similar to gold. And the administration is also going to have a digital asset stockpile, which is going to consist of confiscated altcoins.
Okay, really important analysis, and I like the line about the Tinkerbell moment for crypto. Deutsche Bank Research Senior Strategist Marion Laborde on what to watch for, particularly on the regulatory front when it comes to the crypto space, given that Bitcoin is down about 25% year to date, but of course after those incredible gains that we saw in 2024 more broadly. Coming up, powering the AI boom, we're going to discuss the ever-growing demand for data centres and what this means for Europe. We're going to be speaking to a leader from Schneider Electric, Europe's Operations Executive Vice President. That exclusive interview is coming up next. This is Bloomberg.
do think a lot of people who come into private credit for the first time, do you think that they maybe misunderstand a few things about the industry, given that it is private and they don't see the marks every day? Do they think that that means that things don't move around much in price, that they are inherently safer?
Don't get me down the marking rabbit hole. I actually think just because an asset class doesn't trade doesn't mean the value of that asset class doesn't actually move. With private credit, the biggest challenge is your ability to create liquidity when you make a mistake is more narrow because you're the owner of the asset, and likely maybe the sole owner of the asset or one of a few people of the owner of the asset. So there's not a lot of people following that asset that can provide you liquidity. So you own all your mistakes. Ultimately, when you generate that return, it's going to be whatever your return is, less losses.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Welcome back. Bloomberg has learnt that CoreWeave has agreed a 5-year contract with OpenAI. Sources say the cloud computing company sealed a pact worth close to $2 billion to provide services to the AI pioneer. The deal also gives OpenAI a stake in CoreWeave worth about $350 million. CoreWeave's closely watched potential IPO could value the NVIDIA-backed company at more than $35 billion. Meanwhile, it's estimated hundreds of billions of dollars are needed to build out the infrastructure to power AI demand. Meta says it's planning to invest as much as $65 billion on AI projects just this year. Microsoft looking to spend $80 billion on data centers this year alone. Let's discuss then the outlook and particularly the picture in Europe with Gwennaye Avis-Wet, Schneider Electric's Executive Vice President for Europe Operations, joining me in the studio. Gwen, thank you for joining me and for taking the time. Let's talk about the European piece of this then. There's been a lot of discussion about what the hyperscalers are doing in the US to build out data centers. Are we lagging in Europe? How many data centers are we going to be building this year? And what role are you going to be playing in that?
Yeah, thank you, Tom, for having me on this important question. So just maybe to give a sense of what's happening, we see a global demand that could reach triple by 2030 in terms of data centers. So it's going very fast. It's not happening only in the US, it's also happening in Europe. And I can tell you across the board in different geographies around Europe, we see a large demand. It's coming from the big players, but also it's coming from the co-locators. And the question is how to scale it. The wave of projects that we're seeing in Europe is so massive, so that we need to think about the whole end-to-end value chain from powering these data centers. It's a lot of energy, and at the same time making sure that we collect the data the right way and the regulation is enforcing and encouraging data centers development in Europe. So yes, it's happening. It's, in a very strong trajectory. And the question from us as Schneider Electric is to accompany that with the right technology. And we're talking different types of data centers, data center for cloud, but data center for AI together. So we need to bring the right technology for these data centers to take off in Europe. But second, we need also to make sure that we power these data centers with green energy, right? It's really important to continue the energy transition, and data centers have a role to play in that sense. So that's why sustainability, energy transition, and at the same time technology is core for this development.
So the build-out is happening. Just can you give us some ballpark numbers in terms of how many data centers you expect, how many shovels in the ground projects this year, and which countries are leading on that front?
Well, to give you an order of magnitude, I think that we have never seen such pipeline of projects. The question of the realization of pipeline is something that is under discussion because, of course, we don't know yet if it will be hybrid data centers from data, from cloud or from AI, or a combination or only AI, etc. All that is being designed in Europe. But the question is that we are seeing those developments happening in geographies that were not used to these data centers. Just to give you an order of magnitude, a lot of data centers happen historically in Ireland, for example, but also in Germany, but also in France. Now we are seeing that scale scaling across Europe. For example, now in Nordics, I can tell you that half of the growth is coming from data centers, renewable energy, and hydrogen for our own development. So it's just showcasing that we see a lot of development in new geographies. Why? Energy is available, energy is cheap, and energy is renewable.
But that's not across the board, is it? So the Nordics benefit from that energy. France has nuclear power. Germany, though, industrial energy costs are 3 times higher than they are in the US. To what extent is the energy piece holding some of these jurisdictions, some of these countries back, and how do you solve that?
Well, we see that because at the end of the day, it's also availability of land. It's not only power, it's availability of land, it's the ability also to recover heat, because heat recovery is one aspect. It's also to recover water. So it's a lot of aspects. That's why sustainability should be the enabler of the development and scale of data centers. I'm not talking about Spain and Italy, but I can tell you these are also massive development. Maybe to give you an order of magnitude, we're working with digital reality in France and in Spain, and we are decarbonizing these data centers through PPAs, renewable energy, power purchase agreement with renewable energy. That's also a way to decarbonize.
Some will hear sustainability and they'll hear regulation. Is red tape getting in the way? What needs to be cut at this point?
Well, you're absolutely on the right spot. I think that we have to be careful. Historically, Europe has been over-regulating, and we need to make sure that regulation is the enabler and not, on the contrary, an obstacle to those developments. We want Europe to really embrace this development of data centers that is happening. Why? Because we need that for the digital transformation of Europe. To decarbonize Europe, we need more energy efficiency. To have energy efficiency, we need digital, because we need sensors, we need to collect the data, we need to have hedge, and then we need to have intelligence. So that's why digital transformation of Europe will only happen if we have data centers, if we have these developments. So that's why we cannot over-regulate. And that's something that needs to be really fine-tuned.
Have any of your customers or clients suggested that they're going to be spending less, given the developments that we've seen from DeepSeek on efficiencies?
I can tell you, DeepSeek is a good news, because on the contrary, it showcases that it will become efficient. We need more efficiency in all that. That's why optimization of the design of the data center is something that we've been working on, but optimization of the technologies inside, at the end of the day, this is positive. This is positive for the planet, and we need to consume more data. So you see all that, yes, it's going in the right direction.
Okay, Gwen, thanks so much for coming into the studio to talk through what Schneider Electric is doing and the opportunities around data centers, some of the challenges as well. Gwen Avis-Wet, Schneider Electric's Executive Vice President for Europe Operations, on the push around data centers in Europe, the energy piece and regulations as well. There's plenty more coming up. Stay with us. This is Bloomberg.
Season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays at 9 p.m. Eastern Time, right here on Bloomberg. Context changes everything.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
We have been ready to negotiate since the night of the elections. We have been surprised that there has been nobody really engaging with us seriously.
Do you think it's likely that we could get a deal by the end of this week?
No, I really hope so. I'm like, the situation is dire in Ukraine. We really need Europe to speed up its own defense.
Franziska Brandner, co-leader of the German Green Party, speaking to me earlier. Her comments about potentially reaching a deal as soon as this week on defence spending out of Germany, lifting the euro and as well putting pressure back on Bund futures after the rally that we saw yesterday, after the Greens came in and said, you know what, we're not ready to support this deal. That language seems to be moderating. They have been having those conversations. A deal could happen this week, is what we're hearing from the Green Party. European futures up 0.5% after the losses of more than 1% yesterday. The euro on the single currency gaining 0.2%, and Bund futures under pressure again. Expectations, you might see another move up higher in yields on that defence spend impulse coming through. Let's flip the board and have a look at what's been happening stateside with the sell-off and the end of the Trump trade. US exceptionalism on pause is what Citi says. The S&P 500 closing into correction territory, sniffing at the heels of that level, down 8.6% from its state record high, of course, down 8.6% from that level. You are looking at the biggest drawdown since August of 2024 when it comes to the S&P 500. Let's flip the board and have a look at what's been happening in Mag 7, because that's the pain point. This has been a narrow and a narrowly defined sell-off that we've seen, and a lot of it concentrated in technology. Mag 7 down into correction territory, wiping out the gains post-election. You're seeing losses for the likes of Tesla of about 15%. That's just yesterday, and that is putting pressure on the wealth of Elon Musk and co. Let's have a look at what is happening in terms of the wealth drawdown. You've even had the President Trump coming out and suggesting he's going to buy a Tesla in support of Elon Musk today because he's so concerned about the wealth squeeze on Musk. He's lost about 185 billion. He's still fine, don't worry. He's lost about 185 billion. So what a remarkable turnaround since the picture of all those tech CEOs lined up alongside the president, of course, at the inauguration. We continue to watch the squeeze on the tech stocks through today as well. And the opening trade will be discussing and analysing that. They've got a bunch of fantastic interviews, including the CFO of Volkswagen. Stay with us for the opening trade. This is Bloomberg.
Youth unemployment is an issue in all labor markets.
Good morning from London. I'm Kriti Gupta alongside Guy Johnson and Lizzie Burden. We're an hour away from the opening trade. Here's what you need to know. President Donald Trump says the U.S. economy faces, quote, a period of transition, deflecting concerns about the risks of an economic slowdown. In Canada, Mark Carney wins the race to become the next prime minister, succeeding Justin Trudeau and inheriting a tariff war with the United States ahead of an election by October. And Beijing begins imposing tariffs today on farm products from the United States. It's the latest escalation of a trade war between the world's two largest economies. Lizzie.
Well, checking in on these markets, Kriti, and we have those US recession fears swirling, weighing on US futures, down 0.5%. But look at the European story. Futures higher 0.8%. This gap opening up, the 2-year Treasury yield steady at 3.97%, but euro dollar higher at 1.08 handle. The countdown to the opening trade starts right now.
Monday the 10th. Good morning, folks. Are we talking about a recession in the United States? Are we there yet? Is it going to be a Trump session? That seems to be the talk of the moment, and US markets have been responding to it. Last week, big down week. We're starting off the week in a similar vein this morning. Markets feel fretful, worried, nervous, Kriti, as we go into this week.
Nervous and have been for a couple of months. And then you got a confirmation of those fears with the payrolls report, of course, coming in at about 151,000. The survey was 160. Now, that's not a massive gap if you think about it, but the fact that you're starting to see some of these concerns show up in the data, and you're seeing that globally. It's not just a U.S. story. You're seeing it in the Beige Book. You're seeing it, of course, in the various U.S. pieces, but you're also seeing it in Europe and in China.
Yeah, and when you look at the data and compare it with the stock market story, of course, there's more of a link in the US than there is elsewhere in the world, because you have this disproportionate share of US consumers buying US stocks. So when Scott Bessent, the US Treasury Secretary, says that Wall Street's had its turn, it's now time for Main Street, actually the two are more linked than elsewhere.
The commentary's amazing, isn't it? You've got Bessent talking about a detox, the fact that the US economy has been reliant on this sugar high coming out of government spending for too long. He's going to remove that. Trump's basically saying, I'm not worried about the stock market, don't care about it. That's not my vibe at the moment. I want to talk about kind of the 100-year plan. I want to talk about the longer-term plan. Wall Street's got to be worried at this point, looking at the commentary coming out. It is a story that has been driven higher and higher and higher on the back of government spending. If that's removed, that is a big pillar being taken away from the US stock market.
So this was the Achilles heel of the Biden administration. They were looking at that 50-year kind of prospect and things like climate change, things like education, some of these policies, and then that's where they kind of lost the electorate. This is also coming where the timing couldn't be worse, in that so much of the economic resilience out of the United States that we've been talking about has been a question of savings, still savings coming from the COVID stimulus checks, some of the extra liquidity in the market. If you start to absorb all of that, they're not going to be able to absorb any sort of price hikes that are coming from corporations. And that's where the commentary I thought was interesting, is that if you talk about tariffs, corporations aren't absorbing any of it. They're passing it straight on to the consumer. They're not even willing to eliminate some of that.
So what happens next? Does this continue to drop? Does this market continue to go lower? I think that coming in on Monday morning, that feels like it is the narrative right now. And you've got a series of conflicts around the world. You mentioned China in the headlines, but let's talk a little bit about what's happening in Canada. Mark Carney is going to be the new Prime Minister. He's going to take over from Trudeau. I'm waiting for Lizzie to talk about unreliable boyfriends. I'm sure that commentary is going to come up at some point, formerly of the Bank of England and also of the Bank of Canada. The real question is, does Carney call an early election? The risk around this is that you leave a caretaker government in charge of a narrative that is really difficult to read with the United States. Or does he say, basically, the Liberals are actually coming back onto the front foot, and I need to take advantage of that, and I need to go now?
Yeah, because it shows that you really have to be in it to win it in politics. Just a few weeks ago, the commentary around Carney was, why would he even bother to do this when it could be a Liz Truss situation? And, the Conservatives are clearly going to win, commentators were saying. But given all of Trump's commentary on tariffs, the threats, but also the threats to make Canada the 51st state, that's actually worked in Carney's favour. And so it seems the polls suggest he actually has a chance at this point.
Yeah.
You mentioned his time as the BOE governor. It does give me PTSD, because I can say this now. Mark Carney Carney speaks in clauses that get ever smaller. It's very difficult when you're a print reporter covering Mark Carney. But the other thing to remember about him as BOE governor is that this is a man who's dealt with crisis. He has been through Brexit. He's been through the financial crisis. And so he might not have political experience, but perhaps this is where he steps up in terms of Canadian politics.
Absolutely. And let's bring it back to the markets here, because when we're talking about the digestion of some of those policies, you're already seeing it in lumber prices, for example. I'm having a bit of deja vu from when lumber prices soared off the inflationary story. You're also seeing it in oil prices, the idea that you are starting to have these kind of Canadian oil exports starting to be targeted potentially as well. And on top of that, not just a trade war with the United States, but a trade war potentially with China as well. Those agricultural products are now in question.
Yeah, so a trade war in two fronts, really. Notably as well, because we have to factor this into the inflation story, the latest Chinese data. So Chinese inflation dropping below zero for the first time in a year. And that confirming something that we already heard out of the NPC last week, with Beijing acknowledging that they needed to lower the inflation target because of these deflationary pressures. So really, seeing this impact already in the markets in China, they just cannot shake off the bearish mood when it comes to oil.
They can't. So oil is lower. You've got a potential US recession. You've got China not recovering very quickly. Did you see what happened with property prices, property stocks today? Yeah. Down really hard once again. China's going to find it really hard to work its way out of this difficult economic story with just kind of technology as the driver. It needs those green shoots within the property sector to revitalise even further if it's going to deliver on this. So, yeah, metals are a factor. Commodities more broadly are a factor. Oil is lower. The signal coming out of that comes back to where we started, which is, are we heading for a recession? Even the Saudis are having to lower prices into Asia because they're worried about the growth prospects they're seeing at the moment.
Yeah, the OSP is certainly a great indicator of that. I think it's also crucial to mention here, though, is that even though we do see this weakness story in China, this deflationary story, how relevant is that signal for the rest of the world? Is this the moment where we start to see those fears around China exporting some of that deflation actually show up? So that's going to be something we monitor, of course, but it is certainly significant that we are now officially in that negative kind of data set when it comes to the China numbers. Let's talk about what's going on in Germany here, because we do have some German data that crossed the wire a couple of minutes ago. I want to walk you through some of these numbers because I'm seeing some positivity here, and that's not usually a word I use to describe Germany very often. Germany's January industrial production numbers falling 1.6% on a year-over-year basis. Now, the estimate was about 2.8% of a drop. So this is actually technically a positive number as well. The exports are, however, dropping on a monthly basis by about 2.5% as of January. The estimate was a gain of 0.5%. So a little bit of a mixed data set there as well. And I'm also seeing imports rising by about 1.2% on a month-over-month basis. The estimate also 0.5%. When you look at the euro, not much reaction there, but worth noting that a little bit of a mixed set, perhaps a hint of positivity.
I know, but you take that chart back another 2 or 3 days and you'll see the massive move that we've seen in the euro over the last few days. We'll get a technical take on that a little bit later on. Let's talk about who we've got on the show to walk us through all of this. Isabel Mateos, Ilago, BNP's chief economist, is going to be joining us. Elsie Susi Watts, Global Digital Finance Executive Director. We're going to talk crypto there. William Hobbs, Barclays UK Wealth Management Head of Multi-Asset, going to be joining us. Do you buy this dip in US stocks? What are you doing with the bond market story? We'll get a take there. Plus, David Snedden, Snow Hill Consulting CEO and Chief Strategist, joining us to talk about what is happening within the markets from a technical point of view. Obviously, a lot of CTAs, etc., follow technicals, and it could be a good way of looking at the market right now. We'll get his take on what is happening there.
A perfect time to have that conversation, especially as we're looking down at a week full of data. Let me walk you through what's on the agenda for the entire week. On Monday, we do, of course, have the EU finance ministers meeting in Brussels. What kind of commentary do we have around the tariff story, but then also the deficit story, because that is still looming very much in the background as well, plus this kind of fiscal bazooka out of Germany. How reliable is the narrative we're hearing out of there? Then on Tuesday, we're going back to the data set in the States. U.S. job openings on Tuesday. Do we start to see those federal layoff numbers really show up there as well? Volkswagen earnings, we're going to continue that Germany story as well. And then on Wednesday, U.S. CPI, this is the big one. I'm looking at about I'm trying to find these numbers very quickly. I'm looking at a 4.28 on the 10-year. Do we see some major reaction in the back end of this week? Rheinmetall earnings as well, and the ECB is going to be on the tape as well. Thursday, U.S. PPI, and Friday, UMich consumer sentiment, and then more German car earnings as well. BMW and Volkswagen this week. So what's more important here for Europe? Is it the data sets that we're getting out of the States, or is it the earnings story out of some of these German automakers?
I think the German automakers will be critical. We'll just see exactly kind of how difficult the narrative is for them. Are they going to be, is German industry going to be a beneficiary of the industrialization that we're going to see via the rearmament program? I don't know. Does that feed across into other areas of the German economy? We will watch. The number that actually, the data set that wasn't on there that I'm going to be watching out for is the NFIB numbers, which also come out this week. Small business, backbone of the US economy. What are they seeing right now in terms of, the inflation narrative, the growth narrative? Take a look at what is happening with small caps in the United States. They've been hit really hard recently. There's some more data that I think we're going to see the market focusing on this week. The CPI is going to be critical, clearly, but I think the NFIB read is going to be really important.
Yeah, also just to link the two, the German car earnings and the US economy, of course the link is tariffs. And do you get those exceptions? Do you see business sentiment continuing to plummet when it comes to the German industry section as a whole? And tie it back to China as well. BMW's profitability hurt by the Chinese demand hit as well.
BYD's doing really well. Kind of basically making life very difficult for everybody else in China at the moment. So you've got a tough market there. You've got a tough market in Europe because of the economic backdrop. You've got a tough market in the United States because of the tariff uncertainty. It's a tough place to be right now for an auto company. Are we close to kind of all the bad news being in the price, I guess, is the question many stock investors will be looking at this week. Let's talk about what else we're watching. What else we're watching this morning? President Donald Trump says he is negotiating with 4 different possible buyers for TikTok's US business, and that a deal for the social video app could come, quote, soon. He didn't specify the contenders nor say which way he is leaning. TikTok faces an April deadline to strike a deal for its US operations or be banned from the country under a bipartisan law passed last year. Almost all of Germany's airports face disruption today because of a strike by the labour union Verdi. Ground personnel, baggage handlers and security staff have all been urged to walk out as they demand higher pay and more holiday. And back to the political story, Elon Musk's Starlink is rapidly becoming a key flashpoint between Europe and the United States. Over the weekend, the billionaire warned Ukraine that, quote, the entire front line would collapse if I turned it off. Poland, which pays for Ukraine's access to the communication network, then responded with its foreign minister saying that his country may seek alternatives if Musk's company proves to be unreliable. There then followed a tense exchange on X that drew in the Secretary of State, Marco Rubio. Starlink is also proving to be an issue in Italy, with the FT reporting that President Sergio Mattarella is concerned about Rome's €1.5 billion security contract with Starlink. This is getting fascinating and multi-front, and there's a sort of multiple fronts that are emerging.
Absolutely, and this, of course, comes, and you kind of hinted at there as well, when so many of these European allies are talking about sharing intelligence as well, or lack thereof, with the United States at the same time. Now you take away Starlink as well. There is only one major satellite intelligence provider, and I think we had an interview last week with Eutelsat, if I'm saying that right, talking about trying to fill that gap. But how quickly is that even possible? Yeah,
and how much does it cost to do that? That's a difficulty as well. And also, you know, if you talk about all these other companies that are trying to compete with Elon Musk, you've got Airbus, Leonardo, Thales. You have to open up the Pandora's box that is European politics. You know, Germany isn't going to want to be left out of that, so it becomes even more difficult.
Yeah, so the League in Italy is already concerned about the fact that basically you've got a British-French company, Eutelsat, that could replace it. It's worried about that. Why would you want to go with the French when you could go with the Americans? So even within Italy, there's deep concern about what is happening and which direction we're going to be going in. But how many articles did you read over the weekend about European defence, the footprint that America has, the concern that is growing within Europe about the ability of the United States to turn off key pieces of technology? This is getting more and more concerning from a European perspective. The problem is, though, from a time point of view, we don't have enough to be able to fill the gap.
It's also interesting, and we bring it right back to Italy here, which is that Giorgia Meloni was supposed to be viewed as an ally and a friend of not just Elon Musk, of Donald Trump, but the voice at one point of Europe, perhaps, to the United States. She's making some real divisions in terms of that stance. Things like giving Ukraine NATO security without perhaps giving it membership, still providing that aid as well, and still very much investing in that defense story. So I think this is interesting. That's a relationship, I think, to watch as well.
We've got very excited about this European defense story very quickly. The Euro's rallied. European defence stocks have gone to the moon very, very fast. is there a moment now where we pause and reflect on the reality, the difficulty of actually achieving some of these ends, and how quickly, in particular, some of these ends can be achieved? Europe has a very big hill to climb, and the slope is very, very steep in order to get where it needs to go.
And which country's flag will be at the top of that mountain. But coming up, we have plenty coming up on the programme. Washington announcing a crypto reserve, but markets are trying to make sense of it, and we're going to dig into the details of that. Plus, Germany searching for an identity after the latest leadership elections. We're going to have more on Bloomberg's deep dive story on the politics there. But up next, back to where market concerns over the US growth loom large. We'll discuss that next. But if you have any questions of your own for our guests, please do send them to us on IB plus BBTV Go. This is Bloomberg.
While there have been recent developments in some of these areas, especially trade policy, uncertainty around the changes and their likely effects remains high. As we parse the incoming information, we are focused on separating the signal from the noise as the outlook evolves. We do not need to be in a hurry, and we are well positioned to wait for greater clarity.
That was Friday. That was Jerome Powell speaking on behalf of the Fed, of course, talking about the fact that maybe the FOMC doesn't need to rush to adjust policy, despite some uncertainties that we are seeing. That feels like a long time ago, doesn't it? Since then, we've had President Trump talking about that recession risk. He was asked about it yesterday. He was maybe a little bit more equivocal when it came to the outlook for the US economy, short-term versus long-term. Let's talk about how this is all being reflected in market sentiment. Valerie's here to do just that.
On the market's mind is this growth risk narrative overblown when it comes to the move in the equity market and a move in the Treasury market? Yes, we had Trump again repeating that there might be a bumpy ride ahead for the U.S. economy. Scott Bessent, the Treasury Secretary, also mentioning there might be a detox period ahead on Friday. But we've heard these comments again repeated week after week. It's been 2 weeks running now. We've heard these dire forecasts. We've seen the S&P 500 drop 7% in that time frame, and a big rally into the Treasury market, and near 50 basis point move lower in Treasury yields. So is this move already priced in? That's the questions on markets' mind. Thankfully, on Friday, Jerome Powell himself didn't sound very downbeat on the U.S. economy. He said the U.S. economy is in a good place, and that helped the S&P 500 bounce from its 200-day moving average. We bounced pretty spectacularly from it, Guy, bouncing nearly 2% into the close on Friday. But again, these worries about the U.S. consumer, will we get any confirmation of it in the data this week? I don't really think so, Guy. The focus is going to be on the hard CPI data. Friday, we get the University of Michigan sentiment survey that might be the next kicker for these growth worries. But again, that is a soft consumer sentiment survey. We are yet to see any hard data when it comes to growth. A surprise on the downside.
Yeah, but the conversation is being had, isn't it? And the market can't quite figure out where we're going to go next and whether or not this administration is worried in the short term about that potential economic hiccup. Valerie, thank you very much indeed. Let's carry on the conversation. Isabel Mateos Ilago, Chief Economist at BNP Paribas, joining us now. Good morning.
Good morning, guys.
Short term, do we need to worry about growth in America?
I think so. I think so. There's a lot of uncertainty, policy uncertainty right now, and that's created a little bit of an air pocket. Now, starting from a level of activity, of economic strength, so there's some room for a wobble, but This is something the administration should keep an eye on. And the fact that they're messaging instead that, oh, no, this is nothing to worry about, there may be some temporary disturbance is a worry.
They're planning further down the road. They see a longer-term picture, maybe which is much more positive, but you've got to kind of wean the U.S. economy off government spending. How could that work? What is the effect of a reduction in government spending into the economic data? How do you think about, when you build your models, how do you think about what that number looks like and the effect that it can have?
Well, the problem is that's not the only thing that's going on, right? You've got the cut or the potential cut or the start of cuts in government spending and federal workforce, but you also have the tariff uncertainty.
Yep.
So in theory, you can cut government spending and be okay if at the same time you deregulate, you do all sorts of things that incentivize the private sector to consume and invest more.
But we're not getting that yet.
But we're not getting that. In fact, we're getting the opposite. We're getting a negative confidence shock from tariffs. And consumers are worried about unemployment. Consumers are worried about inflation. Inflation expectations are through the roof at a 30-year high. And so you're getting a negative confidence shock right now. And so you're cutting government spending and not replacing it with private spending. That's where you're getting these worries about recession coming from.
So the logic at the White House among the Trump administration is that the reason you're doing this volatility, the reason you're trying to negotiate, in theory, the approach is shaky, but the reason is ultimately to bring about tax cuts and to bring in the deficit. The deficit ceiling or the debt ceiling hits in July. How much of that is the bigger risk to the U.S. economy?
I think the risk is uncertainty, and you have to manage the private sector. People are not ultimately. You want households to consume and businesses to invest. And if you elevate uncertainty to such level that everybody is going to freeze in their place, you're going to create such a downwind, such a headwind that then you're going to have very little space left to do anything that you had planned to do. And in fact, you're going to hit that debt ceiling wall potentially even higher because the tax receipts are not going to come in, right?
Is that the case for an insurance cut at the Federal Reserve?
Not yet. I think you heard Jerome Powell. We all heard Jerome Powell on Friday. As I was saying, we're starting from a position of strength. The U.S. economy finished 2024 really with huge momentum. So there is a bit of margin. And separately, inflation is still too high. So, the Fed needs to weigh both risks. But, it used to be that they only needed to worry about inflation. And now we're back in a place where they need to keep an eye on both inflation and growth.
So, Isabel, Donald Trump was hanging over another central bank last week, the ECB. And, of course, we had another cut, but a lot of uncertainty over the April meeting. The big question, I feel now, is whether this fiscal boost in terms of growth outweighs the tariff threat. What's the answer for you?
Yeah, we didn't get a whole lot of guidance from Madame Lagarde on this, and rightly so, because these are two big unknowns. Like, in fact, we might get neither the fiscal boost nor the tariffs, or we might get both, or we might get them on a different timescale. So it's understandable that they wanted to leave all options open for the April meeting. What's a bit disconcerting is that, we've heard from Madame Lagarde, well, we'll be data dependent, and if the data warrants a cut, we'll cut, and if it doesn't, we won't. But we're very unlikely to get that much more clarity about the data between now and the April meeting. Okay, maybe there will be a tariff decision, but as we've seen, it might be undone within 48 hours, so that won't give us that much more clarity. And then on the fiscal side, okay, we'll have had a vote in the Bundestag, but how quickly is that spending going to come? We still don't know, so very open for the April meeting.
But so let's say it's the best case scenario and the tariffs are light or non-existent and you get this massive fiscal boost. You've still got all of the problems in Europe, the ageing workforce. Basically, does stagnation continue?
Yeah, so I think it's the mirror image of the U.S. a little bit. U.S., you're starting from a high level and you're having a lot of confidence activity indicators deteriorating. Europe, you're actually seeing a lot of green shoots in consumer confidence, business sentiment, investment, even manufacturing production, improving or deteriorating less, but still operating from a level that's below potential. So you've got really some room to go, and that has to factor in the ECB's thinking in terms of, do we keep cutting or not? Because you're not operating at full potential. There are structural drags, and so you would want to help that economy. But the good thing about the kind of fiscal boost that we're talking about in Germany in particular is that this really has the potential to improve long-term potential, not just a short-term boost.
OK, optimism. We thank you, Isabel Mateo-Silago, Chief Economist at BNP Paribas, but a lot of uncertainty to wade through in the meantime. Coming up, we'll talk Bitcoin, US President Donald Trump's strategic reserve, disappointing markets. That's next. This is Bloomberg.
Good morning from London. I'm Kriti Gupta alongside Guy Johnson and Lizzie Burden. We're an hour away from the opening trade. Here's what you need to know. President Donald Trump says the U.S. economy faces, quote, a period of transition, deflecting concerns about the risks of an economic slowdown. In Canada, Mark Carney wins the race to become the next prime minister, succeeding Justin Trudeau and inheriting a tariff war with the United States ahead of an election by October. And Beijing begins imposing tariffs today on farm products from the United States. It's the latest escalation of a trade war between the world's two largest economies. Lizzie.
Well, checking in on these markets, Kriti, and we have those US recession fears swirling, weighing on US futures, down 0.5%. But look at the European story. Futures higher 0.8%. This gap opening up, the two-year Treasury yield steady at 3.97%, but euro dollar higher at 108 handle. The countdown to the opening trade starts right now.
Monday the 10th. Good morning, folks. Are we talking about a recession in the United States? Are we there yet? Is it going to be a Trump session? That seems to be the talk of the moment, and U.S. markets have been responding to it. Last week, big down week. We're starting off the week in a similar vein this morning. Markets feel fretful, worried, nervous, Kriti, as we go into this week.
Nervous and have been for a couple of months, and then you got a confirmation of those fears with the payrolls report, of course, coming in at about 151,000. The survey was 160. Now, that's not a massive gap, if you think about it, but the fact that you're starting to see some of these concerns show up in the data, and you're seeing that globally. It's not just a U.S. story. You're seeing it in the Beige Book. You're seeing it, of course, in the various U.S. pieces, but you're also seeing it in Europe and in China.
Yeah, and when you look at the data and compare it with the stock market story, of course, there's more of a link in the US than there is elsewhere in the world, because you have this disproportionate share of US consumers buying US stocks. So when Scott Bessent, the US Treasury Secretary, says that Wall Street's had its turn, it's now time for Main Street, actually the two are more linked than elsewhere.
The commentary's amazing, isn't it? You've got Bessent talking about a detox, the fact that the US economy has been reliant on this sugar high coming out of government spending for too long. He's going to remove that. Trump's basically saying, I'm not worried about the stock market, don't care about it. That's not my vibe at the moment. I want to talk about kind of the 100-year plan. I want to talk about the longer-term plan. Wall Street's got to be worried at this point, looking at the commentary coming out. It is a story that has been driven higher and higher and higher on the back of government spending. If that's removed, that is a big pillar being taken away from the U.S. stock market.
So this was the Achilles heel of the Biden administration. They were looking at that 50-year kind of prospect and things like climate change, things like education, some of these policies, and then that's where they kind of lost the electorate. This is also coming where the timing couldn't be worse, in that so much of the economic resilience out of the United States that we've been talking about has been a question of savings, still savings coming from the COVID stimulus checks, some of the little extra liquidity in the market. If you start to absorb all of that, they're not going to be able to absorb any sort of price hikes that are coming from corporations. And that's where the commentary I thought was interesting, is that if you talk about tariffs, corporations aren't absorbing any of it. They're passing it straight on to the consumer. They're not even willing to eliminate some of that.
So what happens next? Does this continue to drop? Does this market continue to go lower? I think that coming in on Monday morning, that feels like it is the narrative right now. And you've got a series of conflicts around the world. You mentioned China in the headlines, but let's talk a little bit about what's happening in Canada. Mark Carney is going to be the new Prime Minister. He's going to take over from Trudeau. I'm waiting for Lizzie to talk about unreliable boyfriends. I'm sure that commentary is going to come up at some point, formerly of the Bank of England and also of the Bank of Canada. The real question is, does Carney call an early election? The risk around this is that you leave a caretaker government in charge of a narrative that is really difficult to read with the United States. Or does he say, basically, the Liberals are actually coming back onto the front foot, and I need to take advantage of that, and I need to go now?
Yeah, because it shows that you really have to be in it to win it in politics. Just a few weeks ago, the commentary around Carney was, why would he even bother to do this when it could be a Liz Truss situation? And, the Conservatives are clearly going to win, commentators were saying. But given all of Trump's commentary on tariffs, the threats, but also the threats to make Canada the 51st state, that's actually worked in Carney's favour. And so it seems the polls suggest he actually has a chance at this point.
Yeah.
You mentioned his time as the BOE governor. It does give me PTSD, because I can say this now. Mark Carney Carney speaks in clauses that get ever smaller. It's very difficult when you're a print reporter covering Mark Carney. But the other thing to remember about him as BOE governor is that this is a man who's dealt with crisis. He has been through Brexit. He's been through the financial crisis. And so he might not have political experience, but perhaps this is where he steps up in terms of Canadian politics.
Absolutely. And let's bring it back to the markets here, because when we talk about the digestion of some of those policies, you're already seeing it in lumber prices, for example. I'm having a bit of deja vu from when lumber prices soared off the inflationary story. You're also seeing it in oil prices, the idea that you are starting to have these kind of Canadian oil exports starting to be targeted potentially as well. And on top of that, not just a trade war with the United States, but a trade war potentially with China as well. Those agricultural products are now in question.
Yeah, so a trade war in two fronts, really. Notably as well, because we have to factor this into the inflation story, the latest Chinese data. So Chinese inflation dropping below zero for the first time in a year. And that confirming something that we already heard out of the NPC last week, with Beijing acknowledging that they needed to lower the inflation target because of these deflationary pressures. So really seeing this impact already in the markets in China, they just cannot shake off the bearish mood when it comes to oil.
They can't. So oil is lower. You've got a potential US recession. You've got China not recovering very quickly. Did you see what happened with property prices, property stocks today? Yeah. Down really hard once again. China's going to find it really hard to work its way out of this difficult economic story with just kind of technology as the driver. It needs those green shoots within the property sector to revitalise even further if it's going to deliver on this. So, yeah, metals are a factor. Commodities more broadly are a factor. Oil is lower. The signal coming out of that comes back to where we started, which is, are we heading for a recession? Even the Saudis are having to lower prices into Asia because they're worried about the growth prospects they're seeing at the moment.
Yeah, the OSP is certainly a great indicator of that. I think it's also crucial to mention here, though, is that even though we do see this weakness story in China, this deflationary story, how relevant is that signal for the rest of the world? Is this the moment where we start to see those fears around China exporting some of that deflation actually show up? So that's going to be something we monitor, of course, but it is certainly significant that we are now officially in that negative kind of data set when it comes to the China numbers. Let's talk about what's going on in Germany here, because we do have some German data that crossed the wire a couple of minutes ago. I want to walk you through some of these numbers because I'm seeing some positivity here, and that's not usually a word I use to describe Germany very often. Germany's January industrial production numbers falling 1.6% on a year-over-year basis. Now, the estimate was about 2.8% of a drop. So this is actually technically a positive number as well. The exports are, however, dropping on a monthly basis by about 2.5% as of January. The estimate was a gain of 0.5%. So a little bit of a mixed data set there as well. And I'm also seeing imports rising by about 1.2% on a month-over-month basis. The estimate also 0.5%. When you look at the euro, not much reaction there, but worth noting that a little bit of a mixed set, perhaps a hint of positivity.
I know, but you take that chart back another 2 or 3 days and you'll see the massive move that we've seen in the euro over the last few days. We'll get a technical take on that a little bit later on. Let's talk about who we've got on the show to walk us through all of this. Isabel Mateos Ilago, BNP's chief economist, is going to be joining us. Elsie Susi Watts, Global Digital Finance Executive Director. We're going to talk crypto there. William Hobbs, Barclays UK Wealth Management Head of Multi-Asset, going to be joining us. Do you buy this dip in US stocks? What are you doing with the bond market story? We'll get a take there. Plus, David Snedden, Snow Hill Consulting CEO and Chief Strategist, joining us to talk about what is happening within the markets from a technical point of view. Obviously, a lot of CTAs, etc., follow technicals, and it could be a good way of looking at the market right now. We'll get his take on what is happening there.
A perfect time to have that conversation, especially as we're looking down at a week full of data. Let me walk you through what's on the agenda for the entire week. On Monday, we do, of course, have the EU finance ministers meeting in Brussels. What kind of commentary do we have around the tariff story, but then also the deficit story, because that is still looming very much in the background as well, plus this kind of fiscal bazooka out of Germany. How reliable is the narrative we're hearing out of there? Then on Tuesday, we're going back to the data set in the States. U.S. job openings on Tuesday. Do we start to see those federal layoff numbers really show up there as well? Volkswagen earnings, we're going to continue that Germany story as well. And then on Wednesday, U.S. CPI, this is the big one. I'm looking at about I'm trying to find these numbers very quickly. I'm looking at a 4.28 on the 10-year. Do we see some major reaction in the back end of this week? Rheinmetall earnings as well, and the ECB is going to be on the tape as well. Thursday, U.S. PPI, and Friday, U.S. consumer sentiment, and then more German car earnings as well. BMW and Volkswagen this week. So what's more important here for Europe? Is it the data sets that we're getting out of the States, or is it the earnings story out of some of these German automakers?
I think the German automakers will be critical. We'll just see exactly kind of how difficult the narrative is for them. Is German industry going to be a beneficiary of the industrialization that we're going to see via the rearmament program? I don't know. Does that feed across into other areas of the German economy? We will watch. The number that actually, the data set that wasn't on there that I'm going to be watching out for is the NFIB numbers, which also come out this week. Small business, backbone of the US economy. What are they seeing right now in terms of, the inflation narrative, the growth narrative? Take a look at what is happening with small caps in the United States. They've been hit really hard recently. There's some more data that I think we're going to see the market focusing on this week. The CPI is going to be critical, clearly, but I think the NFIB read is going to be really important.
Yeah, also just to link the two, the German car earnings and the US economy, of course the link is tariffs. And do you get those exceptions? Do you see business sentiment continuing to plummet when it comes to the German industry section as a whole? And tie it back to China as well. BMW's profitability hurt by the Chinese demand hit as well.
BYD's doing really well. Kind of basically making life very difficult for everybody else in China at the moment. So you've got a tough market there. You've got a tough market in Europe because of the economic backdrop. You've got a tough market in the United States because of the tariff uncertainty. It's a tough place to be right now for an auto company. Are we close to kind of all the bad news being in the price, I guess, is the question many stock investors will be looking at this week. Let's talk about what else we're watching. What else we're watching this morning. President Donald Trump says he is negotiating with 4 different possible buyers for TikTok's US business, and that a deal for the social video app could come, quote, soon. He didn't specify the contenders nor say which way he is leaning. TikTok faces an April deadline to strike a deal for its US operations or be banned from the country under a bipartisan law passed last year. Almost all of Germany's airports face disruption today because of a strike by the labour union Verdi. Ground personnel, baggage handlers and security staff have all been urged to walk out as they demand higher pay and more holiday. And back to the political story, Elon Musk's Starlink is rapidly becoming a key flashpoint between Europe and the United States. Over the weekend, the billionaire warned Ukraine that, quote, the entire front line would collapse if I turned it off. Poland, which pays for Ukraine's access to the communication network, then responded with its foreign minister saying that his country may seek alternatives if Musk's company proves to be unreliable. There then followed a tense exchange on X that drew in the Secretary of State, Marco Rubio. Starlink is also proving to be an issue in Italy, with the FT reporting that President Sergio Mattarella is concerned about Rome's €1.5 billion security contract with Starlink. This is getting fascinating and multi-front, and there's a sort of multiple fronts that are emerging.
Absolutely, and this, of course, comes, and you kind of hinted at there as well, when so many of these European allies are talking about sharing intelligence as well, or lack thereof, with the United States at the same time. Now you take away Starlink as well. There is only one major satellite intelligence provider, and I think we had an interview last week with Eutelsat, if I'm saying that right, talking about trying to fill that gap. But how quickly is that even possible?
Yeah, and how much does it cost to do that? That's a difficulty as well. And also, you know, if you talk about all these other companies that are trying to compete with Elon Musk, you've got Airbus, Leonardo, Thales. You have to open up the Pandora's box that is European politics. You know, Germany isn't going to want to be left out of that, so it becomes even more difficult.
Yeah, so the League in Italy is already concerned about the fact that basically you've got a British-French company, Eutelsat, that could replace it. It's worried about that. Why would you want to go with the French when you could go with the Americans? So even within Italy, there's deep concern about what is happening and which direction we're going to be going in. But how many articles did you read over the weekend about European defence, the footprint that America has, the concern that is growing within Europe about the ability of the United States to turn off key pieces of technology? This is getting more and more concerning from a European perspective. The problem is, though, from a time point of view, we don't have enough to be able to fill the gap.
It's also interesting, and we bring it right back to Italy here, which is that Giorgia Meloni was supposed to be viewed as an ally and a friend of not just Elon Musk, of Donald Trump, but the voice at one point of Europe, perhaps, to the United States. She's making some real divisions in terms of that stance. Things like giving Ukraine NATO security without perhaps giving it membership, still providing that aid as well, and still very much investing in that defense story. So I think this is interesting. That's a relationship, I think, to watch as well.
We've got very excited about this European defense story very quickly. The Euro's rallied. European defence stocks have gone to the moon very, very fast. Is there a moment now where we pause and reflect on the reality, the difficulty of actually achieving some of these ends, and how quickly, in particular, some of these ends can be achieved? Europe has a very big hill to climb, and the slope is very, very steep in order to get where it needs to go.
And which country's flag will be at the top of that mountain. But coming up, we have plenty coming up on the programme. Washington announcing a crypto reserve, but markets are trying to make sense of it, and we're going to dig into the details of that. Plus, Germany searching for an identity after the latest leadership elections. We're going to have more on Bloomberg's deep dive story on the politics there. But up next, back to where market concerns over the US growth loom large. We'll discuss that next. But if you have any questions of your own for our guests, please do send them to us on IB plus BB TV Go. This is Bloomberg.
While there have been recent developments in some of these areas, especially trade policy, uncertainty around the changes and their likely effects remains high. As we parse the incoming information, we are focused on separating the signal from the noise as the outlook evolves. We do not need to be in a hurry, and we are well positioned to wait for greater clarity.
That was Friday. That was Jerome Powell speaking on behalf of the Fed, of course, talking about the fact that maybe the FOMC doesn't need to rush to adjust policy, despite some uncertainties that we are seeing. That feels like a long time ago, doesn't it? Since then, we've had President Trump talking about that recession risk. He was asked about it yesterday. He was maybe a little bit more equivocal when it came to the outlook for the US economy, short-term versus long-term. Let's talk about how this is all being reflected in market sentiment. Valerie's here to do just that.
On the market's mind is this growth risk narrative overblown when it comes to the move in the equity market and the move in the Treasury market? Yes, we had Trump again repeating that there might be a bumpy ride ahead for the U.S. economy. Scott Bessent, the Treasury Secretary, also mentioning there might be a detox period ahead on Friday. But we've heard these comments again repeated week after week. It's been 2 weeks running now. We've heard these dire forecasts. We've seen the S&P 500 drop 7% in that time frame, and a big rally into the Treasury market, and near 50 basis point move lower in Treasury yields. So is this move already priced in? That's the questions on markets' mind. Thankfully, on Friday, Jerome Powell himself didn't sound very downbeat on the U.S. economy. He said the U.S. economy is in a good place, and that helped the S&P 500 bounce from its 200-day moving average. We bounced pretty spectacularly from it, Guy, bouncing nearly 2% into the close on Friday. But again, these worries about the U.S. consumer, will we get any confirmation of it in the data this week? I don't really think so, Guy. The focus is going to be on the hard CPI data. Friday, we get the University of Michigan sentiment survey that might be the next kicker for these growth worries. But again, that is a soft consumer sentiment survey. We are yet to see any hard data when it comes to growth. A surprise on the downside.
Yeah, but the conversation is being had, isn't it? And the market can't quite figure out where we're going to go next and whether or not this administration is worried in the short term about that potential economic hiccup. Valerie, thank you very much indeed. Let's carry on the conversation. Isabel Mateos Ilago, Chief Economist at BNP Paribas, joining us now. Good morning.
Good morning, guys.
Short term, do we need to worry about growth in America?
I think so. I think so. There's a lot of uncertainty, policy uncertainty right now, and that's created a little bit of an air pocket. Now, starting from a level of activity, of economic strength, so there's some room for a wobble, but this is something the administration should keep an eye on. And the fact that they're messaging instead that, oh, no, this is nothing to worry about, there may be some temporary disturbance is a worry.
They're planning further down the road. They see a longer-term picture, maybe which is much more positive, but you've got to kind of wean the U.S. economy off government spending. How could that work? What is the effect of a reduction in government spending into the economic data? How do you think about, when you build your models, how do you think about what that number looks like and the effect that it can have?
Well, the problem is that's not the only thing that's going on, right? You've got the cut or the potential cut or the start of cuts in government spending and federal workforce, but you also have the tariff uncertainty.
Yep.
So in theory, you can cut government spending and be okay if at the same time you deregulate, you do all sorts of things that incentivize the private sector to consume and invest more.
But we're not getting that yet.
But we're not getting that. In fact, we're getting the opposite. We're getting a negative confidence shock from tariffs. And consumers are worried about unemployment. Consumers are worried about inflation. Inflation expectations are through the roof at a 30-year high. And so you're getting a negative confidence shock right now. And so you're cutting government spending and not replacing it with private spending. That's where you're getting these worries about recession coming from.
So the logic at the White House among the Trump administration is that the reason you're doing this volatility, the reason you're trying to negotiate, in theory, the approach is shaky, but the reason is ultimately to bring about tax cuts and to bring in the deficit. The deficit ceiling or the debt ceiling hits in July. How much of that is the bigger risk to the U.S. economy?
I think the risk is uncertainty, and you have to manage the private sector. People are not ultimately. You want households to consume and businesses to invest. And if you elevate uncertainty to such level that everybody is going to freeze in their place, you're going to create such a downwind, such a headwind that then you're going to have very little space left to do anything that you had planned to do. And in fact, you're going to hit that debt ceiling wall potentially even higher because the tax receipts are not going to come in, right?
Is that the case for an insurance cut at the Federal Reserve?
Not yet. I think you heard Jerome Powell. We all heard Jerome Powell on Friday. As I was saying, we're starting from a position of strength. The U.S. economy finished 2024 really with huge momentum. So there is a bit of margin. And separately, inflation is still too high. So, the Fed needs to weigh both risks. But, it used to be that they only needed to worry about inflation. And now we're back in a place where they need to keep an eye on both inflation and growth.
So, Isabel, Donald Trump was hanging over another central bank last week, the ECB. And, of course, we had another cut, but a lot of uncertainty over the April meeting. The big question, I feel now, is whether this fiscal boost, in terms of growth, outweighs the tariff threat. What's the answer for you?
Yeah, we didn't get a whole lot of guidance from Madame Lagarde on this, and rightly so, because these are two big unknowns. Like, in fact, we might get neither the fiscal boost nor the tariffs, or we might get both, or we might get them on a different timescale. So it's understandable that they wanted to leave all options open for the April meeting. What's a bit disconcerting is that, we've heard from Madame Lagarde, we'll be data dependent, and if the data warrants a cut, we'll cut, and if it doesn't, we won't. But we're very unlikely to get that much more clarity about the data between now and the April meeting. Okay, maybe there will be a tariff decision, but as we've seen, it might be undone within 48 hours, so that won't give us that much more clarity. And then on the fiscal side, okay, we'll have had a vote in the Bundestag, but how quickly is that spending going to come? We still don't know, so very open for the April meeting.
But so let's say it's the best case scenario and the tariffs are light or non-existent and you get this massive fiscal boost. You've still got all of the problems in Europe, the ageing workforce. Basically, does stagnation continue?
Yeah, so I think it's the mirror image of the U.S. a little bit. U.S., you're starting from a high level and you're having a lot of confidence activity indicators deteriorating. Europe, you're actually seeing a lot of green shoots in consumer confidence, business sentiment, investment, even manufacturing production, improving or deteriorating less, but still operating from a level that's below potential. So you've got really some room to go, and that has to factor in the ECB's thinking in terms of, do we keep cutting or not? Because you're not operating at full potential. There are structural drags, and so you would want to help that economy. But the good thing about the kind of fiscal boost that we're talking about in Germany in particular is that this really has the potential to improve long-term potential, not just a short-term boost.
OK, optimism. We thank you, Isabel Mateo-Silago, Chief Economist at BNP Paribas, but a lot of uncertainty to wade through in the meantime. Coming up, we'll talk Bitcoin, US President Donald Trump's strategic reserve, disappointing markets. That's next. This is Bloomberg.
Good morning from London. I'm Kriti Gupta alongside Guy Johnson and Lizzie Burden. We're an hour away from the opening trade. Here's what you need to know. President Donald Trump says the U.S. economy faces, quote, a period of transition, deflecting concerns about the risks of an economic slowdown. In Canada, Mark Carney wins the race to become the next prime minister, succeeding Justin Trudeau and inheriting a tariff war with the United States ahead of an election by October. And Beijing begins imposing tariffs today on farm products from the United States. It's the latest escalation of a trade war between the world's two largest economies. Lizzie.
Well, checking in on these markets, Kriti, and we have those US recession fears swirling, weighing on US futures, down 0.5%. But look at the European story. Futures higher 0.8%. This gap opening up, the two-year Treasury yield steady at 3.97%, but euro dollar higher at 108 handle. The countdown to the opening trade starts right now.
Monday the 10th. Good morning, folks. Are we talking about a recession in the United States? Are we there yet? Is it going to be a Trump session? That seems to be the talk of the moment, and US markets have been responding to it. Last week, big down week. We're starting off the week in a similar vein this morning. Markets feel fretful, worried, nervous, Kriti, as we go into this week.
Nervous and have been for a couple of months. And then you got a confirmation of those fears with the payrolls report, of course, coming in at about 151,000. The survey was 160. Now, that's not a massive gap if you think about it, but the fact that you're starting to see some of these concerns show up in the data, and you're seeing that globally. It's not just a U.S. story. You're seeing it in the Beige Book. You're seeing it, of course, in the various U.S. pieces, but you're also seeing it in Europe and in China.
Yeah, and when you look at the data and compare it with the stock market story, of course, there's more of a link in the US than there is elsewhere in the world, because you have this disproportionate share of US consumers buying US stocks. So when Scott Bessent, the US Treasury Secretary, says that Wall Street's had its turn, it's now time for Main Street, actually the two are more linked than elsewhere.
The commentary's amazing, isn't it? You've got Bessent talking about a detox, the fact that the US economy has been reliant on this sugar high coming out of government spending for too long. He's going to remove that. Trump's basically saying, I'm not worried about the stock market, don't care about it. That's not my vibe at the moment. I want to talk about kind of the 100-year plan. I want to talk about the longer-term plan. Wall Street's got to be worried at this point, looking at the commentary coming out. It is a story that has been driven higher and higher and higher on the back of government spending. If that's removed, that is a big pillar being taken away from the U.S. stock market.
So this was the Achilles heel of the Biden administration. They were looking at that 50-year kind of prospect and things like climate change, things like education, some of these policies, and then that's where they kind of lost the electorate. This is also coming where the timing couldn't be worse, in that so much of the economic resilience out of the United States that we've been talking about has been a question of savings, still savings coming from the COVID stimulus checks, some of the extra liquidity in the market. If you start to absorb all of that, they're not going to be able to absorb any sort of price hikes that are coming from corporations. And that's where the commentary I thought was interesting, is that if you talk about tariffs, corporations aren't absorbing any of it. They're passing it straight on to the consumer. They're not even willing to eliminate some of that.
So what happens next? Does this continue to drop? Does this market continue to go lower? I think that coming in on Monday morning, that feels like it is the narrative right now. And you've got a series of conflicts around the world. You mentioned China in the headlines, but let's talk a little bit about what's happening in Canada. Mark Carney is going to be the new Prime Minister. He's going to take over from Trudeau. I'm waiting for Lizzie to talk about unreliable boyfriends. I'm sure that commentary is going to come up at some point, formerly of the Bank of England and also of the Bank of Canada. The real question is, does Carney call an early election? The risk around this is that you leave a caretaker government in charge of a narrative that is really difficult to read with the United States. Or does he say, basically, the Liberals are actually coming back onto the front foot, and I need to take advantage of that, and I need to go now?
Yeah, because it shows that you really have to be in it to win it in politics. Just a few weeks ago, the commentary around Carney was, why would he even bother to do this when it could be a Liz Truss situation? And, the Conservatives are clearly going to win, commentators were saying. But given all of Trump's commentary on tariffs, the threats, but also the threats to make Canada the 51st state, that's actually worked in Carney's favour. And so it seems the polls suggest he actually has a chance at this point. You mentioned his time as the BOE governor. It does give me me PTSD because I can say this now. Mark Carney speaks in clauses that get ever smaller. It's very difficult when you're a print reporter covering Mark Carney. But the other thing to remember about him as BOE governor is that this is a man who's dealt with crisis. He has been through Brexit. He's been through the financial crisis. And so he might not have political experience, but perhaps this is where he steps up in terms of Canadian politics.
Absolutely. And let's bring it back to the markets here, because when we're talking about the digestion of some of those policies, you're already seeing it in lumber prices, for example. I'm having a bit of deja vu from when lumber prices soared off the inflationary story. You're also seeing it in oil prices, the idea that you are starting to have these kind of Canadian oil exports starting to be targeted potentially as well. And on top of that, not just a trade war with the United States, but a trade war potentially with China as well. Those agricultural products are now in question.
Yeah, so a trade war in two fronts, really. Notably as well, because we have to factor this into the inflation story, the latest Chinese data. So Chinese inflation dropping below zero for the first time in a year. And that confirming something that we already heard out of the NPC last week, with Beijing acknowledging that they needed to lower the inflation target because of these deflationary pressures. So really seeing this impact already in the markets in China, they just cannot shake off the bearish mood when it comes to oil.
They can't. So oil is lower. You've got a potential US recession. You've got China not recovering very quickly. Did you see what happened with property prices, property stocks today? Yeah. Down really hard once again. China's going to find it really hard to work its way out of this difficult economic story with just kind of technology as the driver. It needs those green shoots within the property sector to revitalise even further if it's going to deliver on this. So, yeah, metals are a factor. Commodities more broadly are a factor. Oil is lower. The signal coming out of that comes back to where we started, which is, are we heading for a recession? Even the Saudis are having to lower prices into Asia because they're worried about the growth prospects they're seeing at the moment.
Yeah, the OSP is certainly a great indicator of that. I think it's also crucial to mention here, though, is that even though we do see this weakness story in China, this deflationary story, how relevant is that signal for the rest of the world? Is this the moment where we start to see those fears around China exporting some of that deflation actually show up? So that's going to be something we monitor, of course, but it is certainly significant that we are now officially in that negative kind of data set when it comes to the China numbers. Let's talk about what's going on in Germany here, because we do have some German data that crossed the wire a couple of minutes ago. I want to walk you through some of these numbers because I'm seeing some positivity here, and that's not usually a word I use to describe Germany very often. Germany's January industrial production numbers falling 1.6% on a year-over-year basis. Now, the estimate was about 2.8% of a drop. So this is actually technically a positive number as well. The exports are, however, dropping on a monthly basis by about 2.5% as of January. The estimate was a gain of 0.5%. So a little bit of a mixed data set there as well. And I'm also seeing imports rising by about 1.2% on a month-over-month basis. The estimate also 0.5%. When you look at the euro, not much reaction there, but worth noting that a little bit of a mixed set, perhaps a hint of positivity.
I know, but you take that chart back another 2 or 3 days and you'll see the massive move that we've seen in the euro over the last few days. We'll get a technical take on that a little bit later on. Let's talk about who we've got on the show to walk us through all of this. Isabel Mateos Ilago, BNP's chief economist, is going to be joining us. Elsie Susi Watts, Global Digital Finance Executive Director. We're going to talk crypto there. William Hobbs, Barclays UK Wealth Management Head of Multi-Asset, going to be joining us. Do you buy this dip in US stocks? What are you doing with the bond market story? We'll get a take there. Plus, David Snedden, Snow Hill Consulting CEO and Chief Strategist, joining us to talk about what is happening within the markets from a technical point of view. Obviously, a lot of CTAs, etc., follow technicals, and it could be a good way of looking at the market right now. We'll get his take on what is happening there.
A perfect time to have that conversation, especially as we're looking down at a week full of data. Let me walk you through what's on the agenda for the entire week. On Monday, we do, of course, have the EU finance ministers meeting in Brussels. What kind of commentary do we have around the tariff story, but then also the deficit story, because that is still looming very much in the background as well, plus this kind of fiscal bazooka out of Germany. How reliable is the narrative we're hearing out of there? Then on Tuesday, we're going back to the data set in the States. U.S. job openings on Tuesday. Do we start to see those federal layoff numbers really show up there as well? Volkswagen earnings, we're going to continue that Germany story as well. And then on Wednesday, U.S. CPI, this is the big one. I'm looking at about I'm trying to find these numbers very quickly. I'm looking at a 4.28 on the 10-year. Do we see some major reaction in the back end of this week? Rheinmetall earnings as well, and the ECB is going to be on the tape as well. Thursday, U.S. PPI, and Friday, U.S. consumer sentiment, and then more German car earnings as well. BMW and Volkswagen this week. So what's more important here for Europe? Is it the data sets that we're getting out of the States, or is it the earnings story out of some of these German automakers?
I think the German automakers will be critical. We'll just see exactly kind of how difficult the narrative is for them. Is German industry going to be a beneficiary of the industrialization that we're going to see via the rearmament program? I don't know. Does that feed across into other areas of the German economy? We will watch. The number that actually, the data set that wasn't on there that I'm going to be watching out for is the NFIB numbers, which also come out this week. Small business, backbone of the US economy. What are they seeing right now in terms of, the inflation narrative, the growth narrative? Take a look at what is happening with small caps in the United States. They've been hit really hard recently. There's some more data that I think we're going to see the market focusing on this week. The CPI is going to be critical, clearly, but I think the NFIB read is going to be really important.
Yeah, also just to link the two, the German car earnings and the US economy, of course the link is tariffs. And do you get those exceptions? Do you see business sentiment continuing to plummet when it comes to the German industry section as a whole? And tie it back to China as well. BMW's profitability hurt by the Chinese demand hit as well.
BYD's doing really well. Kind of basically making life very difficult for everybody else in China at the moment. So you've got a tough market there. You've got a tough market in Europe because of the economic backdrop. You've got a tough market in the United States because of the tariff uncertainty. It's a tough place to be right now for an auto company. Are we close to kind of all the bad news being in the price, I guess, is the question many stock investors will be looking at this week. Let's talk about what else we're watching. What else we're watching this morning? President Donald Trump says he is negotiating with 4 different possible buyers for TikTok's US business, and that a deal for the social video app could come, quote, soon. He didn't specify the contenders nor say which way he is leaning. TikTok faces an April deadline to strike a deal for its US operations or be banned from the country under a bipartisan law passed last year. Almost all of Germany's airports face disruption today because of a strike by the labour union Verdi. Ground personnel, baggage handlers and security staff have all been urged to walk out as they demand higher pay and more holiday. And back to the political story, Elon Musk's Starlink is rapidly becoming a key flashpoint between Europe and the United States. Over the weekend, the billionaire warned Ukraine that, quote, the entire front line would collapse if I turned it off. Poland, which pays for Ukraine's access to the communication network, then responded with its foreign minister saying that his country may seek alternatives if Musk's company proves to be unreliable. There then followed a tense exchange on X that drew in the Secretary of State, Marco Rubio. Starlink is also proving to be an issue in Italy, with the FT reporting that President Sergio Mattarella is concerned about Rome's €1.5 billion security contract with Starlink. This is getting fascinating and multi-front, and there's a sort of multiple fronts that are emerging.
Absolutely, and this, of course, comes, and you kind of hinted at there as well, when so many of these European allies are talking about sharing intelligence as well, or lack thereof, with the United States at the same time. Now you take away Starlink as well. There is only one major satellite intelligence provider, and I think we had an interview last week with Eutelsat, if I'm saying that right, talking about trying to fill that gap. But how quickly is that even possible?
Yeah, and how much does it cost to do that? That's a difficulty as well. And also, you know, if you talk about all these other companies that are trying to compete with Elon Musk, you've got Airbus, Leonardo, Thales. You have to open up the Pandora's box that is European politics. You know, Germany isn't going to want to be left out of that, so it becomes even more difficult.
Yeah, so the League in Italy is already concerned about the fact that basically you've got a British-French company, Eutelsat, that could replace it. It's worried about that. Why would you want to go with the French when you could go with the Americans? So even within Italy, there's deep concern about what is happening and which direction we're going to be going in. But how many articles did you read over the weekend about European defence, the footprint that America has, the concern that is growing within Europe about the ability of the United States to turn off key pieces of technology? This is getting more and more concerning from a European perspective. The problem is, though, from a time point of view, we don't have enough to be able to fill the gap.
It's also interesting, and we bring it right back to Italy here, which is that Giorgia Meloni was supposed to be viewed as an ally and a friend of not just Elon Musk, of Donald Trump, but the voice at one point of Europe, perhaps, to the United States. She's making some real divisions in terms of that stance. Things like giving Ukraine NATO security without perhaps giving it membership, still providing that aid as well, and still very much investing in that defense story. So I think this is interesting. That's a relationship, I think, to watch as well.
We've got very excited about this European defense story very quickly. The Euro's rallied. European defence stocks have gone to the moon very, very fast. Is there a moment now where we pause and reflect on the reality, the difficulty of actually achieving some of these ends, and how quickly, in particular, some of these ends can be achieved? Europe has a very big hill to climb, and the slope is very, very steep in order to get where it needs to go.
And which country's flag will be at the top of that mountain. But coming up, we have plenty coming up on the programme. Washington announcing a crypto reserve, but markets are trying to make sense of it, and we're going to dig into the details of that. Plus, Germany searching for an identity after the latest leadership elections. We're going to have more on Bloomberg's deep dive story on the politics there. But up next, back to where market concerns over the US growth loom large. We'll discuss that next. But if you have any questions of your own for our guests, please do send them to us on IB plus BB TV Go. This is Bloomberg.
While there have been recent developments in some of these areas, especially trade policy, uncertainty around the changes and their likely effects remains high. As we parse the incoming information, we are focused on separating the signal from the noise as the outlook evolves. We do not need to be in a hurry, and we are well positioned to wait for greater clarity.
That was Friday. That was Jerome Powell speaking on behalf of the Fed, of course, talking about the fact that maybe the FOMC doesn't need to rush to adjust policy, despite some uncertainties that we are seeing. That feels like a long time ago, doesn't it? Since then, we've had President Trump talking about that recession risk. He was asked about it yesterday. He was maybe a little bit more equivocal when it came to the outlook for the US economy, short-term versus long-term. Let's talk about how this is all being reflected in market sentiment. Valerie's here to do just that.
On the market's mind is this growth risk narrative overblown when it comes to the move in the equity market and the move in the Treasury market? Yes, we had Trump again repeating that there might be a bumpy ride ahead for the U.S. economy. Scott Bessent, the Treasury Secretary, also mentioning there might be a detox period ahead on Friday. But we've heard these comments again repeated week after week. It's been 2 weeks running now. We've heard these dire forecasts. We've seen the S&P 500 drop 7% in that time frame, and a big rally into the Treasury market, and near 50 basis point move lower in Treasury yields. So is this move already priced in? That's the questions on markets' mind. Thankfully, on Friday, Jerome Powell himself didn't sound very downbeat on the U.S. economy. He said the U.S. economy is in a good place, and that helped the S&P 500 bounce from its 200-day moving average. We bounced pretty spectacularly from it, Guy, bouncing nearly 2% into the close on Friday. But again, these worries about the U.S. consumer, will we get any confirmation of it in the data this week? I don't really think so, Guy. The focus is going to be on the hard CPI data. Friday, we get the University of Michigan sentiment survey that might be the next kicker for these growth worries. But again, that is a soft consumer sentiment survey. We are yet to see any hard data when it comes to growth. A surprise on the downside.
Yeah, but the conversation is being had, isn't it? And the market can't quite figure out where we're going to go next and whether or not this administration is worried in the short term about that potential economic hiccup. Valerie, thank you very much indeed. Let's carry on the conversation. Isabel Mateos Ilago, Chief Economist at BNP Paribas, joining us now. Good morning.
Good morning, guys.
Short term, do we need to worry about growth in America?
I think so. I think so. There's a lot of uncertainty, policy uncertainty right now, and that's created a little bit of an air pocket. Now, starting from a level of activity, of economic strength, so there's some room for a wobble, but this is something the administration should keep an eye on. And the fact that they're messaging instead that, oh, no, this is nothing to worry about, there may be some temporary disturbance is a worry.
They're planning further down the road. They see a longer-term picture, maybe which is much more positive, but you've got to kind of wean the U.S. economy off government spending. How could that work? What is the effect of a reduction in government spending into the economic data? How do you think about, when you build your models, how do you think about what that number looks like and the effect that it can have?
Well, the problem is that's not the only thing that's going on, right? You've got the cut or the potential cut or the start of cuts in government spending and federal workforce, but you also have the tariff uncertainty.
Yep.
So in theory, you can cut government spending and be okay if at the same time you deregulate, you do all sorts of things that incentivize the private sector to consume and invest more.
But we're not getting that yet.
But we're not getting that. In fact, we're getting the opposite. We're getting a negative confidence shock from tariffs, and consumers are worried about unemployment. Consumers are worried about inflation. Inflation expectations are through the roof at a 30-year high. And so you're getting a negative confidence shock right now. And so you're cutting government spending and not replacing it with private spending. That's where you're getting these worries about recession coming from.
So the logic at the White House among the Trump administration is that the reason you're doing this volatility, the reason you're trying to negotiate, in theory, the approach is shaky, but the reason is ultimately to bring about tax cuts and to bring in the deficit. The deficit ceiling or the debt ceiling hits in July. How much of that is the bigger risk to the U.S. economy?
I think the risk is uncertainty, and you have to manage the private sector. People are not ultimately. You want households to consume and businesses to invest. And if you elevate uncertainty to such level that everybody is going to freeze in their place, you're going to create such a downwind, such a headwind that then you're going to have very little space left to do anything that you had planned to do. And in fact, you're going to hit that debt ceiling wall potentially even higher because the tax receipts are not going to come in, right?
Is that the case for an insurance cut at the Federal Reserve?
Not yet. I think you heard Jerome Powell. We all heard Jerome Powell on Friday. As I was saying, we're starting from a position of strength. The U.S. economy finished 2024 really with huge momentum. So there is a bit of margin. And separately, inflation is still too high. So, the Fed needs to weigh both risks. But, it used to be that they only needed to worry about inflation. And now we're back in a place where they need to keep an eye on both inflation and growth.
So, Isabel, Donald Trump was hanging over another central bank last week, the ECB. And, of course, we had another cut, but a lot of uncertainty over the April meeting. The big question, I feel now, is whether this fiscal boost, in terms of growth, outweighs the tariff threat. What's the answer for you?
Yeah, we didn't get a whole lot of guidance from Madame Lagarde on this, and rightly so, because these are two big unknowns. Like, in fact, we might get neither the fiscal boost nor the tariffs, or we might get both, or we might get them on a different timescale. So it's understandable that they wanted to leave all options open for the April meeting. What's a bit disconcerting is that, we've heard from Madame Lagarde, we'll be data dependent, and if the data warrants a cut, we'll cut, and if it doesn't, we won't. But we're very unlikely to get that much more clarity about the data between now and the April meeting. Okay, maybe there will be a tariff decision, but as we've seen, it might be undone within 48 hours, so that won't give us that much more clarity. And then on the fiscal side, okay, we'll have had a vote in the Bundestag, but how quickly is that spending going to come? We still don't know, so very open for the April meeting.
But so let's say it's the best case scenario and the tariffs are light or non-existent and you get this massive fiscal boost. You've still got all of the problems in Europe, the ageing workforce. Basically, does stagnation continue?
Yeah, so I think it's the mirror image of the U.S. a little bit. U.S., you're starting from a high level and you're having a lot of confidence activity indicators deteriorating. Europe, you're actually seeing a lot of green shoots in consumer confidence, business sentiment, investment, even manufacturing production, improving or deteriorating less, but still operating from a level that's below potential. So you've got really some room to go. And that has to factor in the ECB's thinking in terms of, do we keep cutting or not? Because you're not operating at full potential. There are structural drags, and so you would want to help that economy. But the good thing about the kind of fiscal boost that we're talking about in Germany in particular is that this really has the potential to improve long-term potential, not just a short-term boost.
OK, optimism. We thank you, Isabel Mateo-Silago, Chief Economist at BNP Paribas, but a lot of uncertainty to wade through in the meantime. Coming up, we'll talk Bitcoin, US President Donald Trump's strategic reserve, disappointing markets. That's next. This is Bloomberg.
Good morning from London. I'm Kriti Gupta alongside Guy Johnson and Lizzie Burden. We're an hour away from the opening trade. Here's what you need to know. President Donald Trump says the U.S. economy faces, quote, a period of transition, deflecting concerns about the risks of an economic slowdown. In Canada, Mark Carney wins the race to become the next prime minister, succeeding Justin Trudeau and inheriting a tariff war with the United States ahead of an election by October. And Beijing begins imposing tariffs today on farm products from the United States. It's the latest escalation of a trade war between the world's two largest economies. Lizzie.
Well, checking in on these markets, Kriti, and we have those US recession fears swirling, weighing on US futures, down 0.5%. But look at the European story. Futures higher 0.8%. This gap opening up, the 2-year Treasury yield steady at 3.97%, but euro dollar higher at 108 handle. The countdown to the opening trade starts right now.
Monday the 10th. Good morning, folks. Are we talking about a recession in the United States? Are we there yet? Is it going to be a Trump session? That seems to be the talk of the moment, and US markets have been responding to it. Last week, big down week. We're starting off the week in a similar vein this morning. Markets feel fretful, worried, nervous, Kriti, as we go into this week.
Nervous and have been for a couple of months. And then you got a confirmation of those fears with the payrolls report, of course, coming in at about 151,000. The survey was 160. Now, that's not a massive gap if you think about it, but the fact that you're starting to see some of these concerns show up in the data, and you're seeing that globally. It's not just a U.S. story. You're seeing it in the Beige Book. You're seeing it, of course, in the various U.S. pieces, but you're also seeing it in Europe and in China.
Yeah, and when you look at the data and compare it with the stock market story, of course, there's more of a link in the US than there is elsewhere in the world, because you have this disproportionate share of US consumers buying US stocks. So when Scott Bessent, the US Treasury Secretary, says that Wall Street's had its turn, it's now time for Main Street, actually the two are more linked than elsewhere.
The commentary's amazing, isn't it? You've got Bessent talking about a detox, the fact that the US economy has been reliant on this sugar high coming out of government spending for too long. He's going to remove that. Trump's basically saying, I'm not worried about the stock market, don't care about it. That's not my vibe at the moment. I want to talk about kind of the 100-year plan. I want to talk about the longer-term plan. Wall Street's got to be worried at this point, looking at the commentary coming out. It is a story that has been driven higher and higher and higher on the back of government spending. If that's removed, that is a big pillar being taken away from the U.S. stock market.
So this was the Achilles heel of the Biden administration. They were looking at that 50-year kind of prospect and things like climate change, things like education, some of these policies, and then that's where they kind of lost the electorate. This is also coming where the timing couldn't be worse, in that so much of the economic resilience out of the United States that we've been talking about has been a question of savings, still savings coming from the COVID stimulus checks, some of the extra liquidity in the market. If you start to absorb all of that, they're not going to be able to absorb any sort of price hikes that are coming from corporations. And that's where the commentary I thought was interesting, is that if you talk about tariffs, corporations aren't absorbing any of it. They're passing it straight on to the consumer. They're not even willing to eliminate some of that.
So what happens next? Does this continue to drop? Does this market continue to go lower? I think that coming in on Monday morning, that feels like it is the narrative right now. And you've got a series of conflicts around the world. You mentioned China in the headlines, but let's talk a little bit about what's happening in Canada. Mark Carney is going to be the new Prime Minister. He's going to take over from Trudeau. I'm waiting for Lizzie to talk about unreliable boyfriends. I'm sure that commentary is going to come up at some point, formerly of the Bank of England and also of the Bank of Canada. The real question is, does Carney call an early election? The risk around this is that you leave a caretaker government in charge of a narrative that is really difficult to read with the United States. Or does he say, basically, the Liberals are actually coming back onto the front foot and I need to take advantage of that and I need to go now?
Yeah, because it shows that you really have to be in it to win it in politics. Just a few weeks ago, the commentary around Carney was, why would he even bother to do this when it could be a Liz Truss situation? And, the Conservatives are clearly going to win, commentators were saying. But given all of Trump's commentary on tariffs, the threats, but also the threats to make Canada the 51st state, that's actually worked in Carney's favour. And so it seems the polls suggest he actually has a chance at this point.
Yeah.
You mentioned his time as the BOE governor. It does give me PTSD, because I can say this now. Mark Carney Carney speaks in clauses that get ever smaller. It's very difficult when you're a print reporter covering Mark Carney. But the other thing to remember about him as BOE governor is that this is a man who's dealt with crisis. He has been through Brexit. He's been through the financial crisis. And so he might not have political experience, but perhaps this is where he steps up in terms of Canadian politics.
Absolutely. And let's bring it back to the markets here, because when we're talking about the digestion of some of those policies, you're already seeing it in lumber prices, for example. I'm having a bit of deja vu from when lumber prices soared off the inflationary story. You're also seeing it in oil prices, the idea that you are starting to have these kind of Canadian oil exports starting to be targeted potentially as well. And on top of that, not just a trade war with the United States, but a trade war potentially with China as well. Those agricultural products are now in question.
Yeah, so a trade war in two fronts, really. Notably as well, because we have to factor this into the inflation story, the latest Chinese data. So Chinese inflation dropping below zero for the first time in a year. And that confirming something that we already heard out of the NPC last week, with Beijing acknowledging that they needed to lower the inflation target because of these deflationary pressures. So really seeing this impact already in the markets in China, they just cannot shake off the bearish mood when it comes to oil.
They can't. So oil is lower. You've got a potential US recession. You've got China not recovering very quickly. Did you see what happened with property prices, property stocks today? Yeah. Down really hard once again. China's going to find it really hard to work its way out of this difficult economic story with just kind of technology as the driver. It needs those green shoots within the property sector to revitalise even further if it's going to deliver on this. So, yeah, metals are a factor. Commodities more broadly are a factor. Oil is lower. The signal coming out of that comes back to where we started, which is, are we heading for a recession? Even the Saudis are having to lower prices into Asia because they're worried about the growth prospects they're seeing at the moment.
Yeah, the OSP is certainly a great indicator of that. I think it's also
News when you want it with Bloomberg News Now. I'm Stephen Carroll.
And I'm Caroline Hepker. A global stock rout has begun to show some signs of easing following a sharp sell-off on Wall Street as investors temper their bullish views on the US economy. US and European stock futures are pointing higher ahead of today's cash trading session. That's after the S&P 500 dropped by 2.7% on Monday. The Nasdaq 100 lost 3.8% and Tesla shares sank by 15%. Amy Wu-Silverman is equity derivatives strategist at RBC Capital Markets. She says there could be more losses to come.
So far, it's been relatively orderly, but there's only so many times you can say that as we go 1, 2, 3 standard deviations off in terms of drawdown. There is where I think it's going to be panic at the disco. We haven't gotten there yet, but, you know, as these levels climb, there will be unwinds and more uncertainty that triggers even more.
Amy Wu-Silverman speaking there as the latest moves mark an abrupt reversal for markets after the dominant driver for more than a decade had been the surprising resilience of the US economy, even as growth weakened elsewhere.
The bearish sentiment from traders comes as economists across Wall Street have been raising their odds for a US economic downturn. Citigroup has now joined others in downgrading its view on US equities, citing expectations of negative US data prints as part of its justification. Meanwhile, President Trump has refused to rule out the possibility of a recession in an interview over the weekend, saying instead the economy is in, quote, transition. Gina Martin Adams is the chief equity strategist for Bloomberg Intelligence.
Up until this weekend, it really was about a reset of expectations that were far too robust. I mean, this is something we started talking about in December. Our fair value models were detecting that inside the market, the S&P 500 was priced for greater than 20% earnings growth to emerge this year, which is a next to impossible task. This just doesn't happen unless you're bouncing out of recession.
Bloomberg's Gina Martin Adams there. President Trump is scheduled to meet with top business executives later today as they grapple with uncertainty about tariffs as well as the equity market sell-off.
US Secretary of State Marco Rubio will lead a meeting with top officials from Ukraine today in Saudi Arabia. The meeting is intended to help clarify what concessions might be possible in the push towards a ceasefire with Russia following a breakdown in relations between Washington and Kyiv. US National Security Advisor Michael Waltz is part of the American delegation attending those talks.
The president has been crystal clear, and he's been clear to all sides. The fighting has to stop. Both sides need to get to the table. But we think we're going to get things back on track, get the ceasefire in place, and drive peace home.
US National Security Advisor Michael Waltz speaking there. Sources have told Bloomberg that Russia is willing to discuss a temporary truce in Ukraine, provided there's progress towards a final peace settlement. However, there's been no public indication that Vladimir Putin is willing to compromise or that the US is pushing him to do so.
Germany's Green Party says they're ready to negotiate on the country's planned €500 billion spending package and are hoping for a deal by the end of this week. The party has demanded tougher fiscal guardrails around the spending in a standoff. Co-head of the Green Party, Franziska Brandner, was asked by Bloomberg if the party can resolve the talks with the incoming government by the end of the week.
I really hope so. I'm like, the situation is dire in Ukraine. We really need Europe to speed up its own defense spending, but we also need to realize that cybersecurity, there are new attacks on our security, and we need to be in a modern phase of security. And we need to make sure that we have all we need for our own country in terms of infrastructure.
Brandner's party support is needed to pass the financing package, which requires changes to Germany's constitution. The euro jumped to a session high against the dollar on her comments and is trading about 0.2% higher at 108.59.
Now to news here in the UK. A cargo ship has crashed into an oil tanker off the east coast of the UK in the worst maritime disaster that the country's seen in years. One person is missing and jet fuel has spilled after the container ship So Long collided with the Stena Immaculate in the North Sea. Christopher Parry, a former Rear Admiral and maritime risk expert, says that many questions need answering.
It shouldn't happen at all. Looking at the conditions, there doesn't seem to be a visibility problem, although there were some fog and mist around.
Both ships remain on fire. The Stena Immaculate was carrying roughly 220,000 barrels of jet fuel for the US Navy, but it's unclear how much has spilled, with UK Coast Guard saying an assessment is underway.
Those are your top stories on the markets. We're looking at Eurostoxx 50 futures now, 0.7 higher. DAX futures are 0.7 higher as well. On Wall Street after yesterday's sell-off, S&P E-minis are up by 0.2%, and the euro 0.3 stronger against the dollar now, 108.68. That's news when you want it with Bloomberg News Now. I'm Stephen Carroll.
I'm Caroline Hepker, and this is Bloomberg.
That reversal of fortunes, we're talking about U.S. stocks shedding about, $5 trillion in value. We have the NASDAQ down 5% and Dow 900 points low. I mean, how are you making sense of what we're seeing in the markets right now?
Well, I'm not joining the panic. The S&P 500 is down 8.6% from its February 19th peak. So it wasn't that far back that it actually hit a record high. And if you look at the 11 sectors of the S&P 500, only one of them, that's consumer discretionary, is actually in correction territory, which is pretty impressive considering that the Magnificent Seven are down 16% from the February 19th stock market high. So I think the market's actually held up remarkably well in the face of the major correction in the Magnificent Seven. And so I'm not giving up on American exceptionalism. I think what's happening is a lot of the technological innovations that have driven the Magnificent Seven are now actually benefiting the productivity of the S&P 493.
If U.S. exceptionalism is on pause, how long is this pause, you think?
I don't think it's going to be very long. I think right now we had some very overvalued Magnificent Seven stocks. They were selling at a forward PE of 30 a few weeks ago, and now they're down to 26, maybe 25. So we've had a significant correction in the valuation multiple, but these are still great companies. You know, a lot of them are cloud companies. There's still a tremendous demand for cloud, and that's only going to increase with artificial intelligence. So this idea that they're spending all this money on data centers and it's not necessary, I think that flies in the face of the fact that they've got tremendous demand from customers to do more computing on the cloud and more storage on the cloud.
The thing is, Ed, despite your optimism that, you know, U.S. exceptionalism is possibly on pause, there's data out there suggesting that the U.S. economy is weakening. That can be seen from the latest data. And of course, when you take a look at U.S. policy uncertainty, that is at the highest level in 25 years. So surely that may have an impact on sentiment.
Well, there's a really high noise to signal ratio in the economic data, just the way there is in the political realm these days. But for example, we all are familiar with the Atlanta Fed's tracking model for GDP, and that now shows a decline of about 2.5%. And that was after showing an increase of about 2.5% only a few days ago, actually. A lot of that had to do with this bizarre surge in imports during January, and everybody thought that was companies front-running tariffs. Some of that was what was happening, but they were also front-running tariffs on gold bars. I mean, there was a huge imports of gold bars during January, and that's not something that's going to be sustainable, or I think that's going to be reversed in February and March. Also, we had the coldest January since 1988. And as a result of that, retail sales declined sharply, as did overall consumer spending. And I think that's going to be reversed in February and March, and we'll see consumer spending make a nice comeback. And the same thing goes for employment. Employment growth did slow in January and February, but I think it's going to make a big comeback in March and April.
It does seem like investors are cutting exposure to U.S. stocks. Is this a buying opportunity if you're looking at a longer-term time frame, if your risk appetite is higher than most people? What are you doing right now?
Well, look, in my opinion, the jury's still out on whether these stimulus programs that the Chinese government has put together to boost consumption, and whether the German program to improve German industry, I think the jury really is out on whether these things are going to be successful. I mean, I think we know that given the American attitude towards defending Europe, that a lot of spending is going to go on defense, and I guess that can be stimulative, but it's not really going to make Europe suddenly an economic powerhouse. Europe really lacks a capital market that is as vibrant as the American capital market, that's constantly providing financing for new ventures, for new technologies. And China has a rapidly aging demographic profile, and I don't think they're going to be able to stimulate their consumers. So I think, yeah, the stock markets in Germany and China have had a nice run here, but I think they're going to kind of fizzle out once these realities come into better focus. And I think, meanwhile, the U.S. economy is going to turn out to be remarkably resilient in the face of what we're seeing as a lot of chaos and confusion coming out of Trump 2.0. But I think the economy handled the tightening of monetary policy in the U.S. remarkably well over the past 3 years, and I think that's going to continue to be the case. So I think there's tremendous value here in the Magnificent Seven and a lot of technology names, semiconductor names. I think those names are going to turn out to be good values. I think this is a buying opportunity and not a reason to panic out of U.S. stocks or to greatly change asset allocation away from the U.S. Towards either China, India, or Germany or France.
So, is Citi wrong? Citi downgraded the U.S., upgraded China to overweight.
Nobody's wrong in this business. Everybody has an opinion. That's all there is to it. You know, I mean, at the end of the day, the market tells you whether you're right or wrong. So nobody knows right now who's right, who's wrong. I guess we can come back in 6 months or 12 months or whatever time period. But look, China's been a frustrating market for a long, long time. It's been a tremendous underperformer for a long, long time. And I don't see that there's anything radically changing in that regard. And, you know, the Europeans just really totally botched up the transition, transition from fossil fuels to clean energy. The clean energy doesn't work. It's not reliable. They are going to be extremely dependent on natural gas from the United States. And they also have a geriatric population. And on top of all that, there's a lot of social tension between immigrants that just aren't really melting into the societies over there. So I'm not that impressed by what's going on over there. And you know, sure, they're going to spend more money, but I don't know that it's going to work.
News when you want it with Bloomberg News Now. I'm Tom Mackenzie.
And I'm Stephen Carroll.
A global stock rout has begun to show some signs of easing following a sharp sell-off on Wall Street as investors tempered their bullish views on the US economy. US and European stock futures pointing higher. In fact, you have, of course, European markets down now 0.1% on the stock 600. US futures, though, are pointing to very modest gains. That in the context, of course, of a NASDAQ 100 drop of almost 4% by the end of the close yesterday. Tesla plummeting 15%. Amy Wu-Silverman, equity derivatives strategist at RBC Capital Markets, says there could be more losses to come.
So far, it's been relatively orderly, but there's only so many times you can say that as we go 1, 2, 3 standard deviations off in terms of drawdown. There is going to be a period where I think it's going to be panic at the disco. We haven't gotten there yet, but, you know, as these levels climb, there will be unwinds and more uncertainty that triggers even more.
Amy Wu-Silverman speaking there as the latest moves mark an abrupt reversal for markets after the dominant driver for more than a decade had been the surprising resilience of the US economy, even as growth weakened overseas.
The bearish sentiment from traders comes as economists across Wall Street have been raising their odds for a US economic downturn. Citigroup has now joined others in downgrading its view on US equities, citing expectations of negative US data prints as part of its justification. In an interview over the weekend, President Trump refused to rule out the possibility of a recession, saying instead the economy is in, quote, transition. Gina Martin-Adams is Chief Equity Strategist for Bloomberg Intelligence.
Up until this weekend, it really was about a reset of expectations that were far too robust. I mean, this is something we started talking about in December. Our fair value models were detecting that inside the market, the S&P 500 was priced for greater than 20% earnings growth to emerge this year, which is a next to impossible task. This just doesn't happen unless you're bouncing out of recession.
Bloomberg's Gina Martin-Adams there. President Trump is scheduled to meet with top business executives later today as they grapple with uncertainty about tariffs as well as the equity market sell-off.
US Secretary of State Marco Rubio will lead a meeting with top officials from Ukraine today and Saudi Arabia. The meeting intended to help clarify what concessions might be possible in the push and towards a ceasefire with Russia, following a breakdown in relations, of course, between Washington and Kyiv. US National Security Advisor Michael Waltz is part of the American delegation attending the talks.
The president has been crystal clear, and he's been clear to all sides. The fighting has to stop. Both sides need to get to the table. But we think we're going to get things back on track, get the ceasefire in place, and drive peace home.
US National Security Advisor Michael Waltz speaking there. Sources have told Bloomberg that Russia is willing to discuss a temporary truce in Ukraine, provided there's progress towards a final peace settlement. However, there has been no public indication that Putin is willing to compromise or that the US is pushing him to do so.
Germany's Greens say they're ready to negotiate on the country's planned €500 billion defence and infrastructure package and are hoping for a deal by the end of this week. The party's co-head criticised the current proposal as very narrow, saying it didn't include support for Ukraine and offered too much room for the government to spend on other things. Green Party co-head Franziska Brandner was asked by Bloomberg's Tom McKenzie if they could do a deal with the incoming government by the end of the week.
I really hope so. I'm like, the situation is dire in Ukraine. We really need Europe to speed up its own defense spending, but we also need to realize that cybersecurity, there are new attacks on our security, that we need to be in a modern phase of security. And we need to make sure that we have all we need for our own country in terms of infrastructure.
Brandner's party support is needed to pass the financing package, which requires changes to Germany's constitution. The euro jumped to a session high against the dollar after those comments. It's currently trading 0.5% stronger at 108.91.
A cargo ship has crashed into an oil tanker on the UK's east coast in the worst maritime disaster the country has seen in years. One person is missing and jet fuel has spilled after the container ship So Long collided with the Stena Immaculate in the North Sea. Christopher Parry, a former Rear Admiral and maritime risk expert, says many questions need answering.
It shouldn't happen at all. Looking at the conditions, there doesn't seem to be a visibility problem, although there were some fog and mist around.
Both ships remain on fire. The Stena Immaculate was carrying roughly 220,000 barrels of jet fuel for the US Navy, but it's unclear how much has spilled, with the UK Coast Guard saying an assessment is underway.
Keir Starmer has reportedly backed up the Chancellor's plans to reform Britain's benefits system and cut costs. According to the BBC, the Prime Minister told a private meeting of his MPs that the UK's welfare system was indefensible and unfair. Bloomberg's James Wilcock has more.
The UK government has to find more money, but has ruled out raising taxes or borrowing more. So what are the options? The largest big-ticket spending items in the state's budget are social security, pensions and health. Senior figures, including the Work and Pensions Minister Liz Kendall and Chancellor Rachel Reeves, have started making very similar noises to the previous Conservative government, saying the welfare system encourages people to stay out of work and needs reform. As of January, 9.3 million people are economically inactive but of working age. So what's not clear now is how Prime Minister Keir Starmer convinces his backbench MPs to support what some fear might be a deeply unpopular policy with their core voters. In London, James Wilcock, Bloomberg Radio.
When you see a headline about UK economic data, it's likely to be around 7 a.m. London time after the Statistics Agency rejected calls for a change. Bloomberg's Ewan Potts has more.
Before the pandemic, UK economic data always came out at 9:30 a.m, a civilised time in the morning when traders had had a couple of coffees and, more importantly, the markets were open. But the statistics regulator says it's accepting arguments from the ONS that the current 7 a.m. arrangements serve the public good. The ONS also says its current website would struggle with all the extra traffic from moving the data back to 9:30. The regulator says it's looking forward to reviewing the timings at a later date. I'm Ewan Potts, always up early for Bloomberg Radio.
Those are your top stories. On the markets, we're looking at the Stock 600 now, down by 0.2%. The FTSE 100 is also 0.2 lower. The DAX in Frankfurt up by 0.2, and the euro 0.5% stronger against the dollar, 108.88. The Bloomberg Dollar Spot Index is 0.3 weaker this morning. That's news when you want it with Bloomberg News Now. I'm Stephen Carroll.
I'm Tom McKenzie, and this is Bloomberg.
Youth unemployment is an issue in all labor markets.
With the MPC closing this week, we were all awaiting fiscal stimulus, and it looks like they are going to be juicing the economy a little bit. They're going to raise the fiscal deficit target to GDP up to 4%. Hadn't seen that range in, 31 years. Are they doing enough?
Well, I think raising the fiscal deficit target by a percentage point is more for signaling purposes than anything else, because the truth is the real fiscal deficit, as calculated, for example, by the IMF, is something like 15 to 20%. It's much higher. So what that really means is that part of the fiscal deficit will be shifted away from the local governments towards the central government. But ultimately, it doesn't really tell us a lot about what they're going to do. I think this year will look a lot like last year. The really big question mark is trade. Last year, trade was great. If it's good again this year, it'll look very, very similar. If it's not good, and they're not able to raise consumption, which is their big goal, then we'll probably see a bigger fiscal deficit. We'll probably see more debt and more investment in infrastructure.
Well, what is the panacea for creating that domestic demand?
I think it's pretty simple. Budget constraints. I mean, you basically spend based on your income. If I want you to spend more, I've got to give you a bigger income. So if you raise the income share of ordinary Chinese, the consumption share will automatically go up.
Is that going to happen, though?
It's really tough for it to happen because a lot of people think that low income is just sort of an oversight or a bug in the system. But the low household share of GDP is fundamental to the way the economic model works. And it's the reason why Chinese manufacturing is so competitive. So if you fix one, you undermine the other. You can't really separate them.
From a historical standpoint, how do you see the evolution of protectionism coming on both sides? Obviously, from the trade front with the Donald Trump administration, now 20% tariffs on top of what was already in place. It's a symptom of something you told me, much deeper and longer lasting.
We see it too much sort of as a Trump-Xi thing. And I don't think it's that. I think, we're going to see it continue to spread. The imbalances that we have are the largest we've ever seen. As Keynes explained, these imbalances put downward pressure on global demand. And the countries that absorb that downward pressure have to respond either with higher unemployment or, much more likely, higher debt. And at some point, it's not sustainable, and you've got to reverse it. So we're going through, in my opinion, a major transformation, equivalent a bit to what happened in the 1970s or what happened in the 1930s, a big change in the way the world operates. Trade war is particularly painful for surplus countries. Remember, the biggest surplus country then was the United States, and it suffered most from the contraction in global trade. If you can't run surpluses and you can't raise the domestic demand, then you have to reduce production, which means firing workers, rising unemployment, like we saw in the U.S. in the 30s.
But they're not going to do that.
Well,
they're tightening their belt.
It depends what you mean by they're not going to do that. You cannot produce stuff if your home economy cannot absorb it and foreigners won't absorb it, right? You can produce for a while and just pile up inventory sky high, but at some point you simply run out of the ability to continue funneling resources into something you're not going to use. But demand and supply must balance. If you can't use external demand to balance your weak domestic demand, then you have to stop producing.
Where do you think we'll be in 5 years with the Chinese economy? Essentially, it's going to be going through a protracted trade war, and they have to also stimulate domestic demand. So where are we going to be in 5 years?
That's as much a political question as anything else. Growth will be much lower. I think growth expectations will also be much lower. Debt levels will be much higher, which is one of the reasons they'll have to constrain the growth in debt. But the real issue for me is whether they decide to go through a rapid adjustment, which means taking the losses and allocating them, or a slow adjustment. If I had to guess, I would say they would prefer a slow adjustment because it's socially less destabilizing.
Youth unemployment is an issue in all labor markets. That's why it's one of the major pillars of the conference. One of the difficult things in dealing with labor market that if you change anything, it takes years for us to be reflected. That's the right thing to do. Look at the future and prepare from now. If you have the best practices, the right data, well, you will be able to overcome any difficulties or challenges. I'm hopeful about the future of the labor market.
How much do you think AI is actually boosting businesses globally then?
Take the buyer as an example. So if we think about the search volume for the information or for a product, I think the search volume for the information part is 10 times than the products part. So think about it. If you want to start a business, you will not specifically go to a products or go to a kind of suppliers. You will come up with an idea like what's trending and what's the specific kind of textile you're going to use in your product. And then it's come up the big business plan, and then it's come to the products. So now using AI, have this kind of a multi-round dialogue kind of search. A lot of people now, it's more easy to do business online. And for the sellers, we see current our kind of for agent, these tools is already better than 60 or 70% of the seller if they are new on Alibaba.com in terms of the conversion rate for the customer engagement and for the product management.
But how many businesses, I think there's around 200,000 SMEs that are on the platform. How many businesses are actually using AI today?
So currently the weekly active sellers are more than 100,000. So it's more than half of the sellers is already equipped by this agent-based tools. And for the buyer side, actually, we launched the Axio from last November. Until now, there are accumulatively more than 1 million users is using Axio, using this AI-based powered search.
How much do you feel the competitive pressure on AI, given the amount of innovation that's coming from China?
Okay, so first of all, we think there's a lot we can do so far. For example, we talk about the reasoning models, but based on language. There's a lot on the multimodal stuff that we can do later on. Like you can base on anything, an image, a video, or a file that you uploaded the file that the reasoning model can help you to interpret and to execute upon. So all those kind of things, we still believe there's a huge space to grow and we can leverage the most. I mean, the models from Meta, from DeepSeek, from Ali Cloud, 同一千问. So all these models actually can help us to boost the capability of the applications that we believe application actually is a key here. And why we think we can do it here, we can do better than others, is not going to be a few tools that play for the people, answer the easy questions. It need to be highly integrated into the big scenarios. Like global trade is a $30 trillion business. I don't think of any other business is larger than this. So if we can apply AI in this business and helping a lot of SMBs, so who cannot participate in the global trade, but now they can. So I think this is a big success for us.
A lot of people are expecting industry consolidation or AI consolidation in China this coming year. How many winners do you see in the AI space in China?
So actually, for that part, I can only speak of my opinion. So if you ask this question in January 2025, I think nobody can anticipate that there's a company called DeepSeek. I think you ask this question in March, I don't think that anybody can anticipate what's going to happen in April as well. This industry is moving so fast, and a lot of people doing a lot of innovations. We just need to focus on what are the right problems we need to tackle. As people in this technology domain, I don't think anybody can anticipate what's going on for this year.
Last year, you spoke about expanding to the US. Are you still planning to do that?
Right. So US, actually, we have a team there. Actually, we work with Google, with Meta on the technology part, as well as with the user engagement as well. And also, we see a lot of kind of growth from US, since now we have global supplies in China, in Southeast Asia, in Europe as well. And we believe building a kind of global supplies with more resilient supply chain to help SMBs in Europe is still our strategy. And in the early of this year, we see the US orders, meaning the SMBs buying from Alibaba.com is still kind of 30% of growth. So I think it's very strong, and we'll keep investing on that.
Do you see that still being able to be replicated even if you've got a lot of trade uncertainties and tariffs that are rising?
I think so. So the first one is that we are providing a supply base all over the world. So now we have more than 10,000 of suppliers in Europe and also in Southeast Asia, in India and Pakistan as well. So we're not supplying the kind of product only in one country. Actually, it's a global supply. And the second is still demand and supply is the fundamental rules. So all the other kind of turbulence may impact in short term, but according to the current data, there are still a lot of people who is not penetrated by internet or digital. We believe there are going to be more and more people is using the platform technology to do their business. So that is not my kind of concern now.
We had the inflation figures that came out and they showed that really there's a concern building still around deflation within China, both in CPI, PPI, but you're dealing with businesses that are export oriented. So how are those businesses looking right now?
I think two things that I can share with you. So since the beginning of this year, the search index, both in China kind of search engine or also the social platforms. So searching Alibaba.com and global trading actually increased by 3 digits. It's like 118% of growth, which indicate that more and more people is interested to go global. And also the new sellers onboarded on Alibaba.com actually is growing very fast since last year. So we believe there's still a trend. And also one thing more that we can add to it is AI technology. So previously, many of the Taobao or Tmall suppliers, if you ask them, do you want to go global? I think the answer are all yes. But when they learn that they need to overcome the language, the time difference, the foreign exchange, custom clearance, all this stuff, then it's a little bit hesitant. So now all these layers is kind of is built on top of the new technology. And now we are lower the barrier for everyone to do this business. I think this is another angle that we impact and improve the kind of confidence for the suppliers.
This is the Asia Trade. I'm Paul Allen in Sydney, where markets have just opened.
I'm Heidi Stroud-Watts. The top stories this hour. Asian stocks are poised to slide after a sell-off in big tech fuels the Nasdaq's worst day since 2022. President Trump meeting with top executives this week amid recession concerns.
Washington and Beijing reportedly discussing a Trump-Xi summit that could take place in June.
And Alibaba.com's president tells us he sees more potential for AI applications, including in the company's global trade business.
This industry is moving so fast, and a lot of people doing a lot of innovations.
We'll take a look at this is how we ended up when it comes to the US session, and futures also looking pretty negative. We saw stocks just plunging on the growing anxiety that the combination of tariffs and government filings, as well as a number of other Trump administration policies, will torpedo US economic growth and bring about a recession. The Nasdaq 100 really being hit, wiping out more than $1 trillion in its worst sell-off since 2022. The S&P 500 is now on the verge of a correction. We have also seen treasuries rising there as well as these US this recession. Sort of angst and woes really sending investors fleeing for safeties. Really, markets are boosting bets that the Fed will be cutting more in fear of an economic slowdown. That's really starting as a narrative to take hold across broad risk assets there. Yields on that benchmark 10-year note down as much as 10 basis points to 4.2%. We saw the US stock market, of course, in the meantime, posting the worst day of the year. Take a look at how we're shaping up when it comes to commodities as well. US crude continuing to see that retreat. We're seeing oil falling to that 6-month low again on these demand side worries over weakening economic growth, both within the US and, of course, the global picture in terms of major economies that are about to be hit by trade tariffs. This is a picture then, not a very bright one when it comes to how we're shaping up for Asia. This is how we're opening just a couple of minutes into the start of that staggered open here in Australia. It's tough to sort of get a read, but we can certainly see the direction is broadly downwards. Asian stocks are generally expected to decline today after that sharp drop in the US there, and we are seeing a little bit of downside there in Sydney. Chicago Nikkei futures also pointed firmly to the downside. We're seeing equity benchmarks in Hong Kong as well looking to tumble by almost 2%. A slide is expected when it comes to the start of trading in Shanghai as well. Really, we're seeing this sort of a 3-week stretch of volatility, if you will, around the world. But it is interesting when it comes to volatility. We've sort of come down from the peak fear, if you will, that we've seen in the markets. So perhaps we could sort of, see a little bit of a turn, but certainly that fear greed indicator showing us that the current selling pressure is the strongest on record right now.
Yeah, let's get a little bit more on this. We're joined by Sam Stovall, Chief Investment Strategist at CFRA Research, joining us now. Sam, as Heidi said there, fear. What are the key words at the moment? I guess uncertainty is another one. If we take a look at this chart on the terminal, we can see that the Nasdaq's not just slipped 4%. Seeing the strongest selling pressure on record as fear grips the market. Is this entirely inspired by confusing trade policy, or are there other factors at play here as well?
Well, Paul, I think that the confusing trade policy has really sort of tipped over the first domino, and as a result, we then have additional questions about the earnings for the coming year. The market is still trading at fairly hefty valuations, more than 2 standard deviations above the mean over the last 20 years. And then also the concern is about the consumer, since they represent 70% of the U.S. GDP. If they then start hearing the word recession, they start closing their purses and wallets, and that ends up causing a concern for the consumer discretionary category. So it seems as if this has become a manufactured correction that has caused a lot of sectors to tumble.
So if it's a manufactured correction, could we say with any confidence that the floor is in here, or do you anticipate more selling to come?
I think that there probably will be some more selling. I believe that we probably could see the S&P 500 go down to 5,400, which was the support level seen back in September of 2024. That would be a 12% decline, so a mild correction, in my opinion, and that would probably be a good place in which the market could bounce. I typically say that stocks tend to pop after a drop. So I would not be surprised if we start to see some green by the end of this week.
So, Sam, that's the when part of the question, and I do wonder about the where, which is also the topic of our question of the day. Where are we going to see that potential equity bounce? Because at the moment we're seeing a lot of the skepticism play out when it comes to the sector leaders, right? Tech, consumer discretion, as you say. A lot of defensive, seeing sort of some interest now as well. Where do you see investors potentially buying that dip if and when it happens?
Well, when it does happen, I believe that usually what they do is rotate from first to worst, meaning investors tend to move away from the defensive consumer staples, healthcare, utility sectors, and into the groups that were the worst performers. Obviously, this time around, that's communication services, consumer discretionary, and tech. And should the bounce actually last for a while, traditionally what we find is that the bouncing off of the worst sectors tend to outperform the market by about 5 percentage points, and has done so 73% of the time going back to 1990.
Sam, there's a more compelling sort of argument potentially than ever to invest outside of the US, right? What do you make of the kind of fading US exceptionalism story and the fact that we're seeing that underperformance really in stark contrast to the outperformance in a lot of global markets? China is just one of them.
Exactly. Well, I think that reversion to the mean is starting to take place because the developed international markets as well as the emerging markets have underperformed the S&P 500 in 12 of the last 15 years. And right now, those groups are trading at double-digit discounts to their longer-term average relative PE ratios. So we're looking at areas of opportunity that had pretty much been ignored up until now.
All right, Sam Stovall, Chief Investment Strategist at CFRA Research. Thanks for joining us today with your insights. Well, something that could shift market sentiment. Any updates from President Trump's meeting with US business leaders this week? Let's get to our tech reporter, Annabelle Drawlers now. So, Belle, Trump is going to be meeting with tech executives. What are we expecting here?
Well, what we're expecting, or what we're hoping for, of course, is any sort of updates of exactly what's discussed in these meetings. We know that an event happened on Monday where President Trump met with the Technology CEO Council in the Roosevelt Room in the White House. But we also know from our reporting on the ground that all of Trump events ended up being closed door, and there's been no playback of this just yet. So it's unclear exactly what happened. But just to give some context, the Technology CEO Council is comprised of the IT industry's leading executives, essentially. It's an all-CEO membership. It's currently chaired by Steve Mollenkopf. He's, of course, the CEO of Qualcomm. He's been in this position since 2017. But it's the group that really advocates for the public policy positions on the issues that are critical to the US IT industry's continued growth. And so, of course, it's a very important point for this. We've seen, I mean, you're looking here at the wealth wipeout that we've seen for some of the richest in the US following President Trump's inauguration. But there's a lot of jitters that are feeding across the US tech industry. The worst day you were just discussing there for the NASDAQ going back to 2022. But clearly a lot of recessionary concerns on the horizon. Plus, you've got concerns around how exactly the geopolitical tensions between the US and China in particular are playing out. So that has happened. No details as yet. Of course, there's more meetings this week. And just to mention, President Trump is also expected to address top CEOs and Wall Street bank executives, but that is happening on Tuesday.
That's a very different narrative so far this year for Alibaba.
Yeah, it's been quite an exceptional run for the stock, and we know a lot of the drivers of that. I mean, Alibaba is of course, very domestically exposed, and so maybe a little bit more insulated from some of those geopolitical tensions. It's been successfully executing this turnaround strategy in its e-commerce operations under Jian Fan, and it's also been starting to really see the rewards of investing heavily in AI. Of course, in the latest earnings, the company pledged that it would be funneling even more money into this endeavor. But actually yesterday we had an exclusive interview with the president of Alibaba.com. Now, just to give some context, this is the B2B business, essentially, wholesale division of Alibaba. It sits within AIDC, but essentially a very internationally exposed business, very, of course, prone to any sort of tariff or trade tensions between the US and China, but also has been investing heavily in AI. And in an exclusive interview, I asked Kuo Zhang exactly who is likely to come out on top in the AI race in China. But, of course, it's always a little bit unclear. But take a listen.
In January 2025, I think nobody can anticipate that there's a company called DeepSeek. I think you asked this question in March. I don't think that anybody can anticipate what's going to happen in April as well, since this industry is moving so fast and a lot of people doing a lot of innovations. We just need to focus on what are the right problems we need to tackle.
Thanks so much. So, yeah, you just heard there Kuo Zhang essentially saying that who wins is very unclear at this point in time. But what is interesting and maybe a little bit different from what we see in the US so far, as well as this willingness of big Chinese tech companies to integrate offerings, for instance, from DeepSeek into their own AI product suite in order to essentially stay competitive.
Well, thanks, Annabelle Drawlers there. We do have more ahead on the Asia trade. This is Bloomberg. The US and China are reportedly discussing a potential summit between Donald Trump and Xi Jinping. That's according to the Wall Street Journal. Our China correspondent Min Min Lo joins us now from Beijing. So what do we know about this potential meeting?
Yeah, we're actually getting conflicting reports from various media. SEMP, for example, reporting that this summit could take place as soon as April. But Wall Street Journal is saying that this could be a so-called birthday summit, because if you're curious, President Xi's birthday is on June 15th, but Trump's birthday is on June 14th. So they're looking at potentially setting up a meeting in June. But of course, April is that deadline for that U.S. investigation into China's trade practices, which Trump had ordered, and that could be a basis for even further trade action. We know that China had been keen to start dialogue as soon as possible. That was what the Commerce Minister Wang Wentao had said at the press briefing last week. But a Chinese source, according to SEMP, had said that it's getting harder to engage with U.S. officials in this current administration compared to even during the Biden administration, because of all the changes happening in Washington. Some sources even saying that Washington officials aren't able to start any dialogue now because they can't articulate their China strategy at this point. And of course, the other question is where the two leaders will meet, because SEMP reporting that both sides are wanting the other party to travel to their country. Trump hoping the summit could be held in Mar-a-Lago in his estate in Florida, but Beijing hoping for a more formal summit. And of course, if you look at what happened to Zelensky in Washington, that public scolding there, anyone watching that will want to avoid a repeat of such a heated exchange. China wouldn't want to be seen as a supplicant of the U.S. as well. So perhaps the greater likelihood at this point, according to SEMP, is for Trump to travel to Beijing. But of course, also the climate is very different from 2017 when China last hosted President Trump during his first term in office. China had rolled out the red carpet, treated him to dinner to a meal in the Forbidden City. There was months before that trade war. The conditions and the atmosphere around the two sides, the relations between both sides is of course very different now.
Min Min, we've also got the National People's Congress wrapping up today, having its closing session. Can we expect to hear anything new?
Well, not quite. Today is just going to be a ceremony where the delegates would vote on some of the resolutions from the government work report. They will vote on the national and local budgets this year and the social and economic development plan for the year. But of course, it's known as a rubber stamp parliament. We expect near unanimous votes for most of these items that will be passed today. Normally in the past, we would expect to hear from the Premier who would hold a press conference. But since last year, that has been cancelled. We don't expect to be able to hear that from Premier Li Qiang this year. And that's a sign again of that consolidation of power that President Xi has accumulated over the years, and Premier Li being seen as someone with less free rein over the economy compared to some of his predecessors, because this used to be one of the only times that reporters get to pose direct questions to the Premier, but we're not likely to get this opportunity this year.
All right, Bloomberg's China correspondent Min Min Lo there. Well, US and Ukrainian officials are set to meet in Saudi Arabia on Tuesday to discuss possible concessions for a ceasefire with Russia. Bloomberg News editor John Honey joins us now for more. So, John, it appears both sides have moved on from that, shall we say, unproductive meeting in the White House. What's on the agenda today? What's going to be talked about? And I guess just as crucially, what isn't being talked about?
Yes, the American the American team, the American administration, has, at least in public, been taking a much more conciliatory tone than in the now notorious White House meeting between Donald Trump and President Zelensky. Marco Rubio, the Secretary of State who will be leading the American delegation in Saudi Arabia, has called this a listening session. However, at the same time, the Trump administration expects Ukraine to make some sort of commitment to diplomacy. What will officially at least not be on the agenda is the natural resources agreement, which Trump has asked Zelensky to ask the Ukrainians to sign, and that was what brought him to Washington for that Oval Office meeting.
So far, we've seen an indication of willingness from Russia, but there's no meeting that we know of that's been set up between the leaders. Do we know how smoothly that path will go, and also how much buy-in is going to be required from European partners?
Well, the second question first. The Secretary of State said that the Europeans would be involved in any final settlement. This after much concern, if not alarm, in European capitals over the exclusion of, say, France, Germany, other countries in the talks. At the same time, Steve Witkoff, who's Donald Trump's Middle East envoy, is making a second trip to Russia, where he will meet President Putin. But what the Russians are asking for, or what their input is going to be, is regarding the talks that are going on, that will be going on in Saudi Arabia, are as yet unknown.
All right, Bloomberg News editor John Hartney there. Thanks for joining us. Some of the other stories that we're following: Germany's Green Party has demanded tougher rules for defence spending, making a counter-offer in talks with the Conservatives and the Social Democrats. Chancellor-in-waiting Friedrich Merz needs the Greens' support to pass a financing package that requires changes to Germany's constitution. The package includes removing limits on raising debt for defence and setting up a $540 billion infrastructure fund. A cargo vessel collided with an oil tanker off the UK coast, spilling jet fuel from one of the most significant maritime disasters in the area for many years. One person is still missing from the container ship that crashed into the tanker, which, according to one estimate, was holding about 140,000 barrels of jet fuel at the time. A major support operation is now underway. The environmental impact still being assessed. Heidi.
Well, coming up next, we'll be talking AI in our exclusive interview with the Alibaba.com president, Guo Zhang. This is Bloomberg. Well, the head of Alibaba Group's original core business says the use of various AI applications are having a profound impact on the company. Alibaba.com's president Guo Zhang tells Bloomberg exclusively that its vendors are having an easier time finding new markets for their goods.
Take the buyer as an example. So if we think about the search volume for the information or for a product, I think the search volume for the information part is 10 times than the products part. So think about it. If you want to start a business, you will not specifically go to a products or go to a kind of suppliers. You will come up with an idea like what's trending and what's the specific kind of textile you're going to use in your product. And then it's come up the big business plan, and then it's come to the products. So now using AI, I have this kind of a multi-round dialogue kind of search. A lot of people now, it's more easy to do business online. And for the sellers, we see current our kind of for agent, these tools is already better than 60 or 70% of the seller if they are new on Alibaba.com in terms of the conversion rate for the customer engagement and for the product management.
But how many businesses, I think there's around 200,000 SMEs that are on the platform. How many businesses are actually using AI today?
So currently the weekly active sellers are more than 100,000. So it's more than half of the sellers is already equipped by this agent-based tools. And for the buyer side, actually we launched the Axio from last November. Until now, there are accumulating more than 1 million users is using Axio, using this AI-based powered search.
How much do you feel the competitive pressure on AI, given the amount of innovation that's coming from China?
Okay, so first of all, we think there's a lot we can do so far. For example, we talk about the reasoning models, but based on language. There's a lot on the multimodal stuff that we can do later on. Like you can base on anything, an image, a video, or a file that you uploaded the file that the reasoning model can help you to interpret and to execute upon. So all those kind of things, we still believe there's a huge space to grow and we can leverage the most. I mean, the models from Meta, from DeepSeek, from AliCloud, 同一千问. So all these models actually can help us to boost the capability of the applications, that we believe application actually is a key here. And why we think we can do it here, we can do better than others, is not going to be a few tools that play for the people answer the easy questions. It need to be highly integrated into the big scenarios. Like global trade is a $30 trillion US business. I don't think of any other business is larger than this. So if we can apply AI in this business and helping a lot of SMBs, so who cannot participate in the global trade, but now they can. So I think this is a big success for us.
A lot of people are expecting industry consolidation or AI consolidation in China this coming year. How many winners do you see in the AI space in China?
So actually, for that part, I can only speak of my opinion. So if you ask this question in January 2025, I think nobody can anticipate that there is a company called DeepSeek. I think you ask this question in March, I don't think that anybody can anticipate what's going to happen in April as well. This industry is moving so fast, and a lot of people doing a lot of innovations. We just need to focus on what are the right problems we need to tackle. As people in this technology domain, I don't think anybody can anticipate what's going on for this year.
Alibaba.com's president Ku Zhang speaking exclusively with Bloomberg's Annabelle Jewellers. All right, we have another chapter in the ongoing saga that is Star Entertainment. We are hearing from Star. It's confirmed that it's entered into an exclusivity and process deed with Salter Brothers Capital, and this is in response to media speculation in the Financial Review that there is a $750 million refinancing package in the works with Salter Brothers that would secure Star's long-term financial future. The question on everybody's lips, though, Heidi, is who's Salter Brothers?
Oh, I can help you out. They hold a significant portfolio when it comes to some of these high-end luxury hotel and accommodation assets, including the Bannisters Hotel. So they are the second biggest hotel owner at this point in Australia.
Getting some breaking news out of Australia. It is Westpac consumer confidence for the month of March, and a big jump here, rising 4% from a month earlier. That's the biggest increase since we've seen since November last year. Of course, in February, we did have the RBA cut the cash rate to 4.1%. Coincidence? Perhaps not. Consumer sentiment up 13.5% on year. A number of people who think it's a good time to buy a house now, that's up 4.3% on month as well. This is crucial for the RBA, in fact, because they did mention at that last meeting that they are assessing improved consumption, which could suggest the risk of inflationary pressure resuming. But a big jump there in consumer confidence. The reading, though, still in negative territory overall because it is below 100. Heidi.
Yeah, take a look at to see much of a reaction. Of course, it is broadly a down day after that. A big sell-off in the US overnight. We're seeing equities in this part of the world looking pretty sluggish today as well. This is a picture when it comes to FX. So that flight to safety that we saw, obviously involving treasuries, obviously involving the US dollar as well. The Bloomberg dollar index rising in the New York session, really part of that broader safety trade there. Dollar yen holding at that 146 level. We are looking at dollar yen really on the verge of potentially being oversold. 145 is that sort of level that we're looking at the moment. And dollar China also one to watch as well as we get that wrapping up of the MPC today, and the reporting that potentially we could see this leadership meeting being arranged between Presidents Trump and Xi. Also watching the euro at the moment as well, as some of the concerns over German funding or sort of agreement over funding for the rearmament effort is now being called a little bit into doubt, and that obviously had been such a big driver when it comes to both the euro and the European equity rally over the past couple of weeks.
Well, joining us now is Laura Fitzsimmons, Head of Australia Macro Sales at Deutsche Bank. Laura, thanks for joining us today. I just want to pick up on that theme around the dollar. I mean, we've got a yen now with a 146 handle, although there seems to be a floor in for the US dollar now. Are we stabilising here, or can you see more weakness to come?
Yeah, I think it's more selective going forward. I think broadly there was obviously a lot of subscription to the long dollar trade as we began Trump 2 administration, and a lot of those trades are all being unwound across asset classes, as we've seen. I think in terms of FX, I guess where we're focused at the moment is looking at, I guess, in terms of the equity sell-off that we have in the US, what are the best plays in terms of the FX land that we can look at here? We're taking the dollar leg out of it, and trades like Euro Swiss, for example, also CAD Swiss, essentially CAD Swiss potentially looking lower. But certainly the euro, as you mentioned, Heidi, it has been one over the last week, which has had a huge amount of attention. And being at Deutsche Bank, we've certainly been at the forefront of delivering our views around that. We're still very excited by the prospect. It will face, obviously, some hurdles to come over the month. And obviously from the legislature, we do need to, not rest on our laurels here. However, the base case is that the package will get through. So we are still very bullish from here, and thinking that it's clearly going to be a bright spot in an otherwise rather gloomy global outlook at this point, just given what's happening in the US.
Yeah, well, the bond market's sending some pretty clear signals on what it thinks is going to happen as well, suggesting that, let's not ignore the risk of a recession here. And if we take a look at this chart on the Bloomberg terminal, we've now got markets pricing in 3 Fed cuts for 2025. Although we heard from Jay Powell, he seems to be in no hurry to change policy. What's your view on where we end up with rates this year?
Yeah, it's obviously evolving quite quickly. Deutsche Bank began the year with looking for no further cuts from the Fed, and that was quite controversial at the time. And then it started to play out, particularly as tariffs tended to be seen as having more the inflationary impact. Now, when we heard from Chairman Powell over the weekend, I guess at least the hike was pushed aside, and I think that obviously allayed a lot of investors' concerns that might actually be a risk again. But now it's really about, how much of a clear run do they have at cutting rates again, and we don't think that that's something that's going to evolve in the very near term. It's still a risk for the remainder of the year, but certainly in terms of the March decision and in the very near term, as I said, we still feel that the uncertainty around tariffs and the inflationary impulse that comes from those will be enough to keep the Fed on the sidelines, particularly when they started the year obviously with much stronger growth. Fundamentally, the US was in great shape, and it's really now the noise and the uncertainty, consumer sentiment that's coming off, but obviously inflation expectations also increasing. So they have a lot to consider, and I think from that perspective, we think that on hold makes the most sense.
From a positioning point of view, as you say, uncertainty on US policy basically permeating every front in terms of risk. How much short-term is there in the market? Because we speak to a lot of money managers that are like, even 24 hours, is a very long time in this sort of news cycle.
Absolutely. I mean, the headline noise is hard for investors to deal with. And certainly in markets, I mean, it's something we've become used to. But right now, it's certainly at the peak of noise, we would say. And I think overall, for investors, I guess what I would be more concerned about when I think about the US is actually some of the more problematic things that President Trump will have to deal with. Obviously, the deficits was a huge focus heading into this administration. And so far, they've made a lot of noise about spending and Doge. And, essentially, though, if we are going to look at tax cuts being continued and certainly other cuts being delivered as well, and we're not really, when we look at the numbers, we're not seeing where that spending saving is really coming from. And so the numbers just don't quite stack up. And I think if they're already laying out a sort of a bumpy roadmap to get to these longer-term goals. If the longer-term goals are not that attainable, and actually by weakening the economy, you're compounding the problem, that's actually more of a concern, I would say, for investors. And maybe they're not thinking about that yet. It's a little bit too far down the line. But certainly I think that is what's maybe drawing into some question around owning US assets, whether that be bonds or equities or the US dollar.
It's not just the inflationary growth picture that gets impacted domestically, right? It's also every other economy, including Australia, that's hit by tariffs, by that relationship. And I do wonder, if you take a look at market pricing for the RBA at the moment, is it still too much of a one-way bet in terms of expectations?
It does seem that this market has particularly priced a lot more in terms of easing than maybe you would expect from the RBA, particularly when we heard that rhetoric from Governor Bullock and obviously Deputy Governor Hauser as well recently, striking a fairly hawkish tone for a central bank that's just cut. Now, in our forecast, we actually do have a total of 4 cuts at Deutsche Bank for the RBA this year, but the market is really, I think, more in the like I would say, thinking more that maybe 1 to 2 more might be delivered. I think the market pricing has generally erred, as I said, on the side of overpricing the cuts. And until we really start to see some weakness coming through, not just on the domestic spending side, but also I think once we get past some of the government spending, past the election, that might become a little bit more clearer. But for now, it's just hard to imagine the RBA shifting so soon again to cut rates once more. And I think they've pointed actually to Norway, and obviously we had a very strong CPI coming out from Norway overnight. Now, this is an economy that the RBA has actually drawn some parallels for Australia with. So I think it's worth us noting that they're still very alert to the risks that tariffs can cause on the inflation front. They don't feel like that fight is over yet, and I think we have to keep listening to them from that perspective.
Laura, really great to see you, particularly here with us in the studio. Laura Fitzsimmons, who's the head of Australian macro sales at Deutsche Bank. Well, China has set a fiscal deficit target of around 4% of GDP to counter the effects of rising US tariffs. We spoke with Michael Pettis. He's a senior associate at the Carnegie Endowment for International Peace about what comes next for the Chinese economy.
Raising the fiscal deficit target by a percentage point is more for signaling purposes than anything else, because the truth is the real fiscal deficit, as calculated, for example, by the IMF, is something like 15 to 20%. It's much higher. So what that really means is that part of the fiscal deficit will be shifted away from the local governments towards the central government. But ultimately, it doesn't really tell us a lot about what they're going to do. I think this year will look a lot like last year. The really big question mark is trade. Last year, trade was great. If it's good again this year, it'll look very, very similar. If it's not good, and they're not able to raise consumption, which is their big goal, then we'll probably see a bigger fiscal deficit. We'll probably see more debt and more investment in infrastructure.
Well, what is the panacea for creating that domestic demand?
I think it's pretty simple. Budget constraints. I mean, you basically spend based on your income. If I want you to spend more, I've got to give you a bigger income. So if you raise the income share of ordinary Chinese, the consumption share will automatically go up.
Is that going to happen, though?
It's really tough for it to happen because a lot of people think that low income is just sort of an oversight or a bug in the system. But the low household share of GDP is fundamental to the way the economic model works. And it's the reason why Chinese manufacturing is so competitive. So if you fix one, you undermine the other. You can't really separate them.
From a historical standpoint, how do you see the evolution of protectionism coming on both sides? Obviously, from the trade front with the Donald Trump administration, now 20% tariffs on top of what was already in place. It's a symptom of something you told me much deeper and longer lasting.
We see it too much sort of as a Trump Xi thing, and I don't think it's that. I think, we're going to see it continue to spread. The imbalances that we have are the largest we've ever seen. As Keynes explained, these imbalances put downward pressure on global demand. And the countries that absorb that downward pressure have to respond either with higher unemployment or, much more likely, higher debt. And at some point, it's not sustainable, and you've got to reverse it. So we're going through, in my opinion, a major transformation, equivalent a bit to what happened in the 1970s or what happened in the 1930s, a big change in the way the world operates. Trade war is particularly painful for surplus countries. Remember, the biggest surplus country then was the United States, and it suffered most from the contraction in global trade. If you can't run surpluses and you can't raise the domestic demand, then you have to reduce production, which means firing workers, rising unemployment.
Where do you think we'll be in 5 years with the Chinese economy? Essentially, it's going to be going through a protracted trade war, and they have to also stimulate domestic demand. So where are we going to be in 5 years?
That's as much a political question as anything else. Growth will be much lower. I think growth expectations will also be much lower. Debt levels will be much higher, which is one of the reasons they'll have to constrain the growth in debt. But the real issue for me is whether they decide to go through a rapid adjustment, which means taking the losses and allocating them, or a slow adjustment. If I had to guess, I would say they would prefer a slow adjustment because it's socially less destabilizing.
That's Carnegie Endowment for International Peace Senior Associate and Professor of Finance at Peking University's Michael Pettis speaking there with Bloomberg's Stephen Engel. All right, we have more ahead on the Asia trade. This is Bloomberg.
We'll be watching 7&I shares as we do just about every day. There's always something happening in this latest developments when trading in Japan starts in the next hour. Couche-Tard now saying that it will continue to keep pushing for a deal with the Japanese firm despite 7&I's own attempts to fend off a takeover. For more, let's bring up Bloomberg senior editor Reid Stevenson in Tokyo. So clearly there's still hope that perhaps this remains, one of the few options on the table for 7&I. What are we hearing from Couche-Tard right now?
Yeah, indeed. I mean, this statement from Couche-Tard this morning comes after a flurry of news over the past week. Last week we saw massive announcements by 7&I, new CEO, share buyback, the sale of its U.S. business, and on and on. Monday is when we saw sort of a new development where an activist investor in 7&I came out criticizing some of the steps it's taken in this sort of process where essentially, the company has been seeking to fend off this takeover proposal by the Canadian operator of Circle K stores by implementing steps. And then 7&I itself had yet another announcement yesterday saying that it had made proposals to Couche-Tard about resolving some of the potential antitrust issues in the U.S. And all of this essentially led up to now this morning, where we have Couche-Tard saying in a kind of long-winded fashion that it's still interested in 7&I, it's confident of the financing, and it's also has a clear path, in fact, toward resolving some of the potential U.S. antitrust issues, namely because, any deal between these two companies would mean that the number one and number two player in the U.S. are going to combine, creating a company with more than 20,000 convenience stores in North America, and really dwarfing the next competitor by, 7 to 8, 9 times. So that's where we're at this morning.
Reid, just looking over this media release from Couche-Tard, it's quite unusual in many respects. They're just ladling on the respect with a trowel. Is this part of the strategy here? Is charm and politeness?
I think you're absolutely right. Couche-Tard is actually very much aware of some of the potential sensitivities and concerns around any potential deal. That's why I think they've played sort of a slow game, so to speak. They've, displayed patience, and I think, this statement this morning suggests that they'll continue to do so in pursuit of a deal. What they made clear, for example, is that they did not want to cut jobs or really mess with the Japanese convenience store business of 7&I in any way. Really, that is the crown jewel. In fact, what they want to do is, take some of the best practices from that and really spread them into a sort of an international convenience store champion. Something that 7&I itself has said it wants to do, but hasn't quite executed, leading to a rather low or undervalued share price and attracting a lot of criticism, attention, as well as this buyout proposal.
All right, Bloomberg senior editor Reid Stevenson there in Tokyo. Let's take a look at how Tesla is doing at the last close. Not great. It was a horrible day for Tesla stock. Off 15%. That's the worst day since 2020. Year to date, down 45%. Tesla's wiped out all of the post-election gains, and concerns over sales, Heidi, just keep on growing. UBS has cut its forecast for deliveries for the first quarter and the full year, and registrations in Germany, we all know Elon Musk's relationship with that country, down 70% in the first 2 months of this year. It's had an impact on Elon Musk's wealth as well.
Yeah, and multiple ironies to this. One, of course, is the fact that Tesla gained 98% in the weeks following the election, expecting that it was going to be a bullish signal. And, of course, the fact his very significant role within this new administration, that drop of $185 billion in his net worth since the peak in December 17th, that is, as our very own David Inglis has worked out, the equivalent of Croatia's annual economic output. Sticking to tech, though, Apple preparing a major software overhaul to transform the interface of the iPhone, the iPad and the Mac. The update aims to change the look of operating systems and simplify navigation. For more on this Bloomberg scoop, let's bring in our technology reporter Mark Gurman. And Mark, as an Apple user, I kind of shirk away from these changes in formatting, in the way that the device looks. But what are we expecting?
This is a nice distraction from artificial intelligence woes that Apple has been facing, right? We're not expecting any big AI improvements this year, but we're expecting an entirely new look and feel. This is fundamental to how the devices will operate. These are the biggest changes to iOS, macOS, and iPadOS in many years. In the case of the Mac, a couple decades. In the case of the iPhone, about 15 years, right? So this is largely significant, and it's deeper than just cosmetic changes. It's not just about a new design. It's about how they look, how they feel, how you operate them, how you navigate through the operating system. App icons are going to change, menus are going to change, windows, buttons. So this is an end-to-end overhaul for Apple's biggest operating systems, and this is how users interact with the company's products, right? This is why people buy Apple products, because they get and they use and they like the intuitive user interfaces of the product. So this is a very big deal for Apple.
Well, nice try, but let's get back to that AI distraction. I mean, the update to Siri has been delayed. I mean, what is the hold up here, and when is that update coming?
ओके गाइस, इंडियन मार्केट होने वाला है क्लोज 330 होने वाला है. क्रूड ऑयल देखो रेजिस्टेंस पर है, यहाँ से एक सेलिंग का प्लान है. एंड नेचुरल गैस को देखोगे दो बार सपोर्ट पे आ चुका है, बाइंग चल रही है. वहाँ से थोड़ा सा ऊपर और आ जाता तो इसमें एक सेलिंग का प्लान हो जाता है यहाँ से वापस, कुछ इस तरीके से, या फिर ये सपोर्ट ही अब ब्रेक हो. बाकी इन लोगों ने बाई किया, थोड़ा ट्रेल कर लेना, ये कोई छोटा टारगेट नहीं है, टारगेट है ये. $398 के आसपास भी अगर आ जाता है, के आसपास भी आ जाए तो बढ़िया है. ऊपर आ जाए तो बढ़िया ही रहेगा, यहाँ तो बेस्ट सेलिंग है. अपर लेवल पे अप्रॉक्सीमेटली 403 के आसपास. थ्री 404 के आसपास सेलिंग तो बनेगी, और थोड़ा सा ऊपर और आता तो बेटर रहता. जिन लोगों ने बाई किया ट्रेल कर लो. टारगेट देखोगे तो थोड़ा सा बड़ा ही है ये ओवरऑल, अगर चेक करें तो. यहाँ तक अगर मैं पूरा चेक करूँ तो अप्रॉक्सीमेटली वही बनता है 16 पॉइंट का, तो डायरेक्टली इतना तो नहीं मूव करेगा. यहाँ तक भी मूव कर जाए तो बेटर है, क्योंकि अगर यहाँ से रिजेक्शन मिल जाए तो थोड़ा सा फिर सपोर्ट की इजीली ब्रेक होने के चांस हो जाएंगे. यहाँ से रिजेक्शन मिलता है अगर 404 के अराउंड, तो फिर थोड़ा सा नीचे सपोर्ट स्ट्रॉन्ग माना जाएगा. तो थोड़ा ट्रेल कर लेना, हाफ प्रॉफिट बुक करके देखते हैं ऊपर तक आता है नहीं आता है. ट्रेल करके रिमेनिंग क्वांटिटी देखते हैं. नीचे अभी भी सपोर्ट है, फिर नेक्स्ट सपोर्ट सीधा 368 के आसपास मिलेगा हमें. 367 के अराउंड, सॉरी. बाकी क्रूड ऑयल को देखोगे, क्रूड ऑयल क्रूड ऑयल भी अपने एक रेजिस्टेंस जोन पर ही है, यहाँ से एक सेलिंग का प्लान है 5818 से 5815 के बीच में, ज़्यादा ऊपर ना जाए बस। और नीचे फिर एक मेजर सपोर्ट 5690, बीच में भी एक सपोर्ट है बट वो 2-3 बार टेस्ट हो गया तो मैं उसको भी रिमूव मैंने वहाँ पर लगाया नहीं है। यहाँ पर अभी है, यहाँ पर ना, यहाँ पर भी एक सपोर्ट एरिया बट वो 2-3 बार टेस्ट हो गया तो मैंने वो नहीं मूव किया है, ध्यान रखना। और फिर एक ऊपर का रेजिस्टेंस वो 5940 950 वाला, वो भी कितने बार टेस्ट हो गया, ये तो 1 2 3 4 बार टेस्ट हो चुका है। और गिर सकता है क्या? देखो क्रूड ऑयल का भी ऐसे कह नहीं सकते, हाई टाइम फ्रेम पे मेजरली न्यूज़ के बेसिस पे मार्केट चल रहा है। बाकी एमसीएक्स का टाइमिंग चेंज है, 7:30 पर एक डेटा है, गोल्ड और सिल्वर को इम्पैक्ट करेगा डेटा। बाकी मुंबई सेशन ओपन ही है, लंदन सेशन 12:30 ओपन हो चुका था, न्यूयॉर्क सेशन 5:30 के अराउंड ओपन होगा अब। का ध्यान रखना, सपोर्ट पे ओपन इक्वल टू हाई पे बाय मत कर बैठना डायरेक्टली, और रेजिस्टेंस पे ओपन इक्वल टू लो पे सेल मत कर बैठना, ठीक है। बाकी बैंक निफ्टी को देखोगे, फ्यूचर में क्लोजिंग होने वाली है, 2-3 मिनट रह गए। गैप डाउन हुआ था, रिकवरी आई, साइडवेज चला गया, उसके बाद सेम सिनेरियो निफ्टी का था, गैप डाउन हुआ, बाइंग आई, रिकवरी अच्छी आई, साइडवेज नहीं गया। बट बैंक निफ्टी साइडवेज चला गया था, रिकवरी के बाद कंप्लीटली कुछ ज़्यादा ही अच्छा साइडवेज चला गया। बाकी ऊपर फ्यूचर के चार्ट में देखोगे तो रेजिस्टेंस है, नो डाउट अबाउट इट। पर आपको मिल जाएगा वैसे तो रेजिस्टेंस जोन पूरा ही है, बट 48,290 मेजर रेजिस्टेंस जोन। भी करते रहो गाइस, जिन लोगों ने लाइक नहीं किया, डोंट फॉरगेट टू लाइक द स्ट्रीम। बाकी क्रूड ऑयल का थोड़ा ध्यान रखना, टारगेट का पूरा बड़ा टारगेट वैसे है बट वो काफ़ी बड़ा टारगेट हो जाएगा, इतना बड़ा टारगेट डायरेक्टली अप्रोच नहीं कर सकते कि सीधा 130 पॉइंट गिर जाए। तो ट्रेलिंग एसएल का यूज़ करना वहाँ पे, ठीक है, यूज़ द ट्रेलिंग एसएल, हाफ हाफ टारगेट रख सकते हैं, सो दैट हाफ क्वांटिटी हाफ लेवल पे बुक करें देन ट्रेल करें। समझ में आया? आया कि नहीं आया समझ में? इसमें भी नहीं है। बाकी कल भी इम्पोर्टेंट डेटा है, कल सबसे ज़्यादा इम्पोर्टेंट डेटा है, तो कल का भी ध्यान रखना। टुमारो वेरी इम्पोर्टेंट डे। लाइक करना मत भूलना, कम ऑन, लाइक भी करते रहो सभी लोग। क्रूड में देखो टारगेट को कैसे नीचे रख सकते हैं। मोमेंटम हो जाए 530 तक, नहीं हुआ तो फिर 530 की कैंडल पे डिपेंड रहना पड़ेगा। बाकी देखो यूएस यूक्रेन और रशिया के बीच में ट्रूस अगर करा देता है तो वो भी एक लॉजिकली नेगेटिव न्यूज़ होनी चाहिए क्रूड ऑयल के लिए। उस पर भी नज़र रखना, कभी भी अगर न्यूज़ आई, स्टेटमेंट आया कि ट्रूस हो गया है, तो एक मेजर इम्पैक्ट फिर से क्रूड ऑयल पे हो सकता है, गोल्ड और सिल्वर के साथ साथ। इंडियन मार्केट क्लोज, बैंक निफ्टी ने आज परेशान कर दिया, साइडवे चला गया। लाइव भी करते रहो गाइस, 100 लाइक्स का टारगेट है। डोंट फॉरगेट टू लाइक द स्ट्रीम एंड सब्सक्राइब द चैनल। होली के दिन मार्केट क्लोज है क्या 14 को, या ओपन है मार्केट फ्राइडे के दिन? killed in biggest over Ukrainian drone attack on Moscow. ये एक एरिया रहेगा नीचे का फर्स्ट।
the world. And now, and now our neighbors want to take us.
Nos voisins veulent nous annexer.
No way. No way.
Mais pas du tout.
There's someone who's trying to do the opposite.
Qui essaie de faire
There's someone who's trying to
qui
weaken
essaie
our
d'affaiblir
economy.
notre économie.
Yeah. Donald Trump.
Donald Trump.
Donald Trump. And Donald Trump, as we know, has put, as the Prime Minister just said, unjustified tariffs on what we build, on what we sell, on how we make a living. He's attacking Canadian families, workers, and businesses, and we cannot let him succeed. And we won't. We won't. The Canadian government has rightly retaliated and is rightly retaliating with our own tariffs that will have maximum impact in the United States and minimum impact here in Canada. And my government will keep our tariffs on until the Americans show us respect. The Americans want our resources, our water, our land, our country. Think about it. If they succeeded, they would destroy our way of life. In America, healthcare is a big business. In Canada, it is a right. America is a melting pot. Canada is a mosaic. America is not Canada. And Canada never, ever will be part of America in any way, shape, or form.
While other AI stops at generating ideas, Manus delivers results. We see it as the next paradigm of human-machine collaboration, and potentially a glimpse into AGI.
That was co-founder and chief scientist of Manus AI, which has gone viral on social media on claims that it has launched the world's first so-called general AI agent. Let's get a little bit more about what some are calling China's next DeepSeek moment with our tech reporter, Annabelle Jewellers. Annabelle, tell us, who is behind Manus? Why is it causing such a stir?
Yeah, well, maybe we can start with why it's causing such a stir, because it was only released just a couple of days ago at the end of last week, and the access right now is really limited. So it's still in its beta phase, and so you can access it only by invitation. There's a Discord channel that you can follow as well. But what we know so far is that Manus works like a general AI agent. So it's important to make the distinction here between what Manus can do and a sort of everyday chatbot, because a chatbot like ChatGPT, for instance, is human-led. You put in the text prompts and then it gives you the answers.
Mm-hmm.
This is about taking it to a different level where essentially you have what's called agentic AI, and which was seen as one of the big trends in AI for 2025. But agentic AI is when the AI tool can act autonomously and it's able to make decisions based on the information that's available to it. So Manus on the website lays out a lot of different use cases for this, like analyzing financial statements, screening job applicants, even deciding or proposing where you should live based on your certain requirements in terms of how much you can spend, the kinds of facilities that you're looking for here. It's basically, it seems quite limitless at this point in time, and that is also why, again, it's causing such a hype online, as well as really where it's coming from. And we understand that it's made by a group of researchers in China, and so it again points to that really stiff competition between the US and China, who can be in the lead on AI, especially when Manus is saying it can outperform OpenAI's own advanced AI agent Deep Research.
Such a deep bench in China is one of the aspects, I think. What do we know right now about the limitations?
Well, the limitations, I think, generally go back to the access, because, as I said, it's in the beta phase. Yeah. So right now you can only access it by invitation. So you can submit a request on Manus and give a reason for it. So I've tried as a Bloomberg journalist to get access to it. But we do have a Discord channel as well, and they're putting out some invitation codes on that. It's jumped to around 150,000 followers. So again, the emphasis on that. But there's a lot of different glitches that people are pointing out online, things like Manus crashing, giving incorrect information. But as I said, it's still in that beta phase. It's not fully open to the public just yet. We still need to get more details. How exactly has this technology been developed? How much do you think AI is actually boosting businesses globally then?
Take the buyer as an example. So if we think about the search volume for the information or for a product, I think the search volume for the information part is 10 times than the products part. So think about it. If you want to start a business, you will not specifically go to a products or go to a kind of suppliers. You will come up with an idea like what's trending and what's the specific kind of textile you're going to use in your product. And then it's come up the big business plan, and then it's come to the products. So now using AI, have this kind of a multi-round dialogue kind of search. A lot of people now, it's more easy to do business online. And for the sellers, we see current our kind of for agent, these tools is already better than 60 or 70% of the seller if they are new on Alibaba.com in terms of the conversion rate for the customer engagement and for the product management.
But how many businesses, I think there's around 200,000 SMEs that are on the platform. How many businesses are actually using AI today?
So currently the weekly active sellers are more than 100,000. So it's more than half of the sellers is already equipped by this agent-based tools. And for the buyer side, actually, we launched the Axio from last November. Until now, there are accumulating more than 1 million users is using Axio, using this AI-based powered search.
How much do you feel the competitive pressure on AI, given the amount of innovation that's coming from China?
Okay, so first of all, we think there's a lot we can do so far. For example, we talk about the reasoning models, but based on language. There's a lot on the multimodal stuff that we can do later on. Like you can base on anything, an image, a video, or a file that you uploaded the file that the reasoning model can help you to interpret and to execute upon. So all those kind of things, we still believe there's a huge space to grow, and we can leverage the most. I mean, the models from Meta, from DeepSeek, from Ali Cloud, Tongyi Qianwen. So all these models actually can help us to boost the capability of the applications that we believe application actually is a key here. And why we think we can do it here, we can do better than others, is not going to be a few tools that play for the people, answer the easy questions. It need to be highly integrated into the big scenarios. Like global trade is a $30 trillion business. I don't think of any other business is larger than this. So if we can apply AI in this business and helping a lot of SMBs, so who cannot participate in the global trade, but now they can. So I think this is a big success for us.
A lot of people are expecting industry consolidation or AI consolidation in China this coming year. How many winners do you see in the AI space in China?
So actually, for that part, I can only speak of my opinion. So if you ask this question in January 2025, I think nobody can anticipate that there's a company called DeepSeek. I think you ask this question in March, I don't think that anybody can anticipate what's going to happen in April as well. This industry is moving so fast, and a lot of people doing a lot of innovations. We just need to focus on what are the right problems we need to tackle. As people in this technology domain, I don't think anybody can anticipate what's going on for this year.
Last year, you spoke about expanding to the US. Are you still planning to do that?
Right. So US, actually, we have a team here. Team there, actually, we work with Google, with Meta on the technology part, as well as with the user engagement as well. And also, we see a lot of kind of growth from US, since now we have global supplies in China, in Southeast Asia, in Europe as well. And we believe building a kind of global supplies with more resilient supply chain to help SMBs in Europe is still our strategy. And in the early of this year, we see the US orders, meaning the SMBs buying from Alibaba.com is still kind of 30% of growth. So I think it's very strong, and we'll keep investing on that.
Do you see that still being able to be replicated even if you've got a lot of trade uncertainties and tariffs that are rising?
I think so. So the first one is that we are providing a supply base all over the world. So now we have more than 10,000 of suppliers in Europe and also in Southeast Asia, in India and Pakistan as well. So we're not supplying the kind of product only in one country. Actually, it's a global supply. And the second is still demand and supply is the fundamental rules. So all the other kind of turbulence may impact in short term, but according to the current data, there are still a lot of people who is not penetrated by internet or digital. We believe there are going to be more and more people using the platform technology to do their business. So that is not my kind of concern now.
We had the inflation figures that came out, and they showed that really there's a concern building still around deflation within China, both in CPI, PPI, but you're dealing with businesses that are export oriented. So how are those businesses looking right now?
I think two things that I can share with you. So since the beginning of this year, the search index, both in China kind of search engine, also the social platforms. So searching Alibaba.com and global trading actually increased by 3 digits. It's like 118% of growth, which indicate that more and more people is interested to go global. And also the new sellers onboarded on Alibaba.com actually is growing very fast since last year. So we believe there's still a trend. And also one thing more that we can add to it is AI technology. So previously, many of the Taobao or Tmall suppliers, if you ask them, do you want to go global? I think the answer are all yes. But when they learn that they need to overcome the language, the time difference, the foreign exchange, custom clearance, all this stuff, then it's a little bit hesitant. So now all these layers is kind of is built on top of the new technology. And now we are lower the barrier for everyone to do this business. I think this is another angle that we impact and improve the kind of confidence for the suppliers.
Donald Trump always said he wanted to drain the swamp.
We're going to clean out the Washington swamp. I never knew it was this deep.
It's a catchphrase to describe what he claims afflicts Washington. But unlike the beginning of his first term, this time he has taken swift action. And he knows just the guy to help.
Elon Musk, Doge. Perhaps you've heard of it.
The Trump administration is allowing a private citizen to kind of have the keys and to do all of this while Congress is basically letting it happen and the judiciary is struggling to keep up.
We do need to delete entire agencies.
To do this, Elon Musk and members of his so-called Department of Government Efficiency, or DOGE, have been embedding themselves across the United States government.
Department of Education, Department of Energy, USAID, Department of the Treasury, Department of Defense, Social Security, you name it, they are there.
Musk has kind of been approaching all of this with a lot of glee. He's joked about being the Bobs from Office Space.
What would you say you do here?
The idea of cutting the federal budget, I think, is something that a lot of people, left or right, can get on board with.
The people voted for major government reform.
But there's a lot of question about whether Elon actually knows the ins and outs of these agencies enough to make these cuts, or if he's simply going in with a chainsaw.
I actually just call myself a humble tech support here.
This feels a lot like private equity going into a new company. You look at the books, you sell distressed assets.
This disruption is all part of the plan. This is how Elon Musk runs his companies.
But the federal government is going to run and operate in a very different way than a rocket ship company.
So what are the consequences, intended or otherwise, of trying to turn the federal government into a startup? And is that what Trump and Musk really want? It all started with a meme.
The word Doge comes from this internet meme that Elon Musk is quite fond of. And so when he proposed this idea for a government cost-cutting agency, he created Doge as a backronym for Department of Government Efficiency.
Doge has effectively replaced an agency called the U.S. Digital Service, set up by President Barack Obama to modernize how the government uses technology. Now, Elon Musk says he wants to do that and a whole lot more.
Musk's whole theory is that we have inflation and high interest rates because the government overspent and we're in a deficit. So if they can really rein in spending and drop interest rates, that will help American consumers.
If we don't do this, America will go bankrupt.
They're looking for examples of what they call waste, fraud, and abuse.
Musk promised when he was on the campaign $2 trillion in budget cuts, at least.
I think we can do at least $2 trillion.
Yeah! He later backtracked to say we've got a good shot at getting $1 trillion in cuts. But even that would be quite a feat. Here's the problem. While the national debt has been rising for years, interest payments on U.S. debt have now climbed to its highest level since the 1990s. In the last fiscal year, the U.S. Treasury Department spent $882 billion on net interest payments, roughly $2.4 billion a day. So far, Doge's cuts don't hold a candle to those kinds of numbers.
When you look at what he's actually cutting, it is not much.
Doge started to put online a list of canceled contracts, canceled leases that they say ended up somewhere in the neighborhood of $55 billion, but it didn't take long for people to really look at the details of what they said were cut and find duplicate cuts, typos, miscalculations.
In one line item, Doge mistakenly reported an $8 billion savings from a canceled contract, which turned out to be an $8 million, not billion-dollar contract. With Musk at the top, he has mainly young men with tech backgrounds under him, but there are also some longtime Musk loyalists, like Steve Davis. Their approach has been to disregard norms and in some cases, allegedly laws, about how federal agencies operate, especially regarding personnel and data.
Is anybody unhappy with Elon? If you are, we'll throw him out of here.
Doge came in without really a very clear understanding of who works for the federal government, where, and what they do.
Both Trump and Musk have cited false allegations of fraud and waste to justify mass firings across federal agencies. Some hasty moves have already led to embarrassing and potentially dangerous reversals.
Doge helped to fire or lay off roughly 350 people at the National Nuclear Security Administration. A lot of those people have very important jobs safeguarding the nation's nuclear weapons, and now some of them are being hired back.
We will make mistakes, but we'll act quickly to correct any mistakes.
So far, tens of thousands of federal employees have either been fired, resigned, or taken Musk's buyout offer since Trump's inauguration, a number that's expected to keep climbing in the weeks and months ahead.
Elon Musk has a playbook for starting and turning around companies, and that playbook involves massive layoffs and essentially just sowing chaos within the workforce.
In Silicon Valley, you always hear move fast and break things, and sometimes things do break. In his companies, Musk has often made decisions and then had to overcorrect.
Elon has this tendency to take what he thinks worked in one corner of his world or universe and try to replicate that other places. When he took over Twitter, he immediately wanted to run it like a pure engineering company in much the same way he maybe runs Tesla or SpaceX. After he had already laid off about 50% of staff, he sent this email to employees with the subject line, "Fork in the Road." He basically gave employees a little more than 24 hours to decide, do they want to be part of this new Twitter or not? And about more than 1,000 people ultimately said, this isn't for me, and they opted out.
Very early in the Trump administration, he sent out this email, subject line, "A fork in the road," and it was basically asking people to sort of commit to this new way of doing things or get out.
The consequences for how he handled the Twitter takeover are still happening. He laid off thousands of employees who are still suing him. He ultimately fired people that they had to try to hire back.
Musk's experience in the private sector is if he lays off too many people, he can just hire a few back. That might be a little bit harder to do in the federal government.
And there's a valid fear that the rash quick, fast decisions he's making at the US government could similarly lead to a lot of consequences down the line.
Meanwhile, Congress, which has the power of the purse under the US Constitution, has been mostly silent.
And that's because Republicans control both houses of Congress.
You've seen a lot of lawsuits on behalf of federal workers filed by unions and other advocacy groups, but DOGE is moving faster than them.
Despite the judiciary's slow-moving nature, some cuts have already been challenged as illegal, unconstitutional, or a breach of contract, and more lawsuits are sure to follow.
The government has agreed to spend money. It's in a contract with these groups. It can't just take the money away. There are going to be lawsuits.
With the Supreme Court already involved in some cases, legal observers contend that Trump's ultimate goal here is to give the Republican-appointed supermajority a chance to further expand executive power in his favor. In fact, Trump's current director of the Office of Management and Budget, Russell Vought, is an author of Project 2025, a plan to expand executive power, slash federal budgets, and weaken regulatory oversight.
I'm not sure that Elon Musk has read Project 2025, but nevertheless, a lot of parts of Project 2025 are coming to fruition through Doge.
Russ Vought and the OMB and Project 2025 and then Doge, they're sort of running on parallel tracks, but I think they have similar missions.
The overall goal here with the Doge team is to help address the enormous deficit. It's not an optional thing, it is an essential thing. That's the reason I'm here.
Despite Musk's purported benevolence, he and his multi-billion-dollar empire stand to gain a great deal from paring down the federal government, and the potential for conflicts of interest are everywhere.
SpaceX is regulated by the FAA, for example, and is a huge government contractor at both the Pentagon and with NASA.
Is he really the best person to decide if, say, Boeing or Lockheed Martin, which are both SpaceX competitors, should have contracts?
He owns a car company, Tesla, that the National Highway Safety Traffic Administration regulates to make sure that these autonomous vehicles that he's trying to develop don't run over people.
At least 5 inspector generals that were looking into Elon Musk's companies were fired by the Trump-Musk administration. These inspector generals, who are independent, protected by law.
Musk claims that his transparency allows the public to call out any of these conflicts.
It's not like I think I can get away with something. I'll be scrutinized nonstop.
But the official White House response leaves it up to him.
The president was already asked and answered this question this week, and he said if Elon Musk comes across a conflict of interest with the contracts and the funding that Doge is overseeing, then Elon will excuse himself from those contracts.
The fact that the White House is saying that he will self-police any potential conflicts is a conflict in and of itself.
Just last year, Elon Musk was promised $3 billion from close to 100 contracts with the federal government.
While first it was Twitter employees and then federal civil servants, America as a whole is now facing that fork in the road.
The best case scenario, Doge goes in, it makes it more efficient, and somehow it turns the civil service into the government equivalent of Tesla. The worst case scenario is Twitter, where it's super great for Elon Musk, but along the way, there's a lot of damage to the original business, which is operating the military, feeding the poor, paying out your Social Security. That all kind of falls by the wayside. Those two possibilities, that is a fork in the road that all of us face.
And it's time now for the Wall Street Beat. Millennium is said to have lost about $900 million so far this year from 2 teams focused on index rebalancing, a strategy that's been recently upended by global stock market volatility. Bloomberg hedge fund reporter Nishant Kumar has more on the scoop. And Nish, this usually reliable strategy goes like this. You buy stocks that are entering major indexes, you sell stocks that are exiting them. And this has become wildly popular. So does Millennium's pain signal much more trouble for others, given how popular the strategy has become?
Well, educated guess, yes, though I can't confirm any names yet. Look, last time when it happened, when this trade really imploded, was in 2022. And the pain was across hedge funds, and multiple teams and portfolio managers left as a result. Exodus Point then dialed back nearly all its risk-taking in index rebalancing. But likes of 0.72, Millennium, Baleaz, Citadel, you name it. And many of the hedge funds saw their portfolio managers specializing in this trade leave then. So we cannot rule out that this trade is not affecting others. For sure they are.
There's been a lot more volatility in these markets. Katie recently explained to me what risk parity is, so I feel like I know a little bit more about hedge fund strategies. Don't these kind of investors, they're the masters of the universe, right? The smartest people in the room typically make more money in volatile times, or do they make more money in times of stability?
Yeah, I mean, there are strategies that make more money in volatile times, but this is not one of them. It's a very leveraged, large bet. And when you have a sell-off like this, these traders are bound to, some traders are bound to cut out. Like Glenn Schonberg is one of the biggest names. He's the index rebalancing king of the hedge fund world. This strategy is a big portion of Millennium's risk-taking. And Glenn has made billions of dollars over the years for Millennium. 900 million between two parts is large, and but going back to his track record, like he has made many times more than this. So, I mean, we can question the commoditization of this strategy, but then traders like him and others always find different ways to tweak this strategy, keep on improving, to avoid that alpha decay that we are seeing in the more commoditized form of index rebalancing.
Nish.
This is the Asia Trade. I'm Paul Allen in Sydney. The top stories this hour. President Trump warns the U.S. economy faces a transition period as its focus on tariffs cause market turmoil. He also declines to predict if the U.S. will slide into a recession this year. Former Bank of Canada and Bank of England Governor Mark Carney wins the race to become Canada's next Prime Minister. And China's February inflation declines below zero for the first time in a year, highlighting Beijing's challenge to boost consumption. All right, plenty going on in markets this week. Well, at the end of last week, we saw U.S. stocks close higher, but the U.S. was in fact the world's worst performing market last week amid all the trades and tariff upheaval. And it was only a month ago that we had the S&P at record highs. Futures showing us setting up for another week open in the U.S. later on. NASDAQ futures off by almost 1%. Take a look at bond futures as well. We've really got traders piling into short-dated treasuries. The two-year yield was down pretty sharply. We see 10-year bond futures there pointing upwards, though, by a third of 1%. But the yield curve's been steepening overall. We've got the market now betting on 3 rate cuts this year from the Fed as concerns about growth now increase. TD Securities had some rather colourful language on this, saying sentiment shifted from exuberance about growth to despair. President Trump, meanwhile, saying the economy is in a period of transition. Take a look at oil prices as well, holding above $70 per barrel as production increases. It'll be interesting to watch that. Nikkei futures sitting up for a little bit of softness ahead of the open there. We still have a strong yen, relatively speaking, or is it a weak dollar? We've got the Bloomberg Dollar Spot Index now at its lowest since early November, so the yen hovering around 147 there. The Aussie also showing a little bit of softness, 63 cents. Okay, President Trump says the U.S. economy does face a period of transition, as I mentioned, deflecting concerns about the risks of a U.S. slowdown. Trump's administration is arguing that tax cuts and tariff revenue will spur the economy, despite market turmoil caused by the policies. Meanwhile, U.S. Commerce Secretary Howard Lutnick expects a 25% tariff on steel and aluminium products or imports to take effect on Wednesday as planned. We'll see. Former Bank of Canada and Bank of England Governor Mark Carney, meanwhile, has won the race to become Canada's next Prime Minister. He says retaliatory levies against the US are going to stay in place until Trump drops his tariffs. Bloomberg's Ottawa Bureau Chief Laura Kane joins us now. So, the realisation of a long-held dream there for Mark Carney, Laura. Now he's setting up for an election down the track. Can he win?
Well, it's gotten a lot closer since he got involved, I'll tell you that. For months, Justin Trudeau was really lagging in the polls behind Conservative leader Pierre Poilievre. Now, with Justin Trudeau's decision to resign in January and open up this Liberal leadership race that Carney has now won, and with Trump's threats coming for the U.S., those polls have significantly narrowed. So now that Carney has realized his ambition to win this leadership race and to become the next Prime Minister, he will be sworn in the coming days, he has a decision to make. Should he call an election now, right at this moment that the polls seem very close, but then plunge Canada into a situation where we have a caretaker government amid a massive trade war with our biggest trading partner? Or should he face Parliament and try to get some support from opposition parties? So that's going to be what he has to think about over the next couple weeks. But we do expect that he may be leaning toward calling an election soon. And as I said, the Conservatives still have a lead in the polls, but it is a lot closer now that Mark Carney has gotten involved. And some polls even have him neck and neck with the Conservative leader, Pierre Poilievre.
Yeah, Pierre Poilievre made a lot of hay out of criticising the former Prime Minister, Justin Trudeau. What sort of attack lines is he likely to put together against Mark Carney?
Well, he has started calling him sneaky Mark Carney. And the reason for that is that he's really taken aim at Mark Carney's history as a businessman. He's a former Goldman Sachs banker. More recently, he was chair of Brookfield Asset Management, which is a major investment firm in Canada. And Pierre Poilievre has called on him to proactively disclose his financial holdings rather than go through the months-long process that's required once you become Prime Minister. So Pierre Poilievre has tried to paint Mark Carney as someone who is secretly perhaps holding financial assets that could be conflicts of interest for him and even, potentially be points of leverage that he says Donald Trump might have over him. Now, we don't know if that's the case, and Mark Carney has said he would put his assets in a blind trust, but that is certainly how Pierre Poilievre is going about trying to paint Mark Carney as sort of an elitist, out of touch, and potentially, someone who's hiding something from the Canadian people.
Well, dealing with US trade policy is obviously going to be a major feature of the election. What are both parties saying about that at the moment?
Well, there is broad agreement in Canada that we have to fight back and fight back hard. So both leaders, the Conservative leader and Mark Carney, have said they would keep Canada's retaliatory tariffs in place until the U.S. drops theirs. Mark Carney has also talked a lot about trying to diversify Canada's trading partners, saying that the relationship is irreparably changed, that we can no longer trust the U.S., and today saying, I will find, new trading partners and strengthen those that we already have with other countries. I will also reduce internal trade barriers to try to strengthen Canada's economy. There's really been a huge shift in Canada away from thinking of the U.S. as its greatest ally and trading partner as to potentially even an adversary at this particular moment. And Canadians, including Mark Carney in his speech tonight, are taking Donald Trump's sovereignty threats very seriously. Donald Trump has repeatedly said he'd like to make Canada the 51st state. Justin Trudeau said last week that that is a serious threat. So Canadians are taking that very seriously, and Mark Carney saying very clearly tonight Canada will never be part of the United States and that we will forge our own economic future.
Do we know when the election is going to be held yet?
No. So as I said, he could decide to call the election as soon as next week. Another option is to wait just a week after that. Parliament will resume, and so he could face the opposition parties at that point, and they could decide to bring down the government. His Liberal Party doesn't have a majority of seats in Parliament, so it's in a pretty dicey situation if he tries to hang on a little longer in Parliament. So if he does call an election next week, as is starting to be expected in Canada, Canadians would go to the polls in late April. So, it could all be happening very quickly here for Mark Carney, sworn in as the new Prime Minister sometime this week, potentially calling an election next week, and then we'll see whether Canadians choose him or the Conservative leader to be their leader in the long term as they face this tariff threat from the U.S.
All right, Bloomberg's Ottawa Bureau Chief Laura Kane there. Thanks for joining us. China's consumer inflation has fallen below zero for the first time in 13 months, a sign the economy still faces deflationary pressures. Bloomberg's China correspondent Min Min Lo joins us now from Beijing. Min Min, we've got inflation slipping below zero. This is backward-looking data, however. Some seasonal factors perhaps involved here as well. How serious, how entrenched is this problem?
Yes, the inflation numbers didn't look good in February. It had missed estimates on both the CPI and the PPI. Consumer price index had fallen by 0.7% versus a 0.5% increase the previous month. And you break down the consumer prices, you look at services, you look at consumer goods, everything is down. New energy vehicles down 6%, food prices down 3.3%, a big drag on that index. But even if you strip away the volatile food and energy prices, core inflation also contracted by 0.1%. That's only the second time that has contracted in about 15 years. And you look at the producers' price index down about 2.2% versus 2.3% the previous month, is the 29th consecutive month of decline in producers' price index, signaling that demand and supply mismatch continuing on, and this weak consumer sentiment as well. You combine that with the trade data last week, imports falling by 8%. It really shows how important it is for the government to focus on boosting domestic demand this year. You mentioned the seasonal factors. Lunar New Year last year fell entirely in February. This year it fell between January and February, so there was a high base to work off. But even if you strip away the seasonal impact, China's Bureau of Statistics mentioned the inflation would have been at 0.1%. So overall, still hovering at that very low level, not much improvement in the overall trend over the past couple of years.
And of course, all this happening in the environment of tariffs, increasingly febrile trade war as well. China's now announced retaliatory tariffs on Canada. What more do we know, and what's the potential of more to come here?
So China has imposed 100% tariffs on Canadian rapeseed oil, rapeseed meal and pea products, 25% on pork and certain seafood products. And this is in retaliation for Canada imposing these 100% tariffs on Chinese EVs and 25% on Chinese aluminum and steel. At that time, China had then launched this probe into rapeseed oil. I think there are a couple of points that are interesting. One is the timing of it, coming about 6 months after Canada had imposed those tariffs, and coming at a time when that trade war is heating up, and Canada is under pressure from the U.S. to match U.S. tariffs on China in order to avoid those tariffs that Trump has threatened to impose on Canada. Plus, also coming as Canada is prepared to review that North American free trade agreement with Trump as well. The second thing that's interesting is the scale of these tariffs, 100% and 25%, pretty much matching what Canada has imposed on China, and in stark contrast to how China has retaliated against the U.S., which is less than proportionate. So signaling here that there is room for dialogue with the U.S., but maybe not so much for Canada. It's almost like a warning shot to Canada not to impose further tariffs in China amid this escalating trade war.
All right, Bloomberg's China correspondent Min Min Lo there. Let's get to some other stories that we're following. President Trump says he still expects his Ukrainian counterpart Volodymyr Zelensky to strike a minerals deal with the U.S. Speaking with Fox News, he again accused Zelensky of being ungrateful for U.S. support. Officials from both countries are meeting in Saudi Arabia this week to resume talks for a possible ceasefire between Russia and Ukraine. A U.S. negotiator says a new Gaza ceasefire deal is possible within weeks. Adam Boulder told CNN the possible agreement could even see Israel recover all hostages held by Hamas. A 6-week truce expired earlier this month. Both sides still divided on conditions for more suspension of hostilities. Israel has since halted its limited supply of electricity to the Gaza Strip in response to the crisis. Elon Musk is backing the idea of the US exiting NATO. Musk, who was a senior advisor to Trump, supported a post on X which called for the US to exit the bloc.
इस क्रूड ऑयल को देखोगे रेजिस्टेंस जोन पर ही लग रहा है कल की तरह असर उड़ाएगा फिर से। नेचुरल गैस भी थोड़ा नीचे आ गया, मॉर्निंग पे सपोर्ट पे आया था, 2 बार बाइंग जरूर हुई बट मोमेंटम बहुत स्लो हो रहा है। देखते हैं थोड़ा और ऊपर जाता है या फिर नीचे ही आता है नेक्स्ट सपोर्ट एरिया के अराउंड। नैस्डैक का मार्केट ओपन होने तो फिर ट्रेड करना, अभी फिलहाल के लिए वॉल्यूम ही नहीं आएगा, फिर भी देख लेते हैं एक बार लेवल। जी है 15 मिनट में। यहाँ पर भी करंट जोन है, वहाँ पर भी एक रेजिस्टेंस है। लास्ट टाइम यहाँ से ऑलरेडी एक बार सेलिंग आ गई थी, अभी तो बिल्कुल साइडवे चला गया। 19,495 इज आल्सो रेजिस्टेंस एरिया। कल सेलिंग आई थी वहाँ से एक 1 AM के अराउंड, आज अर्ली मॉर्निंग कह सकते हो फॉरेक्स चार्ट में एक तरह से उसी लेवल पे था, वहीं पर सेलिंग आनी चाहिए थी फिर से, बट अभी साइडवे चला गया। स्टिल होल्डिंग द रेजिस्टेंस, ब्रेक नहीं किया। 19,544 का ही लास्ट रेजिस्टेंस है। तो ये करंट रेजिस्टेंस है, ज़्यादा देर कंसोलिडेशन में अगर नहीं जाता है नीचे तो फिर ब्रेकआउट के चांसेस हो जाएंगे। फिलहाल रेजिस्टेंस पर ही है 15 मिनट। अपर लेवल पे देखोगे अगर, इसके बाद नेक्स्ट ऊपर नेक्स्ट रेजिस्टेंस आपका 19,900 के अराउंड एक, वही 15 मिनट में ही है, ठीक है। दैट इज आल्सो ऑन 15 मिनट टाइम फ्रेम। यहाँ से भी मार्केट जब कल ओपन हुआ था 7 PM, उससे पहले रेजिस्टेंस ले चुका था उसी लेवल से। बाकी नेक्स्ट डाउन साइड पे देखें अगर, सपोर्ट को अगर देखोगे 15 मिनट टाइम फ्रेम पर ही डाउन साइड पे है। मेजर सपोर्ट डाउन साइड पे मिल जाएगा आपको 19,224 के अराउंड। उससे ऊपर अगर चेकआउट करें तो एक 19,360 पर भी सपोर्ट है, बट वो ले चुका है सपोर्ट अभी थोड़ी देर पहले। अप्रोक्सीमेटली देखोगे कैंडल 15 मिनट की 1 PM पे जो कैंडल बनी है अभी थोड़ी देर पहले, वो उसी लेवल पे सपोर्ट लेके गया है। तो नीचे वाला सपोर्ट ज़्यादा स्ट्रॉन्ग है, अभी तक आया नहीं है। ठीक है, तो ये कुछ सपोर्ट जोन है जहाँ पर प्राइस फिलहाल रुक सकता है। 15 मिनट टाइम फ्रेम पे ही ऑब्वियसली है। दूसरे रेजिस्टेंस की ओर तो नहीं जाएगा कहीं। एक पॉसिबिलिटी इसकी भी है। क्रूड में ना अभी जो ये मेजर रेजिस्टेंस है इसको मैं अगर हटा भी दूं तो यहाँ पर ही बहुत सारे रेजिस्टेंस बने, ये भी एक रेजिस्टेंस ही है। ऐसा ना हो कि ये सबकी लिक्विडिटी लेने एक साथ ही चला जाए। बेस्ट तो ये है कि सबसे नियरेस्ट रेजिस्टेंस से ही रेजिस्टेंस ले ले, क्योंकि सबसे पास की लिक्विडिटी वहीं पर होती है। बाकी अगर यहाँ नहीं रुका तो फिर ऊपर जो रेजिस्टेंस जोन है, क्योंकि तीनों एक साथ बनाऊंगा तो पूरा चार्ट ही भर जाएगा। राइट, नहीं रुकता है तो फिर ऊपर 15 मिनट टाइम फ्रेम पे $5,850 एक रेजिस्टेंस ही है 15 मिनट में। And 5,860 वो भी दोनों ही रेजिस्टेंस जोन है। अगर ये यहाँ पर नहीं भी रुकता है तो इन केस, बट इतने सारे लेवल एक साथ हो जाएंगे तो ये मार्केट रेंज को छोटी बना देगा। क्रूड में ऊपर एफईजी भी, एफईजी तो नीचे भी था, एफईजी तो बहुत बने हुए हैं। लॉट्स ऑफ एफईजीज नीचे देखोगे 5,817 से भी एक एफईजी था। ऊपर भी है दो दो एफईजी, एक भी नहीं। 5,860 पर है, फिर 5,890, 5,900, 5,890 पर भी है। राजा नीचे थी, सेलिंग इसमें आनी होती तो ये लाइक अब तो बस टाइम पास कर रहा है। नेक्स्ट रेजिस्टेंस की ओर जाने की तैयारी है इसकी। अप्रॉक्सीमेटली 5,850 टू 860। लेट्स सी यहाँ पर अगर नहीं रुकता है तो। ये भी एक रेजिस्टेंस ही है 15 मिनट का। यहीं से आ जाए तो और बेटर। थोड़ा दूर दूर रेजिस्टेंस बने हो ना, उस रेजिस्टेंस सपोर्ट तो बेटर रहता है। ऐसे नेचुरल गैस में देखो परफेक्ट लेवल है, लाइक सपोर्ट और रेजिस्टेंस के बीच में डिस्टेंस ठीक ठाक ही है, राइट, ऐसा नहीं है कि यहाँ पर सपोर्ट है तो बस उसके ऊपर एक और सपोर्ट बना हुआ है थोड़ी डिस्टेंस में, या रेजिस्टेंस है तो उसके बस जस्ट नीचे एक और रेजिस्टेंस है। डिस्टेंस इनफ है। डिस्टेंस इनफ होने से क्या होता है, आपका इजीली एटलीस्ट टारगेट बड़े बनते हैं और एक्सपेक्ट कर सकते हैं, लाइक लिक्विडिटी है वो थोड़ा नियर बाई से ही मार्केट ले ले। अब एक के ऊपर रेजिस्टेंस बन जाते हैं तो थोड़ा सा प्रॉब्लम हो जाती है। मार्केट कभी फर्स्ट रेजिस्टेंस ही मूव कर जाता है, कभी ऊपर के दो तीन रेजिस्टेंस सब टेस्ट कर लेगा फिर जाएगा नीचे। यहीं से आ जाए तो बढ़िया है। देखते हैं, ऊपर भी रेजिस्टेंस ही है, सारे रेजिस्टेंस जोन है। फॉरेक्स में गया था क्या ऊपर? चार्ट तो अलग है। फॉरेक्स का ही चार्ट है। सपोर्ट बन जाएगा फिर तो। सर आज क्रूड ऑयल दो ब्लू लाइन, ब्लू लाइन अच्छा, वो लेवल के बीच में पूछ रहे हो? लेवल आई थिंक लेवल के बीच में ब्लू लाइन की पूछ रहे हो क्या? जैसा नेचुरल गैस में लगाया हुआ है वैसे पूछ रहे हो आई थिंक। ठीक है, वो भी ट्राई करते हैं। ओके, ये नेचुरल गैस में हाफ प्रॉफिट पर्पल कलर की लाइन पे बुक कर लेंगे। इसके ऊपर निकलता है तो एक फाइनल टारगेट ये रहेगा। ये टारगेट थोड़ा बड़ा है, ध्यान रखना, लगभग 16 पॉइंट का, तो एटलीस्ट हाफ प्रॉफिट यहाँ पर बुक हो जाना चाहिए। पहली कर लिया था तो वेल एंड गुड, नहीं किया था तो अब कर लेना। 10 पॉइंट का ये टारगेट, फिर दूसरा टारगेट ये लेते हैं एंड यहाँ से फिर सेलिंग का प्लान करेंगे वापस से नेचुरल गैस में, ठीक है। गाइस लाइक भी करते रहो। 5:30 पे आपका न्यूयॉर्क सेशन ओपन होने वाला है, 1 घंटा और रह गया। आई होप क्रूड ऑयल में थोड़ा मोमेंटम हो जाए प्रॉपरली। नेचुरल गैस में तो हो ही रहा है मोमेंटम, कोई इशू नहीं है। मेन इशू क्रूड ऑयल में ही आ रहा है। नेचुरल गैस परफेक्टली वर्किंग ऑन द लेवल्स। जैसा वो नेचुरल गैस में बनाया ना, उसी की बात कर रहे हो। कि वो भी कर देंगे। डेली वैसे लगाते रहेंगे। भी करते रहो फिर उसके लिए। 100 लाइक्स का टारगेट रखते हैं आज, लाइक कर दो। जिन लोगों ने नहीं किया अभी तक। रिमेनिंग क्वांटिटी को ट्रेल कर लो नेचुरल गैस में हाफ प्रॉफिट बुक करके। निकलता है पर्पल कलर की लाइन के ऊपर तो यहाँ तक का एक टारगेट रखते हैं। वैसे देखा जाए तो रेजिस्टेंस लोअर टाइम फ्रेम पे यहीं से स्टार्ट हो जाएगा नेचुरल गैस का, बट यहाँ से सेल करेंगे तो फिर एसएल बड़ा लेना पड़ जाएगा। थोड़ा ऊपर आ जाए तो वेल एंड गुड है, मेरे अकॉर्डिंग सही रहेगा वो। नहीं आता है तो फिर कोई नया लेवल बनेगा, फिर उस पर देखेंगे वापस सेलिंग के लिए। रुकना नहीं चाहिए गाइस, लाइक करते रहो सभी लोग। कोई क्वेश्चन हो तो कमेंट बॉक्स में पूछ लेना। Natural gas looking bullish for the day. For the day, no. For me, if it is already bullish overall, but in intraday, if this break resistance is break, ये रेजिस्टेंस अगर ब्रेक हो जाता है तब ये बुलिस कह सकते हैं और ज़्यादा। फिलहाल तो सपोर्ट है, कल सेल ऑफ आया था, थोड़ी बहुत प्रॉफिट बुकिंग आ रही है बायर्स के थ्रू, बट ये सेलर्स निकलना जरूरी है। इफ दीज सेलर्स आर एग्जिट, then you can say it is still continued intraday, because right now if seller again enter over here, there is a very high chances price either do do this kind of things or like this kind of things. So yesterday's high 407 8, above that very bullish. Right now on support, so very good momentum. लेसिंग जो लेटेस्ट न्यूज़ है, कोई डेटा आया है, लेटेस्ट न्यूज़ है, कोई इन्फॉर्मेशन है, इसलिए स्क्रीन को देख देख के मैं ही बोर हो जाता हूँ ना, फिर क्या करें। अब ट्रेड तो हर लेवल पे बन नहीं रहा। 15 मिनट का चार्ट है, टाइम लगता है काफ़ी। क्या करते हैं बताओ, स्क्रीन को देखे देखे बैठे बैठे बोर नहीं हो जाएंगे? इससे बढ़िया कुछ सुन ही लो, काम की चीज़ है कुछ, क्या पता काम ही आ जाए। 30 लाइक्स हो चुके हैं गाइस, कम ऑन लाइक करते रहो। 100 लाइक्स का टारगेट है, 30 लाइक्स नहीं 70 लाइक्स और बचे हुए हैं। फटाफट से लाइक कर सकते हैं सभी लोग जिन्होंने अभी तक लाइक नहीं किया, कम ऑन। ओके, क्रूड नेचुरल गैस आ तो गया हाफ ए लेवल तक, थोड़ा सा और आ जाए ऊपर, 6 पॉइंट इनफ है। 5 PM न्यूयॉर्क सेशन की ओपनिंग है, ध्यान रखना। 5 PM टाइम फ्रेम इज़ वेरी इंपॉर्टेंट। ओके, देखो ऊपर निकलने की कोशिश में नेचुरल गैस 398 इम्पॉर्टेंट है, 398 इज इम्पॉर्टेंट।
Canada, Canadians would go to the polls in late April. So, it could all be happening very quickly here for Mark Carney, sworn in as the new Prime Minister sometime this week, potentially calling an election next week, and then we'll see whether Canadians choose him or the Conservative leader to be their leader in the long term as they face this tariff threat from the US.
All right, Bloomberg's Ottawa Bureau Chief Laura Kane there. Thanks for joining us. China's consumer inflation has fallen below zero for the first time in 13 months, a sign the economy still faces deflationary pressures. Bloomberg's China correspondent Min Min Lo joins us now from Beijing. Min Min, we've got inflation slipping below zero. This is backward-looking data, however. Some seasonal factors perhaps involved here as well. How serious, how entrenched is this problem?
Yes, the inflation numbers didn't look good in February. It had missed estimates on both the CPI and the PPI. Consumer price index had fallen by 0.7% versus a 0.5% increase the previous month. And you break down the consumer prices, you look at services, you look at consumer goods, everything is down. New energy vehicles down 6%, food prices down 3.3%, a big drag on that index. But even if you strip away the volatile food and energy prices, core inflation also contracted by 0.1%. That's only the second time that has contracted in about 15 years. And you look at the producers' price index down about 2.2% versus 2.3% the previous month, is the 29th consecutive month of decline in producers' price index, signaling that demand and supply mismatch continuing on, and this weak consumer sentiment as well. You combine that with the trade data last week, imports falling by 8%. It really shows how important it is for the government to focus on boosting domestic demand this year. You mentioned the seasonal factors. Lunar New Year last year fell entirely in February. This year it fell between January and February, so there was a high base to work off. But even if you strip away the seasonal impact, China's Bureau of Statistics mentioned the inflation would have been at 0.1%. So overall, still hovering at that very low level, not much improvement in the overall trend over the past couple of years.
And of course, all this happening in the environment of tariffs, increasingly febrile trade war as well. China's now announced retaliatory tariffs on Canada. What more do we know, and what's the potential of more to come here?
So China has imposed 100% tariffs on Canadian rapeseed oil, rapeseed meal and pea products, 25% on pork and certain seafood products. And this is in retaliation for Canada imposing these 100% tariffs on Chinese EVs and 25% on Chinese aluminium and steel. At that time, China had then launched this probe into rapeseed oil. I think there are a couple of points that are interesting. One is the timing of it, coming about 6 months after Canada had imposed those tariffs, and coming at a time when that trade war is heating up, and Canada is under pressure from the U.S. to match U.S. tariffs on China in order to avoid those tariffs that Trump has threatened to impose on Canada. Plus, also coming as Canada is prepared to review that North American free trade agreement with Trump as well. The second thing that's interesting is the scale of these tariffs, 100% and 25%, pretty much matching what Canada has imposed on China, and in stark contrast to how China has retaliated against the U.S., which is less than proportionate. So it's signaling here that there is room for dialogue with the U.S., but maybe not so much for Canada. It's almost like a warning shot to Canada not to impose further tariffs in China amid this escalating trade war.
All right, Bloomberg's China correspondent Min Min Lo there. Let's get to some other stories that we're following. President Trump says he still expects his Ukrainian counterpart Volodymyr Zelensky to strike a minerals deal with the U.S. Speaking with Fox News, he again accused Zelensky of being ungrateful for U.S. support. Officials from both countries are meeting in Saudi Arabia this week to resume talks for a possible ceasefire between Russia and Ukraine. A U.S. negotiator says a new Gaza ceasefire deal is possible within weeks. Adam Boulder told CNN the possible agreement could even see Israel recover all hostages held by Hamas. A 6-week truce expired earlier this month. Both sides still divided on conditions for more suspension of hostilities. Israel has since halted its limited supply of electricity to the Gaza Strip in response to the crisis. Elon Musk is backing the idea of the U.S. exiting NATO. Musk, who is a senior advisor to Trump, supported a post on X which called for the U.S. to exit the bloc, saying it doesn't make sense for America to be paying for Europe's defence. Musk's comments come as the future of NATO hangs in the balance, with NBC earlier reporting that Trump had discussed calibrating U.S. engagement with the military alliance. The European Commission says there's no risk or no reason to de-risk the EU's relationship with the US despite changes under the Trump administration. President Ursula von der Leyen has led a shift in the bloc's relationship with China that she has described as de-risking but not decoupling from Beijing. But she told a conference in Brussels that a similar strategy is not needed towards Washington. Let's take a look at US futures because that's changed in the past 15 minutes. They were looking positive for a while there. We've now got S&P futures off by a little bit more than 0.75%. NASDAQ futures still off by about 1%. It's been a pretty nasty week for US stocks last week. It was the world's worst performing market, in fact, against a backdrop of all this trade and tariff upheaval. And what a change from a month ago when the S&P was at record highs. We have more ahead on the Asia trade. This is Bloomberg. China's February consumer inflation dropped below zero for the first time in 13 months. It's an assessment skewed by seasonal distortions, but also signs of deflation.
News when you want it with Bloomberg News Now. I'm Nathan Hager.
And I'm Karen Moscow.
Karen, markets are stabilizing, but it follows another sell-off on Wall Street, and those numbers are not pretty. Tech stocks experienced their biggest one-day plunge since 2022, wiping $1.1 trillion in market value. Let's get the very latest with Bloomberg's John Tucker. John.
And Nathan, Monday's market plunge came as the Trump administration warns of a period of transition and detox for the economy. Economist Dennis Gartman sees it this way.
I think that the economy, no question, is going into recession.
The NASDAQ 100 plunged 3.8%. Amy Wu Silverman at RBC is waiting for the other shoe to drop.
Are we going to get to that second tier of fear?
The NASDAQ 100 down 12.4% from its market high. That's a correction. The S&P 500 flirting with correction, down 8.6% from its record set only last month. Max Wasserman at Miramar Capital says investors are still trying to gauge the impact of the Trump trade war.
In the meantime, an uncertainty, who wants to pay 30, 40 times for these tech earnings right now?
The Bloomberg Magnificent 7 Index, an equal-weighted gauge of the biggest U.S. tech stocks, tumbled 5.4% to bring its rout from a December record to more than 20%. Tesla tumbled 15% yesterday, widening its loss this year to 45%, while Nvidia lost 5.1%. It has erased more than $1 trillion in market value in just 2 months. Unpredictable tariff policies left investors looking for safety. Government bonds globally, they're rallying as bets on U.S. exceptionalism starts to fade. In New York, I'm John Tucker, Bloomberg Radio.
All right, John, thank you. We are seeing the fallout from the recent U.S. stock sell-off. Citigroup is downgrading its view on U.S. equities while upgrading China to overweight, citing attractive valuations, government support for the tech sector, and a technology breakthrough. The divergence in outlook between the U.S. and China is growing, with Chinese equities performing well this year, while U.S. equities have lost 4.5% so far this year. Well, Nathan, when Donald Trump took office on January 20th, he was flanked by some of the wealthiest people. Now, new figures from the Bloomberg Billionaires Index show 5 of those billionaires have lost a combined $209 billion in wealth since Inauguration Day. Elon Musk has been hit the hardest, losing some $148 billion. Amazon founder Jeff Bezos is down $29 billion. Google co-founder Sergey Brin worse off by $22 billion, while Mark Zuckerberg and LVMH boss Bernard Arnault are both down $5 billion.
Karen, those losses come as President Trump gets ready to meet with the country's top business leaders. Mary Nicola is a Bloomberg Markets Live strategist.
He needs to highlight his pro-growth policies. Heading into the Trump administration and after he won, businesses were actually quite optimistic about the future, given deregulation and what some of his policies would be that would be favorable to businesses. But businesses are now worried. They're now worried about the outlook of the economy. They're worried about tariffs. So he'll need to address these recession concerns and that his plans will be more limited. And it really is a short-lived adjustment period because because otherwise you could see this spiral into something even bigger and deeper losses for the markets.
Bloomberg's Mary Nicola notes President Trump scheduled to meet with the Washington-based Business Roundtable today. Cisco CEO Chuck Robbins chairs the organization, and J.P. Morgan Chase's Jamie Dimon and Citigroup's Jane Fraser are among bank leaders on the Roundtable's board of directors.
Now let's get the latest on the war in Ukraine. Nathan, Russia says it shot down 337 Ukrainian drones overnight, including 74 aimed at the capital, Moscow. It appears to be the largest attack on Russian territory in the three-year war, and it comes as Ukrainian officials are meeting with the U.S. in Saudi Arabia today to discuss ways to end the conflict. That meeting going on right now. But the U.S. is downplaying anything major coming out of this meeting, as we hear from Bloomberg's Greg Sullivan.
We saw Secretary of State Marco Rubio come out and say, look, we're not looking for a major breakthrough here. The U.S. is basically in a position where it's listening, trying to see what's possible, especially in terms of concessions. He did say that he expects concessions from both sides, and that could include territorial concessions from Ukraine, which will be quite hard for them to swallow.
And as President Trump pushes for a ceasefire, Bloomberg's Greg Sullivan reports he's sending Middle East envoy Steve Witkoff to Moscow this week to meet with Russian President Vladimir Putin.
McCarran talks between the U.S. and China on trade may be getting stuck. Sources tell Bloomberg News those discussions are bogged down at lower levels. Both sides, we're told, are talking past each other on how to proceed. Officials in Beijing say the U.S. has not given detailed steps on what it should do about fentanyl to have tariffs lifted. President Trump's team says it has been clear. It wants China to stop sending precursor chemicals to Mexico, to give smugglers the death penalty, and to run a front-page article in the People's Daily newspaper condemning the fentanyl trade.
Well, Nathan, let's get back to Washington and signs this morning a government shutdown may be averted on Friday. The ultra-conservative House Freedom Caucus is throwing its backing behind a stopgap funding package, and Bloomberg's Amy Morris has details from Washington.
The Republican spending bill is designed to keep government agencies open through September 30th. Representative Don Beyer, a Democrat from Virginia, talked about the options and the worries that the president will unilaterally delay or cancel appropriations, called impoundment.
Unless there are meaningful guardrails to keep Trump from impounding it, we should vote no in the Democrats in the Senate and hopefully some Republicans in the Senate.
Virginia Democratic Representative Don Beyer on Bloomberg's Balance of Power. House Republicans could pass this on their own if they get enough votes from their own caucus, but even after it passes the House, it still has to get through the Senate. In Washington, Amy Morris, Bloomberg Radio.
Time now for the Bloomberg Sports Update, and we bring in John Stashower. John.
Thanks, Karen. A lot of NFL news, including the well-traveled veteran quarterback Sam Darnold cashing in on what was far and away his best season in Minnesota. Now he's going to Seattle for a 3-year deal, $100 million. The Jets have a new quarterback. It's Justin Fields. He spent 3 years in Chicago this past year with Pittsburgh. The Steelers now may sign the veteran Aaron Rodgers. Garrett Cole, the Yankee ace pitcher, won't pitch at all in 2025. He's having season-ending Tommy John surgery today. That's your Bloomberg Sports Update.
Thanks, John. And that's news when you want it with Bloomberg News Now. I'm Karen Moscow.
I'm Nathan Hager, and this is Bloomberg.
Do you buy the dip?
Not yet. I think this is, we had very extreme positioning and really quite a significant degree of optimism running into this correction. And I think probably that has a little bit further to go. Essentially, though, economies are growing, albeit perhaps a slower pace than people were expecting at the end of last year. And we are going to get some interest rate cuts, and that will, I think, limit the extent of a drawdown. But I think we still probably have some more volatility to come.
You talk about extreme positioning. There is a question that around a lot of the outperformance in Europe that we're seeing, it's really short covering on the European positions, not actual fundamental outperformance. To what extent is that narrative true?
Well, I think there's more of a shift, an inflection point that favours Europe relative, at least, to the US. And this is a topic that we've been discussing really all year. And part of that, I think, comes from the slowdown that we're seeing in the US economy at the margin. It's still growing, but at a slower pace. Our economists have downgraded their forecast for the US. We're now below consensus for the first time in 2.5 years. We're expecting a growth rate of about 1.7 in the fourth quarter, year over year. And that's below trend, but still okay. But in addition to that, of course, we've seen some real pressure coming in the biggest tech stocks in the US. and they have such a big weight in the US market, is dragging the US down more than other markets. And of course, on the other side, European growth expectations have been edging up from a very low base, partly triggered by optimism over increased defense spending, as you discussed earlier. So I think there is a genuine fundamental inflection point that's happening that's supporting Europe, at least in a relative sense.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
The economic growth narrative begins to fray at the edges. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Scarlett Fu. We're kicking off to the closing bell here in the U.S. The losses accelerating this afternoon as we continue to monitor the fallout in equity markets. You have the S&P 500 losing 3.33%. It's now at a 6-month low and losing almost 9% since its record high in late February. It's on track to close below its 200-day moving average as well. The Nasdaq 100 losing 4.4%, the biggest one-day decline since September of 2022. And of course, there's buying of treasuries, which is higher prices, lower yields. The 10-year yield coming down almost 9 basis points to 4.21%. And Bitcoin getting caught up in the risk-off sell-off here. You have crypto trading as a risky asset, currently below $78,000 remain.
The risk-off sentiment, of course, tied to the macro all weekend long. We heard from the administration all weekend long. They had a similar message. President Trump talking about economic transition. Treasury Secretary Scott Bessent talking of a detox period. But all the market could hear was not detox, but stagflation. Not transition, but recession. One of the only cabinet members who really tried to push back on that narrative was Commerce Secretary Howard Lutnick, who, said, don't worry. Right now, on Meet the Press, he said there is not going to be a recession here in America. But for right now, the market really isn't so sure about that. And the case in point is really the price action. No idea what's in the hearts and minds of traders, but the economic risk from policy changes in Washington, they've reached a height that is finally causing a material rethink in the price action on Wall Street. J.P. Morgan strategists warning that their year-end S&P forecast, 6,500, that may not materialize. Lori Calvasina over at RBC lowering her bear case for the index to 5,600. Mike Wilson at Morgan Stanley saying the next support level for the index, that might actually be closer to 5,500. And this is not just an academic exercise either. Short-term Treasury yields down 25 basis points from just 2 weeks ago, 40 basis points from just before Trump's inauguration. The Nasdaq 100 today poised to close in correction territory for the first time since September. And the S&P, which last week was the globe's worst performing major market, poised to now close below that 200-day moving average, Scarlett, for the first time since 2023.
Yeah, so clearly a lot of key technical levels are in play here. The question is, how orderly is this sell-off? So, yes, the price action is pretty dramatic and one-sided. This line is the S&P 500. And since its record high about 2.5 weeks ago, it's been down, down, and down. And when you look at the percent of index members that are lower, about 3 hours ago, less than half. Now, more than two-thirds at 72%. But there is still a rotation into defensive names inside consumer staples like food and household products makers, as well as utilities. And in the past 3 months, what we've seen is that at least 75% of the S&P 500 members falling more than half a dozen times. So we've definitely been here before and recently as well. And Romaine, the dip buyers have reliably been coming in.
Yeah, and that's a big question as to whether they will come back this time around. Amy Wu Silverman joins us to kick us off to the close, equity derivative strategist at RBC Capital Markets. Amy, is this for real this time, this sell-off?
Certainly feels like it. Look, it's when we look at our world at VIX, at correlation, at dispersion, so far it's been relatively orderly, but there's only so many times you can say that as we go 1, 2, 3 standard deviations off in terms of drawdown. There is going to be a period where I think it's going to be panic at the disco. We haven't gotten there yet, but as these levels climb, there will be unwinds and more uncertainty that triggers even more.
There was a lot of talk here about some of the technical levels being breached and the idea that that might actually bring some buyers back into this market. We've pretty much tested the 100-day on everything, the 200-day now in play on the S&P. Is that going to be potentially some level of support for this market?
I will tell you anecdotally, I keep asking if anyone is buying the dip from people who could potentially buy the dip, and they haven't been buying the dip. So they want to know if anyone else is. And my question there is, when you look at kind of historically where you see that buy the dip or you see that FOMO and momentum, it's usually in those call option wings. You're not seeing people step in there yet. Even historically retail, which tends to lead that, we have not seen that yet. But again, we haven't seen this mass panic flight to hedges. We've seen very orderly hedges.
You mentioned panic at the disco. What are the markers of panic at the disco?
I think from where we are here, so obviously VIX has spiked, and we've seen a rise in correlation into the 30s. Historically, when you think about Volmageddon, when you think about the global financial crisis, when you think about August 5th, these indicators, they can go into the 80s. So it feels substantial, and it is when you look at it on a year-on-year basis. But when you look past the history 5-10 years out, these indicators can go substantially higher than we are now, Scarlett.
The other thing is, you think about what's going wrong in the world from equity bulls' perspective. You have tariffs and the uncertainty over that, geopolitics and government firings and what that means for the employment picture. These are all known knowns. Things that typically push the market off the ledge are things that are complete surprises. How does this set us up in terms of the market's fragility and the mindset as, we try to price in things, or I should say we try to absorb things that are unexpected?
Yeah, I think that's so interesting because that nuance is really important, meaning when you think back to August 5th, right, that was sort of like an unknown, like a volatility pothole that just hit the market. The same thing with February 2018 when we had that VIX ETP unwind. Whereas here, this has really just been a mispricing on the investor side, but it wasn't like they didn't know it was going to happen. We knew since November elections that tariffs were on the table. We just somehow magically thought it was all going to be okay. And so that fundamental change, I think, does make a difference here. Perhaps that's why you've seen kind of a very orderly year-to-date sell-off. That said, you get to certain levels where people have been kind of complacent in their trades, in certain trades that have essentially relied on low correlation levels, high dispersion levels, relied on things kind of staying the same. And as you continue to sell off, I worry that that will trigger in and of itself something that is potentially worse, that unknown coming into the picture.
And we've seen stock correlations rise pretty significantly here. We also saw, at least last week in the backwards looking data, we did start to see a lot more people look for hedges in the options market and elsewhere. You're seeing that too in your data?
I certainly am. And I would tell you, the big debate we're having right now in options land is this going to look more like a 08 or a 2018, or is it going to look more like a 2022? And what I mean by that is in 2022, we also had a 20% drawdown. But when you looked at systematic hedging, it actually managed to draw down 21%. So it's kind of a fail. Like option prices did not do what they were supposed to do. And the question is this year going to look like that, where we have to be more systematic or not?
What was the starting point, though? Because I was under the impression that coming in, at least buying downside hedges, at least, if you were smart enough to do it, a month ago, you could have done that relatively cheap, right?
And to be clear, they have been working.
Okay.
So already we don't look like 2022. But the question is, are we going to end the year with more? I don't drive, but I love these driving analogies. Are we going to end up with these like sudden potholes, or is it going to be kind of this like dreary march towards, low and lower from 5,500?
Same. I don't drive anywhere, not in this town.
New Yorkers. Okay, so this is typically a weak period for equities. We've been hearing people say that a lot. What does that mean in terms of how we determine when we're near a bottom? Because people will be looking at the calendar saying, but we're not there yet, because it doesn't happen around this time of the year.
That's fair, but I would say there are certain strategies you'll start to see, not become a trickle but a flood if people start to believe that we're near the bottom. So one would just be call buying. Because if you think about your NVIDIAs of the world, your Mag 7, your Teslas, this is usually where you see people step in and say, I'm going to buy call options, or I'm even going to underwrite. We haven't seen that type of activity yet, but that has been very prevalent post-COVID in these stocks. And those are markers that we've come to rely on to say, now we're much more focused on the right tail. Now we're much more focused on the upside versus the downside.
How much are you paying attention to the 200-day moving average? It's been noted that we've held above that level for 336 days, and people keep saying how nothing good happens below the 200-day moving average. What does it signal to you?
It's interesting because I have changed my mind over time, but I really think technical analysis is just psychological self-fulfilling prophecy. Meaning if like people think that is that important and then we break it, like you will see that panic occur, essentially because they believed it to begin with. And to me, that's sort of the crux of technical analysis in the sense that it's all behavioral finance in the end because it's all people behind their computers. And so I do think there's a lot of importance to that, especially if you start to see that open interest float in that area.
I don't know. Were you supposed to say that out loud? Because I've always believed that as well. But sometimes those self-fulfilling prophecies, I mean, they are, in a certain degree, a true reflection, I think, of at least how people want to sort of price this market. And it gets to the idea that if we do see some opening for a rebound or for dip buying, are we going to go back to the levels that we were, I don't know, say 2.5 weeks ago before kind of the sell-off really took place? Or is this going to be one of those things where, we lose 10% and gain back, 2 or 3 percentage points?
I think it's going to be much bumpier because the problem is right now we're still in the fog of, okay, there are tariffs, but they've been suspended for a month. But what's the exact implementation? Like back in November, we got to wishfully think that this is going to be okay. Now we're down to the devil in the details.
All right, Amy Wu Silverman, always a great conversation. Equity derivative strategist at RBC Capital Markets. As stocks now hitting session lows here with major declines across all of the major moving averages. And a lot of this has to do with economic conditions and tariff jitters. Those jitters reverberating across the markets right now. We're going to dive deeper into that impact with one of America's biggest restaurant chains, Chipotle. The CEO, Scott Boatwright, joins us in just a few.
And within all the red of today's sell-off, Novo Nordisk having an extremely ugly day. You could see they're lower by almost 10%. Why the company's next generation diabetes shot fell short of expectations.
And one of the worst performing sectors on a year-to-date basis, consumer discretionary stocks. We're going to check in with the head of Sandals Resorts. Adam Stewart is going to join us and give us his take here on whether people are still willing to spend on the ultimate discretionary item, vacation. Stick with us. This is The Close on Bloomberg.
All right, less than 50 minutes to go before the market closed, and stocks have been on a steady downdraft, now at session lows. You can see the S&P 500 losing 3.4%, but the S&P equal weighted index, look at that, less than 2% lower. Joining us now to discuss is Gina Martin-Adams. She is chief equity strategist for Bloomberg Intelligence. And Gina, there is a rotation taking place within the S&P 500. 378 names are down, but 124 are up, and you've got telecom services, household and personal products, food, beverage, and tobacco companies rising.
Yeah, and I think that's really been the story since last summer, frankly. It's just been the rotation has been amplified by policy so far this year. So really, if you go back to last summer, we saw some pretty big cues from our sector rotation model suggesting that tech was going to take a back seat to the rest of the sectors. We did see that rotation emerge in the second half of last year with financials and industrials starting to perform well. Now we're seeing more rotation into defensives, but the one consistency throughout that period is tech underperforming. And when you have a market where tech is actually not only underperforming but falling, it's next to impossible for the S&P 500 to rise. It's just too big in market cap concentration. So the loss of faith in tech is a big part of this story. If you take the Mag 7 alone, since their peak in December of last year, they're down 16%. So that's a very, very big loss for the biggest market cap stocks in the S&P, and it's certainly weighing on confidence.
Whenever you see a broad sell-off, you see volume spike, and that's no different today. You have the S&P and Dow showing volume at least 60% higher than the 100-day moving average. But for the NASDAQ, it's only about 3% higher than the 100-day moving average. What do you think that means?
I have no idea what that means. I don't use volume very much in my work. I find it to be somewhat unreliable given the program trading that's out there, and also we trade so much in baskets of stocks as opposed to individual stocks. It's really hard to use it for an indication. I think the things that are most relevant right now are all related to earnings. We came into this year with the market anticipating greater than 20% earnings growth. We were writing about this in December as much as we possibly could. That is next to impossible for the market to achieve. And we're experiencing the reality of the index is probably going to create somewhere closer to 10% earnings growth over the course of 2025. That's a really big downshift in expectations that has to get priced into the equity market.
When does that start to show up, though, in people's forecasts? There was a great story on the terminal today about, some market strategists, they're rethinking their year-end price targets, but not necessarily willing to sort of pull the trigger yet in downgrading that. And similar story with their calls for earnings on the S&P 500. It's still relatively early in the year, still relatively early in this administration. And if you believe what they have to say, they're saying some good is coming when it comes to policies that maybe ends up bolstering, if not the economy, certainly the bottom line of these companies.
Yeah, I can't really answer the question as to how other strategists approach their business. I can tell you that for our approach, we run fair value models, and our fair value models have been saying the S&P 500 is dramatically overvalued. That's where we get our indication that the market was priced for greater than 20% earnings growth. We have to get to a point where the market is pricing closer to 10% earnings growth, which means we need to get down to somewhere between 5,200 and 5,400 on the S&P 500.
But when you made that call, I mean, that was prior to the inauguration. Did you already factor in the potential of some of the Washington?
Nasdaq near और resistance level बता दिया मैंने already. Stream को थोड़ा सा पीछे कर लो. Already अभी थोड़ी देर पहले बताए थे 15 मिनट में. बाकी लेवल जहां पर अभी है वो रेजिस्टेंस जोन जो बना हुआ था काफी देर से टेस्ट हुआ है, साइडवेज आ चुका है कंप्लीटली. कल ऑलरेडी एक बार सेलिंग आ गई थी. ज़्यादा देर अगर सेलिंग में नहीं आता, क्योंकि ऐसा नहीं कि अभी आ रहा है, ये सुबह 1 बजे से लगभग 5-6 घंटे से साइडवेज है, तो फिर ब्रेकआउट पे अच्छा चला जाएगा. नॉर्मली सेलिंग थोड़ा फास्ट ही आती है, रुक के नहीं आती है सेलिंग. नेचुरल गैस भी आधे से ही मूव करना शुरू कर गया. हाफ प्रॉफिट बुक कर लेना नेचुरल गैस में, ध्यान रखना. क्रूड में भी एक ट्रेड बन जाएगा यहाँ पर. लेट्स सी थोड़ा सा और ऊपर आए.
The analyst saying Supermicro has a formidable business model and views its ability to deliver liquid cooling technology for servers as a competitive advantage. Those shares are moving on the day, and you're taking a look there at KeyCorp, which also got an upgrade today to buy, though you're seeing KeyCorp shares down about 4% on the day. We do want to go back to the technology space and push ahead to what's happening after the bell tonight. Earnings from Oracle, a big one. The stock, of course, rallied about 20% in the middle of January. It's down about 20% since. A lot of questions here about the AI spend and whether Oracle is a beneficiary of that. Brent Till joins us right now, software and internet research analyst at Jefferies. He currently has a buy rating on Oracle. All right, Brent, should I get my hopes up for tonight? I mean, Oracle is...
क्रूड लेवल मोमेंटम ही नहीं आ रहा है उसमें, इसलिए जो मैं एक्सपेक्ट कर रहा हूँ मोमेंटम वहां पर हो ही नहीं रहा है बिल्कुल भी क्रूड में. 10 मिनट और है, रुक जाओ. 10 मिनट बचे हुए हैं बस. न्यूयॉर्क सेशन ओपन होने वाला है. आई होप उसके बाद थोड़ा सा प्रॉपर आ जाए मोमेंटम. अभी तो बिल्कुल ही प्राइस सेक्शन फॉलो नहीं कर रहा है प्राइस. 10 मिनट रह गए गाइस, ध्यान रखना। न्यूयॉर्क सेशन ओपन हो जाएगा 5:30 पर। एक वॉलेटाइल कैंडल एक्सपेक्ट कर सकते हैं 5:30 के अराउंड, लाइक भी करते रहो।
Are going to drive margins lower in the short term. But I think the tailwinds for Oracle are better than the headwinds. And again, you look at, the Trump, Musk, Ellison trio, they certainly have a good partnership. And so when the federal government decides to come back and spend money, Oracle's probably going to get one of the first calls. Mm-hmm. Obviously, they're part of Stargate, as part of this government initiative. Yeah. And we're continuing to hear, better things there, and they're expecting accelerating revenue growth. We don't have too many accelerating revenue growth stories in software right now. Yeah. So we're going to go from high single digit to low double digit growth over the next year. So overall, I think it feels pretty good. Stocks, peaked out at 200. It's back at 148. Right. And so this pullback, we like the pullback.
So even if, I understand Stargate and whatever money the government might be trying to facilitate, and obviously in this administration, certainly good to be inside the White House, as Larry Ellison seems to be. On the corporate side, though, is there any concern about a slowdown in spending, some of the spending on data centers and other things that have benefited Oracle?
Not yet. We haven't seen it. And we've heard chatter about cancellations at Microsoft and this and that. And I think ultimately a lot of it's been noise, honestly. And I think many of these data centers require new infrastructure. So Microsoft may be canceling some contracts to go to data centers that they can actually use, or where there's energy or water. And so I think, overall, we haven't really seen a big slowdown. And I think there's this worry, and you see it in AI infrastructure with a number of these semi and hardware names off, that is growth going to slow? The answer is yes. There's no question, growth is going to slow, but we're still early days in terms of this improvement. So we're in my opinion, I think we're in a valuation timeout. Mm-hmm. Everyone's taking a little nap. Everyone's like, I can't own these things right now because they got too hyped and the multiples got too high. And so we're in a little bit of a timeout, but I don't think this is the end of it. Brent, we're literally at the beginning of it.
Brent, very quickly, what would Oracle need to say to get a pop in the stock price today in after hours trade?
They got to put up over 50% OCI growth, continue to hold the revenue acceleration, and continue to highlight that demand is good and that you aren't seeing any corporate slowdown. We haven't seen any evidence of that yet. So as long as they do that, I think the stock's going to get a lift post this report.
All right, good stuff. Brent Thill over at Jefferies giving us his preview here for Oracle, which will be reporting earnings after the bell. And I noticed, Romain, that for the last 4 quarters, Oracle has fallen after its earnings once, and the other times it gained double-digit percentages. Yeah,
11, 13, 11% in 3 of the quarters. The last quarter it fell. It'd be kind of interesting, though. I am curious just to see how much this whole Stargate and a government partnership actually ends up being a tailwind. Because at the end of the day, we haven't actually seen the cash from that. It's a promise. And obviously in this administration, it pays to be close to the president. So if he says you're part of the in club, I guess I would put some money in that, but I also want to see where the money's coming from.
Absolutely. Yeah. And this is what it all comes down to. And of course, we'll be covering those results when they cross after the closing bell. Now, coming up on the close, how rising crop prices and tariffs are impacting fast casual brands like Chipotle. We'll be speaking with the CEO, Scott Boatwright, next. This is The Close on Bloomberg.
Behind the bright lights and adrenaline of pro sport is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
News when you want it with Bloomberg News Now. I'm Karen Moscow. Markets are stabilizing this morning following another sell-off on Wall Street. S&P futures are up 0.2%. This is after tech stocks experienced their biggest one-day plunge since 2022, erasing $1.1 trillion in market value. Begin more with Bloomberg's John Tucker.
Monday's market plunge came as the Trump administration warns of a period of transition and detox for the economy. Economist Dennis Gartman sees it this way.
I think that the economy, no question, is going into recession.
The NASDAQ 100 index plunged 3.8%. Amy Wu Silverman at RBC is waiting for the other shoe to drop.
Are we going to get to that second tier of fear?
The NASDAQ 100 down 12.4% from its market high. That's a correction. The S&P 500 flirting with correction, down to 8.6% from its record set only last month. Max Wasserman at Miramar Capital says investors are still trying to gauge the impact of the Trump trade war.
In the meantime, an uncertainty. Who wants to pay 30, 40 times for these tech earnings right now?
The Bloomberg Magnificent 7 Index, an equal-weighted gauge of the biggest U.S. tech stocks, tumbled 5.4% to bring its rout from a December record to more than 20%. Tesla alone tumbled 15%, widening its loss this year to 45%, while Nvidia lost 5.1%. That has erased more than $1 trillion in market value in just 2 months. The unpredictable tariff policies also spurring risk aversion. Government bonds globally, they're rallying as bets on U.S. exceptionalism start to fade. In New York, I'm John Tucker, Bloomberg Radio.
All right, John, thank you. While the sell-off has been widespread, perhaps the hardest hit have been the richest. We get that story with Bloomberg's Gina Cervetti.
When Donald Trump was sworn in as president on January 20th, he was flanked by some of the wealthiest people: Elon Musk, Jeff Bezos, and Mark Zuckerberg, to name just a few. In fact, thanks to frothy gains in the stock market, they had never been richer. 7 weeks later, it's a different story. 5 of the billionaires have lost a combined $209 billion in wealth, according to the Bloomberg Billionaires Index. Leading the way lower, Elon Musk, who has seen $148 billion wiped out on paper. Bezos has lost $29 billion, while Google co-founder Sergey Brin has dropped $22 billion. Gina Cervetti, Bloomberg Radio.
Right, Gina, thank you. Now to the latest developments in the war in Ukraine. Russia said it shot down more than 300 drones overnight in what looks to be the biggest attack on its territory since it invaded Ukraine 3 years ago. It comes as Ukrainian officials meet with the U.S. and Saudi Arabia on ending the conflict. Secretary of State Marco Rubio is downplaying any major breakthroughs, but Bloomberg's Greg Sullivan reports this meeting is key for Ukrainian President Volodymyr Zelensky.
There's been a ton of pressure heaped on Zelensky by the White House, and the Ukrainian side will really be looking to tamp down that pressure and tone it down and remain engaged so they can hopefully stay at the table and in any kind of future ceasefire agreement potentially have terms that are more favorable to them.
Bloomberg's Greg Sullivan reports President Zelensky is not taking part in today's meeting, but he did speak with Saudi Crown Prince Mohammed bin Salman. Back in Washington, signs this morning a government shutdown may be averted on Friday. The ultra-conservative House Freedom Caucus is throwing its backing behind a stopgap funding package. That's bolstering Speaker Mike Johnson's attempt to pass the bill without the help of House Democrats. The vote on the stopgap is set for later today, and Johnson can likely only afford to lose 2 Republicans on the measure if Democrats line up uniformly against it. Elon Musk hinting that Social Security and Medicare could be targets for spending cuts. The figurehead of President Trump's government efficiency effort discussed it in an interview with Fox Business.
The way it's important in entitlement spending, which is most of the federal spending is entitlements. That's like the big one to eliminate, because that's the sort of $500 billion, maybe $700 billion a year.
And Elon Musk's comments could face opposition on Capitol Hill from lawmakers who've already faced backlash about cuts to federal agencies. President Trump has said he won't reduce Social Security or Medicare benefits, but will go after improper payments. Southwest saying it's going to begin charging passengers for some checked luggage. It's ending a free bag policy that has been a hallmark of the carrier since its founding more than 5 decades ago. American Airlines said it will have a larger first quarter loss than expected as it grapples with weak leisure travel demand and fallout from a fatal collision involving one of its planes in Washington. Delta also slashed its profit forecast. And futures again are higher this morning, signaling a bounce on Wall Street. S&P futures up 0.33%, Dow futures up 0.25%, NASDAQ futures up 0.33%, 10-year Treasury yield at 4.22%. And that's news when you want it with Bloomberg News Now. I'm Karen Moscow, and this is Bloomberg.
As well as to get our current consumers to come in more frequently.
I look at your stock today, Scott, and it's down 0.1%, basically unchanged. You could even say it's up in a market that is down about 2.5%, in part because analysts have cited things like your enviable balance sheet, talking up your ability to have optionality when it comes to investing in stores or spending, as you mentioned, on technology and new developments. what is your single biggest priority when it comes to spending on development? Is it to continue to expand your menu? Is it something more internal, back of the house?
Yeah, it's a great question. So we think about every dollar that we have in the business today, and you are correct. We have an extraordinary balance sheet, a fortress balance sheet, if you will, very little debt, and probably $1.5 to $2 billion in cash. And we believe that preservation of cash is important to weather tough times just like this. So we'll continue to lean into new restaurant development. We said publicly we'll build 315 to 345 new restaurants this year alone. We'll continue our stock buyback program to deliver more value to the shareholder. But we'll also lean into what I'm calling back of the house modernization, where we're going to bring forward equipment innovation that has been in our stage gate now for over 2 years to help drive more efficiency in the back of house, create a better team member experience, which we know will always ladder to a better consumer experience.
What does that mean for hiring as you continue to expand that investment in the back of house operations? Because there's a lot of concern now that the labor market's going to get tighter if we see the pool of labor workers in the labor market shrink.
You know, as we stand here today and we head into what we call our burrito season, which is really springtime, we are better staffed today at Chipotle than we've been in my 8 years with the brand, perhaps in the brand's history. And I really think that's attributable to our best-in-class wages and our industry-leading benefits and what I believe to be a world-class culture that we've created around people development, and growth in the organization. We'll continue to invest in our most important asset, which is the 130,000 team members out in our restaurants, which I've said before, I'll say again, are really the backbone of our great organization.
Do you plan to expand the footprint of Chipotle, more stores this year?
We absolutely do, Romain. We're going to build 315 to 345 new restaurants here in North America. We'll have additional growth in Canada this year. We're looking at expanding our footprint in Western Europe. Our partnership with Al Shaya in the Middle East will produce additional Chipotle restaurants in that region. We're also looking at additional partnerships around the globe as I stand here today, really in this idea of really moving Chipotle into a global iconic brand.
All right, Scott, I really appreciate you taking time for us. Scott Boatwright, he is the CEO of Chipotle. When we come back, we're going to talk to another CEO, the CEO of Novo Nordisk. Excuse me, not the CEO. It's the head of development at Novo Nordisk. I should remember that because we just spoke to him just recently. The share is down here on the day, and this has to do with sort of what's next beyond Ozempic and Wegovy. They were working on something called CagriSema, and apparently in the most recent trials, it failed to meet expectations. Basically, the percentage of weight loss not quite as high as what the company had said. It was looking for 25% weight loss, and in the study only got it to about 15.
A lot of question marks about what's next in terms of innovation for this company, right? Or does it just lose out to Eli Lilly?
Martin Lang, he's the Executive Vice President of Development, not the CEO. We speak to him next, right here on The Close on Bloomberg. All right, the U.S. ADRs of Novo Nordisk are down here on the day. This after the company's next-generation weight loss shot, called CagriSema, fell short of weight loss estimates in its most recent trial. Now, earlier today, we had a chance to catch up with Martin Lang. He is the Executive Vice President of Development at Novo, and we asked him about those results.
The study was a study in patients with overweight or obesity and diabetes. So in essence, obesity and diabetes. The comparator in this trial was placebo. What we saw as the primary endpoint was an almost 16% weight loss, 15.7 to be exact, weight loss in the CagriSema arm. These are among the best weight losses that we've seen in patients with type 2 diabetes. Type 2 diabetes patients have a little bit more of a difficulty losing weight than people without diabetes. So therefore, 15.7% is very substantial. This to be combined with the safety and tolerability profile that we saw with CagriSema that is comparable to that of the well-known GLP-1 class. So very interesting data, and obviously boding well and confirming the weight loss potential that we've already seen from CagriSema in REDEFINE 1.
And when we talk about the popularity of these GLP-1 drugs, we're basically talking about a drug that mimics a chemical, a hormone that's in your stomach. What CagriSema does is essentially introduce a second hormone into that process. One of your competitors is already working on another drug that introduces a third hormone into that process. If CagriSema, as a two-hormone process, fails to live up to expectations, what's next for you and Novo? Do you have something else to work on?
So first of all, we are quite happy with what we've seen with CagriSema, and we've also communicated based on the REDEFINE 1 data that we see a potential for a further weight loss with CagriSema, and for REDEFINE 2, that's the same dynamics. Currently, we have semaglutide on the market. It's a really good weight loss drug, but as importantly, it's the only anti-obesity medication currently approved that has a proven CV benefit in combination with the weight loss. That is currently in the semaglutide label, both for obesity and for diabetes. And obviously, when developing the next generation compounds, including CagriSema, but also our further pipeline drugs, we focus on the weight loss, but we also focus on the comorbidities.
Martin Lang there. He's Novo Nordisk Executive Vice President of Development, Scarlett, who he's not CEO just yet. But it's kind of interesting because he really is kind of the brains behind the sort of the process that these drugs have to go through, the testing and trying to figure out how we get it to market. They obviously had a big hit with Wegovy, which is basically just Ozempic, rebranded for the weight loss set. I don't know what's happening here. I mean, it seems like some people are upset about CagriSema not meeting his targets, but then he was saying, well, look, some of the numbers were actually pretty decent. Also, people were at lower doses, and I guess they weren't like at the highest doses.
It's all relative. That's what it comes down to, right? Because Eli Lilly's Zepbound had, performed a certain way, and CagriSema did not do better than Zepbound. Yeah. So by that measure, it underperformed. And
but people still lost weight, right?
People still lost weight by double-digit percentages, but it has to do better than Eli Lilly's
But he talked about how for some of these types of patients, meaning diabetes patients, it's actually better if they lose it slower as opposed to what Ozempic and Wegovy can do, which is like kind of boom, you just drop 20 pounds like that.
It speaks to how competitive this market has really become, right?
Yeah.
All right, coming up, we're going to take you to the closing bell. We've got a lot more on the current market sell-off here. Anthony Senglabeni, the Chief Market Strategist at Ameriprise Financial, will be joining us next. This is The Close on Bloomberg.
You get to certain levels where people have been kind of complacent in their trades.
Guys, New York session open है 5:30 हो गया, देखते हैं थोड़ा वॉल्यूम आता है तो नेचुरल गैस तो स्टक है वहीं का वहीं, क्रूड ऑयल भी कुछ मोमेंटम में नहीं है. 5:30 open, New York session is open.
Coming into the picture.
And a relatively broad-based sell-off right now. At least at one point on the day, we were looking at one of the worst days going back all the way to 2022, if you can believe it. That was Amy Wu Silverman who kicked us off to the close from RBC Capital Markets, Scarlett. And things really haven't gotten much better. We are off the lows of the day, but still deep in the red.
Yeah, highly correlated among asset classes today. Aside from the yen and treasuries that are higher, everything has a red arrow next to it. I'm looking at the Wilshire 5000, the broadest measure of the U.S. stock market. It's got about 3,300 members, down 2.7%. And then at the other extreme, the Mag 7, in a bear market now, down more than 20% since the record high on December 17th. All 7 names, as you might imagine, in the red.
Yeah, chip stocks also in the bear market. And we should point out, as far as the S&P sector, 6 of those sectors, 6 of the 11 sectors right now in correction territory, down 10% or more as we move closer to these closing bells. Just about 8.5 minutes to go. Let's bring in Anthony Senglabeni. He's Chief Market Strategist over at Ameriprise Financial. And Anthony, two interesting things that jumped out at me today. I mean, everyone's talking about this is going to be the first time we've closed below that 200-day moving average on the S&P since, like late in 2023. This is also going to be the first time, should these conditions hold into the close, the first time we've actually closed in oversold conditions since October of 2023. And I guess my question is, when do these technical levels start acting as that trampoline for a rebound?
Yeah, it's hard to say. It's definitely a risk-off environment today. It's been a risk-off environment over the last couple of weeks. And I think you pointed out some really key stats, right? Semiconductors in a bear market. Mag 7 moves into a bear market today. You see the NASDAQ move into a correction. S&P 500 is getting close to that correction territory. And all of those moving day averages have been violated in all of those indexes. So over the near term, it looks like those conditions are not going to change and the volatility is going to persist as long as we have uncertainty around tariffs and economic policy. But I do believe that longer term investors can start looking at these levels, start putting their shopping list together and start looking at quality names that have been beaten up over the last couple of weeks, if your time horizon is longer than the next couple of weeks or couple of months.
Well said. And I do want to get to some of those names in a second. But before we do, I am curious as to whether you saw this coming. And the reason why I ask is, I mean, you put out your list of recommendations at the start of the year, and it was pretty defensive, at least that's my opinion. It looked pretty defensive to me. And you didn't have, and correct me if I'm wrong, any of the big cap tech names on there, certainly not on the Mag 7. So what did you see at the start of the year that maybe gave you pause?
Yeah, one of the concepts that we talked about coming into the year was this concept of guarded optimism, right? And you've heard it all week on some of the shows and all day today, where valuations were very high, stocks were priced for perfection, some of the valuations in big tech and some of the leaders of the market had been priced at really high levels. And so we have this concept of guarded optimism where if you did see lower taxes, lower regulations, and earnings growth start to accelerate in areas outside of technology, that could be a catalyst to lift stocks through the year. But one of the things that we talked about was this known unknown, which is the tariff drama that we're seeing right now, and the expectations that investors would pull back if they saw that macro environment come down a little bit. I think that's what we're seeing right now. I think the fundamental picture still looks good. I do believe that there is opportunity for growth in this economy. We should get maybe some prospects for lower taxes later in the year, and that earnings story is still pretty strong. So earnings growth is expected to be about 11.5% for the S&P 500. Areas like financials and outside of technology, but materials, consumer staples, their earnings look a little bit more stable. Healthcare. These are the areas that are acting defensive right now outside of technology, and they're the areas that still see some earnings growth for 2025.
So that's where I want to go. They're acting defensive right now, and I'm looking at telecoms, energy names, food, beverage, and tobacco, some utilities, household and personal products that are higher in today's market. Are these temporary hiding places while we get over this bout of volatility, or is there reason to stay in those names for the long term?
I think there's areas outside of technology that can make sense for the full year. So financials, where maybe see more merger and acquisition activity and IPO activity in the second half of the year. Consumer discretionary and staple, the high end of the consumer is still spending. So those trends still make sense. But I do believe that if you get too defensive in this market right now and miss maybe some of the opportunities where the secular growth engines of the economy, like technology, like some of the big tech companies in consumer discretionary and communication services, there will be a point where investors look at some of these stocks and say, you know what, I'm going to hold my nose and I'm going to go in and buy some of these stocks at lower valuations. I don't know exactly where that point is, but I do believe we'll see that at some point. And so you don't want to be totally offside in some of these areas that are really getting hammered today.
I think it's fair to say that investors have been taken aback by President Trump being willing to endure some short-term pain for the long-term gain of rebalancing global trade and shrinking the government, right? He calls it a period of transition or a little disturbance, whereas investors were using the Trump 1.0 playbook to think, no, he's going to come in and maybe support the market through verbal intervention. What are you hearing from your clients as they call you to try to make sense of how they should play out the next couple of weeks and months?
Yeah, they're certainly nervous. There's a lot of uncertainty. You're seeing it playing out in the market. You're seeing it in the sentiment surveys. You're obviously seeing it with clients and conversations that they're having about their investments. One of the things that we talked about was a well-diversified strategy should help you navigate some of the uncertainty that we're likely to see over the next few weeks and maybe even the next few months. Cash, fixed income, alternative strategies. These are areas that you can hide out and lower overall portfolio volatility. We talked about within equities being more defensive. And at some point, with that excess cash, using some of this uncertainty, maybe when we have a little bit more clarity around policy and tariffs and whether they're going to stick and whether this is just a negotiating tactic. Once all that clears, I think there will be an opportunity where stocks can rebound. But in the, kind of in the moment, you want to be well diversified, have some cash and fixed income, and use alternative strategies to help lower that overall portfolio volatility.
All right, got to leave it there, Tony. Anthony Sanglambeni, Chief Market Strategist over at Ameriprise Financial. With markets deep in the red, we should point out we've seen a lot of buying in the Treasury space. Yields across the board, at least on the shorter end of the curve, down by about 10 basis points. We're below 4% on both that 2-year and 5-year. Your 10-year at 4.2.
I'm also looking at Tesla. Shares down about 15, 16%. That is the most since 2020. Yes, there's some fundamental reasons like the pullback in sales estimates, but also that link to Trump.
The VIX elevated on the day, camped out around 28. A full breakdown of all of today's markets coverage starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Scarlett Fu, taking you through that closing bell with a global...
Not yet.
News when you want it with Bloomberg News Now. I'm Karen Moscow. Markets are stabilizing this morning following another sell-off on Wall Street. S&P futures are up 0.2%. This is after tech stocks experienced their biggest one-day plunge since 2022, erasing $1.1 trillion in market value. Begin more with Bloomberg's John Tucker.
Monday's market plunge came as the Trump administration warns of a period of transition and detox for the economy. Economist Dennis Gartman sees it this way.
I think that the economy, no question, is going into recession.
The NASDAQ 100 index plunged 3.8%. Amy Wu Silverman at RBC is waiting for the other shoe to drop.
Are we going to get to that second tier of fear?
The NASDAQ 100 down 12.4% from its market high. That's a correction. The S&P 500 flirting with correction, down to 8.6% from its record set only last month. Max Wasserman at Miramar Capital says investors are still trying to gauge the impact of the Trump trade war.
In the meantime, an uncertainty. Who wants to pay 30, 40 times for these tech earnings right now?
The Bloomberg Magnificent 7 Index, an equal-weighted gauge of the biggest U.S. tech stocks, tumbled 5.4% to bring its rout from a December record to more than 20%. Tesla alone tumbled 15%, widening its loss this year to 45%, while Nvidia lost 5.1%. That has erased more than $1 trillion in market value in just 2 months. The unpredictable tariff policies also spurring risk aversion. Government bonds globally, they're rallying as bets on U.S. exceptionalism start to fade. In New York, I'm John Tucker, Bloomberg Radio.
All right, John, thank you. While the sell-off has been widespread, perhaps the hardest hit have been the richest. We get that story with Bloomberg's Gino Cervetti.
When Donald Trump was sworn in as president on January 20th, he was flanked by some of the wealthiest people: Elon Musk, Jeff Bezos, and Mark Zuckerberg, to name just a few. In fact, thanks to frothy gains in the stock market, they had never been richer. 7 weeks later, it's a different story. 5 of the billionaires have lost a combined $209 billion in wealth, according according to the Bloomberg Billionaires Index. Leading the way lower, Elon Musk, who has seen $148 billion wiped out on paper. Bezos has lost $29 billion, while Google co-founder Sergey Brin has dropped $22 billion. Gina Cervetti, Bloomberg Radio.
Right, Gina, thank you. Now to the latest developments in the war in Ukraine. Russia said it shot down more than 300 drones overnight in what looks to be the biggest attack on its territory since it invaded Ukraine 3 years ago. It comes as Ukrainian officials meet with the U.S. and Saudi Arabia on ending the conflict. Secretary of State Marco Rubio is downplaying any major breakthroughs, but Bloomberg's Greg Sullivan reports this meeting is key for Ukrainian President Volodymyr Zelensky.
There's been a ton of pressure heaped on Zelensky by the White House, and the Ukrainian side will really be looking to tamp down that pressure and tone it down and remain engaged so they can hopefully stay at the table and in any kind of future ceasefire agreement potentially have terms that are more favorable to them.
Bloomberg's Greg Sullivan reports President Zelensky is not taking part in today's meeting, but he did speak with Saudi Crown Prince Mohammed bin Salman. Back in Washington, signs this morning a government shutdown may be averted on Friday. The ultra-conservative House Freedom Caucus is throwing its backing behind a stopgap funding package. That's bolstering Speaker Mike Johnson's attempt to pass the bill without the help of House Democrats. The vote on the stopgap is set for later today, and Johnson can likely only afford to lose 2 Republicans on the measure if Democrats line up uniformly against it. Elon Musk hinting that Social Security and Medicare could be targets for spending cuts. The figurehead of President Trump's government efficiency effort discussed it in an interview with Fox Business.
The way it's important in entitlement spending, which is most of the federal spending is entitlements. That's like the big one to eliminate. That's the sort of $500 billion, maybe $700 billion a year.
And Elon Musk's comments could face opposition on Capitol Hill from lawmakers who've already faced backlash about cuts to federal agencies. President Trump has said he won't reduce Social Security or Medicare benefits, but will go after improper payments. Southwest saying it's going to begin charging passengers for some checked luggage. It's sending a free bag policy that has been a hallmark of the carrier since its founding more than 5 decades ago. American Airlines said it will have a larger first quarter loss than expected as it grapples with weak leisure travel demand and fallout from a fatal collision involving one of its planes in Washington. Delta also slashed its profit forecast. And futures again are higher this morning, signaling a bounce on Wall Street. S&P futures up 0.33%, Dow futures up 0.25%, NASDAQ futures up 0.33%, 10-year Treasury yield at 4.22%. And that's news when you want it with Bloomberg News Now. I'm Karen Moscow, and this is Bloomberg.
attributed these disruptions to a massive cyber attack, suggesting significant resources were involved, possibly from a large hacker group or nation state. Despite these claims, the exact nature of the outages remains unclear, but they were most likely took the form of a distributed denial of service attacks, DDoS. Neil, it was humbling yesterday to realize how often I reach for my phone to check X throughout the day, which only became clear to me when the platform was constantly down every time I tried to access it.
Also, absolutely horrible timing for sports fans because yesterday was the effective start of NFL free agency. It reminded you of how much X plays a role in the distribution and dissemination of sports news. You have people like Adam Schefter and other NFL insiders ready to tweet all of these major moves about different players going to different teams. 3 of the top 5 live queries on Google Trends for searches of Twitter down mentioned NFL free agency. So you had these sports reporters who are followed in the millions on Twitter going to Blue Sky, going to Threads, because they wanted to get this information out. People were craving this information. So absolutely horrible timing for Twitter to go down on a day of free agency like this. In M&A news, real estate listing platform and brokerage Redfin is getting bought by Rocket Companies for $1.75 billion. It shows that Rocket, Dan Gilbert's Detroit behemoth that includes mortgage, real estate, and personal finance businesses, wants to push deeper into the property market in the hopes that Redfin's tech-fueled platform can help it boost mortgage originations, which have been slumping in this era of sky-high interest rates. Redfin stock shot up 67% on the news, but it's still languishing down 90% since a pandemic peak in 2021 when everyone was looking for their country escape.
It's been interesting. This really tough housing market that we just spoke about in the previous segment has actually spurred a little bit more deal making in, the mortgage industry. Last year, Compass agreed to buy Christie's International Real Estate, for $444 million. Last month, Redfin struck an agreement to make Zillow the exclusive provider of rental listings on its site. So we have been seeing a little bit of consolidation in this industry as, the housing market remains just so severely constricted with borrowing costs so high, making it very hard for new homeowners to, enter the market. It turns out that DVDs aren't as timeless as the movies they contain, and some of them have been quietly turning into gross coasters due to an issue known as disc rot. Warner Bros. Has recently acknowledged that numerous DVDs produced between 2006 and 2008 are experiencing premature failure due to this phenomenon, which renders discs unreadable through a process of chemical deterioration. The issue has prompted the company to offer replacements for affected discs. Neil, this isn't a new problem. People on Reddit forums have been calling it out for a long time now, but properly cared for DVDs should be playable for up to 100 years. But when it's getting in the way of a 2001 A Space Odyssey rewatch, it's gonna make some headlines.
My worst fears were confirmed. I looked at this list of movies and DVDs that could be affected that were produced during those years. And yes, Entourage seasons 1 through 4 are on the list. So I gotta go check and make sure that those DVDs are not rotted and that they are in pristine condition. Finally, a top comedy club in the UK says it's banning audience members with Botox because their tight faces don't react to jokes. The owner of Top Secret Comedy Club, which has hosted major comedians like Dave Chappelle, explained the move, saying our incredibly talented comedians are fed up with performing to reactionless faces. I've had numerous complaints from performers who find it increasingly challenging to gauge audience engagement and bounce off their reactions. How do you even enforce something like this? The club said bouncers will be carrying out, quote, expression checks designed to detect Botox. Toby, before you say this is a joke, owner Mark Rothman said, we're dead serious about the ban, and if you're surprised, we need to see that.
I think it's tongue in firmly, reactive cheek here. It is a very funny headline to put out there, but I will say research has shown that when Botox is injected into places like foreheads, it does alter people's brain chemistry because it impacts how you interpret other people's emotions. So if I'm, giving you some fire jokes, Neil, and you're giving me nothing back in return, it actually decreases like our social bond, our chemical connection is off there. So I do see, obviously, like this is a joke, like this is a comedy club, but if you were a comedian and you just saw a bunch of frozen faces in front of you, it would make your job a lot harder. So yes, it's a joke, but I do think comedy is a two-way street in this regard.
Let's roll the credits. Emily Milliron is our executive producer. Raymond Liu is our producer. Olivia Graham and Olivia Lake are our associate producers. Yes, we got a new Olivia. Welcome to the fam. Uchenna Ogu is our technical director. Scoop Sardaris is on audio. Hair and makeup is laughing, I promise. Devin Emery is our chief content officer, and our show is a production of Morning Brew.
Great show today, Neil. Let's run it back tomorrow.
Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail.
Welcome to Stocks in Translation, broadcasting from the New York Stock Exchange. I'm Jared Blickery, your host, and with me is Yahoo Finance's Madison Mills, who's in for the People's Voice. Sydney's on assignment this week. First, please like, subscribe, and comment on Stocks in Translation on Spotify, Apple Music, Amazon, or YouTube. And today we are welcoming Stephanie Aliaga. She is a JP Morgan Asset Management Global Market Strategist. And today we're going to be talking about stocks around the world with a smattering of fixed income for all you bond junkies. Our phrase of the day: policy uncertainty. It's not a surprise, but it's here, and investors need to understand how the table is set. Only afterwards do we feast. And this episode is brought to you by the number 50%. Fully half of all U.S. CapEx spending growth is going to be spent by 4 companies over the next year. Only 4, and you can guess who they are. So, Stephanie, tell us right now what you think of the market so far in 2025.
So far this year, we've seen, as a continuation of the last 2 years, that price momentum and earnings momentum have really been in sync. Now, earnings momentum is still quite intact, but a lot is in the price at the start of this year. And so markets have traded a bit sideways, but that sideways action really masks what we're seeing underneath the hood, which is quite remarkable. A broadening out, which we thought was the focus of, or was going to be the theme of 2025, so far seems to be the case. The EFA is outperforming U.S. equity markets. Value is outperforming growth. The other 493 stocks are underperforming the Mag 7. And this earnings season, when it comes to the fundamentals, 11 out of 12 of the sectors are seeing positive earnings growth. So we think that's the theme this year, is that breadth is really the essence. And I think investors are taking the opportunity, particularly given elevated concentration in their portfolios within U.S. growth and U.S. tech, to lean into some of these areas with now some wind behind the sails.
Yes, and with that massive wind, I think people aren't happy unless the indexes are screaming higher. But as you said, there's a lot happening under the surface here. And part of this is related to our phrase of the day, which is policy uncertainty. So let's break that down right now. Policy uncertainty refers to the lack or clarity of predictability about government actions, such as regulation, taxes, or monetary policy. And this can impact business decisions, investments, and also market stability. stability. So as I said before, we knew it was coming, and policy uncertainty itself can be a tool. So there can be upside, there can be downside. We tend to focus on the downside and the risks more, but tell me what you think about it.
Absolutely. I'll use an analogy that Powell himself used at the December Fed meeting, was that the Fed thinks that they're driving through this fog of uncertainty. They know the road that they're on, they know the direction they're on, and that one, it's a pretty good road. It's one of the economy still growing at or maybe slightly above its trend GDP growth rate, inflation coming down, but there's this fog of uncertainty. What do you do in the midst of the fog? You slow down a little bit. That's what the Fed is doing. They're on holds, likely until this summer at least. For investors, we have to decide, how do we position in the midst of fog, given that there's upside and there's downside risk, exactly to your point. The upside risk, maybe we get more deregulation, maybe that is shown to be quite productivity enhancing. It could also be enhancing for many sectors of the market, particularly financials, industrials, et cetera. But lately, particularly in the last 2 weeks, what's been incredibly foggy and worrisome in some ways has just been the storm of tariff announcements that we've seen. A lot of action from the Department of Government Efficiency, DOGE, and it's really hard to get reputable or credible or get a sense of the numbers around what has been done and what is going to be done on deficit spending. And then you also have the uncertainties farther down the road on the fiscal front, the reconciliation bill. How does all of this net out?
Yes, please.
Really
Crystal ball.
remains to be seen. Will be a fun year to kind of be watching the markets. But I think the way investors are positioning is quite notable, and that leaning into diversification, checking your headlights, checking your brakes in the midst of a storm. How are you protected or potentially can benefit from the way that the chips fall?
Go ahead.
How would you rate the idea of looking outside of the U.S., looking at Europe, like you mentioned, even looking at China, some of the tech names there, as a way to defensively position?
Absolutely. And I think it also comes on the heels of record high concentration in the markets last year, and also very low investor positioning, particularly in U.S. portfolios. U.S. investors,
Not committed. People were not committed.
They weren't in the markets when it comes to, international stocks. And hey, it was good reasons. U.S. exceptionalism, U.S. profitability has really been leading the way globally. But when you're looking at expectations that have never been lower, relative in U.S. markets, expectations have never been higher. Well, the hurdles to reach are not that high. And now suddenly we have some new tailwinds. We're going to get more defense spending from Europe. Maybe we're going to get more fiscal activism from those governments, particularly in the midst and in the wake of this trade war. And you have some of these secular trends like AI, maybe aren't only a U.S. story. And so some of that, I think, is really coming to fruition in the valuation rating in these stocks, which, when it comes to diversification, you want to have a little bit of international in your portfolio. The last few weeks show that when U.S. stocks zig, international stocks can zag and help buffer the impact there.
They just haven't done that necessarily much this century. So U.S. exceptionalism has been a big theme, and I guess investors might be wondering, has it peaked? Do we have an all clear to kind of venture into these other waters here? You mentioned diversification as part of a balanced portfolio, but how far do investors, how long does this last? How long does this foray into the rest of the world last before maybe investors are thinking, okay, it's gonna pull back again like it has so many other times this century?
Absolutely. So the way I'll take this is U.S. exceptionalism is quite consensus view. It's what has driven U.S. gains to really dominate the global marketplace. But a lot is in the price. And if you look at valuations for the S&P 500, they're not screaming bubble. They're not incredibly profitable. Maybe they're justified, but they're elevated. And while elevated valuations won't tell you much about where the market's going to be 1 year from now, they do limit the kind of returns you can expect over the longer term. We have a slide in the guide to the markets that shows this. And over a 5-year, 10-year horizon, higher valuations in the U.S. are going to limit the kind of returns you can see in U.S. equity markets. In our long-term capital market assumptions, this is our view. Eventually, we are expecting to see that international stocks are really going to return a greater amount relative to the U.S. We have a 6.7% average return expected over the next 10 to 15 years in U.S. stocks, compared to 8.1 for the rest of the markets. When does that turn? I mean, this year we're seeing really
and
early
any thresholds, like market thresholds, you look at currencies, the dollar, anything like that?
So one of the things that has really been, placing a ceiling on international performance in recent years has been the dollar.
Sure.
The dollar's been really strong. It's been getting stronger.
It's been a wrecking ball at times, as I said.
It has been. And this year we're seeing the dollar is softening. And I think over the medium term, we expect to see more of this. Growth differentials are narrowing and interest rate differentials are narrowing. Investors are likely going to reposition given record high U.S. concentration and in portfolios. And all of that process should likely lead the U.S. dollar to be flat to down over the medium term. So we don't think it's going to be as much of a headwind for international equities going forward, is what I'll say.
What about the bond market? We've seen the 10-year T-note yield, which is kind of follows the dollar. So as you said, the dollar has been a little bit weak this year, and the 10-year T-note, I think it either peaked in early January or December. It's well off of those highs, but 5% was just this huge psychological number that people had in their minds. I think the 30-year got that. People were scared the 10-year was going to get there. How do rates figure into your perspective?
So we're seeing different impulses depending on where you are on the curve. And on the longer end of the curve, I think, the market rates have been higher despite the Fed cutting interest rates. We've all been reminded that there are plenty of other factors that are really driving the longer end. And we think, the longer end is likely going to remain range bound, if not slightly have some upside risk to it there, given the reality of deficit concerns, particularly as we get into the summer and the fall and market shift focus there. We're going to get a lot more treasury issuance over the next few years. Not necessarily more demand. In fact, central banks, they're buying more gold than they are U.S. Treasuries.
Is that a problem?
Right
I mean, is that a problem, foreign demand for U.S. Treasuries? I mean, this gets into the global currency system and the dollar, reserve currency. What do you think about that?
We have seen this secular trend of diversification.
De-dollarization.
Yes, to a degree. But when it comes to how are you actually going to finance large purchases, finance your government, finance commerce, there is no alternative to the safety, the liquidity that you get in U.S. markets. So we don't think that, the demise of the dollar is anytime soon, but we might continue to see this diversification. Now, who's buying treasuries if it's not central banks?
China and Japan, those have been some of the biggest.
They have been some of the biggest, but most recently, more U.S. households. So actually, maybe it's not so bad if some of the coupon payments that we're making are getting recirculated into, income payments and 401ks and such. And so I think that's some of the stability that we're seeing underneath the hood when it comes to global treasury markets.
And really quickly, since you mentioned consumers and U.S. households, I know a lot of people who put a significant portion of their 401ks into the Mag 7, and now they're starting to get a little bit worried. What would you tell those people?
Look, the fundamentals underneath these companies are still quite robust. I think the amount of upside that you're going to get from these 7 names is more limited in the year ahead. But this is nothing like what we saw during the dot-com boom and bust. I mean, fundamentals have really been the driving force.
And the balance sheets are different. The cash flow is different.
Cash flows are different, yes.
A lot of differences there.
Absolutely. But having a concentration in portfolios does leave you vulnerable to greater kind of volatility, particularly given the fact that, the AI theme is evolving quite rapidly. Some of the assumptions that we have may call, the market leadership into question at times.
I mean, to Madison's point, anybody invested in the S&P 500 last year, which I think is a lot of people, maybe those people should have had concentration worries. So, I mean, given the structure of the dominance of the Mag 7, I think that was a legitimate concern. What about now? Because we've seen the Mag 7 just really not cut. And you mentioned this at the very beginning, that we've finally seen a little bit of this broadening. So how does that play out?
We're seeing a broadening in 2 things. One, it's not only the Mag 7 driving earnings growth this year. Now other sectors of markets are seeing earnings growth. But then the other thing quite fascinating happening is that the AI theme is broadening out. We're realizing it's not only just a few companies that are going to dominate or reap the benefits when it comes to AI, particularly if you get lower costs of compute in the wake of DeepSeek, in the wake of some of these innovations, right? Maybe more companies can participate. And the adopters of AI, those companies across sectors have not really participated as much in the rally, given that so much of the focus has been on the infrastructure build out. So we think that that's likely going to continue.
All right. Hold that thought. We're going to return to that in a second. We need to take a short break, but coming up, we're going to break down the hundreds of billions of dollars spent on AI by only 4 companies, plus a runway showdown featuring U.S. versus Europe. Very 20th century, if you think about it.
Oh yeah, you're not going to forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time. Right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time. Right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail.
We are back, and this episode is brought to you by the number 50%. And as you noted earlier, Stephanie, prior to the show, that this is the share of capital expenditures, or CapEx, being spent by only 4 companies. That's Microsoft, Alphabet, Google, Amazon, and Meta. And just to break down CapEx real quickly for the viewers, capital expenditures is the money that a company spends to buy or to improve its physical assets like buildings and equipment with the goal of growing its business and helping it operate better. But here, in the context of capital expenditures, we're talking about, what, data centers, NVIDIA chips. It's kind of narrow. I haven't seen this before in my investing lifetime, so it's pretty interesting to watch it unfold. What do you think about this particular concentration?
In CapEx spending?
In CapEx spending by the hyperscalers. Like, this is unsustainable, I think. But maybe that's just me.
It's fascinating. I mean, actually, I've seen data that if you even take into account all the announcements of CapEx for this year, we're not at what we saw during the internet yet. So there's likely room for this to continue to scale. And the big uncertainty here is it's really hard for any one of us to fathom how much AI we're going to need and use once we figure out how useful this thing is.
Based on my current levels, it's unmanageable.
Yeah. I've started using it for nearly everything across personal life and work life and research, you know, everything underneath the hood. But we're in really early innings when it comes to adoption. Not only are, you know, the share of businesses right now that say that they're actually using AI to reduce goods and services like 7% in the U.S. We want that, the company spending all this, see that expanding.
It's going to
obviously.
100.
It's going to 100.
Eventually.
And it's deepening. Now, the uncertainty here is how much infrastructure do we need to service all of this? Because longer term, you get a bit of a balancing act. We're going to have all of these efficiencies come from AI because AI is going to get us better at innovating. It's going to reduce the cost for R&D.
It's going to innovate itself.
It's going to innovate itself. There you go. It's going to show us what we're not focusing on that we should be focusing on. And that is what it's so hard to imagine. So we want to look just in the next couple of years. And in the next couple of years, the 4 companies are expected to spend pretty significant amounts this year alone, $318 billion. And we think they have a pretty good sense around demand in the next 12 months. Farther out, there's a bit more uncertainty, but 12, 24, 36 months, all of that spending I think is likely going to be done, and it's helping fuel the economy right now.
In a big way.
Typically, when the Fed raises interest rates, the cost of capital gets more expensive. Businesses start to rethink some of their CapEx plans. But instead, we're seeing this really powerful secular tailwind on the CapEx front, which is helping boost the economy.
I want to ask you, I want to dig into that a little bit. You know, you mentioned that AI is just kind of pervading everything, and we have seen investors really get excited about electricity and all these spin-off plays last year. Do you think any of this is overdone? Where do you see the next opportunity? Because we had a value investor on recently, Lee Munson, and he was talking about companies like SAP, Enterprise Software, CRM, Salesforce, these bolt-on additions that they're doing to make AI better for their particular businesses. He said that thesis is they're able to monetize more quickly, and that's coming later this year, not next year, not 2027. That scale, that whole movement may have been shifted a little bit forward. So there are different plays here. Where do you see the opportunities?
The first thing that really that makes me think of is, with the build out of the internet, it costs a lot of money to invest and build out that infrastructure. But some of the biggest beneficiaries of the internet ended up being companies like Netflix and Facebook that could just piggyback on the infrastructure years later. But things are moving quite rapidly with AI. And I think that's really the question when it comes to software. You know, what are the companies that can benefit from lower cost of compute and really lead the charge on enterprise adoption? Because the difference with enterprise adoption versus just consumer adoption is that enterprises need precise AI. And there is a big market there to service and train AI models and applications that are actually useful for enterprises that they can then adopt and pay for. That I think is an area that is ripe to participate more in this in the kind of AI theme.
I mean, that's kind of the future. Businesses figuring out how is AI going to help me, not necessarily the picks and shovels. Right. How do we load up this entire system? You know, you mentioned the .com era, and what it reminds me of, and it just kind of occurred to me that at the time, high-speed internet, so we were laying down all kinds of fiber. The telcos were kind of like the utilities, the electricity production of today. That was kind of the theme back then. We're going to build out fiber. They overbuilt it to a huge degree. And then after we saw the .com bust, there was just all this excess fiber capacity. But that kind of spurred the next wave of development. And then eventually Netflix and others were able to capitalize on that. So, I mean, as you said, this time frame is kind of condensed here, but I guess I'm not even sure where I'm going with this anymore. I like the fact that there's historical parallels. Do you see anything there?
I'll say the starting point, at the end of last year, the vacancy rates for data centers were incredibly tight, below 5%. And in, West Virginia, the kind of epicenter of data centers was 2%. So we're starting at really, really tight supply and demand levels. Maybe we overdo it and build a few data centers that are vacant. But I think give it a few more years and those will get occupied.
They won't be vacant long term.
They won't be vacant long term. So it's worth the risk of maybe a little bit of oversupply for this longer term vision of a lot of adoption of AI. And I think that is really what is powering all of the confidence around this CapEx spending trajectory.
And one thing we haven't really talked about is DeepSeek that led to that $600 billion sell-off in NVIDIA stock. They were able to train their AI for far less than a lot of the companies that we're talking about. One of the questions I get a lot on social is how to play the DeepSeek problem. How are you thinking about the DeepSeek problem, and is it such a problem?
Well, look, when costs for technology move down, margins can expand, more innovation can take place, and you can get a lot more adoption. And I think that is one of the real shifts that we're now seeing in AI. It's just a lot more players can potentially come into the space. And then even when it comes to the leading tech companies, we realize it is not enough to have the best technology in the game. It is not enough to be first. You need to continue to innovate, You need to continue to adapt. And it all comes down to your business model. Can you turn innovation into profits? It comes down to your distribution, right? And that's why you've seen some companies, for instance, Microsoft swiftly moved into adopting AI or bringing, DeepSeek into their model catalog. It wants to be the provider that sells you service to AI, regardless of who builds it. So I think continuing to invest in distribution as the moat, because models and the technology, maybe they can come and go.
All right. Cue the catwalk, because 2025 markets are serving some unexpected looks. The U.S. has long been the supermodel of global equities, high growth, high efficiency, and balance sheets that go on for miles. But this year, Europe is catching the fashion vibe and strutting down the runway like it owns the place. Germany's DAX and Spain's IBEX have each surged 14%. Even France is turning heads with a 10% pop. Meanwhile, in the U.S., S&P 500 is crawling up 2%, with the NASDAQ not far ahead at 3%. But fashion is forward-looking. So can Europe keep its streak alive, or is the U.S. just between wardrobe changes? And let's settle it, Stephanie. Who is wearing the 2025 market environment better?
I think Europe really came in with a surprise, but I don't know if its streak will be that long lasting. And I think just as quick as fashion trends go, sometimes the what is known and familiar really ends up leading the way. And I think this year will continue to be another year of U.S. exceptionalism, but with others on the runway too.
It's kind of funny that we're acting like it's such a bad year for the U.S. when we've still got multiple all-time highs after hitting such a record after last year.
I know.
So I just think it's interesting.
Markets this year have become tiger parents. It's like we're only
I like that.
A++s from here on out. Otherwise, I don't even bother.
Make sure you practice piano 3 hours a day in the evening or the early morning.
Exactly.
We have a couple more minutes here, so I thought, why don't we do this? I have your notes, and one of your surprises is you have flown a fighter jet. Can you break that down for us? Tell us that story.
Live my Top Gun dream.
Yes.
Funny enough, I have a friend that flies planes, and in his family they have a fighter jet, and he took me up with him, and I basically learned the importance of precision, of patience, and also, listening to instructions, particularly on the G's.
Yeah.
or else losing your breath.
Your friend just has a fighter jet.
Yeah, those people exist out there.
Wow.
High risk tolerance for me, to be willing to go up, right?
Yeah.
Maybe there's a read through here for investing, because a lot of precision is very, very helpful in the markets. You don't necessarily want to be a slave to it, but how do you think about risk management and the thought of before you go out into an investment, just kind of thinking through it and having a trading plan and preparing for the worst as well as, the good stuff?
Absolutely. I think investors want to make sure that they have the eye on the prize when it comes to the time horizon for their investment needs. And then also just making sure you have some balance in portfolios and continuing to really ask yourself that. The big action item for us that we gave investors this year is leaning into diversification, given the likely shift in portfolios that has been experienced with the dominance of U.S. tech and U.S. growth. Where can you lean into diversification, build some sturdier foundations but underneath portfolios, not just for risk management, but also to opportunistically make sure that you're positioned to benefit from the broadening out in performance that we're expecting.
Right, wise words there. And we're going to wind things down here at Stocks in Translation. Be sure to check out our other episodes on your favorite podcast platforms, as well as the Yahoo Finance site and mobile app. And we will see you next time on Stocks in Translation.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Podcast that will make you a smarter investor.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Welcome to Financial Freestyle. Hi, I'm Bob Powell, and welcome to Decoding Retirement. Welcome to Living Not So Fabulously.
Welcome to Trader Talk, the podcast that dishes out the market straight up.
Welcome to Capital Gains. I'm your host, Madison Mills.
Welcome to Word Money. I'm Patrick Murphy. And I'm Dan Coons.
From Wall Street to Main Street to the C-Suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail.
Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Brad Smith alongside Madison Mills. Let's get to the three things that you need to know today.
First up, U.S. stock futures lower this morning after the worst stock sell-off this year. All of the U.S. major averages closed down by more than 2%. NASDAQ 100 fell 4% in its biggest one-day drop since 2022, now down 12% from its all-time high. Sharp sell-off coming amid growing concerns on the street of a growth slowdown as investors grapple with slowing economic growth and tariffs from the Trump administration.
Plus, on the sector front, investors rushed into defensive corners of the market. The technology sector was the hardest hit, along with consumer discretionary, which are seen as more risk-prone and especially amid a weaker economy. Meanwhile, sectors seen as havens amid economic woes were stronger. Sectors like utilities and energy, the best performers amid the sell-off.
And looking at the individual market movers, Tesla shares falling 15% in their biggest one-day slide in 5 years amid growing concerns on Wall Street about demand for the company's electric cars. Meantime, corporate America sending warning signals. Mixed picture for airlines, which initially fell after Delta slashed its outlook on economic uncertainty, while United Air said it's seen weakness in travel demand. Stock futures still in the red this morning after U.S. stocks saw their worst day of the year in Monday's trade, with tech stocks bearing the brunt of losses and the Nasdaq seeing its biggest intraday slide since 2022 amid a growing wall of worry. Joining us now with more, we've got Tony Wang, T. Rowe Price Science Technology Equity Strategy Portfolio Manager. Tony, great to have you on this morning. I think the big question for investors is, especially with tech and the valuation concerns that we've seen during the run-up in these AI names, is this a buying opportunity? At what point is this a buyable dip in tech stocks?
Yeah, I think that's the key question right now. I think that when you look at it, there are signs where we should stabilize and there will be rallies, and the technicals do suggest that we rally back. But I think that when you take a step back and look at the last few years, tech has had a really good run. Growth and momentum stocks have done extremely well. And, when you think about the Mag 7 leading, they've kind of gone to Lag 7 in this year. And I think that's part of it is because they were spending a lot of CapEx, and then the results are becoming more in line. And, if we look forward, they're likely going to be not accelerating. So I think that when you think about kind of the setup here, while there are suggestions that perhaps these valuations are a lot more attractive, I think that you have to know what kind of market you're in. If you're in a bull market, you need conviction, and if you're in a bear market, you need some patience.
And so, all this considered, Tony, we had on the show yesterday Mohammed Al-Arian, who had given us some context about what to expect over the course of this year. And he said a bumpy journey with a growth scare. What does that translate through to the portfolio strategy that investors would be apt to employ?
Yeah, well, so, I think that we want to be understanding in terms of what the market is kind of set up. And so where are there, in my opinion, fundamentals that are improving, that valuations are very reasonable. I think here we see the valuations have been repriced in the last few months, but I think that if you go to conferences, a lot of the sentiment is nothing's changed, right? The fundamentals are still strong, numbers are still good. I think you can read that as it's bullish or it's bearish because numbers have not reset yet and there isn't real capitulation.
So what exactly should investors be looking at when it comes to that capitulation moving forward here? What would be the potential catalyst to get stocks moving back up into the green?
Yeah, I think that it all does come down to fundamentals being sustainable. I think that right now the growth scare is that, what happens in 2026? We're seeing some cracks. I think that this morning, Delta Airlines as well as Asana reported softer macro. Is this a blip? And how do people think about the go forward on 26 being more of sustainable numbers where it's not going to be a dramatic fall off?
And this is a earnings period where we typically see some of those full year forecasts kind of revised and giving the markets a sense of ultimately what they should expect for the rest of the year so that companies might have the opportunity to even beat on some of those expectations. But from some of the revisions that you've seen thus far, has the companies that have reported, the executives, have they clearly communicated whether or not the worst is actually baked into that, or could there be potential downside potential here still to some of the earnings projections that we've seen?
Yeah, I think if you look back at this last earnings cycle, they're actually relatively good earnings and beats, and they were kind of met with relatively muted reactions, or even the stock sold off. And so when companies report good results and the stocks go down, it's actually a pretty concerning thing. Investors started wondering are we just past the peak cycle, and where the investors in the market are looking more towards things being a little bit more half empty. And so I think that was a combination of strong results met with lukewarm or kind of downside in the stocks. And so here I think that you want to look at where are there areas in the market where it's not over earning, and what stocks probably didn't do particularly well in the last 2 years that could have a more resurgence. And so I think that that's kind of what we're looking at in our fund.
But what does that say about the forecasts that they're also putting out there too? Because if you do have that type of reaction, the markets typically on average are looking 6 months out. So it's clearly something about what these companies are saying that's getting baked into their guidance.
Yeah, absolutely. And so if you look at one thing that was kind of interesting is that the Stargate news came out and the stocks didn't move up very much on that. That's an example. And so, I think that the forecasts are, here, but I think that a lot of times, like, the market, it doesn't believe it right now. And so it's essentially discounting it and saying, like, this is not sustainable, the numbers are too high when they're getting sold off. And so, that's the controversy where we're going to have the bull-bear debate. And I think that the next few quarters are going to really matter here.
Yeah, Tony, forgive me. Do you talk names, individual stocks?
I think we can talk some names at high level.
Okay,
I could give a long-term perspective.
So of the Mag 7, obviously in correction territory, now down 16% year to date, which of those names is best positioned for recovery?
Yeah, I think that if you think about, follow this framework of where return is going to improve and where can they accelerate, I think that you probably have Apple being the one that's been out of the CapEx war and like chasing frontier models. And so if the models do become more commoditized and, whether it's like DeepSeek or more smaller models that are able to generate more ROI for enterprises, I think if that plays out, then I do think Apple is a good position where they haven't spent a lot of CapEx and they're still the ecosystem holder. And if there's an upgrade cycle because of that on their iPhones, that they can essentially do a little bit better relative as a result.
I'm still the problem for Apple right now, Tony. I still got this 12 Pro Max right now. The battery is just fine, and I guess the only thing is I don't get all the benefits of apps that are now fully over to that iOS 17. That's a me problem, and somewhat of them problem too. Tony, thanks so much for taking the time.
Thank you.
Well, U.S. stock futures this morning, they are mixed now, with the NASDAQ flat just barely to the upside. We'll see where that holds going into the start of today's trade. The market's meltdown, though, to begin the week coincides with a major shift on Wall Street as strategists rethink the growth outlook for the U.S. economy. Here to discuss this further, we've got Josh Schaefer. Josh, one particular takeout from Citi here, especially kind of leaning into this right now as well.
Yeah, so Citi's global team was out this morning, Brad, saying that they are moving to a neutral stance on U.S. equities. They actually moved China to an overweight. You've seen this kind of move across a lot of different firms as far as moving something overseas to overweight and moving U.S. equities to neutral. What you're looking at on your screen right now is GDP forecasts. Those are from Goldman Sachs and Morgan Stanley. JP Morgan also moved theirs down. And again, notably, Goldman Sachs and JP Morgan moving down their U.S. forecast, moving up their Euro forecasts. You take a look at the stock market over the last month, what's been going up, Euro stocks, what's been going down, U.S. stocks. So sort of what's happening here is a little bit of a play to a rate of change, right? You want to be in the area where things are going up, not in the area where things are going down from a growth perspective. And as we see these economic growth forecasts get moved down for the U.S. economy, that has not been the trend over the last year. So we're counter to sort of where we had been. And what I think is important to point out here, I want to highlight this chart from Lori Calvasina over at RBC Capital Markets. It's a look at GDP and how stocks interact under different GDP regimes. What's interesting in this chart is between 0 and 2% is when you see stocks fall the most, not when GDP is below 0%. So what is that chart showing us? I would argue it's showing you that the most dangerous time in the market is when the market is pricing in a slowdown, right? Not when the market is, when we've already accepted that we're in a slowdown. Right now, we're starting to price in a little bit of a slowdown. We've moved below that 2% level where stocks normally perform well. And the question is, how far down are we going? And quite frankly, I don't think anyone has that exact answer right now. As we always joke, if we did have that exact answer, we'd probably be trading right now, right? But I think that's the key question right now, right? Is you're pricing in a slowdown in growth, how bad is the slowdown going to be?
That's such an important chart and points to the need for certainty in the market. And Josh, I found this chart this morning that I want to get your take on here, just to give our viewers a sense of what might happen today, the day after a drop like we saw coming into the start of this week on Monday. The majority of the time, you do see the market recovering. The following day, you can see a gain of about 1% is going to happen the majority of the time. But of course, there is still a chance that we continue to see selling, and nobody knows where we're going to go from here. What are you looking at? What are your sources looking at to determine just over the course of today, over the course of this week, when we get this key economic data on inflation, where are we going to go from here?
Yeah, Maddie, I think there's two cuts to that chart too, right? The other one would be I could look at the top and the bottom line, which tell me move more than 1% or move less than 1%, that's also over a 50% chance too, right?
Yeah.
So in some ways, perhaps the volatility that you've seen in this market isn't going anywhere.
That's the only guarantee.
And that, I think, is sort of what most strategists are saying right now. Listen, this is not maybe the dip that you buy hand over fist this morning because we feel confident that this narrative is changing right now. It is a little bit of a wait and see. You have inflation data coming out tomorrow. You have consumer sentiment data on Friday that has been moving the market over its last couple of releases. So there doesn't feel like a clear catalyst where you're going to say, okay, now I know it's time to buy, right? And I think that's important for investors out there to understand too, is when you talk about quote unquote buying the dip, no one knows exactly where the dip is, right? And at some point, things just start to slowly change a little bit, and there will be some catalysts along the way. But just because we had the worst day in the stock market since 2022, at least from the NASDAQ's perspective, that doesn't mean that you just get a relief rally today and then it's over after that relief rally, right? I think some of these growth concerns that are out there are legitimate. I think the policy uncertainty is, of course, not leaving us, right? We still don't know what's happening with tariffs in a month. Yeah. That conversation isn't going anywhere. So I don't think this is we're going to leave this week with more answers than we had. We're out of peak earnings season right now, right? We're hearing from some airliners today, but you're not hearing from a lot of corporates right now either. So it's a little bit of a quiet period. We're sort of digesting, trying to figure out what's happening. Again, key inflation data tomorrow seems to probably be your next major catalyst.
The honors physics student in me would say even dead cats bounce. Ultimately,
that is true.
That is still true. Josh, thanks so much for taking the time. Recession fears are creeping into the market as investors attempt to understand the administration's ever-changing trade policy and its potential impact on inflation. The market will get its next gauge on the state of the U.S. inflation Wednesday with February's consumer price index. Joining me now, we've got Julia Coronado, who's the Macro Policy Perspectives founder and president. Thanks so much for taking the time here with us today. Let's just start with your expectations for this next inflation reading that we're set to get this week.
Yeah, I mean, we expect that we're going to see some remaining stickiness, the kind of stickiness we've seen in recent reports. Not quite as bad. We expect some progress in core inflation relative to January, but we're at a 0.3. We get maybe a tick of relief on the annual rate, but really this isn't a report that's going to give a lot of relief to the Fed. We're in a period of beginning of year price resets that tends to keep core inflation a bit elevated in Q1. So we still think we're going to see some of that in the February report. And so that kind of leaves the Fed in the holding pattern it's been in. And just waiting to see how these policies that are very likely going to affect the trajectory of inflation and growth unfold in coming months.
Julia, what does it take, in your view, to get the Fed to really firmly put itself back on the table when it comes to the idea of the Fed put? What does it take for the Fed to come out and be more dovish? We know that the market is pricing in over 80 basis points of cuts so far this year, increasing the chances of a cut in May. How much more pain do we need to see for that cut in May to become a reality, in your view?
I think we need to see more pain. So the Fed is in a very difficult position. The policies being proposed are almost certainly going to lift consumer prices. So they're not going to see the progress that they had expected to see in the near future. That leaves them on the sidelines unless and until the economy really breaks, the labor market really softens decisively. The bar to cutting is a lot higher than it was, say, in the last trade war in 2018 when inflation was running below their target. And so as tariffs disrupted the global manufacturing economy, the Fed could take out a few insurance rate cuts just to make sure that that doesn't infect the U.S. economy. We are not in that position. The Fed is approaching its inflation target from above. Inflation has been sticky in recent months. So it really would be, the next cut is likely to be motivated by labor market weakness. And it has to be, worrisome enough that they're willing to overlook the imminent threat from tariffs on inflation. So they're looking at risks to both sides of their mandates. And I think May feels real early for them to be lowering rates.
Do you think that prompts them or forces them then, if they see more weakening than they're anticipating on the employment situation side, and then perhaps some adverse effects on the inflation side due to tariffs or any policy action, that puts them in a position where they have to make a decision that they weren't prepared to make or forecasted to make coming into this year?
You mean in terms of could they raise interest rates?
Potentially.
That has been a conversation we've had with some of our clients. I think that's less of a likelihood now that we see the economy really starting to show strains from what I'm calling the uncertainty tax. It's not just around trade policy, but every facet of policy, including Social Security. So there's a lot of elements of uncertainty that both consumers and businesses are facing. That is starting to show through to the soft data and even into the hard data. Again, it's pretty early, but the direction of travel seems clear. Given that trajectory we've already been below the GDP forecast you were citing. We came in the year at 1.6, expecting a slowing trajectory on trade wars and restricted immigration. We're getting more earlier than we expected. Really, the wild card here has been the chaos and the DOGE sort of defaults on government contracts and, this payment disruptions and large scale firings that really have injected uncertainty across a range of sectors that really hadn't been expecting that. So given the growth scare, the likelihood of a rate hike seems very low.
And Julia, to that end, I want to bring up a quote we have from the White House yesterday. An official saying we're seeing a strong divergence between animal spirits of the stock market and what we're actually seeing unfold from business and business leaders. So the White House saying, hey, we're hearing from corporate executives that things aren't that bad. And then later on that same day, you hear from Delta Airlines lowering their profit guidance, hearing similar commentary from small businesses and the small business survey this morning, and also from the likes of Verizon. Are we seeing signs of the beginning of a corporate America slowdown in this economy?
Absolutely. What they're doing, you're hearing a lot of sort of damage control and spinning out of the policy officials that have produced this uncertainty. But when we look at measures of business sentiment, when we talk to business executives, when we scrape earnings reports and see what companies are talking about, it is not a growth-friendly environment. And so you can call it detox or however you want to frame it in a positive light. This is a tough environment for companies to make hiring decisions, to make CapEx decisions, to plan for the future. A lot of the actions we're seeing were not the ones we expected going in. Yes, we expected tariffs on China. We did not expect a trade war with Canada and Mexico. These are our biggest trading partners. This is significant for U.S. businesses. So, and unfortunately, we don't see any clarity in sight. It seems like we're still going after our neighbors, and that's starting to affect travel. We hear people canceling plans to come visit the United States. That's going to affect education, students' willingness to come study here. There's a range of sectors that are going to be impacted by this that, again, weren't the ones that we were really focused on starting at the start of the year.
All right, Julia, really wonderful breakdown. Thank you for joining us. We hope you'll come back soon.
My pleasure.
Coming up on the morning brief, we count you down to the opening bell on Wall Street, plus a breakdown the outlook for airlines as Delta and United warn of weakness to come. We'll also dig into Oracle's earnings and what they say about software and the AI sector. We'll discuss all of that and more. A morning brief ahead.
Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail.
That is your opening bell on Wall Street. Let's get a check on the markets here. Taking a look at futures as we wait a second for the market to open on our end here. You're still looking at pressure, though. We're just around the flat line here when it comes to the trade. We're actually seeing a little bit of recovery in the tech-heavy NASDAQ earlier this morning, so it'll be interesting to see if we do continue to get that throughout the trade today. Again, we're still waiting for those markets to open here on our boards for us. If you take a look at the two-day chart, you can see just the degree of selling that we have seen in that tech-heavy NASDAQ here. You take a look at your S&P 500 opening down just about 0.2%. You can also see that struggle when it comes to the S&P 500. And here you can see just how much we are off of our all-time high, down nearly 10% from that all-time high in your S&P 500 here. But I do want to just flip the board over really quickly and take a look at some individual stocks when it comes to the market. If I can get our board behind me to load up here, you're still looking at selling across the board. Interestingly, Microsoft hovering around the flat line. What's interesting about them is they are the cheapest stock in the Mag 7, I believe, at the moment when it comes to their PE ratio. Meta here, the only member of the Mag 7 that is not down year to date. So that's been interesting to monitor. And Amazon also looking relatively affordable given the sell-off that we've seen. Interesting to see Nvidia moving to the upside right now as we are in the market open here. If that continues, could that lead to gains in the market today? Apple's still seeing a sell-off after the biggest sell-off, I believe, for that name since August. So again, interesting to see. And even Tesla recovering today after its biggest sell-off in nearly 5 years, I believe. So interesting to see some of these individual movers at the Mag 7 recovering after that degree of sell-off. Will that lead the NASDAQ to continue to be in the green throughout the day? We're going to get into all of it and more with Yahoo Finance's Jared Blickery for a broader look. But let's move it in markets. Hey, Jared.
Well, thank you, Maddie. I want to go back to the indices, and specifically I'm looking at the S&P 500, which lost $1.4 trillion yesterday. I like this 6-month chart. I'm going to extend it to 1 year. And one of the things I'm seeing right now is the prior highs from last year in July and August, September. Those highs are now kind of yielding to price. So price has dipped below those. And we want to see that recover pretty quickly here. Otherwise, it suggests that we're in for some more downside. So combined with some of the other indices kind of approaching or going through to the downside, their major levels, it just kind of doesn't necessarily bode well for the market. Although it is still possible to get a sharp snapback. And if we are still in this bull market, that's exactly what I would expect right here. If we have another steep down day, that is kind of off the table. Also want to note that small caps are leading right now to the downside. They're down, well, not getting that quote. Let's look at the S&P 600, leading to the upside here, up about 0.25%. And that's after a pretty steep loss yesterday. But the small caps didn't lose as much as the large caps. And we're going to look at the sector action here. Energy, materials, and real estate in the green, while communication services and staples down more than 0.5%, but not really seeing any big outsized movements. And this screen right here, the NASDAQ 100, pretty different picture than we were seeing yesterday. One thing I liked about Apple's movement yesterday was that it stopped right at the 200-day moving average. Unfortunately, and that would be right here. Unfortunately, it's trading below that, and it is now testing support, the 2025 lows. So we'll have to see if Apple can sustain its levels that it's been holding here. Do want to get to Chinese stocks. Those have been jumping. Those have been a bright spot in the market recently. But futures, something interesting in futures caught my eye this morning. That would be coffee. KC equals F is kind of coiling for a move. It's down today, but this formation here, this is a year to date. I'm going to put a 5-year chart on. It's just kind of camping out near these highs, and given the recent run up, I think it's going to be potentially a bellwether for some other action commodities here. Going to leave you on Bitcoin. Bitcoin bounced off its 200-day moving average. So a lot of 200-day moving averages in play here. I'll put a year-to-date from that 5-year, and you can see just getting a little bit of a bounce there. My target still remains 70 to 72,000 for Bitcoin, though. Brad?
All right, we're going to be watching very closely to see if we strike that target. Jared, appreciate it. It's time now for today's strategy session. Investors are grappling with the biggest market sell-off of the year, with several Wall Street strategists souring on U.S. stocks. Citigroup strategists downgraded their view on U.S. stocks to neutral from overweight, citing expected negative U.S. data prints and uncertainty over tariffs and government job cuts. So how should you position your portfolio? Joining us now, we've got Anthony Saglimbini, who is the Ameriprise Financial Chief Market Strategist. Great to have you here with us this morning. First and foremost, as you think about some of the changes in position that we've seen, even from that of Citi to kind of muted on the U.S. exceptionalism trade that really kind of rattled through and was the consensus on the street, how is that shifting your own strategy right now?
Yeah, thanks for having me. The last couple of weeks have been very difficult for investors from an equity perspective. Yesterday was obviously a very difficult day. You saw Mag 7 collectively move into a bear market. You've seen the NASDAQ move into correction. You've talked about some of the technicals. A lot of the major indexes violated their longer-term 200-day moving averages. And I think a lot of it is the market reaction to some of the tariff uncertainty we're seeing from the White House. So the market, I think, is making a judgment that these tariffs, and in the degree that they're being discussed, is likely bad for profits and it's likely bad for the economy. We haven't seen that translate into economic data, but coming into this year, the U.S. economy was on firm footing. We just got the employment data last week, created 151,000 jobs in the U.S. economy. Unemployment's low. Consumers continue to spend. We'll see how that plays out in the first quarter. But the profit situation for U.S. companies was very strong in the fourth quarter. And even though those outlooks have come in over the reporting season, analysts still expect the S&P 500 to earn around 7.5%, which is still a pretty strong earnings number. So our view is there's likely to be volatility in U.S. equities for the, probably the near to intermediate term. But our fundamental view on the U.S. economy and U.S. markets still remains solid.
So if your view remains solid, then at what point in this dip do you see and tell investors to get back in, to utilize the dip as a buying opportunity?
Yeah, that's the question everybody's asking, right, from an investor standpoint. And it's very difficult in the moment to kind of determine where the buying opportunity lies. But when you start talking about an S&P 500 getting close to correction territory, trading below its 200-day moving average, the NASDAQ composite moving down around 14% from its all-time high, longer term, those are typically good buying opportunities if the U.S. economy doesn't move into a recession and corporate profitability remains on track. A lot of questions about how tariffs are going to interact and interplay with those dynamics, but generally from a longer term perspective, investors probably want to be putting their shopping lists together. They want to be looking at equities if they have excess cash on the sidelines. One of the things that we've been telling our clients and advisors is have a plan for addressing the volatility. Right now, a well-diversified portfolio of stocks, bonds, cash, alternatives is helping insulate some of the risks in equities today. And longer term, there will be opportunities that are created in some of the secular leaders. You guys just touched on some of the Mag 7 names that have seen a tremendous amount of pressure over the last couple of weeks. These are the secular leaders in the U.S. economy. And at some point, their valuations will become low enough where investors will look at these opportunities and those valuations and look at their growth rates and maybe put some money to work. And so I think over the next few weeks, the market's going to be volatile. It's going to be very headline driven by the tariffs. But as long as profitability remains solid for U.S. companies and we don't see a deterioration in the economy, this type of volatility historically is a buying opportunity for investors longer term.
And so I guess the larger question, and one that we brought up earlier on in the show, and as Maddie had raised, is what is that catalyst? Because it's more than just, hey, there's a massive dip or massive pullback here. Buy in and hope for the run back up because, of course, over time, we all know markets tend to go higher. But it's that time horizon that investors would have to be banking on to making sure that their time in the market is valuable enough and that there's catalysts that emerge on the other side of that. And so is it clear right now where those catalysts will be? Because a lot of the Mag 7 names that have really been kind of encapsulated within that AI trade have now seen their own retracement, which sends the larger question of should people buy further into those names or should they go into the safe havens like they typically do at a time like this?
Yeah, you're absolutely right. And it all depends on your time horizon. I think over the next few months, the investing environment is going to be difficult. And so having, appropriate levels of cash and fixed income and alternatives can help blunt the volatility in a portfolio. Obviously, more defensive sectors of the S&P 500, like staples and healthcare and utilities, can help blunt some of that volatility. And you're right, you need a catalyst to help reshape the market sentiment, which is quite negative right now. And so I think some of those catalysts will include more announcements on tariffs. I mean, like I said earlier, I think the market is clearly sending a signal to the White House that these tariffs are bad for growth and bad for the market. If we see the White House back off some of these more extreme tariff rates, then I think that could be a catalyst to move the market higher. And then obviously the earnings season in April and May will be a big indication of where investors feel confident about putting money into the market.
All right, Anthony, got to leave it there. Thanks so much for joining us. As we head to break, let's get a quick check in on crypto. Bitcoin and Ether moving still this morning to the downside, but coming back slightly after Bitcoin hit a 4-month low. You're also seeing a big recovery in the tech names. You got your NASDAQ up about 0.5%.
Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail.
It's now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, Oracle missing third quarter earnings estimates and issuing a disappointing forecast for the current quarter. Still, the company expects its cloud infrastructure business to boost revenue over the next 2 fiscal years. Joining us now with more, we've got Rishi Jaluria. He is RBC Capital Markets MD of Software. Rishi, you also lowered your price target for Oracle to 145 from 165 following the results. What's the problem here?
Yeah, and thanks so much for having me. Look, I think it was overall a pretty mixed quarter. As you correctly pointed out, they missed their own guide on Q3. Their Q4 guidance was implied to be a little bit lighter than expected as well. You couple that with strong backlog growth, which was expected. We can get into the puts and takes there. But really my concern is the sustainability of some of this growth, right? That they've signaled they're also seeing capacity constraints. They're taking longer to get data centers online than expected. And really, I think, in spite of the stronger than expected growth that we're seeing out of OCI, which is their competitor to AWS and to Microsoft Azure, in spite of that, a lot of that success, I think, has some temporary or non-sustainable growth drivers, including selling of excess capacity to some of those companies, right? To Microsoft, to Meta, to Cohere, to others. And that's why we felt kind of coming out of this, not surprised to see the pullback in the stock this morning.
Rishi, it's particularly interesting for companies like Oracle, companies like SAP and ServiceNow that are in this basket of recurring revenue, and looking at some of where they're continuing to see their customers have a propensity to spend or even raise some of the seats that they're willing to pay for, plus the added deal scrutiny in this cycle, because this gives us a read through to how CEOs and executive management teams really feel about their business prospects right now, in their comfort to spend in some of the technology that they utilize on a daily basis. I wonder what your read through is as assessed through Oracle's results.
Yeah, no, and I think you're spot on, right? If we can put the results on these and other enterprise software players, we're almost the way through earnings season. That is absolutely it, right? Like, you are seeing more deal scrutiny. We've been in a tough software macro environment for now 2 years, where, it's not getting worse, but it's not getting better. And there is deal scrutiny, especially for large deals. There's consistent, optimization of spending and headcount. And now maybe we have some even broader macro concerns, even if software is kind of viewed as being a little bit more stable, or at least, tariff proof. The fact is, all the noise that we're seeing in the broader economy is creating uncertainty. It is leading to longer sales cycles. It is leading to deprioritization of certain investments. So absolutely, I think that's a right read through to take from this.
What about just the demand picture when it comes to AI specifically, which is a huge sticking point with the market? What is that? What are Oracle's earnings telling you about that demand picture?
I think it's telling us a couple of things, and I think look, the overall demand picture for AI is still super strong. When I'm talking to CIOs and talking to companies, really there is appetite to invest in AI, but increasingly the messaging has shifted more towards faster payback periods, higher ROI, cost savings, margin expansion, rather than kind of the long-term AI story, which I think will still play out. For Oracle, what it is telling us is there still is AI demand. In fact, they've told us one of the issues they had is their capacity constraint, and that's part of the reason for the miss in the softer Q4 guide, is they just don't have enough capacity to meet demand. And by the way, this is consistent with what Microsoft has told us, is consistent with OpenAI has told us. A number of, I think Amazon has said the same thing. There's just more demand than there's actual capacity, and capacity is not just GPUs, right? It's things like liquid cooling, it's power, it's physical space. So the demand signals are still very much there.
Rishi, always a pleasure to grab some time with you. Thanks so much for joining us here on Yahoo Finance.
Thank you.
Another trending ticker we're watching, shares of Tesla regaining some ground so far this morning. That's after experiencing its worst day since 2020, with its price sinking to levels not seen since October of last year. UBS cut its price target for the stock, expecting Tesla deliveries to fall by 5% year over year due to softer demand. Meanwhile, Morgan Stanley analysts suggesting investors buy the dip. President Trump promising on Truth Social to buy a brand new Tesla as a show of support for Elon Musk. There you're seeing the post on Truth Social saying that the radical left lunatics are trying to illegally and collusively boycott Tesla, one of the world's greatest automakers and Elon's quote-unquote baby. First and foremost, we should note that in a free market, there's no such thing as an illegal boycott, because consumers can purchase whatever they want. That aside, for Tesla and the annexation that Elon Musk has selectively made to cozy up to Trump, that was a decision that he made as well. So all of these things considered, investors and consumers, they also have their own decision about how close they want their trade to be tied to the Trump team in the administration. And then additionally, for consumers, they also get to decide whether they want an electric vehicle. And oh yeah, by the way, for the electric vehicle purchasers out there, more of them typically lean left, which is interesting if Trump is trying to bolster more purchases for Musk, because most of those purchasers of his supporters are really more ICE internal combustion engine owners out there.
It's just interesting. I mean, with Tesla, the story is twofold, right? Obviously, there is concern about consumers switching away, to your point, Brad, from the brand here, but also you have concerns about the broader slump in sales and whether or not the lack of availability of additional models is something that's going to continue to weigh on shares moving forward. We're consistently seeing their competitors beating them out, especially abroad in places like Europe and China. And you've got the stock recovering today, but only after the biggest sell-off in 5 years. So certainly a stock that we're going to continue to monitor. But want to switch the board over here and looking at Kohl's. Shares plunging more than 15% in trading this morning. Kohl's anticipating a larger than expected drop in comp sales for 2025. For the three biggest takeaways from the retailer's cautious outlook, we've got Yahoo Finance's own Brooke DePalma. And Brooke, just the latest retailer to issue a cautious outlook. What stood out to you?
Absolutely. This is yet another retailer to really spark concern that we're going to experience this weaker consumer in 2025 that's going to take a toll on their sales. So let's talk about that cautious outlook. The company, or rather executives on the call this morning, said that cautious outlook includes time needed to make necessary changes and uncertainty in the macro environment. Now, with that cautious outlook in mind, same-store sales are expected to drop between 4 to 6%. That was far lower than Wall Street's estimates. Earnings also expected to come in lower. And once again, executives saying that this is taking into consideration the turnarounds, which the CEO says is very achievable. But he also added that it is going to take time. Now, keep in mind, Ashley Buchanan is a former Michaels company CEO. That's the art and craft store. He joined the company in January on 15th, so roughly 2 months ago. But prior to Ashley's tenure at Michaels, he held a variety of senior executive roles at Walmart and Sam's Club for nearly 13 years. And he's certainly taking the helm here and making changes right away. Back in January when he joined, they announced plans to cut nearly 10% of their corporate workforce, and they also plan to close 27 underperforming stores by April. But leaning further into these focus areas is really this idea of assortment, value, and omni-channel. With that assortment in mind, the company did say that they expect to have a more balanced assortment. They plan to refocus attention on core categories that they said they really lost traction, including fine jewelry and proprietary brands, really focusing in on the need for value. Now, on the call, Ashley Buchanan did say from a macro perspective, you had a pretty decent bifurcation among income levels. He said that those making less than 50, that consumer is pretty constrained from a discretionary standpoint, and less than 100, he said that consumer is also facing some challenges. But he said that I don't think we're an anomaly on that. If we look back in recent weeks, we've heard from Macy's, Walmart, Target, also cautioning this weaker than expected guidance for 2025.
All right, Kohl's shares getting rocked right now, down 16%. Brooke, thanks so much for taking the time to break this down. Appreciate it. As we head to break, let's check in on the major averages, the Dow, the NASDAQ, and the S&P 500. Keeping tabs on them as they are mixed right now. The NASDAQ is up by about 0.8%. We'll round that off to the S&P 500 turning positive, flat just barely to the upside. The Dow still in negative territory by about 0.5%. We've got much more ahead on Morning Brief.
Oh yeah, you're not gonna forget to cancel those free trials this time. Right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time. Right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time. Right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail.
Welcome to Catalyst. I'm Madison Mills. We are 30 minutes into the U.S. trading day. Let's get you the 3 catalysts that we're watching this hour. First up, we break down the market action as stocks fluctuate following their biggest sell-off of the year. Plus, we'll break down the economic picture as JOLTS data drops ahead of the key inflation report that is on deck for Wednesday. And we'll hone in on the state of the consumer as retailers report and warn on economic uncertainty ahead. Half an hour into the start of the U.S. trading day, let's get a check on the markets brought to you by Tasty Trade. Taking a look first at the major averages. Interesting to see the S&P 500 still climbing just around the flat line here now, just turning into positive territory for the first time, I believe, since the market opened. But your tech-heavy NASDAQ is where we want to focus. Up now, nearly 0.7%. Nearly every member of the Mag 7 recovering today after record losses. The Mag 7 down 20% from its peak. Will that buying continue in the Mag 7? We will, of course, track that for you here on Yahoo Finance all day today. But let's flip the board into the bond market because we're really seeing the bond market rolling over here and a lot of investors hiding out, particularly in the front end of the curve. No surprise to see those yields popping up as we do see some of the buying opportunities coming into the market today. You've got your 10-year still hovering around that 4.2 level. But finally, let's take a look at Bitcoin. We've been talking about the selling action that we've been seeing this morning, and that is continuing to here. You're still firmly below that 82,000 level, hovering just around 81,000 this morning. But now I want to welcome in my guest host for this morning, Kenny Polcari. He is the Chief Market Strategist at Slatestone Wealth and host of the Yahoo Finance podcast Trader Talk. He's got 30 years of experience in institutional equities and wealth management, and he's joining me now. And Kenny, we're going to talk about some of the jobs data that's dropping this morning here, but just want to get your take broadly on what we're seeing in the market in terms of the sell-off.
So I'm not surprised. I don't think anyone should really be surprised, considering we've been talking about a potential pullback in the market for months now. Everyone's saying, had gotten stretched. Certainly the Mag 7 had gotten really stretched, but they kept feeding the beast, and so no one really wanted to take ownership, right? And then you start getting hit with all the negative headlines, and like I've been saying, suddenly everyone's accentuating the negative and eliminating the positive, right? Because they're finding any negative story they can find. They're ripping it up and they're putting it across the headline, and it's creating a lot of angst in the market. Now, some of it is real. Some of it is concern about a recession. Some of it's, geopolitical concerns, Russia and Ukraine. And some of it is just a normal cycle in the market. Look, we've gone a long time without, more than 20 months without a 10% pullback. And we've gone even longer without more than a 20% pullback, right? So the fact that we're starting to see this, and yesterday was an ugly day. Was it uncomfortable? Absolutely. Did it make people a little bit anxious? It surely did. But as a long-term investor, days like that are actually opportunities.
All right. Well, we're going to continue to cover all of that and more throughout our show. Kenny, you're going to stick with us. I do want to talk about January's job openings and labor turnover survey here, coming in just above estimates. Job openings rising by 232,000 to 7.74 million. That's just above the estimate, which was 7.6 million. Nothing too big to write home about in that headline number. But as the growth scare leads to a sell-off that we have seen in stocks with their worst day in 2025 this week, markets now pricing in over 80 basis points of rate cuts this year. Our next guest does anticipate a cut coming in May ahead of key inflation data on Wednesday. We'll discuss all of it. We've got Veronica Clark here, Citi's economist. Veronica, great to speak with you this morning. Just level set with me. How are you viewing the economy right now? Is this an economy that is in the process of slowing, or are we already slow? And how does that impact your recession potential outlook?
Yeah, I think this is an economy that has been slowing pretty gradually for a while. And I think that's just the consequence of elevated rates. Rates are at restrictive levels. We've seen that weigh on sectors like manufacturing and housing. Hiring rates are incredibly low. We got that with the JOLTS data this morning. And that does mean it's not an economy that's well positioned to handle some kind of shock. So it does look like the economy was slowing even before all these new risks that we're getting into now.
Veronica, it's Kenny Polcari. I want to ask you a quick question. The JOLTS report, because it just came out, so I didn't actually get a chance to look at the whole thing. So tell me, it actually came out stronger, didn't it? Isn't it more jobs?
Yeah, there was an increase in a downward revised level of jobs from December. Of course, this is January data, so it does feel kind of stale at this point.
Right.
We got some revisions to the last couple years, so we'll have to dig into the details more. But I think markets now are reacting to, we just got some new tariff headlines. That's probably more important than this somewhat stale JOLTS reading at this point.
And what were the quits rate number? Did that go up as well?
It did slightly. It's been coming down, just like hiring rates have been coming down. Layoff rates are still very low. That layoff rate actually ticked lower again. But again, this is before the new risks to the labor market as we're getting into the spring and summer.
And I wonder how you're thinking about what might break the labor market, because we keep hearing that is the key focus for the Federal Reserve now, is that second part of their dual mandate when it comes to jobs. And we're hearing more warnings from corporate America over the past 24 hours, from Delta, from Verizon, about their CapEx plans moving forward. In your view, if there is a pause in spending from corporate America, does that break the labor market and push the Fed?
Yeah, this was already a very precarious labor market, I think. It's been low hiring, low quits, but also low layoffs. But that does mean that low hiring rate, this is not a sector, labor market that's well, positioned to absorb shocks from maybe the government sector. Of course, we are looking at, federal worker layoffs in the coming months. Any increase in uncertainty is just going to weigh on hiring more. I think that would be maybe even the bigger cause of an additional weakening in the labor market. Of course, if people are worried about their jobs, maybe you'll cut back on spending, you'll start to save more. Of course, that's less economic activity. Maybe that even slows the economy more. So yes, this does seem like a labor market that's not well positioned to handle a shock.
But Veronica, let me ask you, this is a two-part question. Number one, if the economy slows, because we've been running at a rapid pace, right? So it's intentionally, if they're pulling back on government spending, they want to intentionally try to slow the market down, slow the economy down. And so then we're going to, if we fall into a recession, is that necessarily a really bad thing in your mind?
It doesn't necessarily need to be. Usually recessions are, we're not always talking about 2008, right? We have experienced, many years, long history of recessions every 5 years or so, and they don't always have to be something so dramatic. I do think, rates have been restricted for a while. It's probably been, masked, in terms of, we've had really stimulative fiscal, stimulus, that's probably masking the underlying weakness in the economy. But yeah, this could be still a correction. It still would be painful, of course.
Yeah, well, it might be painful from an investor point of view, but in fact, all this, in this chaos creates longer term opportunity and some really great names that are maybe getting unnecessarily beaten up just because people are anxious. Which, that's a whole nother conversation we can have from kind of the long-term investing side. But let me ask one more question about rates. At 4.25%, you really think rates are that restrictive?
Yeah, I think so. I think rates are restrictive. I don't think there have been enough structural changes in the economy the last 5 years to convince me that rates are, 200 basis points, neutral rates are 200 basis points higher than they were 5 years ago. I do think rates are restrictive, and it's being masked by, substantial fiscal stimulus. The fact that, companies and households have, refinanced mortgages or termed out debt for many years. You're not facing higher rates yet. But I think this level is still slowing, the economy overall.
Really quickly, Veronica, it seems like given the K-shaped recovery, we've already seen a blue collar recession. How likely do you think it is that we see a white collar recession?
Yeah, there's definitely been this bifurcation in the economy and consumers, and you see it in businesses too, large corporates who are doing okay, but maybe small businesses that are struggling more. I do think, slowing consumption, of course, is, we've seen that in lower income households. Maybe one factor that has been supporting, consumption of wealthier individuals has been, a wealth effect from, asset prices going up, and maybe that is now changing. So yeah, there could be this spillover into those higher income earners too.
Yeah. All right, Veronica, thanks so much. We got to leave it there.
Thank you.
Thank you. Some breaking news here as we head to break. President Trump saying he's increasing Canada's steel and aluminum tariffs to 50%. You can see here the S&P 500 continuing to move to the downside off the back of that news. We originally saw the NASDAQ flipping into negative territory. Now we're seeing the NASDAQ flipping back into positive territory, continuing some of the gains that we saw earlier this morning. Again, President Trump posting on Truth Social saying that he wants to increase those tariffs on steel and aluminum, originally saying they were going to be at 25%. Now coming out and saying he wants to raise that tariff rate to 50%. Again, in a post on Truth Social this morning. We'll cover all of this and more when we come back.
Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail.
Some of the biggest names on Wall Street have been wiped out to $2.5 trillion. That is a combined market cap of losses in some of these names, the top 10 in the S&P 500, only this year. So it's a huge reversal in fortunes from 2024. And let me just show you how this breaks down here. Heading the pack is NVIDIA. And you can see they have swung from a $2.07 trillion gain to a $678 billion loss. For Tesla, $500 billion to the upside last year, now $510 billion to the downside this year. And it's only March. In Apple, very similar story. The list goes on to Microsoft and Alphabet. And it's not all bad, though. After we get through Amazon and Broadcom, we see Eli Lilly not shedding quite as much. It was able to add $180 billion last year, but it still lost a nominal $18 billion this year. But Meta still holding on to gains, some of those gains from its 20-day win streak, which was just incredible. That is actually added to gains, so holding on to $36 billion this year. And then you have Berkshire Hathaway. We don't talk a lot about this mega cap stock, but it was up $201 billion last year, and it's already added $94 billion this year. And you can really visualize this in a heat map, and I have these 10 stocks right here. And let me just show you the two-day total, because this will give you an appreciation for what we saw yesterday. Tesla is still down 11.6%. It was down, what, 14, 15% yesterday. Apple still down 7%. Here is the month to date, and fun stat here. NASDAQ 100 having the worst start to March ever, and that goes back to beginning of data, excuse me, in 1985, 1986. And then here's the year to date. And what you'll see here is it's not quite as bad. We do have those gains that I was talking about in Meta, Eli Lilly, and also Berkshire Hathaway. And now I thought we'd do some technical analysis, because the charts on these various issues, those break down in various ways. Some of them are good, some of them are bad, and some of them are downright ugly. And we're going to start with Berkshire Hathaway here. I'll put a line chart on so you can see. This is a 5-year chart, and this is beautiful. This is, you can see, after the 22 bear market, we just took off, and that's from the lower left to the upper right. And before that time, you had another trend channel intact over here, just a very steady series of higher highs and higher lows, which is a definition of a trend. That's what you want to see, and it's in nowhere near even in violation of violating that very nice trend channel that we're seeing. Here's Eli Lilly, another chart that's fairly strong in the technicals. You kind of had a head and shoulders in here if you squinted, but it didn't fulfill. You dipped a little bit down, and then it popped right back above. And so now you just have this consolidation formation near the highs. We can also say some pretty positive things about Apple here, although I don't like that it just lost its 200-day moving average just shown, but it really has some space here to kind of chop around, and this might be a head and shoulders top, but downside levels ought to contain that if we do have that drop into this prior price memory that we see in that formation. Broadcom also looking fairly good. This is a pretty steep trend channel here. It is in the process of violating it to the downside, and this heightened volatility here, you don't sometimes you see that in tops in individual stocks, and so that is a little bit concerning, but it's kind of right down back to the decision point, the Rubicon for Broadcom, so remains to be seen if this is a topping formation. Meta is looking pretty good, but it is in the process of violating a trend line here. Meta is also prone to some very, very steep historical sell-offs, 75% only recently in that 2022 bear. So just history kind of provides some caution for Meta. Alphabet, here's another trend channel break, but here's what I'm looking at. These highs over from 2021, those theoretically should contain price here. It's got a little bit to go to see if it tests this formation. If it goes down, though, we have a huge M top to deal with. But critically, we're not there just yet. Moving down the line, Microsoft looking a little bit toppy. It just broke through its head and shoulders top. Do have some potential price support down here. It has a little ways to go to find that. And then Amazon, here's another that we can see these prior highs from the pre-2022 bull market. It's kind of trying to find its footing up here, and we have seen some accelerated volatility, mostly to the downside, but also a few days to the upside there. Amazon, when it makes its gains, tends to be very fast and furious, so kind of like Meta, you got to watch to the downside, although we haven't had a big Amazon drop down like that, similar to Meta in some time. NVIDIA is just incredibly volatile, and it's looking a little bit toppy right here. I don't have a specific formation, but you kind of want to see this level, the lower 100s. You want to see that hold for NVIDIA. And finally, Tesla, we're kind of getting into the ugly here. It's just been so volatile. This breakout to new highs there, that was just a tease. That was a false breakout, and it's been on the way down just about as quick as it was on the way up. So you put it all together, we got a mixed bags in terms of the Mag 10. And I think Berkshire Hathaway probably comes out on top here. So tune into Stocks in Translation for more jargon-busting deep dives. New episodes on Tuesday and Thursday on Yahoo Finance's website or wherever you find your podcast.
All right, Jared, thanks so much for breaking that down as always. Some breaking news crossing the wire. President Trump saying he's increasing Canada's steel and aluminum tariff to 50% effective tomorrow. You can see stocks continuing their sell-off, the NASDAQ reversing its earlier gains. Now hovering below the flat line, the S&P is down about 0.5%. I'm still with Kenny Polcari on set with me. And Kenny, just want to add so that you're aware here, he's talking about substantially increasing those tariffs on cars coming into the U.S. on April 2nd as well. He talks about the need for Canada to immediately drop its anti-American tariff policy. So this is a long-winded Truth Social post. What do you make of the market reaction?
So I'm not surprised with the market reaction, right? It's just more uncertainty and it's more kind of chaos, right? Because he changes his mind on a whim. He puts it out there on Truth Social, and so the market interprets it. Algos scrape all the headlines. They react to these negative headlines, and so you get what you get in the market, right? So I'm not surprised that the market's reacting like this. Look, there's been a lot of internal damage in the market over the last couple of weeks, and so the market will continue to thrash around until there's more clarity. You're not going to get that until we get more clarity.
Right. Is the clarity, this is my big question, is the clarity going to be enough to stop the selling? Because we've seen global selling of U.S. stocks as well.
So I think clarity will be enough to stop selling once it settles down. Once everyone understands, okay, what's the focus? Is it going to change your mind? Is its mind every day? Then there's not going to be any clarity, right?
Yeah.
Once there's clarity, once we start to see other nations come to the table and start to negotiate on trade, because look, there are countries that hit us over the head with tariffs, right? And we're getting to understand that now as we learn more about that. So once that comes to the table and people really countries start negotiating, then I think it all settles down.
But what if the uncertainty is here to stay?
Well, listen, there's always some level of uncertainty, right, that is in the markets. But I think it's these major issues, right? It's going to be the geopolitical issue.
Hey guys, crude oil में यहाँ पर एक FEG बन गया है, there is a FEG in crude oil. Crude oil level लगाया हुआ है. You can sort in crude oil on the level. Remember the natural gas, don't buy now. Okay, already morning से 3 बार buying आ चुकी है. एक बार यहाँ आई थी, second time यहाँ, third time यहाँ. थोड़ा सा ऊपर जाता तो यहाँ से sell कर देते, exact level था. नहीं आया, कोई नहीं, ट्रेलिंग ऐसा चला गया, हाफ क्वांटिटी बुक कर ली थी। फिर से मत करना, अभी एफईजीए देखते हैं, एफईजीए एक बार निकल जाए तो कुछ हो सकता है, अदरवाइज देयर इज़ अ वेरी हाई चांसेस कि अब ये कुछ इस तरह का एक फॉर्मेशन बनाने की कोशिश कर सकता है इस एरिया पे। सो नेचुरल गैस का थोड़ा सा ध्यान रखना, कोई अगर अभी बाइंग में बैठा हुआ है तो पुट योर एसएल ऑन कॉस्ट, अपना एसएल अपने कॉस्ट पे रख लो, ठीक है, अपना एसएल अपने कॉस्ट टू कॉस्ट पे रख लो अगर नेचुरल गैस में बाइंग में बैठे हो तो। ठीक है, आई एम एक्सपेक्टिंग सेलिंग इन नेचुरल गैस एज वेल, थोड़ा सा प्राइस पुल बैक देना यहाँ से, तो इसमें एक वापस से सेलिंग का प्लान करेंगे। यूएस मार्केट ओपन है, वॉल्यूम ठीक है अब। लाइक भी करते रहो गाइस, डोंट फॉरगेट टू लाइक द स्ट्रीम एंड सब्सक्राइब द चैनल एज वेल। जिन लोगों ने सब्सक्राइब नहीं किया फटाफट से सब्सक्राइब भी कर दो। देखते हैं क्रूड ऑयल में भी कितना मूव करता है यहाँ से अब। नेचुरल गैस में भी यहाँ से एक थोड़ा सा सेलिंग का एक्सपेक्ट है। अभी भी सपोर्ट बना हुआ है बट मुझे लगता है या तो ये रेंज बनानी चाहिए मार्केट को, या सपोर्ट अब ब्रेक ही हो जाए तो बेटर है। P93 के अराउंड ट्राई करना है इसमें सेलिंग एक। फिर टारगेट रहेगा 374 एंड देन ये जो नीचे वाला लेवल है इसको थोड़ा सा और मॉडिफाई कर देते हैं। कि एक टारगेट ये रहेगा सेलिंग में, अगर नेचुरल गैस आता है डाउन साइड पे 374 एंड देन 361 के आसपास। ओके कल इंपॉर्टेंट डेटा है, ध्यान रखना कल सीपीआई का डेटा आएगा विच इज़ वेरी इंपॉर्टेंट। जॉब ओपनिंग का डेटा ऑलरेडी आ चुका है तो अब सीपीआई का डेटा मेन है कल के लिए। क्रूड में भी देखते हैं नीचे लेवल होल्ड करता है या फिर गिरता है थोड़ा बड़ा फॉर्म करके लेवल पे। इंपॉर्टेंट लेवल है इसमें भी। ये तो मुझे दिख रहा है नेचुरल गैस में यहाँ पर अब और एक और ट्रेड बन सकता है आज के लिए। कनाडा की ओर से भी न्यूज आ रही है, यूएस के जो प्रेसिडेंट हैं ट्रम्प, उन्होंने 25% टैरिफ इंक्रीज कर दिया है कैनेडियन स्टील एंड एल्यूमिनियम इंपोर्ट पे, टोटल 50% टैरिफ। मेजर इम्पैक्ट एक्सपेक्टेड ऑन ट्रेड रिलेशन एंड इंडस्ट्रीज। वाओ। ट्रम्प थ्रेटन टू परमानेंटली शट डाउन Canada's car industry and plans to declare national emergency on electricity.
News when you want it with Bloomberg News Now. I'm Nathan Hager. President Trump has just ramped up the trade war with Canada. In a Truth Social post, he announced a 50% tariff on Canadian steel and aluminum effective tomorrow. He cited the 25% duty that Ontario just announced yesterday on electricity into the U.S. The president also says he will substantially increase other tariffs on Canada on April 2nd if the country does not drop tariffs on dairy and other U.S. goods. The market reaction? Giving back many of its gains. Right now, the S&P 500 is lower by 0.4%. The Dow Jones Industrial Average down 0.9%. The NASDAQ Composite is still holding on to a 0.1% gain, but the 10-year Treasury yield is starting to spike up just a little bit, up nearly a basis point to 4.22%. President Trump's economic and political policies may be putting American exceptionalism at risk. That's according to Bloomberg opinion columnist Mohamed Al-Arian, the chief economics advisor at Allianz and president of Queen's College, Cambridge.
One of the U.S. edges is predictability and the rule of law. And the more these two things are questioned, the more people are going to start questioning economic exceptionalism.
You can hear my full conversation with Bloomberg opinion columnist Mohamed Al-Arian on the Bloomberg Daybreak U.S. edition podcast. This new tariff announcement comes as President Trump gets ready to address top CEOs at the Washington-based Business Roundtable this afternoon. Those remarks are set for 5 p.m. Wall Street time. You can hear them on Bloomberg Radio or watch on the Bloomberg Podcast's YouTube page. Before the tariff announcement, we did get a fresh look at the labor market. January job openings rose to 7.74 million. That was more than economists expected. We get more from Bloomberg's Michael McKee.
The quits rate is kind of what a lot of people are paying attention to. Goes up to 2.1%. So people felt a little bit better about getting a new job if they quit their previous one in the month of January. But it doesn't tell us a whole lot about where we are in the middle of March.
That's Bloomberg's Michael McKee reporting. The House is set to vote today on a stopgap spending bill that would avert a government shutdown at the end of the week. Vice President J.D. Vance is urging all House Republicans to support it. The conservative House Freedom Caucus is backing the measure. It would fund most agencies at current levels through September 30th, with increases for defense and border security and cuts to the IRS. House Minority Leader Hakeem Jeffries says Democrats are a no.
This partisan and reckless Republican spending bill fails to protect Social Security, Medicare, and Medicaid, which we know are on the Republican chopping block.
Now, Republicans can afford to lose only 2 GOP votes to pass this bill in the House. It would need support from 7 Senate Democrats to send it to President Trump's desk. Western officials say Russian President Vladimir Putin has no intention of compromising with Ukraine, which could complicate President Trump's efforts to secure a credible settlement in the 3-year war. As Bloomberg's Rosalind Matheson reports, Secretary of State Marco Rubio had already played down expectations for talks that are now underway between the U.S. and Ukraine in Saudi Arabia.
It's really about getting to a position where they can nudge things to the table in a more formal way, potentially knowing where those lines are. And so it's probably about the U.S. Again, I would imagine in those conversations in Jeddah today, pressing Ukraine a bit, saying we really want to get this to a ceasefire and we need to, move from your end also on that. So tell us realistically what's possible here.
Bloomberg's Roz Matheson reports President Trump's Middle East envoy, Steve Witkoff, is going to meet with Russian President Vladimir Putin this week. All this follows one of the heaviest barrages on Russia since the war began. Russia says it shot down more than 300 Ukrainian drones overnight. It says 3 people were killed. Today marks 5 years since the World Health Organization declared COVID-19 a global pandemic. Dr. Ashish Jha led the White House response under then-President Joe Biden.
COVID is still around. COVID is still a bit of a problem. I think for elderly people, high-risk people, immunocompromised people, it can still be pretty serious. I think for healthy Americans, no, I don't think it poses a big risk. We deal with respiratory viruses all the time. COVID is just one of them.
Former White House COVID coordinator Ashish Jha tells CBS News the U.S. is in better shape to prepare for a pandemic than it was 5 years ago. Again, stocks are moving mostly lower as President Trump announces a 50% tariff on Canadian steel and aluminum effective tomorrow. That's news when you want it. With Bloomberg News Now, I'm Nathan Hager. This is Bloomberg.
गाइस क्रूड ऑयल को ट्रेल कर सकते हो, ठीक है। क्रूड ऑयल का एसएल हाफ प्रॉफिट बुक करके कॉस्ट पे रख लो, थोड़ा सा रह गया टारगेट, और बुक द हाफ प्रॉफिट एंड ट्रेल द एसएल.
Still the potential for Trump to disappoint and the GOP to disappoint on taxes if they get a less deep cut, right? So if we end up at 19%, for example, right, that could have a different market response. So we have to monitor, right, the depth of these tax cuts, and if they commit to that 15%, I think that markets will respond positively, right? That's what we're expecting. That's what they've been messaging on. But the other thing I just want to mention on the tax front real quick is, with the corporate lens, you also have to think about where else could they potentially raise taxes. And while the message has been lower taxes over and over again, they did increase GILTI and FDII taxes in 2017 to offset some of the burden. Right. So what that means is that companies that have greater revenue exposure to offshore could have some idiosyncratic risks. So again, this is something we'll look under the hood as the tax bill comes together, and we'll continue to communicate with you and our clients.
And we have certainly seen this uncertainty playing out in the market and also, of course, the economy. We were earlier speaking with Julia Coronado, who is a macro policy founder, just about the environment when it comes to the trade backdrop that we're seeing. Let's take a listen to what she had to say.
A lot of the actions we're seeing were not the ones we expected going in. Yes, we expected tariffs on China. We did not expect a trade war with Canada and Mexico. There's a range of sectors that are going to be impacted by this that, again, weren't the ones that we were really focused on starting at the start of the year.
So, Monica, my question to you is, and I was speaking with a source about this earlier who said that the market saw a lot of relief back in 2019 when there was that truce between the U.S. and China, that 90-day truce, plus the Fed was acting a little bit more dovish. So both of those things led to a bit of a relief rally in the market. Is there the potential for that same thing this time around? If we do start to see a little bit more of a negotiation between the U.S. and China, is that going to be enough, given that there are a lot more players in this cast this time around?
I think that any certainty could create, an opportunity for relief, especially around China. This is, a situation where, China isn't backed up against the wall, so there's still this opportunity for greater tariffs from the U.S. and retaliation, and that creates, again, this sort of leaning into the uncertainty piece. Now, for us, when we're thinking about, where do we go from here and what's the smartest strategy, I think that from a wealth management perspective, folks will automatically think defensive, right? And so we want to sort of remind folks that when you're thinking about high quality stocks, this is actually the time to be looking at cyclicals, right? This is the time to be looking at, financials, industrials, areas where you may get some good high quality equities, right? That, while they do have tariff risk, while they do have economic risk, will outperform as things right size.
Because even over the Mag 7, you think, right?
Even over the Mag 7. Yeah, because Mag 7 has sort of run its course. If we're really looking for winners, it's not just the tax policy winners, but it's also the deregulation winners. And financials are high on that list. They're one of the first places where you're going to see deregulation really impact industry because it is so nimble, right, and responsive, especially to the interest rate environment.
Right.
So one of the things that the administration has talked about, and I love this tagline, is they're trying to de-lever the government and re-lever the private sector. And so if they I would say, open up and have smart, I want to emphasize that, smart and responsible deregulation, especially around community banks, that could create some, I would say, some growth opportunities, especially when you're thinking about lower income, earners, et cetera, and could be a boost.
Some of those potential tailwinds. All right, Monica, giving us a lot to think about. Thank you so much for joining us on set. We really appreciate it. As we head to break, I want to check in on shares of Verizon. Shares falling by their most since 2008 after the telecom company issued disappointing financial guidance. Chief Revenue Officer saying it's been a challenging quarter from a competitive intensity standpoint. You can see here those shares off nearly 7%, but this is just the latest company in a slew of companies now that have reported some disappointing guidance moving forward here. We had Delta Airlines reversing their earlier positive guidance from early in 2025, already 2 months into the year, reversing that guidance off the back of concerns specifically about corporate America spending on airlines. Are we going to see this trend continuing, and how will that impact earnings? We're going to discuss all of that next, right here on Catalysts.
Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail.
From its subscription concept to the rise of streaming, Netflix has built itself into a force in the entertainment industry. The company generated over $32 billion in revenue in 2023, including over 247 million subscribers worldwide. Beyond the Ticker takes a deep dive into the company's biggest moments. In 1997, Mark Randolph and Reed Hastings founded Netflix in Scotts Valley, California. 3 years later, Netflix launched its monthly subscription concept. DVD rentals were mailed to customers, along with prepaid return envelopes. Later that year, Netflix was almost sold to Blockbuster for $50 million, but Blockbuster declined the offer. In 2002, Netflix launched its IPO, selling 5.5 million shares at $15 each. It brought in $82.5 million. 5 years later, Netflix announced that it would debut streaming video while retaining its DVD rental service. Netflix stock fell to around $9 per share in November 2011 after the company revealed that it lost 800,000 subscribers in its third quarter. 2 years later, Netflix released House of Cards, the beginning of Netflix's original programming. In 2015, Netflix shares surged to an all-time high, over $100 per share. That was growth of 574% over the prior 5 years. In 2017, a study by PwC showed that the Netflix subscriber base was now equal to the number of cable TV subscribers, 73% of all U.S. households. 4 years later, Netflix launched its gaming platform Netflix Games, available on Android with 5 games at launch. The company also announced plans to expand its gaming service to iOS. In 2023, Netflix announced the wind down of DVD.com with its last shipment on September 29. From its subscription concept to the rise of streaming, Netflix has built itself into a force in the entertainment industry. The company generated over $32 billion in revenue in 2023, including over 247 million subscribers worldwide. Beyond the Ticker takes a deep dive into the company's biggest moments. In 1997, Mark Randolph and Reed Hastings founded Netflix in Scotts Valley, California. 3 years later, Netflix launched its monthly subscription concept. DVD rentals were mailed to customers, along with prepaid return envelopes. Later that year, Netflix was almost sold to Blockbuster for $50 million, but Blockbuster declined the offer. In 2002, Netflix launched its IPO, selling 5.5 million shares at $15 each. It brought in $82.5 million. 5 years later, Netflix announced that it would debut streaming video while retaining its DVD rental service. Netflix stock fell to around $9 per share in November 2011 after the company revealed that it lost 800,000 subscribers in its third quarter. 2 years later, Netflix released House of Cards, the beginning of Netflix's original programming. In 2015, Netflix shares surged to an all-time high, over $100 per share. That was growth of 574% over the prior 5 years. In 2017, a study by PwC showed that the Netflix subscriber base was now equal to the number of cable TV subscribers, 73% of all U.S. households. 4 years later, Netflix launched its gaming platform Netflix Games, available on Android with 5 games at launch. The company also announced plans to expand its gaming service to iOS. In 2023, Netflix announced the wind down of DVD.com with its last shipment on September 29. From its subscription concept to the rise of streaming, Netflix has built itself into a force in the entertainment industry.
Tariffs, giving a pause. You know, I haven't seen this with on again, off again. It's sort of like Ross and Rachel on the TV show Friends. And, you know, companies don't really necessarily like that level of uncertainty.
You know, as we think about the uncertainty right now, a lot of it still stems not only from what are the policy announcements, but also what some of the retaliatory efforts might look like as well. And as that lingers and eventually becomes more known by the markets, how are you expecting this broader trend of what we've seen in the great reallocation or the great repositioning, if you will, as some of the economists and investment strategists have called it?
Yeah, the biggest thing, and I think one of the area that we tell our clients to focus on more than anything is on a macro basis is how does this impact Fed policy? That's really the world we've lived in, ever since the Fed put was incepted years ago. How does it impact Fed policy? And is the central bank going to focus more on the economic slowdown aspect of tariffs, which tends to happen over the longer term, or their inflationary aspect, which tends to be a little bit near term? And to the extent that they do look at it a little bit more on the inflationary side, that might cause them to maybe, pause a little bit longer with respect to rate cuts. Now, as far as what the market's telling us, the market seems to be saying that it's really the economic slowdown that's a bigger impact, given the fact that in the last month or two, you've seen the projected number of interest rate cuts this year go from 1 to 2 to 3 cuts. And likewise, we've seen the 10-year bond yields come down. And so that's the market's way of saying that, as well as the rotation into more stable areas of the market just says, okay, recession fears are starting to creep up a little bit.
So for a lot of investors out there that are trying to understand with this dip if this is an opportunity or if there should be more caution ahead, what would you say to them? Is this a dip buying opportunity, or is there more that you expect in terms of some of the declines given the volatility that we've been tracking?
It appears that investors should probably, at least given the degree of uncertainty, brace for a continuation of that. And so that's one reason we've seen what may just be the beginning of a rotation into some of the safer areas of the market. One rotation that could be a bit more sustainable would be you've seen value stocks as well as dividend payers have been doing a bit better this year. And, that kind of makes sense. You look at dividend paying stocks, these are the kind of names for which where are you getting your returns from? You're not necessarily getting it all from capital gains. You're getting it from that cash that companies are returning to shareholders. And so, capital gains can be positive or negatives, but, dividends are always positive. And so, that rotation could be just beginning.
Burns, thanks so much for taking the time here with us today.
Thank you.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Today we're looking at the top 3 trending tickers on Yahoo Finance. First up, Tesla, looking to rebound after Monday's big sell-off. Shares closed down 15% yesterday. Shares are up 4% right now. President Trump shared his intent to purchase a brand new Tesla today in a Truth Social post, saying that the left is trying to illegally boycott the company. Shares of the EV maker are off more than 40% so far this year. Next, Delta Airlines cutting its profit expectations by roughly half for the first quarter. The airline citing a dip in consumer and corporate confidence and softening demand amid macro uncertainty. The airline not alone in slashing its forecast, as United came out today saying it's also seeing weakness in travel demand. Shares of Delta are down 8%. Finally, shares of Kohl's down 21%, sliding after the department store's mixed fourth quarter earnings results. The retailer says it expects a larger than expected drop in comparable sales in 2025. The company's CEO says changes over the past few years to attract new customers cause some friction with their core customers, and they need to reprioritize initiatives to better serve all customers, both new and existing. The selling continues on Wall Street today after markets were pummeled Monday. Investors' worries about economic growth deepening after President Trump announced he's raising Canadian steel and aluminum tariffs to 50% in retaliation for Canadian duties. Monday's sell-off wiped out nearly $1.4 trillion from the S&P 500 and just over $1 trillion in the NASDAQ 100. And if you're frantically checking your portfolio this week, you may be in the company of billionaires. We saw a number of billionaires' net worths take a massive hit on Monday. The top 3, according to Bloomberg's Billionaires Index, are Tesla CEO Elon Musk, Meta CEO Mark Zuckerberg, and Oracle founder and CTO Larry Ellison. With Tesla shares closing down 15% Monday, Musk lost $29 billion in net worth. Tesla shares account for a little less than a third of Musk's wealth. This year, so far, Musk is down nearly $132 billion. Not exactly chump change. Zuckerberg lost $9.5 billion on Monday. The majority of his wealth is tied to Meta. Despite Monday's losses, his net worth rose by $4 billion in 2025 so far. As of Monday's close, Meta is the only Magnificent Seven member holding on to green territory year to date. The third biggest loser from Monday's sell-off was Larry Ellison, who lost $7.3 billion, and the majority of his wealth is in Oracle, but he also has a $10 billion stake in Tesla. Well, stocks are lower once again today after President Trump announced an increase to tariffs on Canadian steel and aluminum, accelerating losses after Monday's brutal sell-off. The Nasdaq fell 4% then. The S&P 500, that was down 2%, and investors feeling uncertain as escalating trade tensions and weakening economic data spark fears of potential recession. So, how should investors navigate the current market? Joining me now, we've got Larry Sprung, who's the founder of Midland Financial and author of Financial Planning Made Personal. Larry, good to have you back on the program. How are you advising people near retirement right now to evaluate some of the volatility that we've been tracking tied to policy coming out of the White House?
Yeah, great to see you, Brad. And I think first and foremost is you don't panic. Volatility is the price that we pay for investing. It's as easy as that. But the important thing here is to make sure that you're level setting, checking your plan, and making sure that the plan still works even in a protracted downturn. You know, make sure that you're on track to reach those goals, review that current allocation. And I think just as important as those with regard to your plan is make sure that you have an emergency fund. Although we don't think recession is on the way, be prepared just in case that you have some extra cash set aside for those emergencies should they arise.
So what about those that are earlier on in their investment timeline and further away perhaps from retirement?
Great opportunity, right? And these opportunities present themselves not too many times over your lifetime. So it's a great opportunity. Look to perhaps accelerate IRA contributions that you are looking to make this year. Accelerate 401k contributions. If you're planning to max out, maybe add more now and then, add less later on to take advantage of this dip. Take advantage of that. Make sure your plan is on track. And if you don't have a plan, get one. And similarly, in case, again, we're not in the camp that recession's coming, but if one were to come, make sure you have that emergency fund in place just in case. It's a good thing to have in all markets.
And so what is the mindset that investors are apt to keep in mind, even as they're considering what their time horizon across any age might look like?
Yeah, so I think the interesting thing is, and we forget in times like this, what really actually takes place. Going back to 1990, the S&P has averaged 9.8%. And if you miss the 10 best days, typically there are 10 days across the year that make up the lion's share of the returns for the year. If you miss those, then your return goes down by about 12.5% into the negative. So the whole idea is to maintain your investment philosophy, make sure that it keeps you on track. And remember, some of the best days we see in the markets happen to be clustered right around the worst days. So, we might have some of our best days of 2025 coming here shortly.
Now, what if you just retired? I was speaking with someone just at the beginning of the week, actually over the weekend, about them just commencing their retirement after 36 years working at NASA. And say you've built up that nest egg, you had that retirement and the savings, especially with your investments that you were looking to kind of draw from. What now?
Yeah. So two things I have to say to that is you should plan for that in advance. One thing we do with the families we serve is we run a, bear market test, meaning we run a scenario that if the market were to decline similarly to what happened in 08-09, when it was arguably, one of the worst markets of all time, how would that have affected your retirement if those 2 years, followed your retirement date, which is exactly the scenario you're talking about. And we run it through those scenarios to make sure they're sufficient. If you're in the midst of that, remember, this too shall pass. And the reality is that although you retired now, the reality is that that money is going to have to last you for a very long time, most cases 10, 20, 30 years. So you still have a little bit of a longer term time horizon, and make sure that you have some money positioned for short term, some medium term, and some longer term, so it's not as volatile as having all your assets long term, if that makes sense.
Larry, good to see you. Thanks so much for joining us again.
Thank you.
Let's get a quick check on the markets here as we are just inside of 2 hours into today's trading session, and taking a look at the Dow and the S&P 500 still in negative territory. You're seeing, though, the NASDAQ actually bounce back into the green right now as we are taking a look at that, flat just barely to the upside. We've seen a significant effort in order for that to take place. We'll see if we can hold on to those gains in what's been a very oscillating type of day for the tech-heavy average as it's touched both positive and negative sides of the trade. Coming up, we're taking a look at where things stand in the labor market. We've got ZipRecruiter's chief economist joining us next on Wealth.
Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail.
The number of open jobs in January was higher than anticipated at 7.7 million, signaling a steady labor market at the start of 2025. Although backwards looking, the JOLTS print provides a crucial baseline for the U.S. labor market before President Trump's policies began. A federal hiring freeze, widespread layoffs, and ever-changing tariff plans have since injected uncertainty into the market, reigniting recession fears and rattling corporate confidence. Joining me now, we've got Julia Pollack, who is the ZipRecruiter chief economist. Julia, great to have you back on the program here with us. With what we were just mentioning, how have you seen some of the hiring freezes, some of the spate of layoffs start to impact the hiring propensity and the types of positions that are being filled by companies?
Well, hiring is very stable and steady in the United States at the moment, in that healthcare is the one place where hiring is much faster than before the pandemic. In other industries, hiring has actually been held back for over a year now. Tech has seen job losses for 2 years. Professional and business services has seen job losses for a year and a half. And uncertainty has been the key word for over a year. It's been inflation and interest rate uncertainty. Now that continues to be the case, but policy uncertainty has been added to the mix.
And so how would you describe the health of the U.S. labor market more broadly right now?
I think that the surge in inflation and interest rates really knocked companies off kilter and injected a tremendous amount of anxiety. It's as though it's kind of pushed them to the edge of the cliff. And that is why any further uncertainty, any further shock is so much more dangerous than it might otherwise have been. There are many, many companies, especially small businesses, that rely on credit card financing, for example. And so their financing costs are so huge that they don't know how they can weather the next storm. Each storm has come on the tail of the previous one before companies have fully managed to recover. And that's why you see such small shares of businesses now saying that this is a good time to invest and grow.
One of the statistics that we're continuing to monitor, that's the metrics that we're continuing to monitor, is the average weekly hours. So this work week falling to 34.1. What does that tell us?
Brad, that is actually the key figure in this past jobs report that looked otherwise pretty good on the surface with a low unemployment rate and high number of monthly job gains. The weekly hours number, though, is very concerning because it suggests that companies aren't yet cutting jobs, but they're cutting hours. When I first saw that print in the previous report, I thought it was a mistake. I thought it was a blip. I thought it was due to bad weather in January. But that we saw that number again for February is concerning. And here's what it's caused. It's resulted in a big increase in the share of workers who are part-time for economic reasons, which means they can't find a full-time job. That's now the highest number since 2019. It also increased the share of workers who are multiple job holders. That's now the largest since 2009. So workers are cobbling together multiple gigs because their primary jobs are just not giving them the hours they need.
What within that data, because there are so many different ways to look at that. It could be people who are taking on different side gigs, or it could be freelancers who are putting together different contracts and having multiple companies or clientele that they work with. What is the biggest shift that you're seeing right now, especially as we've seen some of the stats come out and say how millennials and Gen Z are looking to make sure that they can lean further into either creator economy or freelance economy to decide how they work versus the traditional historical element of corporate work?
So you're right. The multiple job holding is a very complex phenomenon. Part of it is driven by opportunity, by a desire for flexibility, by a hot job market where people can take on multiple jobs and earn, twice as much as they might otherwise do. But part of it is also need driven. And where it's taking place now, it does look like it's mostly a response to cutbacks in hours. If you look at earnings across the two groups, across multiple job holders and people with just one job, they're actually very, very similar. And so this is mostly people who are losing income in one job or can't find one job that makes enough, taking on two so that they can just earn as much as someone with one job, not break out and earn more. That said, of course, there are many young people who are very excited at the ability to monetize unused pockets of time while studying, even while in high school, who are getting into the creator economy. And thank goodness that we have those opportunities, especially in times like today when the hiring rate in primary, regular full-time jobs is so low.
Julia, always a pleasure to get some of your insights. Thanks so much for taking the time here with us today.
Thank you.
Small business optimism is receding in February. The NFIB Small Business Optimism Index falling by 2 points last month, with the Uncertainty Index rising 4 points to its second highest reading ever. Here to dig into the details, we've got Holly Wade, NFIB Executive Director. Holly, always a great privilege to grab some time with you, especially on the publishing of this survey here. Just want to walk through broad strokes what you found in this most recent reading.
Yes, so small business optimism, as you mentioned, has fell off a little bit from its peak right after the election. We're still a few points above the 51-year historic average of 98. So small business owners in February still found themselves in, a fairly comfortable position in the economy, optimistic about things moving forward, especially from the previous year where the index was quite low, historically speaking. So there is still a lot of energy out there among small business owners, just tapered off a bit since right after the election.
And so with all of this in mind, how are we gauging the propensity for small businesses either to engage with consumers or, on the other side of that, how they're thinking across their hiring practices as well?
So for small business owners, labor is still the single most important problem for about 19%. So about 1 in 5 are saying that labor is their biggest problem in operating their business. We have still record levels of job openings, especially in those industries related to now retail, construction, and transportation. So those are the 3 top industries that we're seeing from small business owners in having those job openings. Compensation pressures are still alive in the small business sector, with historically high levels of business owners saying that they have increased compensation to attract those applicants for those open positions, to retain current employees. So the labor market is still strong. 13% or 12%, say that labor costs are their single most important problem. So that's driving some of the inflation pressures that small business owners are seeing. And then there's the uncertainty index, where that has spiked quite significantly over the last couple months, with more small business owners not confident about, kind of what to expect in the next couple months as far as the conditions of operating their business.
How are their balance sheets holding up right now? Because that's one of the kind of data points that you're always able to really kind of read through as well. Those who are needing to either tap loans in this near-term period of time or able to at least offset some of the concerns for their balance sheet by raising prices. How are they kind of going about that calculus?
Well, inflation is still one of the bigger problems for a lot of small business owners. That is still registering in our survey. But when we ask about, their assessment of the health of their business, about 2/3 of them say that their business is doing good or even excellent. So, the majority of small business owners evaluate themselves as their business looking pretty good in this current economy or in February. And as far as borrowing, we've seen a slowdown in regular borrowing among small business owners, but that could be because we have seen a real slowdown in capital expensing plans. So, investing in their business in uncertain conditions, isn't moving forward. More small business owners are scaling back on those plans, not borrowing. could be certainly because of those higher interest rates that they're experiencing. So cost of financing is expensive for many of them. And then just the level of uncertainty that they're anticipating or that they feel right now is leveling off some of those investment plans in their business.
How are small businesses, from what you can best gauge right now, thinking about and preparing for the reality of tariffs that has now been in a tit-for-tat form, especially with some of the new ones that have just come out and been announced today?
Yeah, so that is proving to be an area of uncertainty, of concern for small business owners in trying to figure out whether those tariffs will impact them, how it will impact them, either directly or indirectly. In our survey for the month of February, there was a lot of discussion, kind of planned developments of what the tariff landscape might look like. They were in the environment of the increase on Chinese imports, that 10% tariff that took effect in February. So the next couple months of our survey, we'll have a better idea of how those tariffs develop, how they're impacting small business owners and what sectors are being particularly hit by the impacts of tariffs as they develop.
Holly, thanks so much for taking the time here with us to break down some of the most recent findings. Appreciate it.
Thank you.
Let's get a check of the markets right now as we're taking a look across the major averages 2 hours into today's session. We have seen the NASDAQ dip back into negative territory. It has touched both negative and positive territory throughout today's session here. It's flat just barely to the downside right now. The Dow is still down by a little more than 1%, and the S&P 500, you're seeing that down fractionally by about 0.5%, 0.6%. However you want to round that off. Next up, inflation is becoming a major problem for retirees. We talk about that next on Wealth.
Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail.
2 hours into today's trading session, let's get you a check-in on the markets right now. And I wanted to hop over to the Wi-Fi Interactive just to give you a glimpse and put some of the action. Let's put some candlestick action on what's taking place here today. All right, and here's where we're going to point out a few of the major candlesticks that have taken place. You did have a little bit of this rebound green candlestick that happened just after 11 a.m. after we came on air here for Wealth. But here were the ones that I was keeping close tabs on earlier. This was taking place during Catalyst. This was as you saw President Trump and the announcements around the additional 50% aluminum and steel tariffs that were coming through and rattling through the markets here. And particularly, I was taking a look at some of the candlesticks across the major averages back at my desk, and some of those larger ones stuck out to me that had really started to push the markets towards their intraday session lows. But as you can see right now, we've moved off of some of those session lows right now, and this green candlestick had a lot to do with that just after the 11 a.m. marker. Let's take a look at the NASDAQ composite here. Similarly, just after the 11 a.m. marker, big candlestick to the upside. That's what got us back into positive territory, but ultimately we've seen a considerable amount of hyper waffling on the day as the NASDAQ composite, the tech-heavy average, tries to make up its mind here. We'll dig into tech in just a hot second as we take a look at the sector basis. Similarly here, same case for the S&P 500. Some big post-AM candlesticks to the downside there, but then additionally one big one after 11 a.m. that still has us in negative territory. We're down by about 0.4%. So we've got 2 out of the 3 major averages still in the red, but the NASDAQ trying to find its way as that's been hyper-waffling here on the day. I mentioned technology. I want to pop on over to some of the sector activity. We're done with our candlesticks, but we're going to take a look at some heat maps here for a hot second while we have a moment. And taking a look at the sector activity on the day, 11 S&P 500 sectors we've got loaded up here on the screen, and it seems like, and let's put this on intraday, it seems like as you're seeing a sea of red, there is just one barely by the hair of its chinny chin chin gainer on the day, but it depends upon when you check in on it. And technology flat, just barely to the upside here, and it's not even fully registering here. It still says essentially unchanged or flat, but trying to find its way there as we're seeing all of the major averages led lower right now by industrials. Industrials is down by about 1%. We'll just ride out with a quick look at the NASDAQ 100 here intraday. Apple, which we're going to dive into just a little bit deeper on later on in the show, that's moving lower, leading the Mag 7 lower by about 3% right now. More Americans than ever are expected to retire this year, and some of these pre-retirees are facing challenges. 67% of those planning for retirement say that they're confident about their prospects. That's actually down from 74% last year. So, what is behind this big drop? Joining me now, we've got our very own Carrie Hannon. Carrie, why are fewer people feeling confident about retirement?
Yeah, Brad. I mean, this is an interesting finding that it's from a recent Fidelity report. And it says that, these pre-retirees are really, it's sinking their confidence. And it shouldn't be surprising to our audience here. They're caught off guard by rising prices. And so this has gotten them really, especially healthcare costs, have them concerned about, are they able to continue to save for retirement because their day-to-day living costs have come up? Another thing in that survey that was also interesting is they looked at people who are currently retired. And these folks, 7 out of 10 are actually pretty confident. That said, their one big niggle is that they say that their medical expenses in retirement, are much higher than they expected. And 20% of them said they wish they had worked harder at paying down their debt from credit cards and mortgages, et cetera, before they were retired. And, Fidelity has a number that individuals should plan on having $165,000 post age 65 to pay for after out-of-pocket medical costs after Medicare. So that's a pretty big number. And I think